Stay profitable with Profit 360.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple.
If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Good morning and welcome. This is NDTV Profit. My name is Alex Matthew and you're watching All You Need to Know. It's been a turbulent start to trade on Monday morning and we're here to tell you all about that. But first, let's take you through the headlines. Japan leads Asia sell-off and the Nikkei plunges 7%. The Topix hits a circuit breaker briefly. Dow Jones falls 300 points at the end of last week. Global markets face turbulence as surging yen against dollar forces sell-off in US equities and spreads to other markets. The 17-year yen carry trade comes, or rather closes out, as Japan hikes interest rates and markets are caught slightly off guard. Indian markets likely to open lower. The global rough weather may trigger selling in the Nifty 50 and, in fact, key indices. Ambuja Cements to invest 1,600 crore rupees in Bihar to put up a 6 million ton plant. Dharavi redevelopment gets the backing of residents' welfare body, wants the survey to be increased in speed and in fact to meet government officials soon. Now, it's a rough start to the trading week, as I pointed out, for the Asia-Pacific region. That's on the back of sharp losses on Wall Street as well at the end of last week, and several factors playing out simultaneously. One is the closing out of the carry trade that you've seen for so many years in Japan, with the weak interest or the lower interest rates there and the yen being used to perform a carry trade. That is less attractive as things stand right now. And also, at the end of last week, you had the jobs data in the US that disappointed and pointed to a weaker than expected economy. Japan's markets led the losses in the region as the Nikkei 225 and the Topix dropped over 7% at one point. In fact, the Nikkei 225 is off the low point of the day, and so is the Topix. Topix, in fact, for a brief while had a circuit breaker triggered. The heavyweight trading houses such as Mitsubishi, Mitsui & Co. as well as Sumitomo plunged more than 10% at one point. The trigger, seemingly the latest one, of course, is the non-farm payrolls in the US, which grew by just 114,000 in July, which was below the downwardly revised 179,000 in June, and the Dow Jones estimate for 185,000. Now, the unemployment rate has also edged higher to 4.3%, which is the highest level since October of 2021. And bond yields across the board have fallen and fallen sharply. In the US, the yield on the 10-year Treasury has declined by over 40 basis points in the span of just a week. And this is as expectations of rate cuts by the Federal Reserve are reset very quickly. Now, bets are being placed on 3 rapid-fire rate cuts in the remainder of this year, and the rush of capital into bonds has resulted in a sharp selling in risk assets across the world. Let's talk about the implications and what's causing what we're seeing right now and whether our understanding is in fact correct. We've got Anurag Singh, who's managing partner at Ansett Capital, joining in. Anurag, the reading is, thanks so much first of all for taking the time this morning, but the reading is that the easing off or the loss of the carry trade that we've been witnessing in Japan and also the weaker economy than expected in the US are playing out in terms of the sell-off in risk assets and the move to treasuries. Is that what is indeed happening, and how are you reading the signs right now?
Alex, morning. Look, I think it is very hard to say for anybody to what extent what factor is playing. But I think let's lay out some of the important parameters. I think you spoke about some of the data that came out from US. I understand yen carry trade is a factor which for the last more than 10 years, I think this borrowing in yen and investing into US markets and even other emerging markets across the globe, that has been the practice. I understand with a 25 basis point hike in by Bank of Japan will impact this. How much, to what extent, we have seen on the margins it might do, but I don't think it's something that markets need to worry beyond a point. And I think the markets, especially in US, has already taken that correction. Emerging markets, each market behaves very differently. So I think we have to go market by market. But let's also look at, Alex, the other parameters. Now, look, US markets, with 5,600 on S&P and NASDAQ 18,000 plus, I think we have to keep in mind that about 6 stocks were carrying the entire weight of the growth in 2024. And, currently we are still for the year, we are about 12% up, both on NASDAQ and S&P, although NASDAQ has lost about 10%, fairly quickly. But when 6 stocks are carrying the entire weight of the market, then I think anything wrong or anything slightly disappointing on the results and from any of these 6 players, will jolt the markets. I think we saw this in Amazon with a very silly logic that, the Trump assassination and Olympics are impacting its customers buying less on the portal. I think that's as silly as it gets. NVIDIA results are fine, but I think market is worrying that, is the AI story really a case of overinvestment and less ROI? So I think there are individual cases where, and we saw Warren Buffett sold Apple, right? Apple has, as a company, has not been growing top line for the last 3 years broadly, right? So give and take, I think at some point the profit booking was imminent in at least these 6 stocks. And when that happens, the index really takes a beating because those were the ones responsible for a rise of index.
Yeah.
Third parameter, I think you mentioned about the unemployment and all those numbers. I think those numbers are true. But it's not that economy has been cooling down and we all expected that. But I think that's good news because that will prompt Fed to lower rates. And look, 10-year yields are already at 3.8%, just exactly what the markets wanted. So I think this is a turmoil. We should quickly get past this. And I think Federal Reserve should definitely now be more aggressive in cutting rates.
Yeah, in fact, that is the next question, right? In fact, we're talking about the 10-year Treasury at 3.73. It's down over 40 basis points, Anurag, in just about a week. And people have made a killing in the bond markets. Forget the equity markets. You're looking at a shift in capital. But the question is how much further and what are the bets that are currently being built in? Because if the 3 rate cuts that are currently being priced in by the street do not come to pass, what are the implications of that in the second half of this year?
So one is everything in the bond market in US is indexed to the 10-year Treasury yield. And I think market in a way has already done that job for Federal Reserve. It's at 3.8. So, Federal Reserve might take time to drop the rates this year. And I think they might do 3 rate cuts. 2 were anticipated earlier. They'll be more comfortable doing 3 now, unless something slows down even dramatically from here. But, the 10-year yield, if it stays below 4, I think that's pretty much what Federal Reserve wants, that the market should do the job and, help cooling off the markets. So that's where we stand. Look, I think, Alex, beyond a point, I don't believe so much in these probabilities of rate cuts, which change almost every week. I have maintained this stance that we can expect 2 rate cuts this year. Federal Reserve projection also is broadly in that direction. So I think we should broadly, kind of assume that by end of 2025, which is next year, Federal Reserve should be at around 4.1%, which is their projection, which will be good news. But having said this, they're not going back to zero. So that's something which everybody should kind of keep in mind, that is not pre-2008, post 2008 time. So they'll kind of stay at 3.5.
Yeah, all other factors remaining equal. No one could have foreseen COVID-19, and there are a lot of things that we can't foresee right now. Anurag, thank you so much for taking the time for speaking to us this morning.
Appreciate it, Alex. Thank you.
All right, let's turn to the Indian equity markets, and how low can you go is a question based on what we're seeing across the globe. And Agam is here to break down the latest cues on the F&O front. Agam, the cues aren't the best, to say the very least, and that might be an understatement. What are the kind of reaction that we could see here?
So, Alex, well, based on the kind of opening that we've seen across Asia, maybe it will be a little bit more relevant as to what's happened last Friday. That said, we should definitely keep in mind as to how things have fared. So, we did see a little bit of a step back for the benchmarks. The Nifty has come off, and it was now at around 24,700. So, 300 points away from that 25,000 milestone that it did make about a few sessions ago. Again, in terms of the bank Nifty, that's also come off by quite a bit, well away from 50,000 at the moment. And so, in fact, we saw some shots coming into the bank Nifty. Well, as we moved into the options market, after we hit 25,000 and came off, we started seeing a little bit more writing returning to the 25,000 call. And in fact, we've now started to see a lot more accumulation in calls around 24,800, 24,900 as well. So I reckon that a lot of these traders will certainly be sitting on profit. And as you can see, there's very little open interest distribution when it comes to the put side of things, which also means that traders were perhaps just a tad bit wary of making new positions and taking new bullish positions, at least as far as option markets are concerned. Now, let's move on and talk about stocks, because we did see quite a bit of weakness on Friday. We saw shorts in Cummins, Tata Steel, Nalco. I reckon that some of these companies will continue to be under pressure today as well. Even among stocks which are unwinding, there was a lot more weakness, with long unwinding in Birlasoft, IndiaMart, Intermesh, GNFC and Hero MotoCorp. A lot of tech companies will continue to be in focus, and of course all companies who raise their debt in yen. It's something that we will be watching out for. But for now, expecting a weak opening, Alex.
All right, thanks so much, Agam, for getting us those details. And let's focus in on earnings as well, because that's something to take account of. State Bank of India reported its numbers over the weekend, and its PAT number was more or less in line with expectations, came in at just over 17,000 crore rupees. There is, of course, a contraction in the domestic net interest margin to talk about. And to tell you how this panned out, Harsh Saita is joining in. Harsh, what are the key highlights according to you? Morning.
Good morning, Alex. You're looking at around 11 basis point decline in the margins, which is impressive for the size that SBI is. And the way in which the bank has moved with regard to balancing both the deposit as well as the loan rates. Of course, deposit growth pressure continues on most of the banking system. SBI is no different on that front. We've seen deposit contraction on a sequential basis for SBI, and that continues to be a concern. Management spoke about it as well, but they believe they are very, very comfortable with both the liquidity. They have plenty of money parked in SLR, which is around 3.7 lakh crore, and they believe that that will hopefully aid the balance sheet going forward, even from a lending perspective. Let's talk about the operational numbers. We've spoken about a little bit about growth and deposits and margins. Talking about operationally, it was a very strong quarter for SBI. OPEX has largely aided the profit after tax numbers. Provisioning was slightly more elevated, and slippages, we've seen some bit of recovery as well. Let's go straight across, listening to what the chairman of SBI had to say with regard to that slippage recovery, which was quite sharp versus the slippage provision which happened in Q1 FY25.
The point is that this one quarter first quarter is always a bit different quarter. And in this particular case also it's likewise. And this 1% kind of a growth is seen in the context of the elevated cost of resources. As I mentioned that it has gone up by about 45 basis points. So if at all we would have been in a position to maintain the cost of resources at where we were, then perhaps the profit would have looked even better. So that is something which has to be kept in mind. But having said that, I must also mention that even our yield on advances have also improved. And even for that matter, even our yield on investment has also improved. Even yield on investment has improved by almost about 20 basis points in one quarter. And also when it comes to our yield on advances, even that has also witnessed a decent number. Today our yield on advances is somewhere around 8.86. Yield on investment is at about 7.20. What has happened is that since our loan book is growing, and with that we have to go for the aging provision. That is something which has happened. These are all standard assets, so where the aging provision is one major factor which is seen. Apart from that.
All right, that was the management of State Bank of India. And in fact, it's time for a very quick break. But before we go, let's listen into what Pranav Adani had to say about the group's investment announcement in Bihar. He spoke to NDTV on the sidelines of the foundation ceremony of a cement grinding plant in Bihar, where the company recently announced a 1,600 crore investment plan. Stay tuned.
We are always there. We are there today in 24 states out of 28 states. So we are happy to invest wherever there is an opportunity. And Bihar is a very integral part of India, so why not? In fact, it's too late. I would say to all my industry friends that they should come and have a look over here.
So there are many projects as far as Bihar is concerned for the Adani Group in pipeline?
No, like I said, so all the sectors that we are available, that we are working in, we are happy to look at those sectors. And like I said in the Investor Summit in December 2023, we are in line with what we had promised.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple.
If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Welcome back. You're watching All You Need to Know. Let's stick with earnings there and talk about Titan, which came out with its first quarter earnings on Friday. Demand uptick in jewelry segment or rather resulted in an improvement for the company, and we've seen this after the duty cut. But of course, this is something that panned out after the Q1. Let's see what the Q1 results are all about. And let's bring Mahima in to give us some perspective. Mahima, what's the latest?
Right, Alex. So, in terms of the numbers for Q1 FY25, revenue and EBITDA was largely in line. However, the margins and net profit saw misses in terms of estimates. In terms of key highlights, where revenue declined due to high gold prices, less wedding days and heat waves, and jewelry EBIT margin, however, improved by 20 basis points, and this is on account of cost optimization despite the hike in gold prices during Q1. Now, studded mix was flat YOY. Indian business grew around 8%. Carat lane growth was 18%, and watch and wearable segment grew around 15% for the company. However, wearable revenue segment fell by 6% despite of the double-digit volume growth. Now, in terms of key con call takeaways, where demand has witnessed a big uptick post the rate cut, import duty cut on gold, and old exchange contribution was around 35%, which is down around 200 basis points. Wedding contribution was around 20%, which is down again 100 basis points. And new buyer contribution was around 45%. However, this was also down around 100 basis points. They've also said that inventory loss on account of custom duty reduction is maximum 5 to 5.5 billion. And then they've said that they'll be doing higher marketing spends due to the competition intensity, and they've also said that debt related to Carat lane will be paid in the next 2 years. So this is the overall view of how Titan has come out with its number on Friday.
Thanks so much, Mahima, for getting us those details. Let's shift focus to the pharma space, and Divi's Laboratories came out with its Q1 numbers as well, where the PAT number is up as much as 20%, but it still missed estimates. To tell you why, we've joined by Varsha. Varsha, what are the key reasons for that miss? Morning.
Good morning, Alex. So yes, in terms of numbers, if you see, revenue was up 20%, which was pretty much in line. EBITDA was up 23%, while followed by net profit, which was up 20%, which did missed estimates by a little margin. Let's see. So if you see the revenue growth, so revenue growth was on back of strong performance in custom synthesis segment, which grew 45% year on year. The generic segment improved moderately, that is 4.8% year on year. Now this is due to volume growth complementing negative pricing pressure. Gross margin contraction was led by change in product mix, and this also led to decline in EBITDA margin quarter on quarter as high margin custom synthesis. So custom synthesis mainly you customize product for your customers. So the high margin custom synthesis business contributed 49% during Q1 FY25 versus 51% in Q4 FY24, indicating year on year improvement but quarter on quarter decline in EBITDA margins. If you see, custom synthesis grew double digit this year, driven by a few of their products, and generic business grew 4%. Also the nutraceutical business was flat year on year. Now we do have con call highlights wherein companies seeing stable demand for most of established generic products, and also they are expecting production to begin at Kakinada facility in FY25. Management guides that historical EBITDA margin of 35% in earlier quarters is not sustainable given aspiring product mix of 50-50% in generics and custom synthesis. Company is experiencing pricing pressure across its large volume products, but is still able to maintain market share in such major molecules. And lastly, if you see, management is expecting this pricing pressure to taper off in near future.
Right, thanks so much for getting us those details, Varsha. Let's talk about a few stocks to watch in trade today, and Anushi is joining in with the details on delivery as well as Adani Energy and more. Anushi, morning, what are you picking up?
Hey, morning, Alex. So I'll start off with the earnings list first. The first one on the list is delivery. Now the company, if you look at the financial metrics, are beat on all parameters. Revenue about 5% growth. This is on a QOQ basis that I'm going to be talking about. EBITDA has seen about a 112% jump, but the EBITDA margins have moved from 2.2% to 4.5%. Net profit also turned at 54 crore as compared to a loss of 68 crore in the last quarter. In other key highlights, also the company's largest segment, express parcel shipments, grew by 4% on a sequential basis, while the express parcel revenue was up by about 5%. But coming to other stocks in focus, Ambuja Cements is the first one, wherein they're going to invest about 1,600 crore for setting up a 6 million tons per annum cement grinding facility unit in Bihar. Now this is one of the first and largest, if you have to look at the cement players in the industry. This is going to be a three-phase investment, with the first phase going to be expected to be commissioned by December 25. Again, the project is to contribute about 250 crore per year to the state's revenue going forward. Now, if you move on to Ashoka Buildcon, large order win here, 1,280 crore of orders for two projects from Mumbai Metropolitan Region Development, and these are two EPC orders, with one with a 42-month of timeline, which comprises of a 290 crore order, and the remaining 991 crore order is with a 3 years timeline. So this remains on a watch out for. And the last stock on the list is Adani Energy Solutions, wherein the board has approved allotment of up to 8.58 crore of equity shares. And if you look at the QIP price at the same, that is at 976 per share. So this QIP price that we are looking at is 4.98% of a discount compared to its floor price. And again, the issue opened on July 30 and closed on 2nd August. And of this issue, SBI and Citigroup were the biggest investors in Adani Energy's $1 billion QIP that we are looking at. So these are the 4 stocks in focus today.
Right. Thanks so much, Anushri, for giving us those details. More stocks in focus on account of earnings, and the likes of JK Tyre as well as Amara Raja. To talk about, Puneet is joining in with those details. Puneet, what are you picking up? Morning.
Hi, good morning, Alex. So, very strong set of earnings from Amara Raja as well as JK Tyre, which came over the weekend. Let's start with Amara Raja. The revenue growth was almost roughly 17% in this particular quarter, with margins gaining at roughly around 19%, with EBITDA margins finally coming in at 13.4%. This has led to a strong net profit beat also of 26%. This is above the Bloomberg estimates for this particular quarter. Now, in this particular quarter, they also entered into a strategic agreement with Ather Energy. Now, they have said that they will be collaborating with the company for development and supply of lithium-ion battery cells for two-wheeler packs going forward. More details are awaited about this particular transaction and collaboration, but very positive for the company. The second one is JK Tyres. While revenue degrew by roughly 2%, EBITDA as well as profitability had a strong beat. So EBITDA was up roughly around 10%, margins coming in at 13.7%, and profitability positively impacted up 37% compared to the same time last year. And finally, on Britannia, revenue rose roughly 6%, while EBITDA as well as profitability was up roughly in the high single digits to low double digits.
All right. Thanks so much, Puneet, for getting us those details. That brings us to the end of this edition of All You Need to Know. Lots to talk about before the start of trade, particularly the setup in India on account of the global handover. Do stay tuned. India Market Open is up next, and this is NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple.
If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason.
A very good morning. You're watching India Market Open, and it's one of those mornings where you really need to brace yourself. Buckle your seatbelt because you're going to hit turbulent skies ahead.
Yeah.
It's been a whole host of reasons and a tsunami of data factors which has led to a sea of red across global markets. Actually, no chance India would be an outlier. So tough morning ahead.
Yeah, tough morning ahead. You could argue we might have a bout of outperformance because we have flows on our side, at least the domestic ones. But today we'll follow the world. And, just a glance at the past instances of the kind of damage that the unraveling of the yen carry trade does on financial markets gives you a sense that we're not even started. Now, who knows the extent of this damage? What if BOJ comes in and does some conversations? A lot of people are on the ground saying that may happen too. And if that happens, then sure. But until then, this looks a very precarious situation if you were long, and God forbid if you were leveraged long.
Yeah. All right. So let's, in simple terms, tell you what's been happening all across the world and why you're seeing markets from the US to Europe to Asian markets deep in red today. So let's set that up for you. First off, what happened in US markets on Friday close, and not a pretty sight at all. Very, very tough day. The pain has deepened and continued on Wall Street. The Dow was over 600 points in Friday trade. Even the Dow futures are still reeling, and we'll pull up those live rates for you if possible, just to give you a sense of how Dow futures are doing even now and how US markets had closed on Friday. So very, very painful kind of a scenario. Look at the Nasdaq, that 2.5% down. Now, what's happening? Recession fears have essentially worsened in the US because of very poor and worrying data from jobs perspective for July, and I'll break that down for you. Overall, why you're seeing global markets in pain, I would say 3 or 4 key reasons. Some of them Neeraj alluded to. Number one, poor US economic data compounded by weak jobs data. Second is the fear that the Fed may have kept interest rates high for too long. Yes, there's talk of a cut in September, but remember, it was all about that soft landing, managing to cut interest rates or keep them high enough, control inflation, but not hurt the economy. Has the Fed failed in doing that, and has the economy been hurt because of high interest rates? That's really the fear in very simple terms. Corporate results, especially for mega caps, are below expectations in a lot of cases. Look at an Intel, look at an Amazon. All of those stocks have really, really seen pain in trade at the end of last week. Impact of rate hikes in Japan, and that's the yen carry trade factor that Neeraj has been talking about, and we'll get you more details and a very clear explainer on what that is. But the rate hikes in Japan by the Bank of Japan last Wednesday has hit the entire world market. Now let me come to the data bit that I was talking about. July non-farm payroll data, those numbers, those jobs grew by 114,000. So 1,14,000. Compare them to June from 1.79 lakhs and compare them to what was expected, which was 1,85,000. So definitely the fact that jobs are up much below expectations is one point of pain. Look at the unemployment rate. Unemployment rate has increased to 4.3% for the month of July. That's the highest since October 2021. So jobs are hurting. Now, US indices, of course, have been hurt the most, and they're down from their record highs. When we put this together, Nasdaq is down 10% from its record highs, S&P down 5.7%, the Dow down 3.9%. Bond yields, of course, have plummeted on these recession fears. The 10-year at 3.79. Now, this is the lowest level since December 2023. Now, in better times, think of it this way, low yields would have been great news, poor economic data would have been great news because now Fed has to cut rates. But has it been too long is the question. Crude prices, just very quickly, they've recovered mildly after a very sharp fall, but this is the lowest levels in a very, very long time for the Brent, below the $77 mark. And of course, a very painful morning for Asia. I'm just going to pull up the Asian rates before we go to Steve Englander for a very quick chat. Asia reeling. Nikkei, the worst hit among that. Nikkei and the Topix, that's their broader index, are down 20% off their highs. I mean, this is a painful sea of red.
Yeah, there's a painful sea of red for sure. And just before we get to Steve Englander, I think we'll get in Vishwanath in this scene as well. But, you know, amongst other things, viewers, just to explain this, and we'll do a currency phono later on, but is unwinding yen carry trade or the yen carry trade a key trigger? Effectively, BOJ's decision to hike their interest rates or raise interest rates took yen to high levels. In fact, the strongest level against the US dollar since March, and therefore it triggers the unwinding of the yen carry trade. Vishy, a quick 60 seconds. Let's just talk about this before we get to Steve, because arguably the trigger point amidst all the other data points seems to be this.
Yeah, I mean, this is the only large economy that's talking about a rate hike at a time when you've got the Bank of England cutting rates and Fed hinting at a rate cut in the coming month. Interestingly, what has happened with Japan is ending of a very long period of easing and very easy sort of monetary policy, and now finally, Bank of Japan governors talking about of tightening that entire monetary policy, raising interest rates and also ending that quantitative easing and enter quantitative tightening. We saw this when the US did this as well. The impact, I'm just talking about the impact on India. There was a direct impact on Indian stock markets, on Indian companies borrowing foreign money. And you're likely to see some of that flow in as soon as the yen comes in, because there's no chance that after such a long period of easy monetary policy, easy money flowing through Japan, as the Bank of Japan pulls back, that there is no impact on the rest of the world.
Yeah.
You can pretty much see that even in the Indian markets, as Tamanna was talking about the Asian markets.
Please finish your point.
No, my point is, Neeraj, I think we should simplify. We've said yen carry trade several times since the start of this morning.
Which is what I want to do right now.
Yeah, we need to come down to exactly what is yen carry trade.
Yeah, so viewers, just before we get to Steve, effectively, Japan, lower interest rates, stable currency for so many years, becomes a choice of borrowing for global investors. Borrow in Japanese yen, convert it into a currency of your choice where you want to invest, and then make the differential of the higher interest rates. Now, when Bank of Japan raises those rates and the currency rises as well, some portion of that comes into question mark. Not the entire portion, but because the quantum of borrowing from Japan is so high that the little portion that comes into play as well can cause a lot of ruffles, and you are starting to see the signs of that happening out. And that effectively causes ripples in asset classes across the world, including equity markets, which is why seeing this happening in Japan and happening in the rest of the world markets as well.
That is correct. That is correct, Neeraj. So what we are seeing is the sort of end or unwinding of that carry trade, that yen carry trade that has been in play for so long. And now finally, when Japan's pulling back on that free liquidity, investors are forced to unwind their trades, and then that pulls out money from a lot of asset classes, as you were talking about.
Yeah, so essentially you borrow at negligible costs, because that's what Japan's trade was, and then you invest in markets which have higher interest rates. That arbitrage has squeezed in. People have had to unwind their positions, and that's why you've seen that sell-off in US equities. Is that going to continue is the question. Steve Englander with us. He's the global head of G10 FX research at Standard Chartered Bank. Steve, very good morning to you. Thank you for joining us today as we're trying to just work out what's happening the world over. And let's talk about how persistent this pain point is going to be with what we've seen after the Bank of Japan's decision.
I would actually put a little bit less emphasis on the Bank of Japan than you're doing. I think on the bond market, everybody was putting on Trump trades, which were basically higher yield. Then we had the economy slowing. We had geopolitical concerns, all taking down interest rates. And Friday, I think the market became convinced, and that's not our baseline, but the market thought that with the unemployment rate going up to 4.2%, what we're going to see, 4.3% actually, that the US is going into recession. And then they said, well, look, the Fed's going to cut a lot more than we thought if they're going into recession. So, there's a Bank of Japan story, and I think it's correct in the sense that the market was short yen and long some higher yielding currencies, and probably short CNH and long some higher yielding currencies. But I think had the unemployment rate stayed flat at 4, we would not be having this conversation right now. I think the biggest fear is the recession fear that's become very prominent.
Right, Steve. This is Vishwanath here. I just wanted to get a sense of what the current scenario, especially for markets like India, how does that compare to say previous cycles where you had advanced economies sort of pulling back on their balance sheet?
Well, I think at the moment, the market wasn't particularly long Indian assets, so they weren't particularly long the rupee. So, if things settle down, it's possible that India will be a little bit less exposed than normally. Quite often you go, into sell-off with every market at its peak and with a lot of froth. And that, maybe was the case for some of the US equity markets. I don't think it was the case for the rest of the world. So, but, it's going to be painful, but I don't think we're in a 2008 situation or say a 2020 situation. And, let me say this as well, that it's scary when the unemployment rate goes up by that much, and there's some rules that suggest that we're going to be in a recession. We still don't think that the bulk of US economic data are consistent with the recession. It could be that in the next week we'll get terrible data and it will scream recession, but right now I'd say the data are mixed, and I'd be very cautious about declaring, with certainty that a recession is coming.
To your mind, what is the likelihood of a U.S. recession at this stage?
I think the likelihood of a slowdown is very high. You're talking 70, 80%. Whether you're talking about a recession with the economy, negative GDP, I'd still say it's less than 50%, maybe even less than 40%.
Okay, Steve, it's interesting you mentioned that to your mind, it was not, BOJ probably one of the reasons, but not the major reason. But past instances of a yen carry trade unwind, whenever it has happened, has had a very profound impact on the near-term moves of risk assets. There is a thought that could happen and it could take the markets much lower. You don't agree?
I don't think that Japan is that important. We are seeing spillover effects, right? Insofar as there were positions in the market, they were short yen, long Mexico, long Australia, long US, long higher yielders. And, removing those positions is painful and it may have some knock-on effects. I just don't think it's that dramatic. I think the bigger issue is that the market is looking at the configuration of asset prices and saying, if we're going into recession, equity markets are mispriced and bond markets are mispriced, and everybody's scrambling to get to the right recession price. Like I said, it's not our view, but I think this is where the market is right now.
Steve, may I ask you, the last 4 years, at the first word of any kind of a Fed move, the markets have reacted. Weak data and therefore a fear of a recession will get the Fed acting promptly. 3 or 4 large global houses have said that they now believe the rate cuts could be anywhere between 50 to 100 basis points in the current calendar itself. Wouldn't that actually save risk assets?
Ultimately, yes. It's a battle here. It's a battle between, say, the recessionary forces that come from the lagged effects of the US raising rates, and then, Japan to some degree as well, but, versus how fast the Fed can cut rates, how far they'll cut rates, and how quickly the economy will respond. I think that given that the Fed has been moving very gradually, and unlike 2008 and 2020, there's no bolt of lightning that's to hit the economy and really crash it. I think there's a chance that we still could get soft-ish sort of landing. Like I said, we're going to have a significant slowdown. I think there's still a good chance we can avoid a recession. The issue is this, that the inflation rate's coming down. Core inflation's 2.6. Some of the other leading inflation indicators are suggesting we'll get closer to target. If we're getting to a recession, the market is asking itself, where will US interest rates go? And like a week ago, they thought the bottom of Fed funds was going to be, 360 or something. Now they're saying, wait a second, that's still 100 basis points, 150 basis points of real interest rates. If we're in a real recession, we're going to go a lot further. And that's kind of, what the market is debating. I think at a certain point, the market will respond, but I think that they first have to gauge how severe the equity market downturn is and how quick the Fed is going to respond.
Steve, you said earlier that the data you're seeing is pointing towards a recession. Now, just let's go back to Friday's jobs data, the non-farm payroll data and the unemployment rate, etc. It's also a function of an expansion in the number of people looking for jobs, right? Do you think that it's a little premature to say that we're heading to a recession because the mood was entirely different a week ago? I'm wondering if this will be as transient if you see next week's data looking okay.
Well, what I meant to say is that we're heading towards a slowdown with high probability, but much lower probability that we're heading towards a recession. Like I said, I think it's less than 50% chance that we get 2 negative quarters of GDP. Yeah, I think there are data that are still relatively robust. Some of the spending data is relatively strong. We'll have to see. I think that the unemployment rate is an important and stable indicator, but I think both the Fed and the market will be looking for confirmation from other indicators that the sort of worries, the red flag that the unemployment rate was sending on Friday, they want to see confirmation in other indicators that the economy is as soft. And again, as I said, I think it might not be as terrible. It will be soft, but we still could avoid a recession here.
So you may have a recession, you may not have. I mean, I just want to, hark back to recession fears, which happened, I think, about 12 months ago. Then it seemed like the US economy had bucked that trend. So it's one of those things, perhaps, again. Thank you so much, Steve Englander, for coming in and putting things into perspective. So the yen, a strong yen is spooking world markets right now. Will it continue to do so? At least Steve Englander doesn't think so. Let's just take you through what Friday looked like and the fund flows on Friday. Listen, Friday markets for India were rough. It was a rough kind of a closing, rough through the day, and expect another tough day today. I'm just going to pull up the implied open for a second to tell you how we look like we're going to open. All of Asia is down in the red. A lot of pain there. Fund flows on Friday showed FIs selling 3,310 crores, DIs 2,966 in buys, but the implied open, if you can just get that up, please. And where exactly we're heading, it's going to be a tough morning. 350 points nearly down. As of this point, we'll see how that pans out. And think about it. If you're talking about slowdown fears in the US, Neeraj, IT stocks are going to be in pain. Metals are going to be in pain. We saw that in Friday as well. Global demand is looking tough. Manufacturing, maybe domestic banks might buck the trend. I'm not sure, but everything will look very, very tough. Any export-oriented businesses.
Yeah, but I mean, just that. I'm hoping that at some point of time the Fed action helps the global markets and our markets as well. But frankly, I mean,
Are they going to come in before September and say anything? Unlikely.
Yeah, unlikely. And which is why I think the intermediate period of pain, I mean, all sectors will come off, frankly. Some may come on less than others. But today, although I must say, 1.5% is a lot more well-behaved than a lot of global markets are, which is probably a bit of a respite. But let's see how the day unravels.
Yeah. All right. So specific stocks. Let's talk about specific stocks, and just a lot of news over the weekend. Actually, so much to cover this morning.
Yeah.
But so many results which have come in. I'm going to start with SBI. SBI, of course, the big one, and I would say a bit of a mixed bag here. We'll get Bernstein's view in just a few minutes from now. In fact, Vishy is here, so I might just draw him into what he thinks about SBI right away. But all said and done, you had a year-on-year decent number, quarter-on-quarter a bit of a squeeze for SBI. Provisions were up significantly, 114% in fact Q on Q, but lower operating expenses has helped the bank's numbers look better. Remember, all of their wage hike pain is behind them and didn't really reflect in this quarter. The net interest income was a slight miss, and that's not too great. Margins have also contracted but remain in that 3.2 to 3.3% band. Cost to income has declined. The other problems that SBI is facing is essentially across the industry. Your cost of credit is up, your rate of deposit growth is slow. Those pains, I think, Vishy, if you want to come in on this, that everyone in this space is facing. So all things considered, largest bank in India, would you say not half bad?
Actually closer to good, I would say, because just compare the balance sheet size, right? I mean, SBI is so massively larger than the rest of the market. Second that comes on the list, HDFC Bank, it's nearly like 20-30% higher than HDFC Bank. So them doing reasonably okay or even a flattish result would be considered a positive, and sort of a good way to have a farewell for Dinesh Khara, because this was his last quarter of result announcements. He's going to leave at the end of the month.
Only someone who tracks banking so closely would link the quarterly numbers to the current boss going.
When the last boss left, things were not that good. He left in the middle of COVID, so good thing for Dinesh Khara. A lot of work has happened over
He's done a
over the
decent job with the bank.
Not just him. I would say the two chairmen before him, Arundhati Bhattacharya as well as Rajesh Kumar, both have a huge hand to play in cleaning up the balance sheet after the stress, and then coming back strongly. And now finally you're seeing the largest bank in India not being perturbed by any major industry movements, and is holding forth. That's something important, and that needs to be looked at.
Okay, so we'll get an SBI more detailed view in a bit, but just Titan's another one. Just 2-3 big ones that I'm going to talk about. Their numbers, actually, all things considered, again, not bad. Remember, it was a weak quarter for Titan. High gold prices for everyone in that space. High gold prices, heat waves, not so many wedding dates, elections, etc. But having said that, their revenues are up 11.5%. EBITDA is up 11%. Margins have slightly been squeezed, I would say flat and just mildly negative. Net profit is down 5%. Revenue has declined because of the factors I mentioned: high gold prices, less wedding days, and heat waves. Their jewelry EBITDA margin has improved due to cost optimization. That's good. Their India business has grown 8%. CaratLane has consistently been a good acquisition for this company. Their growth was 18% year on year. Watch and wearables also grew 15%. Let me just tell you what brokerages are saying. Nuvama, I'll pull up for you. They're upgrading Titan to a buy with a target price of 3,955. That's about a 15% upside. They think the next levels of growth would come from the scale up of the international segment, Mia and CaratLane. So that's a decent set of numbers. Just quickly talk about delivery, because all of Friday, all your platform companies were in focus because of Zomato's blockbuster numbers. Delivery has not been, that great actually, comparatively. I would say so, mixed kind of a bag. Revenues up 5%. EBITDA is robust though, 112% up. EBITDA margins are at 4.5% and way above the Bloomberg estimates, and net profit at 54 crores. Versus a loss of 68 crores. So these three, and of course many more that you'll have to watch out for today.
Yeah, because we've got Bernstein already and Pranav is here, just keep in mind, a lot of these stocks will correct. RKN, Sheela Foam, or a nuclear software, just a very wobbly set of numbers, and therefore all of those could correct. But let's get in. Pranav Gundapalle, senior research analyst at Bernstein, into the conversation, as Tamanna was saying, because SBI numbers are out. A lot of other banking results are out too. Pranav, great having you. Thanks for joining in. Your initial thoughts on Bernstein? Vishy was saying that it's not that it's not half bad. It's actually closer to good related to what some of the other banks have done.
Yeah, I think it was this quarter's numbers per se were decent. I think the ROA staying about 1% was a relief. But I think if you look at the underlying trends, then I think one does become a bit more cautious about the ROA trends ahead. Because if you look at the deposit growth, 8% was probably the lowest amongst the larger banks. The NIM fall of 8 bips, again, higher despite the weaker deposit growth. So some of these trends tell you that 1% ROA would be tough to maintain in the quarters ahead. So yes, a decent quarter, but the trajectory ahead doesn't look too great.
Right, Pranav, a quick question from you, Vishwanath. In terms of the deposit growth, now you said 8% odd is lower than before, but considering the current market scenario, considering the way liabilities are sort of reacting across the banking space, 8% doesn't look that bad.
See, I think the one to watch out is a 15% loan growth versus the 8% deposit growth. So this quarter, yes, they could pull it off because they dipped into the investments. They did use some of the excess SLR. But the LCR now for a lot of the public sector banks is almost in line with the private sector banks. So SBI is 129, 128, 129 is not too far away from an HDFC or ICICI is 120% plus. So which means that going forward, we will see a convergence of loan and deposit growth for these banks. And if the deposit growth doesn't improve by a lot, that the loan growth differential will start to look quite jarring.
Right.
So that's the real concern.
Right. SBI specifically has been a long-term sort of victim of this first quarter turn in asset quality, especially on the agri portfolio, because they have a sizable portfolio on the agri side. This quarter, that didn't seem to pop out too much. Things look fairly stable on SBI's balance sheet.
Yes, so that was the other good part this quarter where, when you had some amount of asset quality issues, even for the private sector banks, select private sector banks, none of that seemed to show. And especially the express credit, which the bank did clarify, continues to remain a higher ticket size product with average tickets of about 7 lakhs or so, did seem to be immune to the sort of stress we saw in the case of Bajaj Finance or in the case of SBI cards, etc. So I think that was a bit of a relief. And I think the seasonality was mixed across banks. Some banks quoted the election heat wave, others had the agri issues to quote, but that was thankfully a lot lower in the case of SBI.
I just found that interesting how you said that different banks had different reasons to quote for seasonality, and I just found that an interesting take. In SBI's case, you also say that keeping ROA at 1% will be difficult for them or might not sustain. Can you elaborate on that?
Right. So if you look at the various levers that were pulled, you had a higher LDR, you had weaker deposit growth that does improve the margins. Plus you had OPEX, which literally was flat year on year. So some of these are difficult to extrapolate into future quarters. So once you start normalizing these factors, then that 1% ROA does seem to be a bit of a challenge, especially with credit costs still being lower than some of their private sector peers. If that even reaches what you have seen for some of their private sector peers, then yes, that 1% does look a bit challenging.
Pranav, quick question around the broader, sort of banking space. This quarter, some disappointments. You saw your deposit growth sort of shrink more or less across banks, even on a sequential basis, if you were to look at it. Asset quality situation not looking too bad, but also not exactly great numbers. To your mind, what is the one takeaway that you would take from the banking space results Q1?
So I would say we're just seeing an accelerated normalization. So that's what I would say. So I'm not seeing any big reasons for concern. And deposits is not a concern for us because if you go back to 2010 to 17, almost about 65% of an annual deposit accretion happened in the last quarter. So we are probably going back to that level of seasonality. So 1Q being bad sequentially shouldn't be a big concern. Year-on-year growth number is still the highest in a decade at 13%. So a bit of a dip here and there should not really matter for us.
So, Tamanna, you want to take a question with Pranav?
Yeah, just a couple of things, Pranav. One, the call today for SBI, all things considered. I wanted to start with that and then a view on what you've said on SBI cards. But let's start with the SBI, call for the day.
SBI, we think it's a hold. We don't see room for re-rating. So yes, that a decent ROE should mean that compounding continues for a while, but no room for re-rating. So we'll just keep a hold on that. On SBI cards, we have a sell. We think the asset quality troubles would last a lot longer. Clearly, there is trouble in the smaller ticket size segments, and we have a sell on SBI cards. So we see a lot of asset quality issues even for a few more quarters.
I still remember the line that you mentioned in your report on SBI cards, which says sell as soon as you can. Just a last word, most broader credit card lenders don't seem to have been showing the trend that SBI card specifically showing. Anything that's sort of different there?
I think it's just the ticket size and the smaller ticket, let's just call it mass market segment, which has seen the biggest activity from fintechs and all the new lenders who jumped in, seems to be the one that is seeing the asset quality stress. Lenders exposed more to those segments are the ones who are seeing trouble. So it does seem to be localized to that segment, but it is broad based within that segment. So it's not one particular lender. Everybody's going to be affected who are in that segment.
Pranav, sorry, I'll make this the last question. Excuse me for that. I know we were decided, this is Neeraj here, and we were thinking of talking about only SBI, but I want to check with you. The global markets are in a bit of a tizzy. Do you reckon that Indian banks, by virtue of the fact that the private bankers are not quite trading at the valuations that they erstwhile used to, could withstand the kind of pressure that comes in on world markets by and large? Or do you reckon, I'm just trying to understand, are valuations attractive enough for you to advise your clients to go in to buy Indian banks if they were to correct another 5-10%, or that is not necessarily the case?
We would advise to go into the banks, provided the horizon is a bit longer. The banks are cheap, but this whole ROA normalization will play out over the next few quarters, which means there aren't going to be any nice upside catalyst driving a re-rating. So it's going to be like, yes, valuations are cheap, so which means downside is going to be limited, but you'll have to wait for the entire re-rating to play out.
Okay. Pranav, so good talking to you today. Thanks for taking the time out. Thanks for accommodating the time change request as well. Really appreciate it.
Thank you.
All right, that's the view from Bernstein on a bunch of results. Vishy, thanks for joining in for this whole conversation as well. And let's take a break on the note. By the way, the implied open should come up on your screen. It's not looking all that pretty. Remember though, the Indian markets may be a bit more well behaved than the rest of the Asian markets, which is a sea of red with anywhere between 2.5%, 3%.
It's all relative.
This is
also going to be a sea of red.
Yeah.
But just two lines from and we'll put that out for you, what Chris Wood is saying in his Greed and Fear, and there's a lot of detail. But look at what he says. 2 lines on what he says on the Indian markets is where he says the Indian stock market is much more resilient in the face of a US downturn because India's stock market has been driven by domestic money, whereas the opposite is in Japan. So all you people who've been keeping up your SIPs, retail investors, this is the time that the Indian markets are going to bank on you. Very quick break. We're coming back with the FNO setup with Agam Vakil. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple.
If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable.
Welcome back. This is India Market Open. We are taking a look at how the futures and options space has come through and what sort of movement we can expect moving into trade today, which certainly will have a very weak opening. We'll start off by taking a look at how things are faring as far as the Nifty futures are concerned. And we did see that index take a step back, in fact, edging back towards the mark of 24,700, 300 points away from 25,000, and not too much change in terms of the August futures. Coming down the Bank Nifty, on the other hand, we did see a weakness of around 0.4% there and a 6% added towards what looks like shorts at the moment. Now, as we move in, also taking a look at the options market, perhaps on expected lines, we saw the return in writing as far as the 25,000 call is concerned. And this is especially after the Nifty hit that mark and then came off to quite a bit. And now we're also starting to see a little bit more writing around 24,800, 24,900 calls as well. On the lower end, as you will notice, we don't have too much accumulation as far as puts are concerned, and perhaps also expected because traders at this point in time will be just a tad bit circumspect about placing those long positions coming through. In terms of stocks, there were plenty more which lost out as compared to those which advanced. And we did see shorts in Cummins, Tata Steel, Nalco. InfoEdge and Chambal Fertilizers, on the other hand, did see some longs come through. Even in terms of stocks which are unwinding, a lot more in terms of long unwinding, Birlasoft, India Mart, GNFC and Hero MotoCorp under pressure. All in all, it wasn't a day where market breadth was very encouraging, and I'd reckon that this morning is going to be another very, very challenging one for those here long in the markets. Well, with that, it's back to you all.
Challenging indeed. Agam, thanks for... Agam, just one quick follow-up if I can.
Yeah.
I mean, this is a relatively new series, but we've had one expiry behind us. What pockets seem to be having the largest short positions already built in? Any assessment there?
Yes. So until last month, we had names like Siemens India, ABB India, which had shot up, were trading at life highs, and since then we've started to see a little bit more temperance come through. So some of these names have already seen a lot of shorts building in at the moment.
So industrial, certainly a pocket to watch out for. Okay, great. Remember, it's also a week of results for some of these industrial names like ABB, so certainly a pocket that you want to watch out for. Thanks, Agam, for that. So watch out for those stocks. In fact, let's watch out for some other. Let's also hear about some other stocks that you should watch out for. First, let me get in Anushi to tell us some key newsmakers or result movers, potential result movers in the session today. Anushi, good morning.
Hey, morning Neeraj. So first I'll start off with the earnings one. Now the first here on the list is Delivery. The company, if you look at the estimates, the company has beat the estimates on all fronts. Now the revenue saw about a 5% growth sequentially, while EBITDA about 112% of growth at 97 crore. With this, the EBITDA margins also inched up to 4.5% as compared to 2.2% in the last quarter. Net profit turned to 54 crore as compared to a loss of 68 crore in the previous quarter. Now in other key highlights, also the company's largest segment, express parcel shipments, grew about 4% QOQ to 18.3 crore of shipments, and the revenue was about 5% up over year. But in other key stocks that we should be focusing on, first one is Ambuja Cements. Now the year in, they are making an investment of up to 1,600 for setting up a 6 million ton per annum cement grinding unit in Bihar. Now this is the largest investment that a cement company has made, so definitely focus should be over here. Of the 3 phases that the company is going to make this investment in, first phase of 2.4 million ton per metric annum is going to be commissioned by December of 25, and again with this the project will contribute about 250 crore of revenue to state's revenue thereon. Next, moving on to Ashoka Buildcon. So here the company has come out with a large order win with it has emerged as the lowest bidder for two projects worth about 1,280 crore, and they've received this from Mumbai Metropolitan Region Development Authority. So these are two EPC orders, with one with a 42-month timeline and the other 991 crore order with a 3-year timeline. Now, last on the list is Adani Energy Solutions, wherein they've approved allotment of up to 8.58 crore equity shares, with the QIP issue price set at rupees 976, which is again at a discount of about 5% compared to its floor price. So again, this issue had opened on July 30 and closed on August 2. So herein, SBI and Citigroup were the biggest investors in Adani Energy's $1 billion QIP that we are looking at. So these are some of the key stocks which will definitely be in focus today.
Okay, thanks a lot for that, Anushi, and watch out for Ashoka Buildcon. That order win size that Anushi spoke about seems to be very impressive, and therefore it's something that you should certainly keep an eye out for. Think of MedPlus Health as well, by the way. And amidst all of this bad news, there is a whiff of strong earnings delivery from MedPlus. 16% uptick in revenues, which was in line with estimates. But the operating profit margins at 6.31 versus estimates of 4.9 was very strong, and as a result of which the bottom line jump 14.3 crores versus estimated 11 crores, 257% higher. Very likely that MedPlus, which has delivered a strong quarter, well, on an ordinary day could have done well, maybe won't do as well today, but the weak ones, and that's the problem. I mean, RKN, Sheela Foam, and Nuclear Software, for a business, for a stock which has done so well on banking software acceptance, the quarter-on-quarter numbers look really shabby. For a software company, revenues down 7%, EBIT down 51%, PAT down 42% quarter-on-quarter. Very likely that Nucleus could see a slam dunk today.
I'm curious to see what happens with Infosys today, because of course, IT stocks would be under pressure. I mean, common sense would tell you after everything that's happening overnight in the US and in global markets. But the GST authority actually came in and closed the account for 2018-2019 for Infosys. Doesn't mean that 32,000 crore rupee total amount of demand from IGST goes, but at least about 3,000 odd crores for that year goes. And it's just directionally, Infosys came, stuck to its guns, said that this demand makes no sense. Industry came and fought for them. You know, over the last couple of days, you've had this one demand for 1 year actually closed off. So that I would want to see. Divi's is another one. Now, Divi's, remember, has been a bit of an outlier in terms of performance. And even on a very, very tough day on Friday, Divi's was up 1.5%. Their numbers came over the weekend. So that up move was pre-numbers, and they're not half bad. Actually, their CS segment, that's their custom synthesis segment, is the growth factor for Divi's, has grown 45%, while the generic segment has grown about 4.8%. Revenues are up 19%, slightly ahead of Bloomberg estimates. EBITDA is up 23%, a little below estimates, but good numbers. EBITDA margin has also moved upward. Net profit is up 20%. So you might see for a defensive play as well as in a continuation of good numbers, some up move on Divi's. But actually, I think hunting for positive stories in the market at this point. Let's get in Kush Bora, founder at kushbora.com, with us this morning. Kush, how are you looking at the indices? I mean, that's the first question, looking at how deep in the red the implied open is.
Hi, morning, Tamanna. I think we've been talking about a downturn or a slowdown for a while now. The indices haven't really obliged, but I think you have to be a little cautious at these levels. The Nifty was already indicating that there was a negative RSI divergence even on the daily charts, which is actually a very strong indicator for a near-term dip. We saw that on Friday. We're getting a continuation today. My only thing is that we should not be in any kind of a hurry to jump and say that this market has always, or at least in the last 4 years, has been a buy on dips, and it might continue to be so. Well, might, but then you'd want the dust to settle before you go out and buy anything. Bank Nifty actually a slightly encouraging sign, because we started to fall a lot earlier, and the Friday cut wasn't really as bad as at least the Nifty was, because some of the other sectors were now starting to perhaps turn. So Bank Nifty might turn into a buying opportunity real soon. So I'm a little optimistic there. That said, doesn't mean that we can't have another 1,000-1,500 points of downturn before that happens. But then perhaps that might show first signs of a revival. As far as the levels go, 24,500, 24,700 puts have a very strong base. There's a possibility that the bulls might try to fight for the 24,500 level. However, for me, the real support actually comes in at 24,400. If that is defended, I'll take this as a win today. As far as Bank Nifty goes, any kind of meaningful support is the last week's low, which is close to 50,400 odd levels. So if that is held, I think, as I said, I'll still take this as a win. I know these are deeper levels than what the anticipation might be, or at least in case of Nifty, what the GIFT Nifty is suggesting. But if these levels are held, I'll still take this as a win for the day.
In terms of, I'm dreading to ask you this, Kush, but what are the stocks that you're picking up for the day? And this could really actually be an opportunity if you see enough hammering in certain stocks.
So, I think I've been one of the few maybe early ones to say that the Nifty is topping out. We might see perhaps a 10% cut, maybe more, but that doesn't mean that anything goes away in terms of the story, right? Why I'm saying that is because if that dip does come about, I'll perhaps be the first one to go out and say that come on, let's start buying. And you're right, in a lot of stocks, we need to see some of those cooling off effects for them to become attractive. Now, just to give a quick update, we've been recommending a buy and a sell practically every day, right? So just as an update on that, RBL Bank was a short on, I think, Thursday, and it hit the first target of 225. 219 is the second target, which is still very much in play. If anyone's got a short position, you must continue to hold on, lower your stop loss to your buying price now. Also, interestingly, Himadri Speciality, we recommended this on Friday, with the Nifty doing what it did, ending with a deep cut. This stock still ended about 4% higher and hit the first target of 465. Same view here, continue to hold. 480 is your second target. Perhaps even much higher levels are anticipated. But just for now, continue to hold. As I said here too, move your stop losses to your buying price. Now, as far as today's trades go, two of them, same combination of a long and a short. AU Small Finance Bank has been reeling under some pressure, trading below its key averages. So I think there is a certain testing that could happen of lower level. 620 is a support zone, so there's a possibility that we might go down and test that. So in futures, you could go out and sell AU Small Finance Bank, targets being 630, 622, 648 is where you place your stop loss. Epigral is a stock that has seen fabulous run, and there are very evident signs of accumulation for the last month and a half, and there's been very clear relative strength in this one. I have a feeling that this stock is poised for a lot higher, but for now, 1920 and 2000 are the two targets. 1740 is a stop loss. But again, given the kind of day it is, you don't want to jump in and buy right away. Give the markets about 15-20 minutes, half an hour to settle down and see how the stock behaves.
Well, brave man Kush giving a long call too on a day like this, but you know what, sometimes scared money never wins and brave money does. So let's wait and watch if that happens. Aditya Shah, founder of Hercules Advisors, with us on the show as well. Aditya, tempted to dip your feet in if the markets were to dip? I mean, the buy the dip is now will now get tested, right? Friday, today, and over the next few days. Would you buy the dip today? Would you wait for a bit?
Neeraj, good morning. So there was an interesting statistic that I was watching. Over the last 12 to 18 months, the Nifty has not even corrected by about 10%. So the global setup, as it may be that the US is slowing down and the narrative coming in, is a good opportunity for the market to correct, the froths to get cleared out between the small and the mid caps where there is excessive froths building up. So I am happy that the correction is really happening, and over a longer period of time, this is healthy for the market as well as for the Nifty. That underlying market will correct, froth will get cleared out, and we will then move on towards 26,000 and eventually higher on. So nothing to worry about. This is a brilliant opportunity in very high quality companies where earnings are backed by cash flows. At the top of a bull market, short-term bull market, cash flows become really very important, and you need to start seeing how the companies are executing their orders and getting cash flows. So I'm happy with this correction. Good opportunity within the banks, within the asset management companies, within pharma, chemicals, FMCG, all baskets of the market where good cash flows are coming in.
All right, even as we break up what the day is going to look like, very important and I think interesting note, Neeraj, from Chris Wood, the Greed and Fear note, which is underlying the kind of fear we're seeing. Now, his view, Chris Wood's view, is very clear that the jobs data is looking bad. He says we have unambiguous evidence of weakening in the US job markets. This is a time when inflation is above US Fed's 2% target. So like I was saying, that soft landing, both things are not working. You've not managed to curb inflation like you wanted at 2%, and you've wrecked the job market. So, I mean, the Fed is going to get a lot of flack on this one. Money markets are discounting 116 basis points of easing by end of this year. So that's already factored in, but is it going to be too little too late when they finally get down to cutting rates in September? The headline increase of 1.14 lakh is talking about the non-farm payroll data specifically. It's the second lowest since December 2020. The fact that such few jobs are being added is a pain. And it's not just that companies are sacking people. If you look at the minutiae of that data, it's about less jobs being advertised. And when companies hire less, that's concerning. Unemployment rate is the highest level since October 2021 versus expectations of 86 basis points before the payroll data. So yeah, the jobs data is bad. He's giving those details. Excess savings from the pandemic have finally been spent. Rate cuts are not necessarily positive for US equities. I found this very interesting. Rate cuts are not necessarily positive for US equities. He also goes on to speak about India. Indian stock markets are much more resilient in the face of a US downturn because the market has been driven by domestic money. I think that's our saving grace, Neeraj, honestly.
Yeah, and maybe which is the reason why. I mean, we will maybe outperform simply because in the last few days, you've been highlighting the fund flow numbers. Look at the equal and opposite inflows, which helps in some fashion some of these stocks as well. Plus, mutual funds on last count on budget day or the day after the budget, or that weekend, which was last week, right? We're sitting on a cumulative cash pile of 1.2 lakh crores. That's a large sum of money waiting to be deployed. Not saying it'll happen right now, but that money plus fresh flows, plus EPFO, etc. There's a fair cushion of money that we have to maybe come in at lower levels.
And if you're looking at purely economic performance, economic indicators, then India's looking pretty good compared to what you're seeing the world over. China's still in a bit of a slump, and that pain not ended. So yeah, that's all the positive side of that story. Whether it plays out for you today or not is the question. Aditya, very good morning. Now, in terms of if this global recession kind of narrative continues through the day and say the next couple of sessions, where do you think are going to be the greatest beats, in the sense which sectors will be hurt the most, which ones will be seen as safe havens?
So which sectors will be hurt the most? The sectors which have run up massively and froth has been created there. Straight away, defense sector. Although defense is a multi-year opportunity and indigenization of defense is a very good theme to play on, but stocks have run up massively. Over the last 1 year, 5 to 10x, the stocks have run up. So there could be a correction within the defense sector. The next prime candidate could be the green energy sector. Again, a very good theme over the period of next 5 to 10 years. But in the short term, these companies have run up massively. So there could be a correction there as well. Then again, the last one will be the PSU pack. The PSU pack has been re-rated massively, and there is a need for some correction to take place there because stocks are running up irrespective of the fundamentals. So those are the 3-4 sectors where I think there could be a short-term correction, and you have to look at what price do you want to buy these companies really at. Stocks where you should be looking at, as I've been saying before, the larger private sector banks is a place to be. Then you have to look at the chemical sector. Then you have to look at the pharma sector. As you were talking about, Divi's Labs was really very resilient even on Friday because of their custom synthesis business and the capex that they have announced. So these are the 3 sectors that you should look at selectively within the FMCG pack. Mind you, FMCG pack is also undergoing some slowdown, and as Neeraj was also pointing out, the QSR space is not giving a good commentary per se. So these are the 3-4 sectors that you need to look at. Again, I would repeat, look at cash flows. In a bull market, when valuations are out of whack, cash flows, if the company profits are backed by cash flows, the stock prices will start to do well. If they're not backed by cash flows, you could see a fall in the stock price per se.
What are 2-3 companies that you have identified, Aditya, which tick all of these boxes, especially on the cash flow parameter that you've mentioned?
Within the chemical space, somebody like a Deepak Nitrite looks really very good. The stock has run up massively from about 2,300 to about 3,000, and the recovery within the chemical space is starting to come back. So that looks really very good within the chemical space. Within the banking space, I really like ICICI Bank and HDFC Bank both having very different outlook. ICICI Bank doing extremely well with the change in management, and HDFC Bank dealing with the merger gyration. However, the valuations look extremely good there. Somebody like a CDSL, which is playing on the demat account story of India, that looks really very good. As you said, somebody like a DV's Labs looks really very interesting, where DV's has announced a capex and their custom synthesis business starts to look really good. Within the diagnostic space, somebody like a Krishna Diagnostics looks really very interesting, where they are in the B2C format and working with the state governments per se. So these companies, their cash flows are really very strong. And even though there will be a short-term correction, people will be compelled to buy these companies as the profitability increases by a moderate 15 to 20%, but the business continues to be extremely strong.
Okay. Kush, you gave the index trades. I'm just asking for some specific names here. Let's say a Titan, which has been under pressure. We spoke about the numbers thereof too, looking slightly, having one or two chinks in the armor, plus there is new competition coming in. If Titan were to open lower today, do the charts open up for more downsides because it's an expensive stock?
They do, Neeraj. 3,400 is a level that Titans try to hold on to for the last 5-7 sessions now. Somehow has been able to. But if 3,400 is indeed broken, then I think you're looking at a 3,330, as the next target, or perhaps further down 30 to 50 is where any kind of meaningful support comes in. So the stock's very clearly under pressure. Any kind of recovery has failed around the 200-day moving average mark, which comes in about 3,500. So yes, if we do get a break below 3,400, then I think for a positional target of 30 to 50, Titan does look a little weak and could skip to those levels.
Okay. Okay, Jaman, stay on. Lots more to talk about. We'll be back after a very quick break. In fact, very close to the market open. The currency markets will open as well. And could there be gyrations there? And what could the impact on the rupee be, if at all? We'll try and get in a quick currency phone or two immediately post 9 a.m. So stay tuned. Lots more opinion, both local and global, coming up. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health.
Right, back with India Market Open right here on NDTV Profit. In moments from now, the currency markets open as well. So we'll, maybe get in Anindya Banerjee for a very quick perspective. But we'll also mark the rupee when it opens. So Anindya, good having you. Of course, thanks for joining in as always. But just wondering, this whole talk of the way the yen has risen and the resultant ramifications that it is having, do you reckon it has ramifications for the currency as well? In the Indian rupee as well?
Yes, thank you for having me. Yes, actually the yen carry trade unwind is a big phenomena. Whenever it has happened in the past, it has triggered a weakness in the Indian rupee and a sell-off in the stocks. And it's just not limited to stocks. We are seeing the impact on the commodities as well. Yes, it is quite an important phenomena, but this thing doesn't last for long. They generally continue for a week or 10 days, but over that period of time, we tend to see a lot of impact on the currency as well as on the risk assets.
Okay. So what is the likely impact that you see, and would it be contained as far as India goes, or is it difficult to call that right now?
Either India may outperform as far as the impact is concerned, but it will be difficult for the Indian equity markets or the Indian markets to completely be immune to this kind of a phenomena, because the selling is across the board and the impact will be felt. But the good point is that historically such carry trade unwinds have not lasted for a long time. They tend to be short, but they tend to be quite sharp.
I mean, okay, so Anindya, just wondering, to your mind, I mean, and I know it's difficult to say, but if, let's say, the BOJ doesn't do any other intervention right now, there's a school of thought which says the BOJ might come in and calm nerves, etc. If the BOJ doesn't do anything like that, how much further does this yen carry unwind have? To the best of your guesses, if you will, Anindya.
See, this entire, already the USD JPY has almost retraced the rally of this year. It started from around 140-ish, it's around 144. So I think 135, 136 is a worst case on the USD JPY right now, because these are very large currencies. They don't, they're not like emerging market currencies which can move like 10-15% without any kind of rebound. So I think the worst case is 136, 138, which we can see, and then we should see a rebound in the USD pair, which should have a positive impact on the market.
Okay, just wondering if we can show the rupee. I know equity markets are center stage, but these rates are unbelievable. So we'll get them, but because Anindya is with us, let's just quickly get the rupee to try and see. Okay, 83.75, no big reaction, Anindya. Just before, last word, before we let you go. What is the level on the rupee that you'll watch out for?
So I think in a worst case, 83.90, 83.95, because RBI remains very vigilant over here. So we don't see a blowout move in the rupee. So 83.90, 95 on the upside.
Okay, Anindya, we'll leave it at that. Thanks so much for joining in. So, well, that's a quick perspective on the rupee as well. It doesn't see too much of weakness there because the RBI is vigilant too. And remember, our central bank has, well, thankfully, a fair degree of gunpowder in its arsenal to be able to intervene if need is felt. So bear that in mind. Okay, unbelievable rates on the Nifty, by the way. Let's get the index now. We've talked about the rupee. The rupee is out. Let's get the currency, or rather the equity markets in. For now, 730 points. It is all over the place. So I vote that we should give these rates a chance to settle before we, at 9:08, before we try and take further call. In fact, Kush's advice about how let the market also settle for the first 15 minutes before you try and do any trade might also be welcome. So these numbers all over the place, we'll wait for them to settle down a little bit. Kush, very quickly revisiting the bank Nifty. Now, what's the trade that you would watch out for here, with an assumption that the bank Nifty also starts about 1.5% to 2% lower?
So, Neeraj, if 50,400, 50,600 zones are kind of held for the day, the bank Nifty might in fact even try to rebound. So, right now I wouldn't do much. As I said, I'll wait and watch. But, for the day, if we see any kind of support around that 50,400, 50,600 mark, about 800 points lower, 800 to 1,000 points lower from here, then there is a possibility that, the bank Nifty might see an intraday rebound. We've seen the first hint or green shoot of strength in bank Nifty. Too early to call it, a turnaround of the near-term downward trend. But then there's a possibility that, an intraday mild recovery is still possible. So I wouldn't go out and short because of the kind of levels that we might see at open. But if support zones are held, then intraday there could be a possibility of a long trade.
Okay, maybe the bank Nifty is the key to watch out for as well, because as I said, we'll wait for the Nifty rates to settle down. I mean, it seems a bit difficult to believe that we'll nudge or kiss 24,000 on open today. Let's get the Nifty up on the screen. 24149, if I'm not wrong, currently 24150. Like I said, all over the place, moving very, very swiftly. As we speak, Britannia seems to be showing a bit of a green. Titan seems to be showing a bit of a green, maybe because on expectations that the quarters ahead might be okay. And stocks like RKN Chemicals, amongst others, are showing a fair degree of red on the kind of numbers that came out. Aditya, you were constructive on some chemical names. I heard you speak about Deepak Nitrite, but what about the numbers which have not come out too well? RKN is a case in point, wherein the margin miss, PAT number much lower than estimate. What do you do with some of the chemical names, Navin Fluorine, which didn't quite meet estimates?
So Neeraj, what is happening in the chemical space, even with companies like Deepak Nitrite, is the numbers are not really good at this stage. However, the market is pricing in that over the by the end of this year and second half of FY25, the numbers will start to look really very good, and that's what the market is right now playing with. So you have to go company by company and then see. Let's take the example of Navin Fluorine, SRF, Gujarat Fluorochem, and the entire fluorochemical space. None of them have reported really great numbers at this stage. The only silver lining is that the refrigerant gas demand in the US is expected to recover in the second half of this year. Now with the US slowdown coming up, this may get pushed up. But the real theme is that the chemical story will only get revived in FY26. The stock price may run up now, but the recovery numbers wise will only happen in FY26. So again, these stocks are not really cheap. However, these companies will really do well in FY26, 27, and 28. So you have to go company by company, as this is a heterogeneous space, and look at what chemicals these companies are really producing and then go on from there. Specifically to Archean Chemicals, the results were not really good. However, the stock looks really very interesting considering their presence in the bromine space, which is ultimately going to go into the EV batteries per se.
Okay, by the way, Britannia seems to be holding out, I must say. Even MedPlus marginally in the green. So a couple of those names to be watched out for. Aditya, I'm more interested in the winners of last week, right? And let's say a Zomato with the kind of move that it had. Now, would you take profits or would you stay long looking at the results?
Neeraj, it really depends on what kind of an investor you are.
Let's assume I'm a long-term investor, Aditya.
Yeah. So if you're a long-term investor, I don't see why you should be booking out of Zomato. In my opinion, the story has just started. Blinkit has surprised all of us, and Blinkit per se is not looking to take market share away from the value retailers like DMart and Reliance Jio. What they're trying to do is they're trying to do a niche within their own space. So in my opinion, the journey has just started. Having said that, in the near term, the gains are all done now. There could be a time correction on companies like Zomato for the next 6 months to 12 months, after which we could see an up move. So short term, the move is done. Longer term, you must stay invested in this stock because the journey has just started. And the next flip could be from the Swiggy listing, where that could also push the multiples up.
Okay, so well, that's the long and short of what's happening with some of the stocks, at least Zomato, which did well. Aditya, very quickly, a quick 1 minute view on Britannia. It's holding out reasonably okay.
Positive on companies like Britannia. The rural recovery is just starting to happen, and if there is a worldwide slowdown, fund managers could start to come back to the defensive stocks, and Britannia is one of them. So I'm positive on this.
Okay, positive on Britannia is Aditya. Watch out for that one as well. Aditya, where are you negative on?
As I said, defense. PSUs, renewable energies per se, where so basically where a lot of rally has happened irrationally, and the market is starting to price in FY20, FY34, 35, 36 earnings. Those are the places where I am really very careful on. However, domestic facing economy stocks is something that you have to really bet on given the worldwide slowdown that we are experiencing now.
Got it. Okay. Well, but it's just the perfect time. Aditya, thanks for those views. It's just the perfect time to get in somebody who's looked at these cycles so closely for so many years. Adrian Movat, a market veteran, has looked at the yen carry trade unwinding, the US recessionary period and Fed action very closely for a number of years. Joins us right now on the show. Adrian, really appreciate you joining us on a short notice. Neeraj here, good morning. How are you looking at the current landscape? Because there is geopolitics, there is this US data which is not looking very good for the economy, and the yen carry trade happening simultaneously. Which is the bigger trigger? What is it that you are watching out for, and what's the likely impact?
So I think the context here is that you've had very good returns from the US capital markets. You've had a successful yen carry trade, and we're moving into the summer months. And there have been some reasons why people have begun to unwind those positions. You know, a stock like Nvidia is still up substantially this year, even with the type of correction we've seen. Now, we have had some important data in terms of a change in perception about the US economy. So that loss of momentum in the US labor market, you know, still printing an increase of around 117,000 jobs, but some concern that most of those were in the public sector and healthcare, has caused people to sort of question about the robustness of US growth. And you've seen that being reflected very nicely through what the bond market has done and the equity market selling off as bonds rally. I think the danger here is that you read a little bit too much into what the markets are doing and try and extrapolate that into a real fundamental change. I'm not sure that is the case. You know, with the yen carry trade, which you referred to, which was another sort of risk on trade, the Japanese central bank, the Bank of Japan, came in with some relatively large intervention and has caused people to close out positions in that trade. But as I look at that trade, I still think the Japanese economy is fundamentally very weak. Demand there is weak. The inflation they have is imported inflation, not really caused by domestic issues. My suspicion actually is the sort of the yen weakness fundamentally will reassert itself. So it's really going to go back to what's going on in the US. So we've had this notably weak data point in the labor market relative to what we've been expecting, or what we've experienced in the last several years. The other thing that I would note in terms of weak economic data is the global manufacturing PMI, which is in contractionary phase. So what do I expect over the next couple of months? I actually think this volatility will continue. It is possible, markets will be lower, as we exit the summer, but I don't see this as a significant ongoing correction that people should get overly anxious about.
Okay, you don't. So then, Adrian, tell us, what could be the harbinger of good news from Bull's perspective? Would it be Fed rate action? Because suddenly I see maybe your ex-house too, but some of the other global banks all talking about how their assessment or assumptions around the Fed action has changed. Citi, Goldman, JPM, everybody now believes anywhere between 50 to 100 basis points in the current calendar itself.
Yeah, that's the good news here is that the Fed's got rates at 5.25. So there's plenty of room for the Fed to cut rates if economic data is weakening. And Mike Feroli reacted to the labor market data, the PMI data, and he's now calling for a 50 basis cut at the September meeting and perhaps another 50 basis point move. Now, when you sort of think about 50, that seems like a lot. We've been, tightening in 25 basis point incremental moves. But to move back down to a neutral level, which perhaps is what the economic data is now signaling, then you would like to see a decisive Fed. And I think a 50-point cut seems very rational considering the new data points that we have. But that usually is pretty good news for equities. And I think it might, as you look at this weakening economic data and then you reflect on what's really been happening in the US equity market, if you look at the equity indices that's equally weighted, it's barely done anything. We've had a very narrow market. I think there is an argument that the market does actually broaden, and the more cyclical stocks which have been performing poorly because people have been worried about the Fed's tight policy leading to slower economic growth, they can now look ahead as the Fed begins to ease. And okay, the economic data is likely to deteriorate, but remember, equities look 12 months ahead. So if the Fed is easing, it might actually cause a broadening of the market into more cyclical stocks.
Also arrest the ongoing correction, Adrian. Could the Fed play the role or could it be something else? And very quickly, Adrian, just 2 minutes left to market open. A quick view alongside that on Indian markets.
But a lot to do in such a short period of time.
Sorry.
I think the Fed can obviously help markets by decisive action. Now we're talking about September, so we have to wait a bit for that. Look, I think India, remains somewhat as an isolated story. It's clearly done incredibly well within emerging markets. The Indian fundamentals continue to be strong. It's suffered in terms of international flows because people have not liked emerging markets. And they haven't liked emerging markets because of issues around China, but they haven't liked it because the dollar's been strong, Fed rates have been high. If the Fed starts cutting rates, that tends to be good for EM, which means broad flows into passive EM products and active EM products. And India will probably benefit from a pickup in FII inflows if the Fed moves into a significant easing cycle, which, if it does move by 50 in September, would be a pretty strong signal, wouldn't you think?
Yes, indeed, Adrian, would be a pretty strong signal. But thank you for laying it out. I know the time was short, but I appreciate you playing ball. And thank you so much for joining in today and giving us your thoughts this morning. Very important to have them. All right, that's the view from Adrian Mowat. Like we said, a guy who's seen a number of these cycles, and he believes that people shouldn't be too unfazed with this ongoing correction. A lot of factors, including the Fed rate cut likely to come, may change it. Remember, I think he made an important point. The Fed is no longer at 2%. The Fed is 5.25%, and therefore the ammo that the Fed has to cut rates is fairly large, and that might just help risk assets. Chris Wood says it may not be necessarily good for US equities. Adrian Mowat says it may well be. In general, it may just prove to be a sentiment changing event as and when it happens. Only in September at the earliest. Keep that in mind. Okay, our markets haven't corrected as badly as maybe the first initial rates of the pre-open session were suggesting. About 1.5%, which is digestible. Maybe slightly more than the implied open was suggesting. But let's see what we do immediately post-open. Maybe the broader carnage will be in the broader market stocks, but about 1.5%. So okay, 400 points. Banks, actually, well, not resilient really, but relatively resilient, if you will. I think all of the things that we see today, we'd probably see them in relatively to what the Nifty and the Sensex do. I guess the mid-cap and the small-cap indices would be showing a tick of red too. 2% for the mid-caps, small-caps too should be in the red. Bring up the heat map just to see if there is anything in the green, if at all. Nothing. Maybe an Apollo Hospitals, maybe a Britannia, which was marginally in the green in the pre-open session in the first ticks. Sun Pharma, Kotak Bank, Nestle, but clearly the defensive bent, pharmaceuticals and FMCG right at the top of the pile, maybe a bit of insurance. But look at the correcting moves that are happening. Metals and auto are being taken to the cleaners. Titan, one would suspect, is also a factor of the point that the markets are looking wobbly, and Titan results were ho-hum. Oil has corrected, so ONGC is down, LTI Mindtree is down. Financials are also taking it on the chin. Adani Port is amongst the top 10 losers too, and just shows that almost everything is being taken down in trade today. Tamanna, no luck really. Argue that some of the pharma names are doing okay, but like you said, that's only relative.
Yeah, and it's completely defensive play because consumption, pharma is all that's working. Relatively a divi is about 1% down is looking better than other things all considered. Let's pull up the breadth of the market just for a second before we go back to broader indices, just to give you a sense of how tough things are right now. 2.5% down on the mid-cap 150. And the small cap index also really hurting. So it's a broader market cut. The last I checked on the NSE 500, you had barely 3 stocks in the green. And you are going to see that kind of a pain continue. In terms of indices, and let's pull up sectoral indices if we can. I think IT is hurting, PSE is hurting. We talked about how those sectors which have run up the most are going to see the biggest hit. There is nothing on the other side today. 4% down for a cut on Realty, PSU Banks, getting hammered, metals getting hammered, auto, media, PSC, IT, all of it looking pretty bad. Let's pull up the top losers and gainers if there are any on the NSE 500 and look at what's happening there. On the losing list, Archean Chemicals, all right, we can attribute that to results, but 10% cut today. Phoenix Mills, LIC Housing, Sobha. So you're seeing all of your discretionary spend kind of plays are also seeing a bit of a hit. We talked about Titan a little earlier, and yes, quarter one is usually bad, but discretionary spends seems to be the theme which is getting hit. TTK Prestige, Marico, Sun Pharma doing okay on the other hand. Very, very defensive play coming in. So you're going to have a really tough day in the markets today. There is little doubt about that. Not too much of sucker over there. Let's just look at the internals of some of those sectors, and let's pull up realty, banks, and just look at in those indices which are the sort of stocks which are hurting the most. Phoenix Mills is the big hit this morning, 9% down. Sobha, Prestige, all of that list. I want to look at the bank index as well, and then we'll look at what's happening with PSU banks, whether there's any kind of sucker there, and not really. SBI, after numbers which are frankly not that bad for this quarter, down about 3%. PNB is being hit quite badly as well. So all in all, Neeraj, I would say it's a painful market. I mean, now you could try and look at the glass half full. I don't even know if it's half full or 1/3 full right now. But you can say that, yeah, relative to all things, India's not doing that badly, but we're just in the first few minutes of trade. So we'll have to wait and see before making any call on that.
Yeah, IT is also looking very wobbly. Kush, we have the next guest ready, but quick 60 seconds, Kush. Anything on the charts that stands out? Quick 60 seconds.
Well, only on the short side, Neeraj, and as you've rightly pointed out, IT looks bad. So Wipro is a call that can slide further to levels of 475, 480. So any fresh short positions, you could consider Wipro. RBL and AU Bank, which were already mentioned as short positions, they continue.
Gentlemen, I'll have to call it a day, but thank you so much, Aditya and Kush, for joining in on an important morning and giving us your thoughts. Really appreciate your time. If you follow Mihir Vora on his X handle, you will see that he looks at some of these macros and the correlations very closely. It's an absolute pleasure to have him today at a very opportune time to try and tell us what does he make of all of that's happening around the world. Mihir, good morning. Thanks for joining in. And you mentioned in one of your latest posts about how, where you say that how we got here, and you attribute one of the reasons of this current global mood to the yen carry trade unwinding as well. What would you assess is the resultant impact here on? Because we've seen some bit of a fall in markets already.
Sure. Hi, good morning, Neeraj. So first of all, let's not correlate India directly with the yen trade. That was a general post. I guess it applies more to global markets where there are large hedge funds and large leverage positions using the Japanese yen carry trade as the leverage, so to say. So India, of course, is collateral damage. Hopefully, not too long, because first, I don't think we've got those kind of hot money flows from FIIs recently. As you know, the numbers have not been very good, so I don't think we have too much of hot money in India. And second is that cyclically also we are not that linked to the global economy because we are not export dependent like Japan, Korea, Taiwan, etc. So to that extent, the impact on India should be much lesser to start with. But having said that, the yen carry trade is a significant issue globally, and we have seen that post COVID, when the US rates were zero, almost close to zero, and so was the Japanese interest rate, you did see the yen being used as a large funding currency because of the fact that you got to borrow at zero in a depreciating currency. So that, I think, went on for almost 3-4 years, and it's become a sizable trade globally. And now that Japan started feeling the pinch of depreciating currency in terms of inflation, they had to react, which they did last week. And this is what we are seeing as a correction. So I think the yen has strengthened from 160 to 148 almost. So that's quite a sharp correction. And I do expect some kind of stability to happen And if it doesn't happen, I do expect a significant central bank intervention from the Bank of Japan, because I don't think any central bank has a stomach for this kind of volatility in bond markets and equity markets.
Yeah, Mihir, good morning. That's a very good point. We've been talking about how Fed will come in and react since this morning, but Bank of Japan may have to, in Indian policy terms, rollback is a favorite sort of method. Not rollback, but they might have to soften the blow a bit. But, let's focus on what's happening in India. And I think your comment is very interesting, that the impact of the yen carry trade factor, or the fact that Japanese interest rates have inched up, so that's impacting the world, and how much it affects India is not as much as expected. We are seeing a sea of pain today. Do you think this sustains, or then domestic money which is waiting on the sideline comes in?
First of all, let's stop calling a 1.5% correction a big pain. It's part of the course.
Nearly 2%. All right, and this pinch this morning.
Yeah. No, I think it's of course expected, given the fact that the world markets like Japan, Korea are down 5-6%. India could not go unscathed. But as we discussed, I don't think it's such a big issue. And so far, at least in the last 5 years, Indian institution as well as retail investors have been conditioned to some kind of a buy on dip kind of a mindset, which has worked so far. So at least in the initial part of the correction, I do expect the buy on dips strategy to continue as far as the retail investors are concerned.
Okay, so buy on dip in the initial part of the correction. What is this initial part of the correction? You see this correction lasting a day, weeks, has just begun. Even you rightly pointed out that 2% is not even pain if you look at what's happening in relative terms. But in the broader markets, the pain is truly deeper.
See, that will be a function of how the global markets ultimately pan out. My guess is a lot of the pain is already done. Japan is down like 15% in 3 days, and so are markets like Korea, Taiwan, which were quite linked to tech, I would say. And we also must remember that we are already in a Fed easing cycle probability. So people are expecting, the markets are expecting the Fed to start cutting in September itself because of the US slowdown. So to that extent, the liquidity support by central banks to the markets will continue, I think. So I think whatever volatility we see should hopefully be very sharp and short, which we are in the middle of as of now.
Just wondering, I know you mentioned that the BOJ might come and intervene. The Fed intervention or the rate change action, if it happens, will only happen, let's say, in September. So in the ensuing period, if the BOJ doesn't do anything, and if this yen carry trade unwinding keeps on impacting global markets, do you think we can go down further, or at some point of time, mutual funds like yours are sitting, I'm not saying you are, but collectively mutual fund houses are sitting on nearly 1 lakh crores of cash. Does that start coming in at circa 24,000, you reckon?
Yeah, there is certainly cash in the system, but I think it's more important to get the market call right, because I don't think any amount of cash helps when things turn sour, and vice versa. You don't really go against the fundamentals beyond a point. So cash can help to some extent for a few days, but it can't change the direction. So I would not bet on institutional money trying to save the market. That does not happen. Ultimately, it is fundamentals that need to save the market. And the Indian fundamentals compared to the rest of the world continue to look quite attractive.
Right.
So my guess is that ultimately local and global money will float the Indian economy and the Indian market.
Which is the point I was trying. I was not saying that you will a domestic institution or institutional money will come in and save the market, but do you reckon at valuations or levels of circa 24,000 or 23,500 or 23,000, whatever, is the sweet spot?
Certainly, I would say that will be the first support for the markets. A 5-7% correction would be a good entry point, at least in the first phase.
Okay, Mihir, you talked about a buy on dip strategy that Indian investors have sort of gotten used to. How should those watching this program right now and trying to understand what this global narrative means for Indian markets look at it? If there is going to be persistent pain in the US, what sectors does it hit the most? What are the sectors or spaces that you should look at which are resilient to these global headwinds?
Sure. So first of all, the first thing to do is not to do too many trades, because we also must understand that we are seeing the impact of the unwinding of the global central bank balance sheets after a long time. We had extra stimulus on fiscal and monetary side for almost 5 years. So unwinding of that also will not happen overnight. It happens over a period of time. So a lot of the sections of the market is used to easy money, which will be incrementally less easy, so to say. So I don't think we should be, trading too much, but rather taking a strategic call over the long term as to what our asset allocation strategy should be. And within that, I would stick to Indian domestics, which is basically sectors which are not that exposed to the global economy, because I think the global economic downturn will definitely be sharper than what we see in India. So India will still continue to grow at 6 to 8% hopefully, and to that extent, when the rest of the world is growing at say 2%, India does become an attractive market. So I would stick to domestic sectors like financials, like discretionary, like consumer, and of course the physical asset creation play like infra, construction, cap goods, etc. Over the longer term.
Liking financials right now, Mihir? I mean, it's a bit of a fear. I won't say pain point again, but it's a bit of, I think, trepidation this morning, wait and watch. But you talked about financials. Are any of those public sector plays, private plays looking interesting or will begin to look interesting?
Actually, the whole financial space is looking attractive. It's just that we've had borrowing costs staying so high for so long, that's kind of dragging down credit growth. But as we just discussed, we probably are near the end of the tightening cycle and beginning of the loosening cycle globally. So liquidity conditions should improve, and balance sheets have never been healthier for financials, both banks as well as non-banks. So tactically, I think we are more bullish on the non-lenders as of now. But in the next few months, even lenders will start becoming quite attractive.
Okay, Mihir, appreciate you taking the time out and joining us and clarifying those points as well. Key points, thank you so much for that. Viewers, Mihir Vora says that the yen carry trade, a global phenomenon, that impact being felt on our markets. And by the way, it is being felt because the Nifty is now at the lowest point of the day, 500 points gone, nearly 2% down for our markets, 24,200, a far cry from 25,000 all-time highs last week. Yes. Time for a short break then. We need a break really. On the other side, talk some corporates. Arun Mishra, CEO of Hindustan Zinc Johnson. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health. Back with India Market Open right here on NDTV Profit. Let's get in some corporate conversations going, two large cap names. First off, we spoke to Arun Mishra, CEO of Hindustan Zinc, about the Q1 earnings and more. Listen in.
This quarter was marked by highest ever mined metal production of 263 KT. Of course, that resulted into highest ever finished goods production of 262 KT, which is a growth of about 1% year on year. But at the same time, we reduced our cost of production by 7% from same quarter last year, which has resulted into having our EBITDA as well as PAT increased drastically. The PAT went up by 19% compared to same quarter last year, and we reported a PAT of about 2,345 crores. So this is something which is a good achievement, I should say, both in terms of the quantity of production, also in terms of cost of production, and also which resulted into better profitability.
EBITDA margins have also improved to 48.5%. What is the target for FY25 since, FY24 did see a contraction when compared to the previous year?
No, so we should always try in this business to be around 50% EBITDA margin all the time. So that is the number that we would try to achieve.
Coming to your refined metal production, how was it this quarter and what volume growth do you expect going ahead?
So for last 3 years continuously, we have been increasing our production. We started off somewhere around 850 KT. Then we crossed 1 million ton for the first time in finished goods. Then this year, last year again, for the second time in a row, we finished 1 million ton, about 1033,000 tons. And this year we want to go closer to 1.1 million ton number. So that is what is in front of us. And every quarter, last year I had spoken that my target is to produce more than 260,000 tons every quarter. And maybe at the last quarter, finish closer to 300,000 tons. So that is the whole way I look at this business. And we have done quarter one as per our expectation. Quarter two should be better than quarter one, and then should be followed by a better quarter three and best ever quarter four. That is the way we operate.
You also mentioned cost of production has come down in quarter one. What was it this quarter, and what's the targeted range for FY25?
No, so this quarter we achieved around $1107 per ton, which is 7% lower than last year. And we also have an estimate that we finished the year at $1,050 per ton. We are working structurally on cost reduction, both in terms of since 40-45% of our cost is power cost. So we have worked on our power plants, modified them to enable them to operate with higher percentage of domestic coal. So today they are operating at about 45% consumption of domestic coal in our coal mix. Also, we have been able to provide 8.5% of renewable power, where the cost of which is lower than that of our cost of generation or cost of grid power. And this number is going to grow up to 30% by the year end. So very, very structured way of working on the cost, and we will be reducing the cost further as we go through the next few quarters.
Right, sir. I also wanted to get some perspective on pricing. Now, Q1 FY25 saw strong metal prices, but they have corrected in July 24. Now, how would this impact the company, and what's your outlook going ahead?
Quarter two will be slightly subdued based on the pricing, and I'm sure we'll have to do more on the cost side to keep our margin intact. And going forward till December, I don't see much beyond it. It won't be able to break the 2,700 or 2,750 mark by the year end. I'm sure the quarter four will be better in terms of prices, simply because I am basing on the fact that in Europe, two big elections, both of France and UK, are over. Whereas American election is in November, which should be over by that time. And we will have more optimism and major push in infrastructure work. And we should see that should result in a quarter four being much better.
Well, there you go, subdued prices for the next quarter. But, coming to the mining operations, before I talk about capacity, I wanted to get your sense on how the latest ruling by the Supreme Court of India on mining royalties will impact the company. How much additional liability are we looking at?
No, as far as we are concerned, we are already paying GST on royalty. So no backlog on that. So we are not affected by that. Unless something new tax or cess is levied by the state, and also it is done retrospectively if Supreme Court gives the judgment that states can levy something retrospectively. So that's not the case as of now. And other matter is the land tax in Rajasthan, so where we are clean. So we have nothing pending out there. So as of now, I don't see much materialistic effect on our operations as far as this judgment is concerned. But yes, if new taxes or new cess are levied, then it will be another issue. But let's wait how things turn out. We will only see.
Well, there you go, no material impact. But where are the current mining reserves of the company and how are the mine metal exploration shaping up?
So currently we have a reserve of about 30 million ton of metal in ore and on the resource basis, and about 12 million ton metal in ore on terms of reserve basis. We have a target to continue our exploration and take these numbers to more than 40 million ton metal in ore on resource basis, and maybe up to 20 million ton in terms of metal in ore on reserve basis. This is primarily we would be doing with the strategic objective of doubling our production from 1 million ton to 2 million ton, which will call for at least 10 years of reserve, that is 20 million ton metal in ore on reserve basis. So those are the targets of explorations that we have for ourselves.
Right, sir. Could you also tell us how the new roaster at Daberi as well as the new fertilizer plant at Chanderia are progressing, and when would these two be commissioned?
So the new roaster in Debari is progressing very fast. It should be commissioned by Q3 of this year, if not early Q4. As far as fertilizer plant is concerned, we expect it to come online in Q2 of FY26, which is year after next.
Right. And, when you talk about CAPEX, what's the CAPEX budgeted for Hindustan Zinc for FY25?
So we have got about 2,500 to 3,000 crores worth of CAPEX lined up for this year. So they cater to mostly, apart from this project on roaster in Debari, also the fertilizer project, but we have number of high payback, small CAPEX performance improvement projects for which also we will be spending money. At the same time, we have mining equipment routine replacement schemes lined up. They will also require some amount of money to be spent. So overall, our CAPEX is in line and we don't see any need to revise that CAPEX that we have outlined for ourselves. Of course, if the 2 million ton expansion pre-feasibility report gives us any hope of a very good future prospect, which we expect that this 2 million ton is feasible. And whenever board approves, they will come out with further CAPEX outlay for such a large expansion.
And how will this allotted CAPEX impact the balance sheet with a potential additional outlay?
No, as far as Hindustan Zinc is concerned, net we have about 11,000 crores invested in various investments and about almost similar number as far as debt is concerned. So we are absolutely on net debt-free company. Our balance sheet is strong. Our ability to generate about 8,000 to 9,000 crores every year on cash basis on profit after tax, that also remains. So as long as these fundamentals are in place, I don't think it will be very difficult for a company like Hindustan Zinc to fund for its own growth, even if that requires about 18,000 crores. It's not much difficult.
All right, in more corporate conversations, I had the opportunity to speak with Titan. They put out their first quarter earnings on Friday. Revenues had a double-digit growth, but EBITDA margins as well as profits were hit in Q1. Now, this is a traditionally weak quarter for the jewelry business, and I started by asking Titan's CFO Ashok Sonthalia what he thought of the quarter gone by. Listen in.
Q1 is generally among all the quarters a soft quarter for us. Keeping that in mind and whatever was happening during the quarter, you rightly said, extreme heat waves kept customers inside doors. So footfalls were slightly lower. But overall, we are very happy and satisfied with the quarter performance.
Okay, let's talk about the margin and net profit metric for this quarter. Can you elaborate on where that squeeze is coming from, Mr. Sonthalia?
So if you look at EBITDA and EBIT level, we are fine. We are in line with the revenue growth. There are some financing costs which have gone up. You are aware that we acquired Carrot Lane during last year sometime in November, and we raised long-term borrowing for funding that, and that cost is about 63 crore in a quarter, which was absent in Q1 last year. So when you compare at net profit level, so some of those things are playing into why net profit is slightly lower than last quarter.
Okay, and how long do you expect this to carry on, the carrot lane costs, which you're
So
seeing
as far
in
as
quarter
the
one?
related borrowings are concerned, I think in next 2 years we will pay it down. And when we had acquired at that point of time, also we had said that this acquisition will be EPS dilutive for 2 to 3 years, and then it should start adding to the overall EPS profile of company.
As a growth segment, though, carrot lane's growth has been pretty robust, all things given, isn't it, Mr. Sonthalia? When you compare to the India business, the studded mix, all of that, carrot lane is performing as expected?
Yes, so carrot lane grew about 18 to 19%, and within that, their core portfolio grew about 22, 23%. So we are overall happy. They margin-wise, they were almost flat, slightly lower than last quarter one. But we see there is opportunity for this company to kind of keep improving their margin as they scale up.
What are the growth targets you have for carrot lane as well as Mia?
Both should be growing faster than Tanishq just because of scale. One is the scale. Tanishq is at a very, very high scale. And both the players, Carrot Lane and Mia, are addressing to a segment which is really, working independent, modern women's class, where the India is really going through a huge revolution, I would say, where the decisions and independence in all those things are happening, and they are riding that social change wave. And we see a lot of opportunity, multi-year, next 5, 10, 15 years, these brands should ride that wave.
Absolutely. But in terms of top line growth for FY25, what have you penciled in?
So of course, Tamanna, we don't give guidance on the growth thing. But as I told you, overall, Titan has a FY27 guidance for jewelry business put together. And we are tracking that, which was 2.5 times from FY22.
Okay,
Yeah.
so you're on track for the FY27 targets. All right, let's talk a bit about the import duty cuts. Now, I think one factor of a bit of a drag on Q1 has also been high gold prices. That has corrected quite sharply since the budget. Are you already seeing the impact of that? And how do you see, lower retail prices because of the import duty cuts work out on demand?
So, of course, import duty cut has been a very, very positive step for the industry and for organized players like us, while prices came down for some time, and then again international prices have gone up because of geopolitics intention and US interest rate cut announcement, very likely, like starting September. So prices will keep going up and down, but our competitiveness have certainly improved. The difference between our prices and the market has kind of improved to some extent. And in the long term, it kind of helps everyone in the industry because the gold sourcing will be at par for everyone. And it will improve competitiveness of our brands.
What about the inventory hit? Because you were, of course, carrying inventory right before prices came down because of customs duty. And I know there's an assessment you've given on it. Is that a one-time hit, and is that expected to weigh in on this quarter?
So, yes, it is a one-time hit, Tamanna. So our inventory cycle is typically 5 to 6 months. And that is what we told, that over next 6 months, roughly 500 to 550 crore is the hit which will go through as we liquidate or as we sell this inventory.
You've also guided, Mr. Sonthalia, for higher marketing spends, which makes sense if you want to consistently increase market share. There's more competition coming in. What is the impact on margins you see because of those higher marketing spends?
We are not really in a position to say the adverse impact of the margin at this point of time, because it's very uncertain. But yes, marketing spends are going to go up slightly as the competition in the organized sector is increasing. But the macro or the large trend where the industry is getting organized more and more, and unorganized is coming down, it gives opportunity also for us to improve our market share. So don't see very significant impact, but yes.
What is the market share that you're aiming for? And when you're saying that the share of organized players is growing, what are the kind of trends that you're seeing? Any numbers that you can add to that?
So, we are currently 8%. Our estimate suggests that we are currently 8% of overall jewelry market. And we believe by FY27, we should be close to 10% or slightly above 10%. That's our estimate. Yeah, so, yeah, so that's what I would like to say at this point.
Yeah, and in terms of organized players growing in market share as an industry trend?
For sure. You look at the numbers every year and 1-2 percentage point unorganized is giving in favor of organized.
In terms of all your segments, Mr. Sonthalia, and I'll wrap this up in a couple of minutes, your wearables revenue is slagging a bit. Revenues have fallen despite volume growth. Why do you see that happening, and do you see that persisting?
So we earlier also talked that this seems to be up to festive, the whole inventory glut which has come in the industry of wearable smartwatches will get cleared. It is our expectation in next 1 or 2 quarters, and post Diwali festivities that should get normalized. And we in Titan are trying to kind of slowly and gradually differentiate ourselves on the better price point, better service, better features, etc. But yeah, that's a slightly long-term, 1 to 2 years kind of a story. But in the short term, we believe that this kind of prices coming down should stabilize in next 1 to 2 quarters.
And the next 2 quarters become important, Q2 and Q3, as we move towards Western festive season. What's your outlook there?
We are positive. July has been generally started well. After custom duty, we are seeing a lot of excitement for the customers on the gold jewelry side, particularly, which is good. And more customers are coming back. More wedding days are expected in Q2, Q3, etc. in the second half of the financial year. So overall, we are very, very positive about the Q2 and Q3.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell?
Welcome back. What's happening in Indian markets? What's happening in Indian markets is what's happening across the world. No one has been spared, which is why this nearly 2% hit on the Nifty should be looked at in perspective. For example, trading was suspended briefly on the topics. The Nikkei was down nearly 7%. Kospi had to suspend trading for a brief period before it has come back, but still down over 6%. So the world is hurting. India is also getting impacted by what is happening globally. Now, within Indian markets, I just want to pull up the heat map for you to give you a sense of what is being spared the carnage today relatively. And it's all your defensive plays, your consumption plays. The idea that at the end of the day, we'll pull up the heat map actually, the end of the day, people will be basic consumers. So you've seen a Sun Pharma, results were actually decent on Friday when they came out, and you had an up move there. That's doing okay. HUL, Asian Paints, Nestle, Britannia, Tata Consumer. Look at the only 5 names which are in the green on the Nifty. On the losing side, Autopac has another bad day. This was on Friday as well. It continues in that frame. Autos and metals were worst hit. That theme continues very, very clearly today as well. I just want to pull up the India VIX for a second to give you a sense of what's happening on the volatility index. You know, you are going to have a bit of a tough period. The VIX is up about 17% right now. In terms of sectoral indices, and let's pull up some of those sectoral indices on what's hurting the most. Realty dragged down the highest, and that's because of Phoenix Mills, which is nearly 8-9% down last I checked. So you're seeing a bit of a pain over there. Yeah, nearly 9%. Banks are getting hit a fair bit, not as much as IT stocks. IT stocks are also seeing a big bout of pain. The broader markets is really where the major pain is. I mean, pull up the micro cap index for a second to get a sense of what I've been telling you. The mid cap 150, yes, recovered maybe from the lowest levels of the day, but not a pretty sight. Down about 4% at one point. You're seeing some recovery coming in. I think you can take, if you were looking for a silver lining right now, you can take solace in the part that the sell-off is contained at these levels. I don't know what you think about that, Neeraj. The sell-off is contained at these levels. It's not deepening. You've had now about half an hour plus of trade, and you're not seeing a sell-off deepen. Yes, the cut is there, reflecting what's happening across the world, but that panic has not set in or is not deepening, at least as of now.
Touch wood for now. Let's just hope that this stays this way, simply because the Nasdaq futures are down another 3%, 2.5 to 3%. The good part is that Dow futures are okay. They're just down 300 points, which is about 0.75%. But the Nasdaq futures are trading with some serious downticks, so watch out for that. Before we hit the break door, wrap it up, remember, Tamanna is talking about withstanding pressure, and I think it's a great idea to get in Agam to talk about some of the outliers in this session today. Agam, it's a sea of red. There is some which is doing better.
Right, well, gainers are certainly few and far between, but it is essentially the FMCG pack which is standing out in trade today, and a lot of these counters are in fact advancing and trading in the green. Now, while Britannia is of course reacting to the earnings are in line with street expectations, and there is nothing outstanding as far as Britannia earnings are concerned, but we're still looking at a single-digit revenue growth of around 6%. Perhaps what does stand out for Britannia is the expansion in its operating margins, coming in at around 17.7%, a 50 basis points improvement on a year-on-year basis, and that has had a consequential impact on its net profit, which rose around 11%. Besides Britannia, we have gains in Hindustan Unilever, Marico, which will announce its earnings today, Godrej Consumer Products, Dabur, as well as Tata Consumer Products. So a lot of these frontline FMCG names continue to advance in trade today, and which are bucking the trend as well. The other counter is UPL, Again, it's not advancing substantially, but and while the earnings are also weak year on year as well as quarter on quarter basis, there is some commentary which is positive that comes through as far as UPL is concerned. So firstly, the management has maintained their guidance, revenue growth guidance from 4 to 8%, but they're also suggesting that they are in line when it comes to debt reduction of around $300 to $400 million as well. And among many other factors, the adverse effect of pricing that came through in the first quarter will not be coming through in the subsequent quarters for UPL, is also one of the many other reasons why UPL also trades in the green at the moment.
All right. So, yeah, we're looking at those spots of green in an otherwise sea of red. Thank you for that, Agam. We'll wrap here on India Market Open, but the non-stop coverage on what's happening in the markets continues on NDTV Profit. Up next is Talking Point.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. It's just the perfect day to have our guest on the show today. The case for a chat for Vinay Jaising is multi-pronged. Of course, the rising yen spelling red for any kind of risk-on strategy and leading to a risk-off. Are rate cuts imminent though in the US as the US hiring and the US data is showing signs of a slowdown, and will we see more of that? I'll dwell upon that a bit. And of course, we talk about what's happening to global tech and Indian tech in that period as well, because as we speak, the worst hit index across the world seems to be, after the Japanese markets, the NASDAQ. Vinay Jai Singh joins us on the show to talk about all of this and more. Vinay, great having you as always, but more so today because it's just coincidental that we have you, but I wanted a guest who has a great insight on what happens in the global arena, and by virtue of your previous role and I'm sure your current role as well, I'm guessing you have that. So would love to understand, Vinay, what is causing the flutter according to you? Because this, since Friday, when I'm asking people about whether it's the US data, whether it's the yen carry trade, or whether it's geopolitics, and it could be all of the above, but people are still choosing sides and saying maybe the yen carry trade doesn't have as big of an impact as at least I was making it out to be. I would love to understand your thoughts.
Sure. Thank you so much for the opportunity. It is a perfect storm and a great day to chat up with you as well. Pardon me if I don't do justice because there's no real answer to what you're asking. But let me make an attempt. Did we not know interest rates would be cut this year? The answer is yes. And when the moment of truth comes close by, that's the time when the market corrects. Now, despite knowing the interest rate cut, if I were to go back just 2 to 3 days, Nasdaq was up 14%, CYTD 20% last year, and growing at a CAGR of about 15 to 16% in 5 years. Now, if you keep that in mind and you start seeing how Nasdaq fell by about 2.5%, and even the futures of Nasdaq is down by about 2 to 3%, what you're saying is, despite all that, CYTD, Nasdaq would be up 7 to 8%, even if there's a correction in the future. So, a lot was priced in the market. The market were looking at euphoria, and actually when they realized interest rates are being cut for the reasons, which is there is probably a global slowdown coming up, that is what now investors are grappling with. So stocks or companies which have done very well, where valuations have got frothy, be it Magnificent Seven or otherwise, they are being questioned, and I think that's the right thing. These are healthy corrections because you're cutting interest rates in US because there's a problem, not because you want the economy to grow a lot faster. So I think that's the first point. Going to the second point, what is Japan doing? Japan is raising interest rates. That means the yen, which had got depreciated substantially, there are question marks of what will happen to that future. And it's led to Japan correcting by as much as 17% in the last month. So one of the most preferred markets last year, because you were seeing inflation come up, earnings growth come up. Now, courtesy, interest rates moving up, and question marks of yen versus the other dollar is creating another problem with the Japanese market. So that again is not become a safer haven. So now the question really arises is, which is the best performing market in the world? I'll reach your question on IT, but which is the best performing market in the world? And that leaves you to India, which even after this correction is up 19 to 20%. I'm talking about MSCI, CYTD. So, people are probably looking at a risk off trade as against a risk on trade. Yes, valuations are important, but where do you see relatively good earnings growth and liquidity coming into the picture? That's what people are looking on. As far as IT is concerned, if there is a global slowdown, you're already seeing the interest rates of US, come below, the 10-year rates come below 4%. Less than 6 months ago, they were around 5%. So you've seen a sizable change in the interest rates, which means, yes, interest rates are imminent for the wrong reasons, cuts, and that would lead to probably slow down in the order books for IT. So people who are hopeful that the worst is behind them may be surprised. So we come from that camp actually. We are underweight the IT sector for quite some time. We know the absolute valuations are not extremely bad. They're pretty much where they are. But yet, they're still at COVID levels, post-COVID levels. So we think, pre-COVID levels, my apologies. So we think it's a nice time to be underweight IT as we talk.
Okay. And I'll peel off these layers one by one. But I just want to, viewers, take your attention to a particular set of data points and the reasons. So a lot of you must be thinking, why is it that the markets are so choppy? So key decision, as Vinay said, BOJ's decision to raise interest rates took the yen to the highest levels in a really long time, at least since February or March, if I'm not wrong. The move, of course, triggered the unwinding of the yen carry trade effectively.
people or global investors would borrow in the Japanese markets because the interest rates would be low, invest in other markets, take the cream and revert it back. So as long as interest rates and currency stays low, I'm simplifying this because we would love to get more of Vinay, but I'm just laying it out here. As long as the interest rates and the currency stays low, it's a very good trade to execute. As interest rates move up and currency moves up, it becomes a problem because the rate differential and the currency differential eats into your profits, and I think that is the sign that we're seeing. So we've seen a bit of a global sell-off in the last 48 trading hours. As we speak, the Nasdaq futures are down under the 3%, and investors probably should expect increased market volatility in the near term. The point that I want to ask Vinay Jaisingh though is the next plate, and the next plate says what now brokerages or global think tanks think of what the Fed will do. So Citi expects 125 basis points cut by the end of 2024, JPM about 50 basis points cut, each in September and November, so about 100 basis points. BofA sees rate cuts starting in September versus December earlier. So clearly, there is now a belief that interest rates will start coming down very, very quickly. Now, Vinay Jaisingh, we know that since the COVID days at least, the Fed has been the principal mover of risk assets, particularly equity markets globally, and thereby even in India. If the Fed were to cut starting September and show that aggressive stance, because it's at 5.25 and can afford to, do you think that's a bit of arresting the fall kind of a tool for equity markets globally?
So, yes. So I think if you look at the 10-year chart, it's exactly what you're saying, which is, close to 4%. So 5.25 is already being factored in the bond market of having a cut of as much as 100 to 125 basis points. 3 months to 4 months, we don't need to be as cute as whether, you get 125 in 3 months or 125 basis points in 4 to 5 months. But, I think that will become consensus. Remember, 6 months ago, we were talking about 7 cuts and even more aggressive cuts coming in totality. I think that's behind you. Probably a 6 month forward comment of 4% interest rate in US for 10 years as well as a 4% interest rate for Fed of 4 to 4.25 is a lot more real. Now, when that happens for the first couple of months, my bet is people will realize why that has happened, which is, you're seeing delinquencies and mortgage rates, you're seeing credit cards, payment problems happening from the retail customer. You're seeing capex slow down in US. And when you see all these things getting added up, the market will probably, short-term correct before they realize, guess what, the cost of capital is going down, which is good news for the market. But that, I think, will be 3 to 6 months forward. So 6 months forward, you'll probably see the market a lot more stable to moving up. But in the next 3 months, I see a lot of volatility in the global markets.
Okay, volatility with a downward bias, or could the Fed action help arrest that downward bias? Sorry, I'm asking that question again, but I just want to get it out of the way and get it clearly.
Sure. My bet is it's volatility with a downward bias, just because the market, especially depending on the market you're talking about, just because the market, let's say Nasdaq is still up 10, 11% in like 6 to 7 months. It's had a wonderful run in the last 2 to 3 years. So, that arresting some correction in terms of valuation probably is warranted. So I would tend to believe in the next couple of months, you're a little more conservative on the market than aggressive.
Okay. Vinay, a word on flows. I'm guessing you look at them too very closely. Now, 2 aspects. One, rate cuts in effect should be conducive flows. Plus, we did some analysis that in the budget week, we did this analysis of what kind of gunpowder were the Indian mutual fund industry sitting on. That at least our analysis seemed to suggest about 1 to 1.25 lakh crores. Now, what role would flows play if indeed the markets become choppy or volatile with a downward bias? I heard you say that it depends on the market. So if the global markets are doing this, India may not have downside bias, but it will certainly have volatility as well. So could Indian markets downside be a lot lesser relatively because of the flows aspect?
It's a beautiful question. I had a table made for you. Let me talk about global liquidity before we come to Indian liquidity. If I were to look at peak liquidity or M2, in the market, if I just take China, Eurozone, Japan, and US, that was somewhere close to $92 trillion a couple of months ago, 6-7 months ago. Now it's down by $5 trillion. It's at about $87 trillion. The maximum downflow is actually, the maximum reduction has happened in Japan, followed by $1 trillion in Europe and US. It's very marginal in China. So that also tells you what the reason why I mentioned that, volatility with the downward bias could happen in US. Now in India, it's exactly the other way around. You've got a couple of engines firing. The first engine firing is what you just mentioned. Our estimates, we have Dharmendra, our data analyst, who helps us a lot with looking at this data, and his calculation suggests about 5 to 5.2% is the overall percentage of AUM which the mutual funds have cash on hand, and that's about 1.5 lakh crores. That's a lot because the AUM itself has gone up so substantially. At 1.5 lakh crores, you're talking about 15 months, my apologies, of SIP data coming on a month-on-month basis. So they have a lot of gunpowder. Now, if you look at where this ammo gets normally used, normally the mutual funds are a lot more in the small cap space than the mid cap space and the large cap space. So as far as I'm concerned, the domestic liquidity followed purely by mutual funds. I'm not even talking about retail India, which is also singing, today about 1 to 1.1% of overall GDP comes in from retail India and shares and dividends. So that's another $30 to $35 billion coming on a yearly basis. So I think retail and domestic money, be it through mutual fund or directly, is going to help the market have a cushion wherever there is a fall. So I would tend to believe that, in the shorter term, you may see some corrections, but that's a time wherein domestics will start buying substantially. And then earnings growth, this time the earnings growth results which came out was tepid in my eyes, but the earnings growth will be equal to, what you would expect in terms of absolute market returns in the times to come.
Okay. One more question, and we kind of focus on the macro a bit before we talk about the micro in the other side of the break, Vinay. And that is this, that there was a belief that a China recovery will help base metals, will help anything related to property related demand quite significantly, and might even help exporting sectors like chemicals. Now I wonder if the talk of a global slowdown plus the very choppy China data puts paid to these kind of hopes on metals, on chemicals, some of these global sectors.
So let's break the sectors up into two. But as you rightly put it, if China would have grown, things would have been far more interesting for both the metal sector as well as the chemical sector. But between the two, and again, I'm putting the pricing of the stocks into the picture as well for India, we would be a lot more bullish on the chemical sector because, they've corrected substantially, and the depends on the product you're talking about. The sales realization per ton for a lot of the chemical names are closer to the bottom. You've seen a good rain. You've seen a good, I would say, concerns of El Nino, La Nina, they are behind you. So that should lead to even agri growth as well as chemical growth, courtesy domestic formulations do better in India. So for us, chemicals, we'll have a bias over the metal space, but in the metal space there are some, I would say, interesting names which are not directly metal related. They are more related to recycling, where we are looking at in a very big way. But our bet, because of what's happening in China and the global slowdown, our bet should be more on chemicals because their sales realization, their EBITDA margins are close to the bottom, and you can see upsides coming in on there. And so though the P may look a little higher, when the stock price, when the earnings are so low and they're set to move up, you may actually see in the next year or year and a half much better days for chemicals. So nice time to nibble and buy these names.
Got it. Okay. Well, let's take a break on that note. Maybe we'll probe some of these points further. I did go a bit micro, even though I said that we'll stick to macro, but it was a globally linked piece, so worth it. We take a quick break and come back and talk more with Vinay Jaisingh. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Back with Talking Point in conversation with Vinay Jaisingh. Vinay, so were you sitting on some gunpowder on your portfolios? And if so, would you start deploying it starting today, or are you waiting for a valuation number? I mean, I can only correlate it with the number on the Nifty, so I'll use that as an example. But are you waiting for, say, for example, the Nifty to touch 23,500, 23,000, 24,000, what have you, before you start deploying, or are you selectively already deploying if you are sitting on gunpowder dry?
So, we're sitting on under 3% of cash. We strongly believe, it's our duty to probably buy cash proxies when we want to, because lots of stocks keep on doing well as cash proxies as well. We have just under 3% currently. Having said that, whenever we get cash, including this 3, we are deploying it as we talk. We think there are a reasonable amount of spaces as absolute stocks. Don't look at the indices, but as absolute stocks where you can keep on nibbling and making the position stronger, especially if there are corrections. And that's what we're doing currently.
Okay. Point well noted. So, Vinay, what is it? I mean, the last time that we had spoken, you had spoken about a very interesting set of businesses and sectors where your bets came from. Is it more of the same, continuing where they were, or has this earnings season prompted any changes in sectoral allocations?
So I don't think it's the earnings season or even the budget which has made us make changes, but it's just because of our outperformance and some stocks which have done so much better in capital goods and industrials, whereby what we've done is we've added some, value-added metal names. Though I said, metal as a space would not do very well, but you have some recycling space in metals which are very good ESG stories, which we are looking at, and healthcare and specialty chemicals. We are betting on that as well substantially compared to where the market weightage is. So these two spaces, we are incrementally increasing our overweight position. We will still be very, very overweight capital goods and industrials. Given a chance, we're keeping on still cutting down our IT space, energy space, even financials. We are relatively underweight, though the financial sector had, I would say, not a great result, but not a bad result. But mostly our calls have been taken more so for the medium to long term, where we are seeing where the government is spending money in, where we are seeing, where the company's return on capital employed is substantially higher than its past, and where we are seeing, growth at reasonable valuation. So these are the parameters which we are using when we are buying any of these sectors.
Mm-hmm. Okay. The commentary, Vinay, from some of the rural-focused companies seems to be turning at the margin. Has that enthused you at all?
In the rural front, I would say not just rural, but rural and semi-urban front. What's enthused us in the results, I would say, is the housing companies. There we are seeing, even if you were to look at the budget, There we are seeing, the amount of inflows with the government is putting it in PMAY being substantially higher. So that's where, we are betting a lot. So even in the banking stocks, we're looking more at the housing part. But pure rural play, pure FMCG plays, we are relatively avoiding it. Even when we look at FMCGs, we're looking at some bottlers, which have been doing extremely well, food and drink company, which have been doing extremely well even historically. Adding to that, some ammo and consumption, but that's not rural led. We're looking at just consumption growing just because the reach is increasing of these companies, and then you have, I would say, technology run consumer names which we are looking at, in the food chain. So for us, we are not looking at rural being a big rate of change of earnings for any companies, because if you make the change of earnings from 4% to 7 to 8%, these are cash proxies for us. We are buying growth. For us, if we are buying growth, we prefer looking at companies which have much higher earnings momentum. Case in point, companies like, let's say, Varun, companies like, let's say, Zomato, companies like Trent in the past, wherein the growth is just getting stronger and stronger. Those are the names we keep on studying virtually every day.
So, wonder, Vinay, I was going to ask you about banking, but I'm tempted. We have a minute and a half left. I'm tempted to ask you about Zomato, not as a stock recommendation, but just as what the business is doing.
It's crazy, right? You can buy me coffee sitting in your office just by a pull of a, plug of your hand, and I'll get some good Starbucks coffee sitting out here. So that's one thing it's doing. It's making every restaurant, every room into a restaurant, to keep things better. It's using the telecom concept, I think. What it's doing is it's increasing the ARPUs which an investor is spending by telling them, if you want the products fast, you should start paying us an ARPU, become a gold customer. And technically, what they're doing is they're increasing the ticket of what you're giving them purely for the service they're doing. Plus, they have wonderful tie-ups with the restaurants. So, probably they get supply a little bit faster when their orders go up, and, people are consuming more. So the ARPU of a single investor or single consumer for the products it's having is increasing. So if subscribers grow up, the ARPU per customer goes up, and obviously their margins will go up because, you don't start spending more on costs. So at one end, Zomato is doing really well on its core business, which is, I would say, transmitting food. But then the other end, even Blinkx, they're doing pretty well out there. They're increasing their gamut out there. Earlier it was just, I would say, packaged products. But, I won't be surprised as they're keeping on increasing. They'll become a full-fledged, e-commerce network down below there. So both these together are a perfect engine for Zomato, in the future to start growing aggressively. As it's done in the last couple of quarters. So, 25% plus top line growth, a much higher EBITDA growth, and the path to profitability in 2 years. I think all these are making investors very, very, positive on looking at the company like Zomato.
Got it. Okay. Well, Vinay, I will take your address from our team, and coffee, whether Starbucks or otherwise, is on its way to you today or tomorrow. Thanks so much for joining in today.
Cheers.
That's the view from Vinay Jaisingh, though I must say he lives very close by, so we can have a coffee in person as well. But okay, on that note, just marking that the world markets are not a very happy place. The Asia Pacific basket has corrected quite severely as we speak at the time of the show getting recorded. The US markets and the futures too are trading with a bit of a red, so please keep all of that in mind. But as we wrap up the show, it's pertinent to hear from the largest bank in the country, SBI, which announced its Q1 results, showed a growth. Harsh Seta spoke to Dinesh Khara exclusively about the Q1 slippages when he reassured that they are just temporary aberrations. Listen in.
The point is that this first quarter is always a bit different quarter. And in this particular case also it's likewise. And this 1% kind of a growth is seen in the context of the elevated cost of resources. As I mentioned, that it has gone up by about 45 basis points. So if at all we would have been in a position to maintain the cost of resources at where we were, then perhaps the profit would have looked even better. So that is something which has to be kept in mind. But having said that, I must also mention that even our yield on advances have also improved. And even for that matter, even our yield on investment has also improved. Even yield on investment has improved by almost about 20 basis points in one quarter. And also when it comes to our yield on advances, even that has also witnessed a decent number. Today, our yield on advances is somewhere around 8.86. Yield on investment is at about 7.20. What has happened is that since our loan book is growing, and with that we have to go for the aging provision. That is something which has happened. These are all standard assets, so where the aging provision is one major factor which is seen. Apart from that, we have also seen some little bit of distraction in our retail unsecured loan book, and that was essentially attributed to some delayed credit of salary in various salary package accounts where people had availed the unsecured loan. Out of about 7,900 worth of slippages, 7,900 crore worth of slippages, almost 1,600 crore slippages have already been pulled back. So that's a very clear reflection that it was merely a temporary phenomenon. That's the reason why we have seen higher provisions, and I don't think that it will be a secular trend going forward. Our credit quality is pretty good. As far as our SME is concerned, our NPA, gross NPA is somewhere around 3.5. When it comes to retail, it is when it comes to retail, it is all less than 1, much less than 1. And when it comes to our corporate book also, it is somewhere around 2. So I think these kind of numbers are something which is a reflection of very healthy trend. Incidentally, our PCR also in the corporate book could be somewhere around 93-94%. So there's hardly any challenge. Some bit of a provisioning is done just to ensure that the balance sheet should never get weakened, and that's the kind of a thing. Though the conduct of the account does not warrant the provisioning, but still we have done some provisioning like that also.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about
Benchmarks log worst decline since election results day following weak global cues. Nifty trades below 24,300. Sensex falls below 79,500. Rupee weakened by 7 paise amid unwinding of yen carry trade. The currency opened at a record low against the US dollar. Rising credit costs proved to be a worry for SBI as the lender hits its lowest levels in 2 months after reporting Q1 numbers. And telecom major Bharti Airtel is set to report its June quarter numbers today. Profit is expected to see a double-digit growth, while margins may expand. Hello and welcome. This is the FNO show. I am Agam Vakil, and in this show, I'll take you through all that is happening in the futures and options space. It's a tough Monday. We've seen a considerable weakness as far as Indian benchmarks are concerned, and I'm talking about all the key benchmark indices, largely on account of weak global cues. We've had that impact of worsening cues from Asian indices, which has led to a near 2% cut on the Nifty 50. In the morning, it was, in fact, at one point in time, officially down by as much as 2%. We've seen a little bit of recovery from intraday lows. And besides the Nifty 50, the Bank Nifty is also currently under pressure. We don't have too much to speak for otherwise, but it's down around 2% there as well. Perhaps a little bit more of an underperformance when it comes to the mid-cap and the small-cap indices. The mid-cap index down around 2.4%. The small-cap index is down by just as much, around 2.5% as well. So there's been a lot of weakness, and the advanced decline ratio is not encouraging at all, as one might expect on a day like today. So just look at that wide gulf. We have about nearly, well, one gainer for 2 losers at the moment, and pardon me, one gainer for 10 losers at the moment. And well, perhaps on expected lines too, right? Because we knew that it was going to be that sort of a day. And I reckon that at least the bulls will wait for a little bit of recovery. Is that a possibility today? Well, that's a wait and watch on that one. But for now, of course, we are looking at that weakness. With that, let's also very quickly take a look at how things are faring, in fact, in the futures space. So let's pull up the snapshot there. So a lot of unwinding as far as the Nifty is concerned. And this is we're looking at an August futures declining around 2.8%. Remember that a lot of longs that came through around the mark of 24,000 and 25,000, there in between, those kind of longs are now starting to unwind. Well, besides that, let's also pull up the Bank Nifty as well and see how things are faring there too. And there we are, in fact, looking at more shorts building into the system. Remember that it was a weak day of trade for the Bank Nifty last Friday, and today, looking at a near 2% cut on this particular index, we're now looking at more, well, shorts building in, even as the open interest increases by around 6%. But as we move into trade this week, has there been a big shakeup when it comes to the options market? You know, now 25,000 is completely out of the picture, and we start seeing 24,000 back into the horizon at the moment. And well, 24,000 put, though, it does seem like it has a reasonable amount of open interest at the moment and would likely provide a little bit of support in the near term. It's also that round number which, you know, usually becomes a little bit harder to take off. But on the higher end, we'll now start seeing 24,500, 24,600 and thereabout calls, strikes, which would start to see a little bit more writing coming through on account of the Nifty coming off quite substantially. So these are some of the cues that we will be watching out for. But let's find out what our experts have to say. We have Vinay Rajani of HDFC Securities and Brijesh L of IDBI Cap, who's joining us on the show. Good morning to both of you. Thank you so much for joining in. Vinay, I want to start with Nifty specifically in this case. It has come off substantially. How are you trading this one?
Yeah, so from the all-time high of 25,078, the Nifty has corrected almost 900 points, which is around 3.5% correction. As compared to the global market, we are still outperforming. We are down by just 3.5%, while in Japanese market, we are seeing witness a fall of more than 18 to 20%. So definitely strength is there, but we cannot rule out the global weakness, and that's why today we are witnessing some sharp correction. So if you were to look at the overall setup actually turned weak on Friday itself, because on Friday we witnessed that Nifty closed at near the low, and there was a upward sloping trend line which was broken down on Friday's closing. So that was a first indication. And now the support comes in around the budget days low, which is 24,074. And if you were to take the entire rise which we saw from the 4th June low, which was the election day result, so at that time Nifty hit a low around 21,000, and from that level we have risen to 25,078. So if we take this entire up move, and 23.6% of this retracement of this entire up move comes in at 24,180. Right now, Nifty is trading around that level only, hovering around that level only. So what we advise to our traders is the 24,050 to 24,200 is a very strong base for the Nifty, which can act as a short-term support as of now. Things are definitely getting weak, but this is a strong support, and I think market should give respect to it. So as of now, if you are planning to go short in Nifty, I think one should wait for a intraday pullbacks to come, and then only short position can be taken, because Nifty as of now trading around its crucial support of 24,000 to 24,200 band. So that's what I believe. And Bank Nifty relatively looks weak to me. Stocks like ICICI Bank, Axis Bank are actually getting weak on the charts, and looks like that after intraday pullback they will again resume the downtrend. So as of now, to me, Bank Nifty looks more weaker than Nifty, and definitely intraday pullback should be utilized to exit long position, and fresh short position can be built up at the higher level. So overall bias is negative, but right now Nifty is into a buying zone, or we can say a support zone, from where we can see some pullback. But pullback will sustain or not, it looks like overall setup is quite negative, so market should go down only. So Bank Nifty is looking more weak to me as compared to Nifty.
Okay, well, Nifty at support, but Bank Nifty looking a lot weaker. Brijesh, morning to you as well. Your assessment on these two benchmarks?
Hi, morning. So I think we are now going to follow the global suit. So the pressure, it has been on the Monday start of the morning. So what I believe that this level of 24,000, 24,200 are the immediate support levels. There can be some support the market might find, can be some intraday bounce can be there. But directionally, what I sense, the value of the 50 SMA, which is somewhere to the 23,850 mark. So that is what I'm looking into. So I believe this level will be tested during the week. I would take the long bets only when I see 23,800. So I think I won't be taking any bounce back trade or something like that. I would like to wait. The cooling off will only take after 2 or 3 days. So it will be too early to say whether we should be doing any bottom fishing, or since the market is at the support, do we need to take any buy trades? I think it is better to keep a wait and watch kind of a strategy. And since it is the start of the week, start of the Monday, my sense is just keep quiet, just stay away. 23,800 is something which I think might be seen on the charts. And once we see those levels, then we start reviewing the position. That's for the Nifty. For the Bank Nifty, I think the panic was already there, and Bank Nifty with the overall global event, it has come to the 50,000 level. So from the A-Lake point of view and from the chart perspective, I believe we are coming somewhere close to the support for the Bank Nifty. Already the corrections are there. So let's keep a watch on it. If 50,000 level is taken down, then probably 500 max, that can be close to 49,500, that can be a support. Mainly because the PCR, which is at 0.6, might come somewhere close to 0.5, and that may act as a support. So let's keep a watch on it. We need a day or two to understand how this thing cools off, and at lower level again we can re-enter the long trades.
All right. You know, what's really important, I guess, is also as far as the Bank Nifty is concerned, that it recently made a low on the 26th of July. And at the moment, that low, or at least on the spot, the Bank Nifty spot, was around 50,438 to be precise. And we're about 200 points short of that now. And should we sustain this weakness, and should we actually continue to see this Bank Nifty trade around there, perhaps close below that mark of 50,400. You never know how things could pan out, because it's not been a very long time since we actually saw that low. We saw the Nifty the Bank Nifty recover from that particular mark, and it does seem like at the moment there's been substantial unwinding coming through. So that's the other aspect that we need to watch out for. From the start of a little more than the start of this expiry, we had seen strength return to the Nifty, and in the meantime, we also saw the Nifty actually make a new life high. In fact, going all the way to the mark of 25,000, and now suddenly we find ourselves 800 points shy. But as I was suggesting earlier as well, Vinay has made this point about the Nifty being somewhere close to its support range at the moment. So there could potentially be a divergence as far as trade is concerned. We'll have to wait and watch because it does seem like, around the 25th of July, the Nifty as well made that low of 24,210 to be precise. And currently, we're exactly at that mark. So if we actually do see further weakening in the Nifty, and if we actually see the Nifty close below and prominently below that 24,200 mark, again, I shudder to think as to how things could potentially pan out. But we must also remember that at around 24,200, maybe a couple of weeks ago, when traders had taken position, at least as far as the options are concerned, there is a certain premium that was exchanged as well. So you need to count not just 24,200, but also a rough average of the options premium that could have played a part at that point in time, as far as the Nifty is concerned, beyond which you start seeing a little bit more precipitation on the downward edge. But for now, of course, the Nifty is hanging on. It is trying to defend this particular low, and it is very much at a support at the moment. But along with that, let's take a look at stocks which are on the radar of our experts. Vinay, coming down to you, any stocks that look interesting at the moment?
Yeah, so ICICI Bank looks weak to me. So it is a typical textbook bearish head and shoulder pattern on the daily chart. ICICI Bank has also broken down below its 50 days exponential moving average. So that was another evidence that one should go short in the ICICI Bank. So I see opportunity in ICICI Bank on the short side. So ICICI Bank August future can be shorted around 1173. Stop loss can be kept at 1194, and on the downside, I'm expecting a target of 1148. This is 1 to 2 days view on the short side. On the other side, I see some sort of defensive stocks can outperform and show some resilient move. So Colgate Palmolive is one of the FMCG stock which looks very strong and trading and moving around its all-time high. So that can outperform. So if some pullback comes, stock like Colgate can show some intraday bounce. So Colgate August future can be, one can go long around 3,400. 3350 is a small stop loss I am suggesting for the traders. With a strict stop loss, one can go long in the Colgate Palmolive August future, and target should be 3480. So this is just a 1 to 2 days view. So one on the short side and one on the long side.
Okay, so the Colgate Palmolive, of course, is a very interesting counter because it has seen so much strength, specifically after its earnings. Brijesh, what about stocks on your radar this morning?
Yeah, so basically I have two long trades. One is the BHEL. So my understanding is that during the rollover, the 290 was a very strong base from where the rollover did happen. And now with the current correction, the BHEL is back to the 290 level. So I believe this is a very strong support level. If market finds support at 24,200 or something like that, and there is some amount of bounce, so BHEL can see a good bounce back. So I would like to take a long trade in BHEL with the stop loss of maybe below 290 for the target of 305. This could be again a trading bet. And secondly, the stock which didn't correct in this market was the IPCA Lab. So it's again a trading opportunity. I don't want to take any positional bias. Somebody wants to take that trading move. IPCA Lab can be bought at the current price. The stop for the trade will be 1298 for the target of 1350.
Okay, so those are some trading ideas from our experts. Very quickly, let's take a look at all the stocks which are buzzing in trade on account of increase in open interest, and I'm sure that a lot of them will be towards the short side, at least this morning. So we have Vodafone Idea, which is down. We have a lot of weakness in Samvardhan Motherson. That's actually taking quite a knock off. PI Industries is marginally in the green, but I wouldn't want to, call that or classify that as longs. City Union Bank, Bharat Forge, all of them looking at substantial declines with a substantial increase in open interest. Besides that, let's pull up stocks which are seeing unwinding. So you have Maruti Suzuki, which is seeing unwinding, Cummins India, Titan and MCX. Titan, of course, to a certain extent also reacting to its earnings, which have been mixed, I would say, with respect to expectations. But Britannia, on the other hand, is bucking the trend and looking at a marginal up move there. Well, I guess that this is also one of those days where we have, in fact, seen a lot more strength relatively when it comes to your FMCG companies. So, of course, one of our experts has already spoken about Colgate Palmolive. But, if we can actually take up something like Britannia as well. Now, Brijesh, I come to you on Britannia. how is the stock looking to you on the charts? Is this, pardon me, something which is range bound at the moment, or do you think there's an opportunity to go long or short in Britannia at the moment?
I think the FMCG is the only one space which is now holding up in this entire foreign market. So, as like the Colgate is one bet, and even somebody having a position in Britannia can keep having a long bet, because the trend for the basically Britannia is positive. The structure of the higher to higher bottom structure is intact, and whatever the recovery we are seeing can be a good opportunity to take long. The recent high of 6,005 can be easily taken out. So the bias is pretty much positive, and somebody having a position should hold, and somebody who wants to take the trading bet can also take this opportunity to take the fresh longs.
Okay. The other stock I want to talk about is OFSS, that's Oracle Financial Services, very, very weak this morning. And we've actually see it move from the mark of 11,500 all the way to below the mark of, well, 10,000, currently at 9,900 if I'm not mistaken. Yes, there you have it. Vinay, your view here, do you think that this is perhaps a range at which you can initiate even more shorts? Or could this be a likely play for a bounce back at the moment? What's your assessment here?
Yeah, so if we go by the sector, IT was the sector which closed on a weak note on Friday, and it took the lead on the downside on Friday's session. So it is follow-up selling is also there in the IT stocks. They are underperformed. Still, they are making low. So I am not going against the trend. The trend of the IT index is down. This is one of the IT stock, and this has also fallen in last 3 sessions. And we have also seen some short build-up happening in the stock. Technically, last week's close on the candlestick chart was a bearish engulfing candlestick pattern, which is after the prolonged uptrend. So this is a reversal sign from bullish to bearish. So definitely it is trading around its 50 days EMA support, which is placed around 9880. But still, I feel that the stock has potential to extend the downfall. And because the sector is looking weak, because the weekly pattern is negative on the candlestick chart, so I feel that it should go down. It can extend its falls more. 5 to 6% fall could be there immediately. So right now momentum is there and weakness is there, and because of the sector weakness, I am expecting OFSS to go down further from here. 5 to 7% immediate fall could be there, and those who are trading shorts can have a stop loss of today's high, which is placed around 10,200 odd levels.
Okay, just want to talk about maybe 1 or 2 more erstwhile very strong stocks and to see if there's an opportunity. I want to talk about Bharat Electronics, that's BEL. And today, of course, naturally it's weak in line with the rest of the markets. But, very recently it made an intraday low of somewhere around 281. It hasn't come to that mark just yet. Brijesh, are you seeing a change in trend, and is BEL now turning for the worse? Is there a potential opportunity here to go long or short?
Agam, I believe as long as the BEL doesn't break 280 mark, the structure would remain positive. Definitely with the overall market, it has been down. But there has been a very good buying which we saw lately, over the last 3-4 trading session. Good amount of buying was there. And this correction, as long as this 280 levels are not taken down on a closing basis, I don't believe there would be very sharp corrections. It might take a little bit of time. The value of the 50-day moving average is somewhere close to 305. So as long as this 305 mark is not taken out, I think that it will be more in a range. But then definitely it is near approaching the support zone. So with somebody who wants to take a positional long bet can take this call. Maybe trading bet would not be that much feasible, but positional long bets can be taken with 280 as a stop loss, and the exact trigger will follow when 305 mark will be taken out. Short to medium term, I think the structure is positive and one should take the long trade.
And perhaps one more stock that we can talk about, that is Trent. Trent was also very strong of late. In fact, it went all the way to nearly 5,900 rupees per share. But since then, it has come off in the last 2 to 3 sessions. And it does seem like today it's actually triggering a lot of stop losses here. Vinay, an opportunity to go short on Trent at the moment?
I would say it is not a high beta stock. So definitely because of the market weakness, it could extend its losses. But I think this is not the stock, a momentum stock, a trader's favorite stock if somebody wants to go short. So better to be on a sidelines if we are talking about Trend. There are many opportunities in the capital goods. There are banking stocks, financial stocks, which are looking weak right now. So better to avoid this kind of stock for the shorting because momentum is less in this counter and primary trend has been very bullish. So once market settles down or come up, pullback comes, then this is the stock which can bounce back early. So I would suggest not to go short here. There are high beta sectors and stocks which can be considered for going short.
Okay, there you have it. That's the view on Trent. Well, with that, we take a moment to thank both our experts, Brijesh and Vinay, for joining us and taking us through their views on the markets. Many stocks discussed as well. We also slip into a short break, and on the other side, we continue with all the action on the commodity space. Back in just a bit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Welcome back to the F&O show. Well, we now have Vandana Bhatia of SMC Global Securities who's joining us on the show. Vandana, good morning. Thank you so much for joining in. Well, a lot of tussle when it comes to currencies, specifically in this morning in the markets. Of course, you've had the US jobs data coming in, and let's not forget a lot of unwinding when it comes to the yen carry trade as well. How are you looking at currencies in general at the moment? What's the view here?
Yeah, right now it's very volatile, and we have surrounded with many news like geopolitical tensions, and now many research they are coming with their interest rate cut announcements and all. So among all, I have seen that INR now it is trading above 83.80, and we are expecting that very soon it should touch the level of here 84.10. And if we talk about international market, dollar index is continuously moving down. Earlier it was only 50 basis point cut announcements by the market, but now we are expecting that there should be more than 50 basis point cut in 2024 in US. That's why we have seen that continuously dollar index is moving down. Now we are expecting that 101.75 is a possibility, and that's why we have seen a certain kind of actions in many financial sectors. And of course, unwinding of Japanese yen carry trade is another reason for this volatility. And we have seen a rise in volatility VIX in today's trading session.
So, Vandana, what are you doing with precious metals like gold and silver right now?
Now all funds are taking shelter in this counter, and we have seen that whenever we geopolitical tension rise and some kind of mayhem we see in equity market, then suddenly all funds are flooded in gold and silver. So same scenario is happening here, and on Friday, it has made new historic high of $25-22 on COMEX, and today we are expecting that again we should see a record high in gold prices. So we can expect that the buying should continue in this market. On MCX, we can see some kind of volatility of both sides of move, but basically the trend should be of upside, and I am a buyer in gold. So 70,375 should be the level where one should go for buy. The target is 70,800. Stop loss should be of 70,100, and ultimately we can see the level of 71,000 to 71,200 in gold. And if you talk about silver, silver is again a buy. So 83,325 is a good level for buy. 84,000 should be the target, and we should keep a strict stop loss of here 83,125.
And how are you trading gold, Vandana? Pardon me, crude. The crude is what I meant.
Yeah, because of Middle East tension and certain non-farm payroll weak data, we can see further fall in the crude prices, and $71 to $72 should be the next support for WTI. If we convert it into MCX, it should reflect the level of here 6070. And for today's trading session, one should go for sell near the level of 6170 for the target of 6100 with a stop loss of 6200. If somebody wants to take positional trade, they can go for sell at current market price for the target of 6070 with a stop loss of 6220.
Okay, Vandana, we leave it at that. Thank you so much for joining us and taking us through your views on those commodities and, of course, the currency market, which becomes so very crucial in moments like these. But with that, it's a wrap on the F&O show. Indiabulls Housing Finance is now Samman Capital Limited. They say Jio Samman se. Keep watching NDTV Profit for all your news and stock market updates.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investment.
Hello and welcome. Good morning. You're watching the Small and Mid Cap Show here on NDTV Profit. I am Harsh Saita. With me is Varsha Chandnani. And, let's quickly take stock of where the markets are at. Of course, global markets putting pressure on Indian markets. Global macro also doing that with all that's happening with regard to the yen pair trade. Clearly, our markets under pressure. We're at the low point of the day, 2.5% lower on the Nifty 50. Let's pull up some stocks which are the key contributors in trade today. You have some IT names as well as the heavyweights on the index weighing down the Nifty 50. Something like an HDFC Bank, an RIL, an Infosys, an ICICI Bank really weighing down on indices. In terms of positive contributors, far and few. Some bit of consumer and pharma possibly just about aiding the index, but not much support at all. Let's look at the advanced decline because it seems like a secular red across the board. And there you go, just about 120 advances to 2,000 declines. So clearly in favor of the bears, at least at the moment, in terms of where the markets are at. Let's look at the broader markets because that's where a bulk of the pain is. Let's pull up the Nifty mid cap. That one's down over 3%, nearly 3.5% lower now, slipping and slipping fast. We're at the low point, at or equal to the low point where the Nifty mid cap is concerned. The Nifty small cap, if you can pull that up as well, not looking pretty either. Pretty much very similar trend on the Nifty small cap, 3.7% lower, very close to the day's low now. So it's just worsening as we go forward, and we have to wait and watch as to how this plays out, especially post 1 p.m. today. In terms of sectoral indices, the Nifty Bank, the key drag along with auto, IT, 3.5% down on the Nifty IT, the Nifty Auto 2 down nearly 4%, and you have the Nifty Bank down 2.5%. The Nifty Metal and the Nifty PSU Bank down 4% each. The Nifty Realty, the top loser on indices today with a 4.5% cut. And you're seeing the Nifty Energy Index also down roughly 3.5%. But, it's time, and as always on this show, to bring on two quick managements where we have a chat. We have Sandhya J, who's the Group CFO at Narayan Health, to talk to us about the numbers for Q1 FY25. Welcome on board, ma'am. First off, want to try and understand how Q1 has played out for you and what we can expect from the rest of the year. Margins have gotten slightly better. Do we expect you to operate around this margin range, or can you probably inch higher as the year progresses and as you scale up?
Good morning. Thank you for having me here. So from a performance point of view, I think our revenue performance has come in terms of a steady state performance, if one can say. We're coming off the highs of COVID. I think this is more like a good steady state performance. But what we've also done is consciously taken a balanced approach between cash flow, profitability, and growth in terms of the kind of business that we're picking up. And that's really reflected in our margin journey. The other aspect is that we are not very aggressive on pricing, and therefore our build will always be a little bit of a slow and steady build. So in terms of outlook, I don't want to make any forward-looking statements, but this is a good steady state performance that one can look at on the revenue front. And in the margin front, I think it also varies between quarters. For us, Q1 and Q3 are typically a little bit of a lower quarters, and Q2 and Q4 are higher performing quarters. So the little bit of that upswing will come in Q2 and Q4 because of the seasonality of the business. And also a lot of the effort that we are putting in terms of our quality of revenue, our throughput, our cost optimization initiatives, some of the benefits of that will also flow in our overall performance.
Hi Sandhya, Varsha here. If you see ARPOB growth, so we have seen almost 10% of growth in last few quarters, but this time ARPOB growth was around 6%. Now, is this because of weak quarter in healthcare, and where you are seeing this ARPOB growth going forward?
Sure. So like we've always said, we believe that average revenue per patient is a better measure than ARPOB. Having said that, our average revenue per patient for this quarter, year on year, has grown about 6%. And our ARPOB year on year, if you look at last year, same quarter to this quarter, is about 10%. But the ARPP is a more real reflection of the underlying business traction. Q1 is a little bit of a weaker quarter for the industry itself, and therefore you will see a slight moderation between Q4 to Q1. Also, our price increase, which comes through in January. For many healthcare institutions, it comes in April. So therefore, some of the benefit of the price increase is already baked into the ARPP or ARPOB that you've seen as of Q4. And Q1 being a slightly moderated quarter, so therefore you are seeing that little bit of adjustment in the numbers. In terms of outlook, I think we continue to strive to improve the quality of the revenue and improve the growth, but ours will be slow and steady, like I explained earlier.
Sure, Sandhya. So where does revenue go from here, especially for FY25? And if we can get a more wider lens at this, maybe over the next 2 to 3 years, what are the growth plans and where does revenue therefore go for you?
Sure. So I think this may be the right time to segue into our CapEx journey. And we have invested almost close to 1,000 crores over the past 2 years. And we are looking at another, this year we've guided between 1,600 to 1,700 crores of CapEx. And we are expecting to keep this high CapEx momentum over the next 2 to 3 years. However, most of the CapEx investments which we are making are greenfield in nature. Therefore, we are building new hospitals. So therefore, the next big inflection in revenue that will only come when these facilities come in. Until then, we will try to grow with maximizing our throughput through our existing facilities, and therefore we will continue to show organic, reasonable growth. Over a longer time frame, because we are doing a very heavy CapEx over the next 3 to 4 years, therefore, when we complete that CapEx cycle, I think the next big inflection will come.
How much of bed capacity we are adding through this CapEx?
So it is still work in progress. We have at the moment announced 2 to 3 projects, all adding up to about 1,000 beds, but all greenfield. But that's just the starting of the CapEx cycle. We're going to create more capacity, and as and when we announce these projects, we'll be able to share more details.
All right, thank you so much, Sandhya. We're going to have to cut this short. Markets in a tizzy, but thank you so much for coming in and speaking with us. Markets in a tizzy, we're looking at significant cuts across the board. The Nifty small cap has now slipped 3.5% odd. We continue to see pressure. We're at the day's low where the Nifty 50 is concerned. Can this get accentuated is the question we're going to try to answer through this over the next hour or so. It's an interesting day from a perspective that we're seeing deep gashes in lots and lots of segments. We've now slipped below the 17K where the Nifty small cap 250 is concerned. So we're seeing significant cuts across the board. The Nifty IT, if I can pull that one up, is down now 3.8 odd%. And we're seeing some bit of pressure across the board. There you go. At the lowest point is where the Nifty IT is at. Weak global cues continue to push markets lower. Let's pull up all of, or rather the heat map for the sectoral indices and see which ones are seeing the largest cuts, and it's likely IT, which is seeing that along with realty. Realty, metal, PSU bank, auto and IT are some of the key spaces where we are seeing pressure. Let's pull up the constituents of the Nifty IT. It's pretty much a secular red across the board. Even the breadth of the market is looking extremely weak. There you go. TCS down 3.5%. We're seeing almost a 4.5% cut on both Infi as well as Tech Mahindra. Coforge down nearly 5. L&T Tech and Emphasis. There's no end to some of this pain that we're seeing, not only in any specific sector, but across the market. I have with me Neeraj as well. Neeraj, do you expect this pain to just get worse from here, at least for today?
Anybody's guess, Harsh. I think that's the point that we've been trying to make since the morning, that let's not try and second guess what the extent of the damage could be, simply because at least I feel that I don't think I don't think it's possible for people to know the extent of the damage that could come in from a three-pronged concern that the markets have, right? One is, of course, the US data and the way it is. Two, as much as some of the guests today have said that the yen carry trade unraveling doesn't have as much of an impact, I think if you just look at the past instances when something like this has happened, the impact has been very severe. Sure, Indian markets may not be as badly impacted directly, but the contagion effect of what's happening in the world markets, and I think some of what's happening after the initial stability in the market today is by virtue of what's happening to the US futures. The NASDAQ futures are down, I believe, 3.5%. So there is consistent pain between Friday and Monday in the US markets. There is no surprise that we would fall, and no surprise that we should fall the way we will. Remember, as a market, we are stretched for valuations as well.
Yes.
So that's part one, that the yen carry trade unwind, if not directly, is having an indirect impact on our markets. This is, of course, the Dow futures, but if you look at the NASDAQ futures, those are the ones that are showing the serious pain that exists in that market as well, about 3% for the NASDAQ futures as well. So that's the first part of the equation. And we are maybe a tad bit better than what some of the other Asian markets have. Kospi triggered the lower circuit. Taiwan is down. China is a different kettle of fish because it hasn't corrected only as much, or hasn't gained as much. It can't correct. But I mean, look at those scenes out there in the Asian markets. There's no surprise that we are doing this, and no surprise that the volatility has gone up. By the way, Harsh, just one quick thing, and I know we'll get some phoners out there, but India VIX is doing today what US or CBOE VIX did the whole of last week. 40% uptick in CBOE VIX last week. So kind of we are showing the first signs of that. I don't think it's possible to say that this will end at a particular level or in a particular number of days. It's still unraveling.
So today's fall, Neeraj, and I'm just looking at the graphs. Today's fall virtually brings us to the level at which we were on the 1st of July. So the reversal isn't very, very sharp. Of course, given the kind of way in which we've gone up, but at the same time, there's plenty of pain, especially in the broader markets. Any specific sectors you are looking at in terms of which could play adversely given the current setup and given geopolitics as well, because exports could start to get impacted. That's something we haven't spoken enough about, if at all, given the entire Iran, Israel, US, the build-up that's happening there.
It's such a pertinent point, Harsh, but just that, thankfully, things haven't worsened as much out there. Imagine if you add that bit of element to this cocktail, and then how potent does that become? So that's the other piece to keep an eye out for as well. The thing though, is this, Harsh, that anything which is export oriented, as you said, comes under question. Metals probably come into question in a meaningful way. But I just think that a sell-off of this nature, essentially everything will go down. I mean, sure, when the tide turns and some sectors will emerge stronger than others, but for now, difficult to say that. And which is why I think the point that you made about what will correct more is more important, because if you are from a trading mindset, then you want to keep a keen eye out for that, of not going long on those sectors if you are a buy the dip trader. Or if you are a positional trader, then maybe try and look at that. And therefore, certainly IT, chemicals are withstanding some pressure simply because the cycle is slightly different for them. But IT, metals, etc., certainly out there.
So couple of bright spots, if I can call it, in this market.
FMCG.
One is FMCG, of course. The entire rural play likely. And even at a point when valuations are elevated for FMCG stocks. But if you were to go out and buy something at this point, what would that be? We spoke about banks in the morning, or rather through the morning in India Market Open.
Buy cash, Harsh. No, the real point I'm making is that because you are not a mutual fund, you do not have those performance pressures. You do not have to make sure that you don't sit on cash or can't sit on 15% cash. What's wrong in sitting on 15% of cash? And the good idea might be that let the tide change. Now, you see the tide change. It's okay to buy 5% more expensive, but at least there is a bit of a certainty to this. What's the need? If you have been smart enough that at 25,000 or 24,800 or what have you, whatever the number is, you went out and you liquidated because you heard the commentary that the valuations are expensive. Why be in a rush? Cash will be king in a market scenario like this, because like I said, I don't think anybody knows. We'll try and get the best opinion, but I'm guessing that the best opinion will give their hypothesis that we are a buyer at 24 or 23,500 or 23 as Mihir Vora did today. Because we believe from that level, we are looking at a 1 year, 2 year, 3 year view, and we are fine with taking that bit of pain. If you're a retail trader or an investor, you don't necessarily have performance pressures versus the index. You can sit on cash, you can make merry. Anybody who sat on cash from 25,000 levels is very happy right now. You don't be in a rush to deploy the cash, is all I'm saying. Just one last point, Harsh. The texture of the market today shows that it is not certain that this will change or stabilize after a particular level. Global markets are in a tizzy. There is this risk of geopolitics. No need to rush in.
Understood. You know, one last point I want to try and get your view on, as well as probably throw some perspective on. You'll likely see, at least there's talk of US recession. That's one thing to keep in mind. And therefore, you may want to tilt your portfolio in a certain direction. If at all I am to look at only a US recession standalone, along with possible rate cuts on the anvil, would you go slightly more positive on IT as a sector? Because that one's really beaten today. It's 4% down. Is this that opportunity to possibly look at IT?
Yeah, I mean, horses for courses, Harsh. I think Vinay Jaising today was making the point that while there is jobs peak index, which is higher, etc., and stuff like that, if indeed the US economy itself is going into a bit of a recessionary phase, and if decision making is going to be taken post the November election, which is now running close as well, again, no need to rush into that sector. Let the tidings turn a little bit. You missed the first part of the rally that the IT companies showed post June 1st.
Yes.
Now wait for a bit and bide your time and bet into it. Again, because you're not a mutual fund, you don't necessarily have to get into IT, no benchmark pressures as well. But I mean, selectively, those businesses are great. And as and when the tide turns in the commentary or in the performance, sure. But today, yeah, I mean, you need a brave man to buy into this falling knife, which is Nifty IT, which is down 4.5 now as we speak. Quite a bit of shakeout there.
Yeah, absolutely. And mind you, the last time we saw this fall was immediately post-elections, which is first week of June. Now, just for perspective, the markets, of course, on that day were down, but post that, we've seen a very healthy recovery in markets. So, is this a possible, sell-off just before another rally? Is a question, Neeraj, which is going to confuse me, especially given the kind of move that we saw back in June. And you know, we were talking about how it could lead to a larger sell-off, never came. We just rallied from there. We spoke about how flows have been extremely strong. None of those domestic factors have really changed.
Yeah, the only difference that if you identify the two falls that happened there versus what's happening right now, it's a global concerted fall that is happening right now versus what happened during the elections or otherwise, being a very local event, and the local factors didn't scare too many people and the flows were strong. It'll be very interesting to see the flows this week, by the way. So that's to be kept an eye out for, particularly from the domestic side. Is this the dip that domestic funds are buying? But you know, Harsh, I'm just that in a matter of an hour and a half, from showing that sign of stability and being 1.5%, Sensex is now down 3%.
Yes, exactly. Did you expect that?
No, I mean, I'm saying I don't think anybody can expect anybody be surprised at anything.
Correct.
Simply because the extent of the impact that a yen carry trade unwind, coupled with softer data as well as geopolitics, is not known. It could be short-lived simply because the Fed action is round the corner. And from 2020, a Fed action has been the key trigger, key turning point, what have you. So that is round the corner, but that is only in September. We still have August to deal with.
And we have an RBI MPC as well at the end of this week. So it will be very interesting to watch out, or rather listen into that commentary. But we're just slipping and slipping sharply. We're seeing Nifty IT now down over 4%, closing in on 4.5. PSUs are down. Auto is down over 4 as well. Nifty Energy has now slipped to 4% lower. And metals are down 5%. So across the board, there is a sea of red. There's absolutely no sector which has been spared. FMCG, which had some bit of gains, has now lost all of that. But it's time to slip into a short break. We'll continue to bring you insights. We'll continue to try to break this down further. Where do markets go from here? Stay tuned to NDTV Profit. We'll be back after a very short break. Now, just to close this, Indiabulls Housing Finance is now Samman Capital. Jio Samman se keep watching NDTV Profit. We'll be right back. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term?
Welcome back. You're watching the small and mid cap show. While it's not much of a show left, but let's pull up the Nifty 50 because we're focusing more on markets today. The sell-off has been sharp. We're now over 3% lower. We're at the day's low. And let's pull up the contributories as well, see how that one's playing out, especially among the top ones. The heavyweights are pulling the index lower, and HDFC Reliance contributing roughly over 170 points negative on the Nifty 50 itself. But outside of that, you have 800 points negative among all negative contributors combined. So when you're looking at it in the larger scheme of things, HDFC, RIL not the only ones which are in the red. We're seeing across the board, we're seeing red. Let's pull up the advanced decline because that seems to have thickened. If there was even scope for that. Let's pull that up. And there you go, 2,000 plus stocks in the minus and just about 90 in the advances. Not seen this kind of a breadth, such a weak breadth in that sense in markets. We also have Vishwanath Nair. Of course, I have Neeraj with me even now. Vishy, let me come to you. Just with regard to your views on the yen pair trade, what do you believe are going to be the key impact factors to look out for where this yen pair trade is concerned? Because such a sharp reaction to it, I don't think, at least you and me, when we were speaking about it in the morning, we didn't expect this kind of a sell-off.
Yeah, so on the equity side, you are seeing that sell-off play out. But conversely, on the rupee front, when you're talking about the currency trade, there's really not that bad an impact. Yes, you saw rupee hitting what 83, 82, which is like the lowest ever it has been briefly, and then sort of it pulled back because the RBI did come in and try to protect it. So RBI has been warding off that kind of volatility on the currency front. So that part is more or less resolved. Having said that, what traders are telling us is that just a little while ago, this was back in April and May, when companies were being encouraged to go out and borrow in yen as much as they could, because it just made a lot more financial sense, a lot more interest cost wise. There was a lot of sense, which now traders are saying probably a poor move from that side of the story. So that's where we're at.
Yeah, so well put. Thanks, Vishy. But let's all of us join in this conversation because we'll get a battery of market experts. Start off with a really important one. Pankaj Murarka, CIO of Renaissance Investment Managers, with us on the show. Pankaj, thank you for agreeing to talk to us, but important to have some voices on a day like this. I mean, this is literally a sell-off that not too many people would have anticipated the extent of which. How are you thinking about what's happening to world markets and India within that?
Good afternoon, Neeraj. That is the nature of the beast, Neeraj. This is how equity markets function. We've had a very ferocious rally in Indian equities over the last 15 months. India was an outlier market. And obviously, everyone has been waiting for a correction for a long period of time where people have tried to time a correction around election results, budgets and all of that. And finally, we have one. And the cause for correction as it comes out is global markets. Obviously, the fears globally is one. I think about the data that came out of US is much weaker than what was expected, and as a result, from where globally markets are pricing is just about probably a 1 or 2 rate cuts during this calendar year in US. Now, the base assumption that global markets are pricing in is about 100 basis points of rate cuts in US, starting with 50 basis points in September itself. So I think this is a global shift in that sense. And we've seen last week Bank of Japan finally moved, meaning one of the most extraordinary monetary policy that we've ever seen in the history of central banking has been done by Bank of Japan in the last 12 years since they embarked on quantitative easing. And they finally moved first time raising rates to neutral. All of this is causing dislocation into currency markets and financial markets across the board. And in India, we're seeing the after effects of that. Having said that, that combined with the fact that Indian markets were overextended, we are seeing this pullback. I still think probably this is a storm. We just need to lie low and just let it pass, kind of a thing. Fundamentally, I don't think so anything has changed in India. The good thing is, in the backdrop of financial turbulence globally, India's macroeconomic fundamentals are very stable. A sharp appreciation in yen by about 15% in the last, let's say, 3 weeks or something like that does not or will not have any significant impact on India's macroeconomic fundamentals.
Agree completely.
So I think this is nothing but a correction in equity markets. Valuations to some extent were extended in India, especially there were pockets of market where we had valuations which were rich, and there were pockets of market where there was a lot of fraud. We've seen the kind of retail enthusiasm that exists in the market. So I think it's an unwinding of all of that. I still firmly believe this is nothing but, from India's context, a correction in the bull market. The underlying bull market remains intact.
Okay. So that's the first part. Pankaj, here's the question therefore. You mentioned that you would want to let the storm pass by. In its wake, can the storm take Indian markets much lower than where they are right now? We are currently at 24,000.
I'm of the firm believer that India's bull market remains intact. Bull market corrections by their very nature and definition are one, very sharp and quick. And secondly, in magnitude, they can be anywhere between 10 to 15% on an average in that sense. So if markets peaked out at 25,000 Nifty, let's say last week, then a 10 to 15% correction on the index can't be ruled out, which effectively can take markets closer to 22 or 22,500 or somewhere there, kind of a thing. That can happen. I'm saying despite that correction, we still remain in bull market. This is nothing but a correction in a bull market. There could be pockets of market, especially in small caps and mid caps, or some of the overextended sectors like defense, where there's been a lot of euphoria or enthusiasm and where valuations are rich, which could have a deeper cut. But at the index level, I think probably a bull market correction by its very definition is on an average about 10 to 15%. So something like that can happen in India.
Okay, Pankaj, Harsh also joining in.
10 to 15%, Harsh.
Yes.
That's 22,000 on the Nifty.
Yes. So Pankaj, if that were to happen, what would in your opinion, be the best place to go and buy? Because you continue to believe we are in a bull market. So what would be the right place to go and buy?
Longer term, from a 1 year, 2 year, 3 year, 5 year perspective, I am firmly in the bull camp, and this correction does not change any of those things. If at all, it throws exciting opportunities to buy into. Harsh, I think also the other thing I expect is probably once this correction settles down and we embark onto the next leg of the rally, I think there will be a sectoral rotation in the market. There will be change in leadership. The last 2 years, the leadership was about industrials, capital goods, defense, and PSUs. I think that part of the rally is done because valuations in that sector are extremely rich. Stocks within those sectors are already discounting earnings 2-3 years out. So in that sense, I think there are other pockets of the market which have underperformed and for which the growth outlook remains strong or has changed in that sense. So I like IT. We like IT as a sector. We think IT as a sector has underperformed for the last 2 years, except for some pickup we saw in the sector in the last few months. I think from here on, we remain constructive on IT. So we like IT as a sector. We like healthcare as a sector. India has gone through a cyclical consumption slowdown. Consumption has slowed down because of rural distress, and urban consumption also slowed because probably consumers overbought during the unlocks of COVID. So we see post good monsoon probably we're having this year, we'll see a revival in consumption. So probably I think IT and lastly, I think probably in India also now with all of this, with accelerated rate cuts from Fed, probably towards the end of the year or early part of next year, we'll start seeing rate cuts in India as well. So I think once we have rate cuts coming in financials, which has been a big underperformer over the last 2 years, that will also start participating. So I think there'll be a change in leadership, and we would look to buy stocks within IT, healthcare, financials, and consumers.
Right. Pankaj, this is Vishwanath. You're talking about being constructive on IT. There are murmurs of that US recession making a comeback. Any sort of impact that you're expecting?
So I'm on the firm belief that US will not have a recession. Probably will have a soft landing in US economy. The corporate balance sheets and household balance sheets in US are very strong. And you don't get a recession when you have strong balance sheets across corporates and households. Consumers are not going to pull back on their spending. So I don't see a recession setting in US. And in that context, from whatever we are seeing or I'm hearing and I'm talking to companies, I get a sense that we are seeing early signs of recovery in IT spends globally, and I think it will accelerate going next year because a lot of large companies in US have been holding back their IT spend. So I remain constructive on overall IT spends in US, and in that context, we remain positive on IT.
I have one question, sorry. I mean, what to buy is a great thing to do, but most people are talking about how this undervaluation of the yen is not quite decided as to how undervalued the yen is, and therefore if this upsurge in the Japanese yen continues and this storm in the global markets continues, do you expect that 10-15% correction that you're speaking about in India to be a swift one, or could this get spread out until the Fed moves in September? And I don't know if that also happens and if that changes, but let's assume that's the first port of call of a bullish global move. Do you think that the markets will have a swift move until whatever 23,500, 23 or 22,500, what have you, or could it be a prolonged one?
Well, Neeraj, I think the yen carry trade was a very crowded trade. We saw, meaning in the last 9 months, yen actually moved from 140 to 160 odd, and now we are back to 143. So it was a very crowded trade. When you have a shift in trend in a crowded trade, that is what actually happens, that everyone wants to get out of the door at the first sign of trouble, and you realize that it's not possible for everyone to get out. So some of those trades are very crowded trades globally and very directional trade in that sense, and probably stretched as well. It's difficult to time how all of this plays out, but I think markets looks like globally and in India also, we have a very steep cut in a very short span of time in just 2 or 3 trading sessions. So I think my sense is that we'll have a pullback in this. Markets, meaning the sharp reaction itself shows that everyone is positioned on one side of the trade and everyone wants to just get out, which is not possible, and which is what we are seeing in markets when you see Japanese markets falling by 11-12% in a single day. And obviously, you have a rub-off effect of that on financial markets across the board and in India across the board and in India as well. So I think the reaction has been very sharp. I think there'll be a pullback in the short term before we have another leg of correction. Probably this correction could play out over the next 4 to 6 weeks in that sense. And my sense is that probably markets will make a trough of this correction sometime around mid to end September, which is when you get the final first rate cut and market gets the confirmation that the Fed is really now changed its stance and it's supporting markets in that sense. I think probably that could be a trough of this correction.
Thank you so much, Pankaj, for all of that perspective, for joining us today on call at short notice. Thank you. Really appreciate this one. But with that, it's a wrap on the small and mid-cap show. Stay tuned. We have more action on the other side. We have indices continuing to slip and slip sharply. The metal index is now down 5+%. PSU Bank also down nearly 5%. Stay tuned. Ask Profit will take all the action on the other side of this break.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When?
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit, and my name is Alex Matthew. What a day it has been, and what a start to the trading week. We're seeing the implications, or we're seeing the play out of a global sell-off in risk assets. And we're at very close to the low point of the day for the benchmark Nifty 50. In fact, it is still trading at below 24,000. We've recovered some bit of ground, but it's still sharp gashes across the board. You have the mid-cap index that's trading with cuts of very close to 4%. You have the small-cap index that's trading with cuts of over 4%. And in fact, the market breadth will tell you what a stark picture it is. It is, in fact, just a handful, 200 or so, or in fact, only 80 or so gainers at this juncture. And you have over 2,000 declines right now. In fact, a worse picture than it was even about half an hour, 45 minutes back. And the sectoral picture is even more difficult to look at this juncture. The biggest losers are the metal pack, which is down over 5%. You have the PSU banking index, which is down about 4.8%. Realty is down close to 5%. IT is down 4.5%. The PSE index as a whole is also down over 4%. In fact, you name it. The consumer goods are down about 3% or thereabouts, and if anything, they're performing better than some of the other pockets of the market. Let's bring our experts on board. We've got Samir Dalal of Natwarlal and Sons, and we've got Rajesh Palvia, who's the Senior Vice President, Technical and Derivatives Research at Axis Securities. Gentlemen, it's a tough day to be commenting on the markets right now, but I think the question that a lot of my viewers will have is, where do you duck for cover at this juncture? Rajesh, if you have open positions, what do you suggest to do?
Yeah, good afternoon. So, looking at the sell-off in today's session, we are now almost trading near to 50-day moving average. So, I think 23,800 is now the immediate level where the 50-day moving average is we have for the Nifty. So, if it breaks below 23,800, so I think one should close some of the long position, because below 23,800 there is a possibility that Nifty may continue furthermore sell off towards 23,250. That's the 100-day moving average for the Nifty. Bank Nifty is already slipped below to 50-day moving average, and the way Bank Nifty is witnessing the supply pressure, we believe that and India VIX, that's the fear index, has already moved up. So these all parameters are indicating that possibly Nifty may attempt to give breakdown below 23,800. So I think those who are already sitting in profit in their positions, I think they may trim down some position if you have those position for short-term trading perspective. But for long-term investor, I think again this fall of market is again giving the opportunity. But I think one should wait for this fall to settle down at certain level, then only to deploy a long trade. I don't think today is the day where one should jump and deploy to buy these dips, because it's still a global sell-off is there. There is no reversal at all in any of the indices at the global market as well as in our market. So I think one should wait for Nifty to settle down at certain level. Then yes, again this falling market is giving you opportunity to deploy some of the your capital or investment in quality stocks.
Right, Rajesh. Samir, just a quick view on what you would say about the longer term investments, because I have a confession to make. My SIP is due today, and I haven't put that on pause. I would think that for the long term investor, it's not, of course, it's not something to scoff at. It's not a small cut, it's a large cut. But what would you say to the long term investor?
So honestly, if you ask me, we've been saying this to long-term investors also for a while, that look, this is not the right time to get into the market, for the simple reason that what are the returns you're going to walk away with at the end of 2-year period, right? Because valuations are stretched. So if even earnings catch up with valuations, we've always been of the opinion that your returns are going to be very low teens or even high single-digit kind of returns over a 2-year CAGR returns we're talking of, which is not something exceptional. Now, what you rightfully said, you have an SIP like you. There are tons of people in India who have these SIPs ongoing who are not going to cut them for a one-day fall in the market, which is of this proportion. And because of which the valuations of the market, which are elevated, will continue to remain at elevated levels, because at some fall, let's assume the market falls another 2%, right, from here, these mutual funds, which are sitting on almost 1,40,000 crores of cash, will come in to buy into the stocks that they like and where they feel the relative correction has been good. So they will kind of continue to support the market at these higher levels. However, having said that, this correction was long overdue. We've been saying for a while that the markets are due for a correction. It's been defying all logic, defying all bad news that has come into the system. Now, finally, some amount of rationalization, but how short-lived this is going to be, I think it could be short-lived. I think you will see maybe another 2-3%, and then you'll see the markets bouncing back with the kind of money flow that is there in India.
Yeah, absolutely. Fair point. And the point that you were making of over 1 lakh crore sitting on the sidelines, just with the mutual funds, in fact, and that will be deployed as and when it's required. Let's kickstart the query segment, and quite a few of you have written in. By the way, that number that you see on your screen, if you're tuning in for the first time, that's where you send your questions. And if you've got specific questions about why this event is taking place or why the selling is taking place, don't hesitate to ask. The first question we're taking is from Vinod. He's writing in from Chennai and he's asking about 5 stocks. I will list those stocks. Samir, anything that catches your ear, perhaps you can talk about Morpen Laboratories, Jamna Auto, Balmer Lorry, ONGC and Hudco. Which of these stand out today and which of these would you buy based on the fundamentals?
So if you ask me which I would buy today, I would probably consider ONGC. I'll tell you why I'm looking at ONGC. There is a lot of talk about Iran attacking Israel, and this is probably going to happen soon. In fact, you had the US Defense Secretary saying that, look, it could happen as soon as one day. Now, if something like that happens, what you're going to see is oil prices spiking up. And that is a beneficial for ONGC. Of course, the government will take it away in some sort of way by increasing their, what is that little tax? I forget the name of the tax they call it, but they'll increase the tax on crude prices. So ONGC won't get the benefit. But at least some amount of the benefit of increased crude prices could come to ONGC. We believe the Middle East crisis is not totally over. It can escalate. So that would be one of the reasons I look at ONGC. Strong business model, strong cash flows at the end of the day. So the others, I don't cover that much. Those many of them, so I don't have only one.
Yeah, that's a fair point. All right. Let's run through quite a few of the questions coming through right now. So let's take as many of them as possible. The next one's on Rajesh Exports, and this one's for you, Rajesh. We've got Gilson, who's bought at levels of 306, and he's looking for an outlook over the next 18 months. He's bought at an average price of 1,306, or okay. I'm not sure about the price. In fact, I should pull up the chart and see where it's currently trading. It's 306, not 1,306. There was a mistake in that plate. He's bought at 306, and he's wondering what to do. Rajesh, what's the view?
So stock is now, shown, breakdown below 20-day moving average, and now stock is trading at 50-day moving average, which is placed at around 294. If any breakdowns happens below 294, then there could be further more supply pressure we can see towards 285. Anyhow, stock is in downtrend. Stock is moving in falling channel on a daily as well as on the monthly chart. So we believe that any pullback should be used as an exit opportunity in the stock. The major supply zone for the stock on the higher side is placed at around 330 level. So I think if you get any opportunity in some pullback towards your cost, or so you should try to exit in the stock, as overall structure for Rajesh Export is on the bearish side.
It's not too far away from the buy price, so perhaps now is a good opportunity. Rajesh Maheshwari is writing in from Indore. He's asking about Global Spirit, and he's got 200 shares, which he's bought at an average price of 1,242. What's a short to medium term outlook on this stock? Is it advisable to remain invested, or should you sell? I will come to you on this one, Samir, because generally you say that a spirit company is not something that will be affected by global factors. At least I would think not, right? At least the fundamentals should not be. If anything, it might actually see higher sales based on people, trying to drink their sorrows away. What would you say about that? And would you say that you should hold on?
Absolutely, there is some amount of resilience when it comes to companies like this. Global Spirits, unfortunately, is not in my coverage, but we are saying that the business that they are into is quite positive. UPL and United Spirits are two companies that we do cover. Where we find valuations a bit extended. So even though we like the long-term prospects of the business, we are saying that this is not the time to get in. And we've actually, if you're holding, you can continue to hold, but it's difficult to say that valuation re-ratings are possible and growth is going to ensure that these stocks continue to move up. Global Spirits, no actual coverage, so I can't really comment.
Fair point. All right. Brigu's got this next question. He's holding ITC at levels of 500. Let's pull up the chart and see where it's currently trading. It is at 487 despite, it's actually holding on with cuts that are far lower than what you're seeing across the board. And he's got a 2 to 3 week view. He's got a leveraged position. He's asking whether he should book a loss or should he hold out for a few weeks. Rajesh, dangerous to have leveraged positions in this market. What would you say? What advice would you give?
Yeah, in this kind of market, yes, it's very difficult to hold the leverage position because the way market is falling. I think ITC is also under pressure because of market volatility, but still the stock is holding about 20-day moving average. So I would suggest here to keep a strict stop loss of 480, 478. This is the two level where he should keep as a stop loss. Because if it breaks below 478, then furthermore sell-off would be there, then 460 would be the next level for the ITC. But at this juncture, I think still stock is trying to hold out above 20-day moving average. So I think he may hold the position with stop loss of 470.
Coming back to you on IREDA, and this is a question coming from Sandeep Khatare. He's wondering whether this is the right time to buy with 5% down. And maybe we can pull up the slightly longer term charts over the last month or so. This is, of course, a stock that has run up quite a bit. The 12 months, it's still up quite considerably. The last month, it has still gained about 5% despite the fall today. Would you suggest a fresh entry for the next 6 months, Rajesh?
So I think the way stock has corrected from its recent swing high, I think IREDA again, if it comes near to 220, then I think he may needs to average out certain more position, because it's a very important and major support area for this decline. So IREDA
Clarify that, Rajesh. Let me clarify that. What he's saying is that he hasn't yet bought. If he hasn't bought, would you suggest a fresh entry?
So I think wait for 225 to 220 zone, where again stock is having good support area. He can add positions around those level, which is important, and risk to reward would be in favor for IREDA around 225 level. At that time, he can keep a stop loss of 215. On the higher side, 250 is the resistance zone. If it crosses those level, then yes, there could be a possibility of rally towards 270, 75 also.
And I think everybody tuning in will have seen Samir shaking his head quite noticeably when I asked whether it can be bought at the current juncture, and that kind of answers the question on the fundamental side as well. Tata Steel is the next question. Samir, unfortunately, we're getting a lot of short-term questions. I will come to you on a fundamental one soon, but Tata Steel for the short term, bought at levels of, or rather, we don't have a buy price. Sarvesaran is asking whether or not is the right time to buy at this juncture for the short term, at least for this week. What would you say, Rajesh? Very short-term view.
So Tata Steel, most of the metal stocks are, hammered in today's sell-off. I think Tata Steel is also now on a verge of giving breakdown to its previous swing low of June 2024. So I think if it slips below to 148, there could be a possibility of furthermore go downside towards 139 or 138 level. So that would be the next level for Tata Steel on the downside, but still on the higher side, 160 is the supply zone as of now. So until the stock not crosses 160, it may remain under pressure, and possible downside we can see towards 138 for Tata Steel.
Okay. Poshak Limited is the next counter, and Samir, I'm hopeful that you have a view on this one, because we've got Vinay from I don't know where, but Vinay is asking about this. He's bought at 6,000 levels. It's currently at 5,725. Should he hold on?
Sorry, these are companies we don't cover.
Okay, that's a fair point. It is not a very large company. It's got a market share of just about 1,750 crore rupees. Rajesh, any view on the charts?
I'm sorry.
Not enough data. Okay, fair point. All right, that's all right. We have to try and get views on this. Viewers, understandably, very small companies, it's a little difficult to get you a view. Patel Engineering is the next one. Shahul is holding at levels of 62. Samir, view on this one?
I think one can continue to hold it. The engineering space, the construction and engineering space is going to continue to do well over the next few years, given the fact that we're going to see a lot of capex coming through. They cater to that kind of a business model as well. So when the order flows continue to trickle through and we see the execution continuing to see an uptick, we will see the profitability increasing, which will probably run up the stock a little further. No doubt it's moved up over the historical levels. But remember one thing, this is a cyclical business. So maybe a year and a half down, once the positivity of the order book is all factored in, then one should take money off the table, because, we've seen that historically, whenever these cyclical stocks move up because of strong order book and things, eventually they start coming down.
Yeah, okay. This is a question from Roshni, and she's bought Reliance Futures at 3,200. Stock is currently at 2,886. I'm assuming she's talking about the August future. Rajesh, what advice would you give her?
It's a way below to the stop loss level because in futures, so always one should keep a stop loss. 3,200 is very far from the current market price. So already stop loss, she should be adopt around the 3,100, but now she's already in loss. My advice would be try to exit if you get any pullback towards 3,000 mark. But again, it looks very difficult looking at the market condition because stock is now slipped below to 20-day, 50-day moving average. And looking at the structure, it's now penetrating to its multiple support zone area, which is placed at around 2880. If it slips below to 2880, then further more supply we can see towards 2800 level also. So I think either they can add some put position to at least to hedge this downside. Try to buy at the money put option to hedge at least to protect this downside, which is visible on the chart at this level.
Yeah, quite considerable. A persistent system, Samir, we're trying to fit in a couple more. We've got Mahesh, who's holding 3,500 that he's bought at levels of, I'm not very sure about the buy price. He says it's 500, but I haven't looked at the long-term charts to see when he's bought this. He's looking at a 2 to 3 year time frame. Would you suggest holding on to this?
Given the kind of purchase price that he has, I think he can continue to hold on. Look, I'm expecting the IT industry to go through a bit of a consolidation because honestly, if you ask me, yes, it consolidated, but you've also seen a bit of a run-up far ahead of what the fundamentals should justify because I don't think there's a very clear picture that is coming out from the international markets that the spending on IT is going to see a big major uptick. Companies are still guiding from 3 to 5%. In fact, Persistent has been one of the outperformers, if you ask me, when it comes to the top line growth and the profitability growth. Hence, you've seen a massive re-rating and it's trading at valuations which are similar to the larger caps, if not a little higher than some of them.
Okay,
so I think that there could be a possibility it consolidates, but if since your purchase price is 500, ride the wave over the next 2 years. I think there's more money to be.
Okay. Unfortunately, we are completely out of time. Samir, Rajesh, thanks so much for taking the time. Viewers, I know you have a lot of questions and we will be back tomorrow at 11:30. Of course, we have live market coverage through the day and that continues at 12 today. But lots to talk about, of course. And do stay tuned, keep your questions ready and send them to us. We'll take them tomorrow at 11:30. Do stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy?
welcome. You're watching Market IQ. I'm Mahima Vachrajani. Well, before we move on to what we have on the show today, we're going to talk about the IPOs this week. Let's take a quick look at what the markets are doing. Well, it's an extremely choppy day for the markets. Nifty and Sensex have plunged nearly 3% after the kind of global sell-off that has taken place. Even if we see the global indices, the Nikkei is nearly down 13%, but let's take a look at what Nifty is doing. Nifty is down nearly 3% now as we speak, down 720 odd points. Let's also pull up the Sensex. Sensex is also down nearly 3% as we speak, and it's down around 2,400 odd points. But let's also see what the broader markets are doing, because the pain is worse in the broader markets. The Nifty mid cap 150 is down around 3.7%. The small cap 250 is down nearly 4% now. Let's also quickly pull up the Nifty contributors. Well, in terms of what is weighing down the Nifty at present, it's Reliance 87 points, HDFC Bank 80 points, Infosys, ICICI Bank. It's all the FMCG names that are nearly doing well, which is HUL, Tata Consumer, Britannia and Nestle. Let's also quickly pull up the sectors. All sectors as we speak are trading in red right now. The highest hit has been taken by Nifty Metal, Nifty PSU Bank, Nifty Realty, Nifty IT, Nifty Media, all down 4%. All of these sectors. Let's also quickly pull up what's doing bad in the Nifty Metals, constituents of Nifty Metals. What are the worst performers on the Nifty Metal? There you go, all in red. SAIL down 6%, Nalco down 6%, Hindustan Zinc down 5.8%. Let's also quickly pull up the breadth of the market. Of course, the breadth of the market is skewed towards the seller today, but let's see what the chart looks like. Oh my God, there you go. There are 20,000 odd declines versus just 106 odd advances. But let's put the spotlight on India's primary markets, which will remain buzzing this week with the opening of two IPOs, Brainbees Solutions and Unicommerce eSolutions, and two IPOs already open for subscription, that is Ola Electric and Seagull India. And also, we have three new listings of Acom Drugs and Pharmaceuticals, Seagull India and Ola Electric. To take this forward, we will be joined by Gaurang Shah of Geojit Financial Services and Sunny Agrawal. But before I come to both of you gentlemen, I'll quickly move to Mihika and to take this up through the list of IPOs on our watch list.
Yes, so up first is Brainbees Solutions, which is the parent firm of online e-commerce platform FirstCry. Now, the total issue of over 4,190 crores. It has set a price band between 440 to 465 rupees per share, and the initial public offering will open on August 6, which is tomorrow. Then second is Unicommerce eSolutions, which manages commerce operations for brands, sellers, and logistic providers. It will open for subscription tomorrow as well, that is August 6, with a price band of 102 to 108 rupees per share, and it has a total issue size of 277 crores. And also the much awaited IPO of Ola Electric has already opened on Friday and was subscribed 35% on day one. As of today, on day two, the total subscription was over 62% or 0.62 times. We also have Seagull India, which was subscribed 1.23 times on day two, and today's IPO has subscription has done better at 2.18 times. And lastly, the three main board IPOs that you need to watch out for that will debut on national bourses this week. Up first, we have Acom Drugs and Pharmaceuticals, Seagull India, and Ola Electric.
Right. Mika, thank you so much for giving us those information and summarizing the IPOs this week. Gaurang, I'll come to you first. Gaurang is the head investment strategist at Geojit Financial Services. Gaurang, my first question to you is on Brainbees Solutions. What are your views overall on this IPO? Because I want to understand that how their revenues have increased 5% year on year. However, they're still running into losses of roughly 320 odd crores. So what is your overall view on the entire IPO that is coming out?
Thank you and good noon to all of you all. Not a direct recommendation since we've not covered this particular company, but whenever a company goes and hits the street and if the company is carrying losses or the company is very close to break even, the interest amongst the retail investors tends to be a little bit lackluster. primarily because large part of our investor base has got used to looking at listing gains rather than looking at the growth story of the company. So I think the management will have to possibly do a lot more than what they've done in terms of turning around the company's profitability and bringing it in the positive side. In terms of opportunities, well, the company is placed well to take advantage of the opportunity, but at the same time, they need to do something extraordinary in terms of getting retail investors investing in their company from a long-term point of view.
Right, absolutely. We are also joined by Sunny Agrawal, who is the head of fundamental equity research at SBI Cap Securities. Sunny, I want to understand that, margins for retailers are usually higher. But in this case, since the company is in losses, the margins have not expanded at all. So I want to understand that what is the kind of performance that you're expecting from Brainbees in FY25 overall? Do you see some kind of turnaround story here?
Yeah, good afternoon and thanks for having me on the show. I think looking at FY24 number, it seems that company has already turned around on FY24 numbers. And it is to be seen whether this performance will continue. Ultimately, what I believe is that in case the sales growth momentum continues in FY25, then operating leverage may kick in and that may lead to the expansion in EBITDA margin. But again, we need to see how things will pan out over the next 3 to 4 quarters in terms of sales momentum and profitability. There is no doubt that there is a huge opportunity both online as well as offline in the kids as a segment. Industry is growing at a decent pace. At the same time, looking at a general psychology, I think today parents are willing to go extra mile to spend on educational content as well as on various clothing, apparels and various toys as far as kids are concerned. So I think very interesting category. However, when it comes to businesses, I think ultimately it is the profit which drives the valuation, and Street will keenly watch for signs of profitability, and any commitment on long-term improvement in EBITDA margin will definitely interest a lot of institutional investors also.
Right. And Sunny, from an investor point of view, from a viewer point of view, who do you think should subscribe for this IPO? Should it be a long-term play, or do you think, a person can subscribe for this IPO and then exit, on the listing day, take the premiums and just exit? What do you think?
I think listing gain is something which I don't believe FirstCry will have, especially in today's scenario where we have seen a significant collapse in equity market globally. So I think somebody who is really a long-term investor, when I say long-term, at least having a vision of 2 to 3 years, can invest one tranche through this IPO route and then track the company's performance and then gradually add on to the position once the company is delivering on the committed numbers.
Right. And Gaurang, coming to you, what do you think about the valuations of the company, and how would you, as an investor, play with this IPO?
Well, honestly, when you have a situation with the bottom line, that company getting listed at a premium, I think that chances is far, far low. And of course, I'm not equipped to comment from the listing gains point of view. But I would say that instead of rushing into it, just wait out for the opportunities that lie ahead of the company to play out. Let the management do something more than what they are doing in terms of profitability, and possibly then take a call.
Now I'll shift focus to the Unicommerce E-Solution Limited IPO. It's basically a SaaS platform providing e-commerce solutions to brands and sellers. It's an IPO of roughly 277 odd crores. Sunny, I'll first come to you. Your views on the IPO, since the profits have doubled as compared to FY23, and margins have also increased by more than 600 odd points. So, what do you think about the IPO overall, and whether one should subscribe for it or not?
Again, one should subscribe only for a long-term gain rather than looking at a listing gain. Despite of a very robust performance where we have seen revenue doubling from 59 crore to close to 104 crore, profit increasing from 6 crore to 13 crore. I think the IPO is the price that close to 49 times FY24 price to earning multiple. Although return ratios continue to remain healthy, close to 20-25%. I think a good, solid business, but I think everything is in price. So if somebody is a really long-term investor, can definitely look at an IPO. I think listing in is something which I don't expect in the current scenario.
Got it. And, Gaurang, what do you think about this IPO? Should one subscribe it from a long-term perspective?
So it's a new technology-oriented kind of a company, and the overall size is somewhere close to about 276 crores. Valuation in terms of the band that they are offering looks to be a little bit attractive. Again, we've not covered Unicommerce IPO, so we don't have a coverage. But in a market condition that we are in, I think investors need to look at the growth story of the company and a little bit of longest time horizon. No doubt there are plenty of opportunities for the company to kind of encash upon, but that will only be visible to us in terms of numbers. So in terms of e-commerce embedded services and the software services platform, as we go forward, there will be multiple opportunities. But how much the capability of the company is to translate that into numbers in terms of top line and profitability, that remains to be seen.
Got it. And Sunny, what about you? Do the current valuations look attractive to you?
For Unicommerce?
Yes.
No, I think it's fairly valued, coming at close to 49 times FY24 price to earning multiple. So I think it's fairly valued. I mean, even if I assume that profit will double in the next 2-3 years, it is trading close to 24 times 2-year forward price to earning multiple, which is in line with other small size IT product companies, whether it is Salya Kale, or although there is no like-to-like peer comparison available in the market. But there are many product-based companies which are listed, case in point Biotech or Salya Kale solution, which are catering to a niche industry. I think if I take that into account, it is fairly valued at the current juncture.
Got it. So from both of your point of view, valuations are fairly valued right now for Unicommerce e-solutions. Gentlemen, I'll come back to you. But before we slip into a short break, we spoke to the management of Brainbees Solutions, also known as FirstCry, and Unicommerce Solutions about the outlook and the IPO expectations. Listen in.
Just as a backdrop, I would say FirstCry was started in 2010. Late 2010, and we are the largest shopping destination for mothers, babies, and kids in the country. We operate, in all three demand pockets where young parents or young mothers buy from, which is online, which is 75%. I'm talking about India multi-channel, which is 75% of our GMV. We operate also 1,000 plus stores. And which gives us almost close to 25-26% of our GMV. And then we recently forayed into taking our home brands to pharmacy and grocery stores as well, where that's a third demand pocket. Having said that, our business model is essentially we are the largest shopping destination for mothers, baby, and kids. But over a period of time, we have also built a very curated and widest assortment of 1.65 million SKUs across 7,500 brands and a growing range of home brands as well that we have been able to build out. Within that home brand, we have Baby Hug, which has also become today India's largest multi-category mothers, baby, and kids product brand by GMV. And as a matter of pride, Baby Hug has also become the largest product assortment brand in Asia Pacific, excluding China. And with that, with such a massive framework of SKUs, brands, home brands, shopping destination of 1,000 stores online, and grocery and pharmacy stores. We also run India's have largest parenting channel on YouTube, plus our entire parenting community where young mothers come and build a relationship with us right from the time she conceives a child, during the pregnancy, post-pregnancy, up to a certain age of the child. And all that relationship is being built through the pediatricians, gynecologists, and all of that help. All kinds of trackers that she needs. And that relationship transforms into a shopping relationships over a period of time. So we give a kind of a new age economy, a 360-degree retail framework to build a relationship with young moms and young fathers. So that's the business model that we have been able to establish and built our several modes around, expanding the frameworks around online, offline, and supply chain, investing in brands and technology, and so on and so forth. So that's broadly the essence of our business model that we have been able to establish over the last 13 years.
So essentially, we in the e-commerce value chain, as a consumer, when you're ordering, you see the interface on which you're placing your order, and you see the delivery boy that's getting the item to your doorstep. Whatever happens in between, we are powering that entire journey. We are this invisible force behind the entire e-commerce backend to make sure that everything happens seamlessly, right from the time the order is placed till the time the item is delivered. We are the largest player in this transaction processing layer, which is this invisible backend that I was referring to. We have, in terms of our business model, we are charging our clients basis the number of transactions that they process on the platform. So as the number of transactions grow in the country and on our platform, the revenue continues to increase. We serve a very diversified base of very marquee clients, both in India and international markets. We serve digital first brands, the likes of Mamaearth, Lenskart. We serve offline first brands, the likes of TCNS, Paragon, and also marketplaces such as PharmEasy and logistics players such as ExpressB. So we have a fairly diversified base of clients and catering to multiple categories as well as varying scale. The platform is flexible to work with a large enterprise which may be processing millions of orders to a small SME which is processing only a few hundred orders a month. The platform has also been around for more than a decade, so we have built a very comprehensive product suite to be able to cater to wide variety of use cases and is deeply integrated into the technology stack of a seller. That's why we have very long-term relationships with this customer base and gives us the ability to further cross-sell other offerings. So we continue to be a backbone for the entire e-commerce, and we are ensuring that we are shielding the entire complexity for the brand. Our motto is to simplify e-commerce selling, and that's what our platform does to enable or free up the brand to focus on their brand and their customers, and the entire complexity behind the backend is taken care of by this solution.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Welcome back. You're watching Hot Money. Well, in this edition of Hot Money, we are talking about all the IPOs that are getting listed and that are getting open this week. The most awaited Ola Electric IPO did open on Friday, and so far the IPO has been subscribed for roughly 45%. But you know, if we take a look, it's a fresh issue of 5,600. The total IPO size is 6,145, and the price band is 72 to 76 per share. You know, Sunny, I'll come to you first. How do you see the valuations for Ola Electric? Because you know the street consensus is that overall the stock, the IPO is overvalued. I think you're on mute, Sunny.
Yeah. First of all, disclaimer, so our parent company FDI Securities is a merchant banker to the Ola Electric, and hence I won't be able to share any view on the IPO. Yes, on valuation front, compared to other listed incumbent players like Hero MotoCorp, TVS Motor, where we have seen a substantial chunk of the business also coming from two-wheeler electric portfolio. Compared to that, yes, definitely valuations are slightly expensive as far as Ola Electric is concerned.
Got it. Gaurang, you know, the street consensus is that, you know, the current loss of roughly 1,500 crore is a bit disappointing. But do you think that Ola Electric also has a turnaround story just like Zomato has one?
Well, I hope so, to be very honest. So I think, you know, it's like quite comparison. Brainbees was also in not so good condition in terms of profitability, and Ola Electric has got somewhere close to about 1,500 crore losses. Can't compare. Let me give you a disclosure since you put this question to me. Zomato, when the IPO had come, I think it was at 76, if I'm not mistaken. I stand to be corrected if I'm wrong. We had initiated a coverage from a long-term point of view for the IPO. Stock rallied to about 140, 150. Then it slipped because the numbers were not encouraging, and it actually slipped below the IPO price, somewhere close to about 50 or 60 odd rupees. That is Zomato. And then on fallback of earnings and the recent numbers that Zomato reported, I think Blinkit share to the profitability is only going to go forward from here on. So on Zomato, we are also maintaining a positive coverage. But I mean, honestly, I don't think we can compare both of them. One is a e-commerce, food and provisioning delivery company, Zomato, and the other one is into E2W, that is electric two-wheelers. So somewhere close to about 35% market share, or a little bit above that, Ola Electric. They are going to launch almost about 3 or 4 variants of electric motorcycle. Curtains are going to be up on 15th of August for the first one. And in terms of their cell factory, electric vehicle battery factory, they are quite optimistic about the commentary in terms of having an in-house inbuilt battery, which will actually bring down the cost of the vehicle. The problem is with the durability of the vehicle. There have been a lot of cases that you and me have heard in terms of, Ola electric scooter turning into a fireball. I think for customers' satisfaction, you need to address those kind of issues. So a disclosure from a long-term point of view, that is 1.5, 2 year plus kind of horizon. We have come out with an IPO note giving a subscribe recommendation to Ola Electric. And I hope the management is able to turn around the company sooner rather than later.
Got it. You know, the next IPO, which is the third day of its opening, is Seagull India Limited, and the price band is roughly 380 to 401, and it's a total issue size of 1,252 odd crores. So, Sunny, I'll come to you first. For this particular IPO, you know, the order book to bill is higher as compared to others, which is a plus point. Plus, the revenue and the net profit growth also as compared to FY23 has been significant. So, how do you see this IPO panning out to be?
One of the fastest growing EPC company. However, a few negative points which I would like to highlight are basically, if you see the last 3 years, we have seen a consistently negative operating cash flow. At the same time, in terms of geographical concentration, Punjab, UP, and Jammu and Kashmir account for 87% of FY24 revenue. So it's quite concentrated in terms of geographical exposure. So I think at the same time, debt levels are on a higher side, which we believe will reduce substantially post this IPO money. So I think it's a slightly high risk, high return kind of investment bet, especially looking at a negative operating cash flow during the last few years. So somebody who's looking for a long-term, slightly higher risk, high return kind of IPO application, I think Seagull India is for them.
Got it. And Gaurang, your views on the IPO, because, like Sunny mentioned, the net debt to EBITDA is slightly higher than the peers. Two-part question, how do valuations look to you, and should, one subscribe for the IPO on the final day or not?
So, prudent to give a disclosure, we have given a subscribe recommendation to this IPO, and valuation, I think possibly if the management is able to do well going forward, then there should be justification from a long-term point of view. But again, Seagull, if you're asking me from a listing gains, etc., I'm not qualified to comment on that. But from a long-term point of view, we do believe that this may turn out to be a good investment story.
Okay, well, Gaurang, one last question before I let you go. Acom is listing this week, and I want to understand that what is the kind of street expectations for this IPO?
Well, street expectation is multiples, isn't it? Whereas the reality is something totally different. But yeah, I mean, I hope, again, we've given a disclosure, we have given a subscribe to Acom's IPO from a long-term point of view. There could be selling pressure in terms of those investors who are looking at listing gains. So, and for all those investors who have gotten from a long-term point of view, I think I would say that don't get disheartened in case if there is selling pressure on listing. Again, not qualified or to comment on the listings gains, but I guess there should be value justified for long-term investors.
Got it. So there should be value justified for the investors. That makes absolute sense. Well, thank you so much, gentlemen, for coming to NDTV Profit on such short notice. But with that, that's all we have on the show. Stay tuned to NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Good morning and welcome to Earnings Edge right here at NDTV Profit. We're now in conversation with Mr. Kathuria, President of JK Tyres, on the back of the strong Q1 earnings. Good morning, sir, and thank you so much for joining us today. I just wanted to start off with, this particular quarter. Now, we've seen revenue degrow by roughly around a couple of percentage points, but the story has continued from Q4, which is of strong EBITDA as well as strong profitability in this particular quarter. Talk us through what has been, the trends in this particular quarter. We've seen some price hike also, if you could quantify in this particular quarter as well. How have you seen the quarter gone by, and especially trends at the end of the quarter and leading into Q2 as well?
Good morning, and thank you for having me on the show. So regarding the quarter, we saw that our profitability was quite good. In fact, the PAT jumped by 33%. And it was a strong quarter for us in terms of EBITDA margins as well. We were able to sustain the same. The demand side, yes, the replacement demand was more or less flat for us. The OEM demand, especially when we talk about the commercial vehicle, the medium and heavy commercial vehicles, there we saw some amount of sluggishness. But in my understanding, this is more of a temporary phenomena, and it would come back maybe in the latter part of this quarter itself. And the next half of the year, the FY25 second half, is expected to be quite robust in terms of demand in the CV industry also. However, our exports were very good. In fact, in Q1, we saw the exports were up by almost 17%. And this definitely helped us to sustain our top line.
Just so if you could quantify what was the price hike that you had taken this particular quarter, because we've seen some commodity cost has risen steadily since the start of the year, but we've seen a sharp rise in natural rubber prices as well in this particular quarter. If you could just quantify what is the price hike that you've taken in Q1 specifically, and until now, in July, have you taken any other as well apart from that?
Yeah, so if you remember that, in the Q4 of last year, the raw material prices have started to harden. And there was further hardening in Q1. In fact, in Q1, if we take, there was a further increase of almost 3 to 4% in the raw material basket. We have been making our efforts. We have spoken about our efforts on premiumization. We have further continuing to work on that. We continuously also improve our operating efficiencies. So some part of the raw material cost is definitely being set off with that. But definitely that's not good enough. So we have been able to take a price increase in the month of April and May. The cumulative price increase for the quarter was around anywhere between 1.5% to 2%, depending on which category we're talking about. And this, along with the efforts on premiumization, as well as the improvement in operating efficiencies, were in a way we were able to negate the overall impact and thereby maintaining our EBITDA margins. However, going forward in Q2, we expect that there would be further raw material costs would further go up. The expectation is that it would be in the range of 5 to 6%. So definitely, we would be working on all the three levers, but there would be a need to pass on this increase in raw material costs to our customers. We will be watching this very carefully. We have taken a small percentage increase even in the month of July, and we would be watching this very carefully. And definitely our efforts would be to see to what extent this can be passed on to our customers, both in the replacement market as well as in the OEMs.
Well, thanks so much, sir, for quantifying the price hikes. Now, just one question on you did touch upon recovery in the second half of the financial year, especially for the trucking industry. We have seen, in this particular quarter, the share of OEMs revenue, by revenue has slightly gone down by a couple of percentage points. But in the second half, and most OEM makers in the truck as well as the passenger vehicle industry have guided for a lot of launches in this particular year. How are you seeing this particular share going forward for the full fiscal year in this particular year? Are you seeing the share of OEMs will slightly rise? Because over the last 12 to 18 months, we've seen that the share has largely been stagnant for all tire makers because of lack of launches by most OEMs. How are you seeing this particular, the number going forward?
So first, let's look at the demand, the absolute demand. We expect that in terms of the numbers, it is expected to get better. From actually the market starts picking up generally from the month of September, and therefore production of the commercial vehicles should start getting better in the latter part of this month itself. We expect that from the second half, which is Q3 and Q4, these two quarters are generally very strong in terms of OEM demand for us. And we expect that this year also we should see the similar trend. Your other question was regarding the mix between replacement versus OEM. The replacement market also is expected to be quite strong. Definitely with the road infrastructure getting better, the freight availability, which we talk in terms of a billion ton kilometers, that is also expected to be growing. And this is very closely correlated with our GDP growth. So if the GDP growth rates are expected to be in that 6.5% to 7% range, we expect that even the freight availability, when it is measured in terms of billion ton kilometers, should see a CAGR of 8 to 9%. And this would definitely augur well for both in the creating the demand for vehicles, and the OEMs would be able to meet those demands. And also when the freight availability is better, the replacement market also gets to become a little strong. So we expect that the second half of this year should see us getting back to the numbers that we generally see.
Now, one question you did highlight, that export growth in this particular quarter has been really strong. I just wanted to get a sense of what are you seeing in terms of competitions from the MNCs that are in India as well as in Europe, because we've seen that Europe has been lackluster over the last couple of years, but this year we have seen that finally there could be some growth as well as premiumization trend has already been playing out for a lot of tire makers, including SLF. So just how are you seeing the competition specifically with MNCs in terms of premiumization in India as well as in Europe?
So first, let's talk about the export market. For us, we had seen a growth of around 17% in our exports revenues. This growth has come, we are broadly quite widespread in the markets that we cater. While around 50% of our revenue comes from the Americas, both the North and South continents put together, and the remaining 50% comes from other markets. So we are quite well spread into these markets. There are a couple of challenges that we need to take cognizance of, because we are seeing that both the freight rates, the international freight rates are on the increase, and also there was a little bit of a challenge in terms of availability of vessels and containers. But we expect that by the end of this quarter, things should normalize, both in terms of availability and also the freight rate should start coming down from Q3. So overall outlook for exports, whether it is in the Americas or other markets, including Europe, Middle East, GCC countries, and even in some of the Southeast Asian markets, we should see that the demand is there and we should be able to meet the demand. Our capacities that we had planned a couple of years back have got commissioned, especially let's talk about the passenger car radial. Here we have the not only the capacity but also the capability to produce the high rim size tires. We have the capability to go up to 24 inches. So both for the domestic market as well as the international market, we are developing a lot of new products in the high rim sizes. We are working with many of the OEMs, passenger vehicle OEMs, and we are one of the leading suppliers to big OEMs when it comes to the higher rim sizes, 17-inch, 18-inch. And we are working along with them, both in terms of development of tires, which are low RRC or energy efficient tires. And also we are working with them for both their ICE engines as well as the EV vehicles which will be launched in the latter part of this year or even coming into FY26.
Just a follow-up question on what you mentioned, Mr. Kathuria. Now, specifically the passenger car segment is something that you are expecting and very bullish on. Do you see the share in revenue for passenger cars going up from, it's been around the 28 to 29% range over the last 2 to 3 years. Do you see a share? Because we are seeing also recovery in the truck and bus market in the second half, but we will be seeing a lot of launches starting Q2 itself, from major OEM makers in the passenger vehicle space. Do you see the share of passenger vehicle revenue or in this particular year to go up from this particular range of 28 to 29%?
So if you look at the passenger line, what we call as the PLT segment, definitely our revenues are improving year on year. And we expect that this year also, with the new capacities that have been put into place, and also our efforts on premiumization, the share of revenue from the PLT segment will definitely be going up. But just to amply clarify, that doesn't mean that the demand for truck and bus will go down. Only as a percentage, the PLT will definitely go up.
No, just we saw in the last particular quarter there was the hit for all tire makers, especially because of the EPR provision that came into place. Now, because of that, of course, a lot of tire makers had to purchase certificates also at that time to meet those guidelines. How are you seeing the impact for this particular year? Will it be limited to around the 100 to 110 crore range as we'd seen previously? Or any kind of range that you want to specify in this particular year for EPR provision specifically? And also on CAPEX, what is the kind of CAPEX that JK Tyre specifically is commissioning in this particular year?
So regarding the extended producer responsibility, or EPR as we call it, there was an impact in the previous fiscal because we were not passing it on to the customers. But from this year, we and as well as many of the other players in the industry have decided to make it a pass-through cost. So from the month of May, we have been charging our customers on the EPR liability. It is a pass-through. We are not making any profits on that. But whatever is the cost that we incur in terms of certificate purchases, we are passing it on into the replacement market. And we are also in dialogue with all our OEM customers to see how we can quickly come to an understanding as to how this cost can be passed on.
Sorry to interrupt, sir, but so basically, since this will be passed on directly, you see no impact in this particular year like we saw in the previous fiscal year, specifically for EPR provisions?
This has started in the replacement market, and we are very hopeful that we will also be able to get into a similar arrangement with the OE customers.
And any kind of lag that you see in this particular, or do you see not much, maybe a quarter's lag and it should be fine?
Yeah, at best a quarter's lag.
And just on debt, sir, if you could, and CAPEX and specifically on debt as well. So CAPEX for this particular year, what kind of targets does JK Tyre have? And debt, we've seen a steady, pay down by the company over the last couple of years. That's also improved the net debt to EBITDA ratio. Where are you seeing this at the end of the fiscal year?
So first, let's talk about CAPEX. As you remember that a couple of years back, we had announced a CAPEX program of 800 crores. That CAPEX program has played out very well. The facilities have got commissioned and the capacity is being utilized, whether we talk about the passenger car radials or even the truck and bus radials. So that is complete. A couple of quarters back, we had further announced another 1,400 crores, out of which 1,000 crores was more towards the passenger car radial, and another 400 crores was, out of which 112 crores was the all-steel light truck radial, and the balance was for the TBR. So all these projects have got, we have started working on this, and we expect that by the second half of the next fiscal, that is FY26, these capacities should come into being, and they would get commissioned. And I think so timing-wise, this would be appropriate because by that time, we expect that the demand for both PCR as well as TBR domestically and even in the export market should be looking robust. And this capacities that will be commissioned would be very useful in meeting that increased demand.
Well, Mr. Katuria, thank you so much for joining us today and speaking to us here at NDTV Profit, much in detail about the Q1 results as well as the next year as well in this particular year. Thank you so much for joining us today, and we look forward to our next conversation.
Thank you.
Well, that's all the time we have on this edition of Earnings Edge. Stay tuned to NDTV Profit for more.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the
Apple has done consistently well over the last 5 years. If you look at our revenue has grown 6x, profits have grown 5x, and the growth journey has been very consistent over a long period of time. And Q1 this quarter was very special because not only did we deliver 106 crore of profit before tax, EBITDA and PBT being over 100 crores was for the first time for us. And the revenue growth has been robust, both in emerging markets as well as in developed markets. Organic growth was over 20%, consolidated basis close to 28% growth, year-on-year basis. So it's a very consistent growth performance. Even on margin expansion, if you see EBITDA margin has actually expanded year-on-year basis as well as sequentially, it is on a positive trend line. So I'm very, very happy with the way the team has performed throughout this period.
Right. Mr. Soham, profits were largely down because of a higher effective tax rate in the current quarter. So do you expect the current tax rate to continue, or do you expect that to go down?
In the long term, all the geographies around the world, they are basically working towards a certain fair baseline taxation. So you would expect all companies, all jurisdictions around the world to be in that 15 to 20% tax range. So I think where you see today, we have taken a conservative approach that for our UAE entity, we have actually taken and provisioned as if there will be tax in that jurisdiction because the laws are already there, but it's still not clear. So we've taken a conservative position. But what we wanted to present from this financial year onwards is that this is a fair tax basis. Even on a fully sort of taxed basis, we are delivering a sensible sort of bottom line performance. So if you see it on a pro forma basis and apply the same tax rate that we had last year, you would see a much higher growth in PAT, just on a like-to-like basis. So what you see now is a fair, fully loaded tax basis, and we think that we are doing really well, even with that taken on board.
Right. Okay. So let me move on to the CPCU, that is cost per converted user kind of business. It's a really healthy growth of around 37%, and which is like almost 99% of the revenue. So that 1% of the non-CPCU business, you had mentioned last time that you would like to reduce the focus over there. So what kind of revenue proportion do you expect from the CPCU and non-CPCU business going ahead?
So our endeavor has always been that, we are a consolidated consumer platform, a single cash generating unit, all our acquired businesses as well as, markets, both emerging and developed markets, is one cash generating unit for us. And we are seeing this CPCU business as a dominant factor within the consumer platform business. So I would expect 100% of the revenue to be a consumer platform business, and within that decisively, 90%, 95% to be CPCU business.
5% to be CPCU business, is it?
I said over 95% to be CPCU business, and it is part of what we define as a consumer platform business, which is largely derived from giving digital advertising.
Right. Okay, got that. So one other question from my side is these Apple OEMs, etc. These guys have come out with a new feature wherein they would allow users to ask them whether the app can track their activity or not. So do you see some kind of risk from, say, Apple users because of this kind of privacy issue? Because privacy has now become a very important concern for users. So how does that affect our business?
So if you look at our track record, over 19 years, Apple has been leading this business consistently. And in fact, the change in Apple's privacy policy that you're talking about happened in 2021, in early part of 2021. And we have shown that in 2021 itself, we turned it into a competitive advantage by being better prepared, by taking the position in a strong way, because our IP, which is anchored on 36 patents now, includes forward-looking Gen AI preparation as well. But most importantly, it is fundamentally privacy compliant by design. Since inception, since April 2005, our company has stood for consumer consent, consumer privacy. In fact, our first patent was filed in April 2005, and it talked about consumer acceptable advertising. Even in its title, it talks about consumer acceptance. So we are very much in favor of consumers' consent, being honorable and responsible, taking privacy seriously. And our IP for the future is also privacy ready by design. And we have actually turned the Apple privacy changes since 2021 to a competitive advantage. In fact, one of the case studies we have shared in our earnings presentation this time talks about how we are helping advertisers in India to succeed on the Apple platform. And I mean, this is amazing. So we are ready. And another thing that I would like to mention is that Google just in the last month has announced that it is no longer going to deprecate the cookies, at least not in the foreseeable future. And this is something Google had said they will do over 4 years ago. And now in 2024, they have said they won't do it anymore. So their privacy sandbox project is also delayed. So I'm not expecting any major, let's say, ecosystem level changes in the next couple of years. So there's a very clear runway for consistent, predictable, profitable growth for our company.
So just a follow-up on that, if this kind of project gets implemented in the next, say, after 5 years, in the next 6 to 7 years, so will it affect our business? I mean, not in the near term, as you likely said, because it's not expected, but what after that?
So we have already demonstrated that when Apple did this change in 2021, by the way, Apple is always ahead in these changes versus Google. And their change in 2021 made most of the industry players quite nervous, but Apple took it head on and converted into a competitive advantage. So having dealt with that several times in the 19 years and most recently with the Apple privacy changes, what I'm saying to you is that Apple's platform is already privacy compliant. What I'm also saying to you is that our future proofing with Gen AI related use cases covered in the 36 patents that we have filed and the IP portfolio, we are future ready and privacy compliant by design. So I'm not worried about data privacy related changes making as much of an impact, because we have already negotiated it and converted it to our competitive advantage in the past.
Right. Right, so privacy compliant is what Affle is about. Got that. Okay, so moving on to the inventory part of the company. So largely Affle, pays for a mobile ad inventory, regardless of whether user is generating revenue or not. So can you explain to our viewers how does this affect the dynamics, the profitability dynamics of Affle India?
I think we have shown consistency in our bottom line performance as an organization, and we are absolutely clear that what we are delivering to the advertiser is a bottom line sensible ROI focused deep funnel conversion based platform capability. So the advertiser only pays us when they see ROI, when they see conversions, and that's the way we command the budgets. As far as the our own profitability is concerned, if you look at the last 5 years or even longer, pre-IPO, post-IPO track record of our company, we as a DNA are a bottom line sensible company. Cash flow positive operations, profitability is super important to us. We have done acquisitions in the last several years, and those companies were not as efficient on the bottom line, and we have consistently brought them up, turned them around to give a consolidated 20% plus EBITDA positive performance in the last several quarters. So I am very, very clear about our focus on margins. As far as the inventory costs are concerned, most of the places in emerging markets as well as in developed markets, there is a significant supply of inventory. As more and more people are using mobile phones, more and more people are going using mobile apps even to make payments. Everything that you can imagine is going digital. I mean, the consumption habits are going more and more online, and therefore there will be a lot of inventory.
What do you...
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Hello and welcome. You're watching Market IQ. Let's take a quick look at where the markets are at first. Now, on the back of weak global cues, we've seen the markets open weak, and so far in today's day of trade, they've continued to lose momentum. We continue to hover not too far from the day's lows. The Nifty 50 is currently down by over 3%, as is the Sensex, while the Nifty 50 is hovering a tad below the 24,000 mark. We're currently closer to the 23,900 levels. The Sensex is hovering around the 78,000 levels. Let's also have a look at some of the key contributors of the Nifty 50. It's a broad-based decline, but what's really dragging down the Nifty 50 among the key constituents are some of the RIL, HDFC Bank, Infosys, ICICI Bank alone contributing almost close to about 300 points of decline of the 800 points that we're seeing the Nifty 50 down by. But as we can see, most stocks continue to be in the red, though these are the key contributors. What's marginally in the green is HUL, Nestle and Britannia, but there again not too much happening, and it is clearly broad-based decline that we're seeing on the benchmark indices, with nearly 47 currently declining, with only about 3 to 4 currently advancing. Let's also take a look at sectoral indices. There again, we're seeing a sea of red. Most sectors, nearly all the sectors at this point in the red. Metals taken the maximum hit, and that's down by over 5%, as is Realty and PSU Bank along with media, but the others not performing particularly well either. And Nifty FMCG is down by almost about 0.5%, but metals seeing the maximum drag. India VIX is also, it's risen by 51% in today's day of trade. Again, on the back of extremely weak global cues. We had seen weak data coming in from the US. We're looking at mild chances of the US economy heading into a recession going forward, despite talks of rate cuts being advanced, possibly one taking place at the Fed's next meet in September. We're also hearing about chances of a likely emergency meeting being convened by the Fed, but currently that's all hearsay. We will continue to bring more on that if that does actually pan out. But let's also take a quick look at the broader markets, and there again not much of an improvement there. The Nifty mid-cap 150 is down by almost about 4%. So the broader market seeing an even sharper decline than the benchmark indices. The Nifty small cap 250 is down by about 4.7%. So that's among pretty much the worst hit among the indices. Let's also speak to Dheeraj Nim, economist and FX strategist at ANZ Research, to help us unpack what's happening on the street today. Dheeraj, hi.
Hi, Pallavi.
Thanks a lot for taking time out for us. So, first of all, there's a whole host of weak global cues with what we're seeing taking place in the Asian markets, and of course the weaker cues from the US economy as well. So, starting off with what we've seen in terms of unwinding of the carry trades because of the appreciation in the yen, how does something of this sort typically pan out, and how is most of the impact now factored in, or can we continue to see some weakness on the Indian currency going forward?
Sure, Pallavi. So I think three factors are currently playing out. The first is, as you mentioned, the unwinding of the carry trade because of the yen appreciation and what's happening to Japan's interest rate after the monetary policy meeting. The second is, of course, the news coming out of the US docket, the weak number, basically, flaring concerns that US could be heading into a recession. Now, I do think that, the yen unwinding trade is sort of having a more dominant impact on the global market sentiment right now. And the US concerns have only added to it. Now, how does this pan out? Well, for the longest times, global investors had benefited from the low interest rates in Japan and the weak currency into funding their investments abroad, both of the long-term nature as well as the short-term nature. And currently what we are witnessing in terms of the unwinding of that carry trade is the portfolio shock effect. So basically, as Japan's interest rates have risen and the currency has strengthened, more than expected, the cost faced by these borrowers have increased, which is leading to this unwinding of the carry trade. Now, look, the market reaction has been certainly very negative. If you look at the Japanese stock markets, they have crashed really hard. The Asian markets are significantly down, including India. And of course, with what's happening in the US, the things are not looking very nice at the moment. So I don't think that, there is any silver lining in this particular episode, at least for now. But we have to be very mindful to watch how long does this sell-off last, because that is where we can begin to see, some understanding of how the real economy impact of this would be. Because financial markets, to be honest, they do overreact in the wake of events. So let's wait and watch out on that front.
No, sure, that's true. But tell me something, given what it's looking like now, and despite the continuing intervention we're seeing by the Indian Central Bank, are we now looking at the rupee breaching the 84 mark against the dollar?
Look, at least in my baseline forecasts, I'm not looking at rupee breaching the 84 mark, but the risks have certainly shifted towards a weakening bias for the rupee. Until so far, there were several factors that we were discussing that would determine the rupee's trajectory. One was, of course, the broad dollar strength. The dollar is weakening as of now, as we speak. We'd also spoken about the importance of the yuan's exchange rate. Now, the yuan has significantly appreciated, in the last few days, toeing the line of the Japanese yen, which is a key yuan competitor. Now, the question is, what would the RBI do? Remains the paramount, factor of importance as far as the rupee's trajectory is concerned. Now, given the kind of portfolio effects we are seeing today, the portfolio shock and possibly withdrawal of the FII flows, I think there is a bit of a weakening bias for the rupee in the near term, but the RBI will be able to manage it and should manage it, given their own commitment that they don't want any disorderly moves in the currency. Right. So, and they also do have a very large war chest of FX reserves that they can deploy to sort of stem this volatile episode. Having said that, once there is more clarity as to what the Fed is likely to do at their September meeting, I think there will be clearer cues for where the rupee could go. But to answer your question a bit more succinctly, I think the weakening bias in the rupee that has remained over the last 1 month is likely to sustain, but I don't expect any runaway moves on the weakening side either.
Sure. Okay. But also help us understand. So, and we understand that, we are still watching out for how the current scenario pans out. But as things stand, in terms of merchandise export impact, again, given a whole host of weak global cues, along with recent geopolitical conflicts once again coming to the forefront, given that in recent months we have been seeing a little bit of an improvement in merchandise exports, and this is at a time when outlook was expected to get a little bit better, are there any concerns on that front currently?
Well, there are. So, even before we headed into this entire volatile episode, I think the consensus view was a slowdown in the US economy. And mind you, over the last few years, the US has become so much more important for not just India, but a lot of other Asian economies as well, from an external demand point of view. So anyways, our expectations were that, the headwinds that the global economy could face in terms of US slowdown could also mean external demand weakness for Asian economies, including India, and that could temper the export momentum a bit. If anything, the last data point coming out of the US, the risk is that could be a bigger concern that factored in so far. And this could impact India's both goods and services exports, right? So India exports a lot of services to the US. US is one of the largest consumers of Indian services exports. So I do think in net terms, the recent developments are negative as far as, external trade is concerned for India. But I do also think that, this slight weakening bias for the rupee, could help prevent a very sharp slowdown to a little extent, to the extent that rupee could be slightly, cheaper than its peers, especially the yuan, etc. It could help, but that would be a marginal positive impact. I think external demand would still be the most dominant factor. Which is suddenly not looking very good. But of course, we need to wait and watch out. More data coming from the US.
Right. We do have commentary coming in from Japan with the Japanese finance minister putting on record that they're looking at addressing some of the ongoing concerns. They're talking about positive moves in the Japanese economy itself. We will continue to bring more on that. But Dheeraj, before we let you go, I do want to ask you, given the spate of events we have been seeing and given the impact it's been having on financial markets. Like you did say, some of it is not necessarily entirely grounded in global cues, but also a little bit of maybe a knee-jerk reaction that we're seeing in the markets today. What do you think will help bring some sense of sanity to the Asian markets as well as, the American markets?
Look, I think the market will be very closely watching for more data coming out of the US over the next few weeks and in the run-up to the Fed meeting. Our base case is not of, an emergency meeting by the Federal Reserve, so on and so forth. But I do acknowledge that the market is now expecting a lot more from the Federal Reserve. As we speak, I think over the next 3 months, the market is expecting the federal funds rate to go below 5%. Now, this is not our baseline call as far as economic forecasts are concerned. I think, if the current dire situation, volatile situation in the market continues, a lot more would be needed from the Fed to calm the markets. But if, of course, as you're saying, this could be a knee-jerk reaction, and we could see some consolidation in the days to come, which is why this week remains very important. And if that consolidation does happen, then maybe we would have some bit of a saner check on, what do we expect from the Fed, or what should we expect from the Fed at their September meeting.
Right. Dheeraj, while, like you've said, that the base case so far, despite the rumors swirling in the markets currently, is that the Fed is likely to meet in September. It's, of course, been signaling rising chances of a rate cut when it does meet next. But we are, just a few days short of the MPC putting out its resolution. Given the recent changes we have seen a whole host of developments from the last MPC to this one. We've seen a weaker rupee. We have seen easing bond yields. We have seen some improvement on the monsoon outlook, with July having registered surplus rainfall after a very volatile June. That could possibly help ease inflation concerns going forward. But at the same time, we did see a higher print on the last inflation figure for the month of July. So given all of those developments, and of course today's developments added to that, what's the MPC? What are you going to be watching out for at this meet of the MPC? We do broadly expect a consensus around the benchmark lending rate and possibly even the stance. But what are you going to be watching out for?
Look, two things. The first is that I'm not expecting the Monetary Policy Committee to change the stance or the policy rate, like you said. But I do acknowledge that over the past months, since the Monetary Policy Committee last met, two important developments have taken place. The first is that the aggregate quantum of monsoon has been normal or slightly above normal, if I'm not wrong. But I am noticing that there has been a bit of a discrepancy in terms of its spatial distribution, in the sense that some of the wheat and rice rice-growing states in the northwest and somewhere in the east, they have had deficient rainfall. In the sense that the entire, array of worries that we usually have from monsoon in terms of its quantum and distribution are not allayed. So I think we do require to monitor food prices going forward for a little longer to be more confident that food inflation is certainly easing. And I think that the Reserve Bank of India, being such a cautious central bank that it has been all this while, will continue to do that. The second and the more important bit is that, like you said, yields have been falling. And then I think that the financial conditions in the money market have also eased a bit. Now, if you look at the banking liquidity, it's been averaging in a bit of a surplus of around 1 trillion rupees the last 30 days, which has meant that the weighted average call rate has already fallen below the repo rate. So even if the Reserve Bank of India actually does not sound dovish at all, or does not change the stance of the interest rate, there has been a bit of a de facto easing in the money market conditions to the tune of around 7 to 10 basis points in the last month. Now, I think this is something which was also expected, that as inflation risks remain contained and monsoon progresses as per expectations, the Reserve Bank of India may incrementally become less hawkish, but not so much in its commentary and rates and stance action, but in liquidity action. So one thing I would really want to watch out in this Monetary Policy Committee meeting is what the Reserve Bank of India does with the liquidity. And does it announce any tools or not is of course one thing I'm very interested in.
All right. Thanks a lot for that, Dheeraj. We will continue to keep in touch with you to see how these developments pan out. In the meanwhile, the Japanese finance minister trying to assuage markets, they are saying that they're continuing to watch markets with a strong sense of urgency, and they are saying that they expect continued moderate recovery in the economy. They're also cautioning investors who are worried to judge the markets with a slightly calmer viewpoint. We will continue to bring more on that. With that, let's slip into a short break. Lots more happening on the other side. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome in the thick of earnings. You're watching NDTV Profit. I'm Harsh Saita. We have with us the Managing Director and CEO at Bank of India, Mr. Rajneesh Karnatak, to talk to us about Q1 numbers, I beg your pardon, for FY25. Sir, first off, welcome. Good morning. Want to try and understand what's happening with margins because they've gone up. Any one-offs here? Also, if you can tell us whether this level of margin number is sustainable going forward through FY25, given the deposit growth pressure that's there in the system.
Yeah, so margins have improved for the bank. If you see the NIM, it has been closed at 3.07 and it has been increasing sequentially and on a YOY basis. So if you see March 24 for Bank of India, our margin was at around, NIM was at around 2.92, and in June 23 we were at around 3.03. So margins is improving, and it is improving because our yield on advances has now touched 8.60%, and we have grown the yield on advances by 50 basis points on a YOY basis. Cost of deposit is also 4.82%, and that cost of deposit has increased by only 60 basis point, and the gap between the two is around 3.6 basis point, because of which the NIM is around 3.7%, 0.7%. But definitely this NIM is also improved because of some recoveries happening in the return of account, where the same is going to the non-interest income. That is one of the reasons. So considering the fact that there is pressure on the resources and the interest rates are rising in the deposit side, domestic deposit side, and CASA and retail term deposit is a challenge, we feel that margins will be under pressure. But still we will like to maintain our margins at shade below 3% for the current financial year.
Understood. So margins likely to cool off for over the next 2 to 3 quarters is the sense I'm getting from you. Your yields have gone up, you suggested. Talk to us about what has changed in terms of the book. Is there a change in book composition? Is there a change in focus with regard to what areas you are growing in? Is this a conscious effort, or is this something that's just happened in a one-off quarter?
No, it's not a one-off situation which is there. It is a conscious call at the top management level that top line is important for us, but equally important is the bottom line. So if I tell you that the last time the Reserve Bank had raised the repo rate was in January 2023 from 6.25 to 6.50%. Since February 23 till date, as we speak, we have raised our MCLR by 6 to 7 times. And presently the MCLR has gone up from 8.4% to presently 8.95% on a one-year MCLR. So we have increased by nearly 55 basis points. So transmission to the lending side has happened from our bank side. Another thing that we have done is in the corporate book, we are not lending at repo rate or any advance which is up to 180 days. So anything which is above 180 days, we are lending on the MCLR side, and our MCLR, the lowest MCLR is the overnight MCLR, which is 8.15%. So we are very conscious on the margins that we are trying to maintain, and there is no particular shift in the overall credit numbers, in the sense that 55% of our book will be continue to be the RAM book, and 45% will be the corporate book. Within that, MSME, retail and agriculture is there, and the other portion is there as regards the interest rate composition in the book, credit book, standard book which is there. Fixed book is only 6%, remaining 94 is floating, which is linked to the deposit market rates. So we are very conscious on the margins which is there per se, and the NIMs we will try to protect as much as possible in spite of the pressure which is there.
Understood. So incrementally you're not doing riskier product to push yields. That's what I was trying to gauge. Are you pushing yields through riskier product?
No, we are trying to keep a balance on the credit growth side after due diligence and other things. So if you see our corporate book also, where 80% plus is on the investment side, the external benchmark rate, external rating advances. So there we are trying to grow our credit book with BBB advances also, A advances also, where margins are better on the interest rate side, and non-interest income, process fee and other LCBG commission is also better. So in a very nuanced approach, we are trying to go our corporate book also, and also our RAM book.
Understood. And advances growth as well as deposits growth quite strong for you when I'm looking at it sequentially. Talk to us about what's driving the kind of growth that you're seeing, because not too many banks showing at least growth on the deposit side, which you've shown this time.
So deposit has always been a very strong franchise for Bank of India. So if you see our slides which are also there, only 14% of our total domestic deposit is bulk deposit. Remaining 86% of our deposit is either CASA deposit or retail term deposit. In fact, we have closed our CASA number at around 43% of the CASA book. That is there. And 60% of our branches are in rural and semi-urban areas, which are giving us good CASA numbers and the retail term deposits. So as far as our bank is concerned, there is no much challenge as far as the increase in deposit is concerned. If you see sequentially also from our slides, we have grown our deposit more than the advances on a sequential basis from March 24 to June 24. But on a year-on-year basis, right, our credit has grown more than the deposit. But sequentially, since we have given more concentration on raising deposit in the Q1 quarter of this financial year, our deposit growth was more than the advances growth in Q1 quarter.
Understood. And I want to try and tie this in with what's happening on the provisioning as well as credit cost front. So while growth has been likely quite a strong driver in that sense. Margins have also gone up. But what's happening on credit costs? Where should they lie on a normalized basis? Because they've come off quite sharply. And tell us just what's happening there and what can the full year FY25 guidance be?
So on the credit cost side, if you see our credit cost, we closed at 0.85%.
Yes.
Sequentially, it is improving. If you see the credit cost, which was there in March 24, it was 1.4%, around 1.4%. So provisions we have made in this quarter as a matter of prudence. In fact, if you see that our provision coverage ratio has now improved to 92%, our gross and net NPAs have also come down sequentially. Gross NPA, which was earlier much above 5%, now it is 4.62. We were already below 5% as on March 24. It has come down further to 4.62. Net NPA, we have for the first time gone below 1%, and we are at 0.99%. So that is another number which is there. So provisions definitely in this quarter credit cost was high, but overall in the entire year, I think the credit cost would be at around 0.70% on an annualized basis, because most of the provision which was there has been made, and good recoveries are also happening. If I tell you on the recovery side also, we have fresh slippage of only 1,900 crore. Against that, we have done a total recovery of 2,700 crores, which does not include the write-offs. So this recovery is from upgradation through cash recovery and recovery from return of accounts or in the interest income in the NPA accounts. So 2,700. And if I include the write-offs also, then the total reduction in the NPA book is around 4,000 crore in this quarter itself, as against fresh slippage of 1,900 crore. And our cash recovery to slippage ratio within that is already 1.4042%, which is excluding the return off. So already we are at a healthy number, which means that against 100 crore of slippage, we are doing a recovery, cash recovery, upgradation, and recovery from the return of accounts of 142 crores. So that is the kind of run rate we have built now from this quarter.
But yeah, so I noticed that metric and it was very impressive. I agree with you, Mr. Karnatak. But is that sustainable is what I want to ask. And also, what's the full year FY25 guidance on recoveries?
So this number will be sustainable for the reason that we have a lot of put efforts. Our ARB branches and our recovery setup has been tightened. The entire organizational setup has been revamped. So we have a lot of OTS schemes also, which the fields are doing, not only from the normal OTS, which are there for small accounts, mid-corporate account and large accounts, but even for the return of accounts, targets have been given to the field. In fact, internally, we have given a target that our total recovery should be twice the number of slippage which is there. So overall, the end of the year, you will see a better number as far as the slippage ratio is concerned. Present slippage ratio is already down at 0.35%. So we, on the annualized basis, if I can say that, we will be trying to maintain our slippage ratio at around 1.10%.
Understood. So what's your full year loan growth as well as deposit growth guidance, if I may ask?
So as far as the credit growth is concerned, on the global credit growth side, we will be growing at around 13 to 14%. And on the deposit side, global deposit side, we would be growing at around 10 to 11%.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
So it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future,
as we've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes.
Welcome, you're watching the Mutual Fund Show. I'm Tamanna Inamdar. Today on the Mutual Fund Show, I think we're going to focus on the question that is on every investor's mind. It's that time of the month when a lot of SIPs go out. It's also that kind of a day when portfolios are looking bruised and battered. It's not just the Indian markets that have seen a sharp cut, but it is a global kind of an impact that we're seeing. So a lot of questions right now, right, that we've been talking about all day. Is this something that's going to persist? Is the US going to go into a recession? What happens to India? What happens to global markets? What happens to the Nifty? But in this particular show, we're going to be talking about what happens to your portfolio. Is this a good time to buy the dip? Because remember, Indian retail investors are also very smart at doing that. What is the kind of strategy that you should employ in order to navigate the ongoing market sell-off? You know, there are two ways of looking at it. In fact, various views on what you should do. And we're going to be speaking today with Hemant Rustagi, CEO of Wise Invest, and Pankaj Matpal, founder and CEO of Optima Money Managers. Welcome to both of you. Thank you so much. Pleasure to speak with you on the Mutual Fund Show today. Hemant, let me come to you. It's a tough day on the street for investors of every kind, but for mutual fund investors, I think at the end of the day, they would be the most secure knowing that their SIPs are going out on time. Is that the way you should look at it?
Oh, absolutely, Tamanna. I think you're right. This is a tough day. And in fact, this is the third time in the recent times that we are seeing such a day. We saw that there was a deep cut in the market when the election results were announced, and also on the day when the budget was presented. And this is the third time. And as you rightly mentioned, I think this time the reasons are slightly different. They're more basically global reasons than the domestic reasons. But you're absolutely right. If you analyze the way the investors have been investing in mutual funds in our country in the last few years, most of them are investing through SIP, which means that they are following a disciplined approach. They are committed to kind of hold this money for a longer period. And I think one important thing is that most of them have aligned these investments to their goals. So they have much more clarity in terms of how long they can hold these investments. So I think any investor who has kind of been investing in a disciplined manner has done the right thing by selecting funds as in line with the asset allocation. I think I would say that those investors need not really worry about the kind of deep cut that we're seeing in the market, because we know that volatility in the market is a natural phenomenon, and these times will come and go. But only difference this time is that the reasons are global, and we need to really wait it out whether the recovery that we saw in our earlier two occasions, whether we'll see that kind of recovery or it's going to take some more time.
Pankaj, let me come to you. Wait it out is some of the advice that is coming in. What about the question of buying the dip? Look at the next few days and what is going to happen here on. You are going to hear from central bankers. You'll probably hear from the Federal Reserve in September. You could see a rate cut. You could see a reversal of this trend. Is this a good time to start lump sum investment or bump up SIPs or start a new SIP?
Yes, Tamanna, say when we talk about mutual fund, generally, especially in equity, we expect a long-term horizon. Means investors invest with a long-term view. Considering that fact, I'll say that it can be an opportunity for investors. I'll not say that you invest the total amount in a single day, but definitely every dip is an opportunity for investors for investing in mutual funds. But Tamanna, I'll say one thing that considering the recent trend, investors have invested more in small cap, mid cap, and especially in some themes like PSU or defense. And we have been advising this that investors should maintain a balanced portfolio or proper asset allocation. So if investors have more investment or more allocation in small cap or themes like defense and PSU, is the time that they should realign their portfolio with their financial goals and reduce their exposure in these sectors and themes. But yes, they should stay invested.
Okay, so you should stay invested. But, I'll just take that forward to Hemant. The whole rage, two-part rage, one of NFOs, one of thematic funds, and especially in some of the sectors that Pankaj mentioned, defense, infrastructure, all of these themes which have really been running up. Is it the right time for investors to relook and reallocate, stick to basically the good old bread and butter, your large cap stocks?
Tamanna, it depends on the kind of investor you are. Look, the fact is that people who have been investing over the last many years have built a decent sized portfolio. They are comfortable with how equity market behaves. They understand the nuances of how equity market functions. Obviously, they reach a stage where they think that they have the risk profile to invest in these kind of funds. I mean, they can be fine, provided, again, of course, the important aspect always is how much exposure do you have to sector and thematic fund. Now, while there are thumb rules which says that 10 to 15% can be invested, but the thumb rule obviously always do not take into consideration your own personal situation. So it depends on, like I said, the kind of investor you are. But for the retail investors, if someone has been investing here thinking that there is an opportunity to make a quick buck, obviously not because there is a correction, even otherwise also, I think there is definitely, I feel that an opportunity or also the time for investors to rethink their strategy as to how much investment they should be having, or if at all they should be having in that. Because my belief always is that if there are certain themes, certain sectors, they have the potential to do well going forward. And if you're invested in well-diversified fund, which have been performing consistently well, surely the fund manager will have exposure to these two or three or four sectors or segment that have the potential. Of course, it may not be as much as you actually can get when you invest directly into those, but they will definitely be participating through this diversified fund. So my point is that not because there is a correction in the market that we need to relook. I feel that for someone who is trying to build a portfolio over a longer period to smaller contribution should always stay away from sector and thematic fund. And if someone has included, surely it's time to kind of relook at that.
But today, what about today and now? It's very timely that we're doing this show today, on the 5th of the month. And people are figuring out what to do. They're probably looking at their portfolios and saying that, yes, I have made money over time. And I'm seeing some of those gains, which are still right now notional, evaporating. Do they have to wait? Buy, sell, hold is a very simple, basic kind of a query which viewers have been asking us. And let me put that to you now first, Pankaj.
I'll suggest that investors should add or top up their flexi cap fund, or they should add flexi cap funds to their portfolio. And they can book profit from small cap fund, especially even then they have lost some good amount today. But still, I'll say that it's the time that you should book profit from small cap or exit from small cap if you have a large exposure. And flexi cap within diversified category looks better, or large cap index funds can be considered. And if you want to add theme, for example, you do not have exposure to theme, then I'll say that healthcare or consumption, these themes could be better compared to your defense or PSU, because see, thematic funds perform better within a certain period of time. So when we have seen that these themes have outperformed the broader market, so now it's a time that you should exit from those themes and add such themes where you are looking, where you can expect better performance.
Okay, so let me recap that. Very specific and important advice from Pankaj Matpal. He's saying move from your small cap funds and increase allocation in your flexi cap funds. You can look at large cap funds. If you're keen on thematic funds, then look at healthcare and consumption, which haven't run up as much as others. And remember, it's the recession-proof story, right? So that's why they call the defensives. Hemant, you have similar advice?
Yes, I think, but like I mentioned earlier, I think it's important for investors to realize what will work for them in the long run. If you're making any decision based on what is happening in the market today, trust me, if you see a recovery, if there is a, let's say, unscheduled rate cut by US, and then suddenly if you see a recovery, then the thought process will change again, saying everything is fine now, why should I make a change? So I think it's important not necessarily to look at only the market mood and how the markets are behaving, then make changes. As I mentioned earlier, I think one needs to really look at what will work in the long run. In the long run, for a retail investor, for someone who's trying to build a portfolio, as I mentioned earlier, I think the key is always to go into well-diversified category. And I think that if someone who is keen on having exposure to all the three market segments, for example, the multi-cap funds can be great addition. Then there are a large and mid-cap fund and of course the flexi-cap fund. So my view is that, like I said earlier, not because there is a correction in the market, but otherwise also I think investors should relook at their portfolio, realign if there is a need, and try to build portfolio with well-diversified fund. And of course, those who have the risk profile, who understand the attendant risk, can obviously have exposure to different markets, different sectors or different themes.
Okay, so keep it steady, hedge your risks, and at the end of the day, remember, it is the domestic investor who's been putting his faith or her faith in mutual funds that has kept Indian markets relatively fine. I mean, I know you're looking at a 600 plus point cut on the Nifty today and it's seeming painful, but if you compare with what's happening in the rest of the world, it's definitely not that bad. All right, let's take specific queries, and remember, if you want to write into us or you want to ask our experts your questions, the numbers on your screens. Let's start with Piyush Dhule's question. He's 28 and asks that I have 60% exposure to mid-cap and small-cap sectors, but should I reduce the exposure in the current market scenario? Thank you for your question, Piyush, and thank you for watching. Pankaj, let me come to you first for your response. So it's not unusual to have investors like Piyush, and especially he's 28 only, who have a larger exposure to mid and small caps. Do you think it's time to relook at that strategy?
Exactly, Tamanna. Actually, 60% allocation in mid cap and small cap is not a good choice. And now also means my suggestion, he should reduce exposure from small cap at this moment. If he wants to exit even, that is good. Because we are seeing that small cap have run well, and it's the time that should have larger exposure in large cap, flexi cap. Flexi cap category, because fund managers have choice, they can allocate funds according to situation. So flexi cap can be a better choice at this moment, but definitely from mid cap and small cap, Piyush should reduce his exposure.
Okay, so reduce your exposure in small cap and mid cap. Anyway, it was not a great idea to have 60% exposure to these sectors. Hemant, what would be your advice for Piyush?
Well, Tamanna, I would say, like, look, there are three segments in the market: large cap, mid cap, and small, and all three have an important role to play. Of course, the key is to have them in the right proportion. Now, how do you decide the right proportion? One is to follow a thumb rule, which says that for any investor who's investing over a longer period and who's not very well experienced, should always have a bias towards the large cap. Now, that can be either through pure large cap fund, or it can be through flexi cap fund, or even large and mid cap fund. So that again depends on the kind of investor you are. So I think someone like him, if he's investing for a long term, even then I think the exposure is high. He needs to kind of cut down that exposure. Now that can be done in a phased manner. It need not be done on a single day or immediately. It also depends on whether he's looking to increase his SIP. Now, for example, if he's investing, let's say 10,000 rupees and 6,000 is going into small and mid and he wants to add another 10,000, he can actually invest that money in the large cap or a flexi cap or a large and mid cap rather than kind of, stop investing in this. So I think there needs to be some clarity on how you look at your investment process going forward and what is the size of the investment and how much money are you investing in this, because the percentage does not always give you the right idea.
All right. One more question coming in, and this is from Mahendra, age 36. Asks, is it a good idea to invest in foreign funds right now, given they may consolidate further and could be up for grabs for lower valuation? Excellent question, Mahendra. And Pankaj, this is what I say about the Indian investor who is largely optimistic. I mean, they're looking at an Nvidia, all the mega cap stocks which have been completely liquidating and saying that I watched these stocks from afar and thought they were out of reach. Are they in reach now? What would be your advice?
Tamanna, adding international funds to your portfolio is a good idea. But at this moment, if somebody wants to invest, I'll say Indian markets are looking better. So have larger exposure in Indian market only, because you do not know the bottom of these funds. So not the good idea to add at this moment these NASDAQ or this kind of funds, especially US market I'm talking about. Better invest in Indian market.
Okay. All right, so it is a good idea, but not right now. And an important point over there, that in relative terms, do the Indian markets fundamentally look better? Well, absolutely, perhaps they do. We'll take a very short break, but we're coming back with your queries. We're going to focus on your queries in today's show. It's a day when people want to know what to do with their portfolio, and we'll try and help you out as best we can. Very short break, and we're right back.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Welcome back. You're watching the Mutual Fund Show. Now, this is the portion of the show where we take your queries. Ananya has written in, age 35, says, I want to buy the dip, but do not believe mutual funds are the right avenue. So is it a good idea to rely on ETFs to buy the dips? Ananya, excellent question. Thank you for writing in. Hemant, let me come to you first on this. People do want to buy the dip. Ananya's point is a valid one. Why should she go through mutual funds, pay that fee? Should she just look at ETFs right now?
Well, I think this is an important question, Tamanna. It's not only because on a particular day you want to buy a dip, and this is the issue that we keep discussing again and again, whether I should go for active fund or passive fund. Again, I think there are pros and cons of investing in both. Of course, there is no doubt about the fact that if you're buying an ETF or an index fund, because there is a cap on the expenses, the costs are lower, right? And of course, there is no human bias because these ETFs and index fund, they track a particular index. So in that sense, yes, I mean, there are advantages of that. But I think, again, there have been occasions, there will be occasions even going forward, where you'll see that actively managed funds, not necessarily maybe in the large cap, but in the small and mid cap, and also those options which give you a mix of different segments can do better. So it clearly depends on, as an investor, whether you want to go in for a passive fund or active fund. But I think both have pros and cons. And also, let's not forget that in the rising market, you may see that the passively managed fund will do better. But in the market, when the market turns choppy, or if you see a steep fall, there is no protection because the index funds have to be fully invested in all time. Whereas in the active fund, the fund manager does have the liberty to kind of keep being in cash for some time. So like I said, there are pros and cons of both. You can always have a portfolio which has a mix of active and passive funds.
But Pankaj, right now, the question is that Ananya wants to buy the dip. To buy the dip, should she look at ETFs?
Not exactly. As Hemant said, I agree with him that ETFs as well as mutual funds, both are important in the portfolio. So at the dip, you can even buy mutual funds, because when you invest in mutual funds and markets are down, the NAV will be low. So that can also be a good choice. So both can be in your portfolio. And the advantage with the actively managed mutual fund is that fund managers, they try to reduce the risk. They try to manage the risk. So that is why you cannot ignore active mutual funds. As you want to build your portfolio, you have space for both the things.
Okay, Manish writes in, age 25, asks, I don't feel much comfort in equity valuations right now. Can you suggest some safer mutual fund bets for someone waiting for a correction? I think, Manish, your question has come to us, or you've sent this question to us before that correction. Having said that, many will argue a 2.5% cut in the Nifty is not really a correction, even in your broader markets. But Hemant, I'll let you field that question first. What are safer bets for someone waiting for a correction? And is that wait now over, or has the correction just started?
No, Tamanna, I think we can't say that the wait is over. I mean, we just discussed that there are global issues right now. We need to really see how the market pans out from here. But, if someone is looking at a safer option where the money can be kept and, invest in equity at the right time, the question is, what is the right time, whether you're able to time it properly or not. But I think the options would be maybe a liquid fund where the money can be kept. And as and when one feels that there is an opportunity to get in to equity, one can do that. But I think timing that is always very, very difficult. So maybe one way I would say is to kind of do systematic transfer plan. And maybe you can do it on a weekly basis, you can do it on a fortnightly or even monthly basis. And within that, if you see a dip in the market, then maybe you can switch a larger portion of that rather than trying to time in market, because it has happened on so many occasions that investors have been waiting for correction. When the correction does happen, they feel that this will go down further, and suddenly there is a U-turn in the market and they lose the opportunity. So I think timing that can be a bit difficult. STP can be a good option. Like I said, in the process, if you see that there is a fall, try and kind of transfer a larger sum through switch.
Timing the market is actually a losing proposition one way or the other, which is why the good old SIP investors at the end of the day always feel that comfort. Perhaps they're not really crying buckets today like a lot of investors may be. Pankaj, would you agree with that? That it's tough to time the market and wait for a further correction? But the question specifically was, suggest some safer mutual fund bets What would you reply
Exactly. See, I'll say two options. One, as Hemant said, that one should invest in staggered manner, so STP can be a good choice. Second is one category is there, which is called balance advantage fund. So this category gives you this opportunity that you invest in one fund, and fund managers, they take a call that how much in equity, how much in debt. So balance advantage fund can be a good choice that you invest your money and leave it on the fund managers. But within this category also, funds are managed differently. So select a fund which has lesser allocation in equity at this moment, like ICICI Prudential Balance Advantage Fund can be a good choice in this category, or Kotak Balance Advantage Fund. So this kind of category can be a good choice. Or if you want lesser risk compared to this even, then there are conservative hybrid funds or equity savings fund. These kind of categories can be considered.
Okay. So you have to look at various categories at this time, and STP is a good idea because tough to time a correction. It could be today, it could not be today. I mean, you will hear people saying with complete confidence that this is just the beginning. If things turn by tomorrow, then they're not going to be really able to tell them anything. Let's take this question from Sahara Nagraj. Says they've received a security deposit of 12,000 rupees, looking to invest this amount into mutual funds. Where can I invest in? Let me just add one bit to that question and take it to Pankaj first. If Sahara was sitting today with this 12,000 rupees, would you say deploy the cash today or stagger it over the next few days?
Again, it depends that how much money he has already invested, means his portfolio size. But if somebody wants to build a portfolio now and the horizon is longer, this amount can be invested in one go today.
Okay, can be invested in one go today. That's interesting. Hemant, someone sitting with a bit of money and anyway looking to deploy, today is a good day?
Well, today is a good day, but we don't know whether it's stopping here or the correction will continue. It should be that tomorrow you start feeling that, okay, I kind of acted very fast. So again, you can stagger it. Like I said earlier, it's very, very difficult to time it to perfection. Maybe if you want to invest 100 rupees, maybe 30, 40 rupees, you can begin investing and then maybe wait and see how the market pans out. But in this particular case, if he's saying he has a security deposit of 12,000, I don't know if he has to kind of refund it after a year or what is the time horizon. I think all that is important. So even if the market presents a great opportunity, if the time horizon is not long enough, I would say stay out.
Yeah, but I mean, at the end of the day, they already want to deploy that 12,000 rupees. The question is about whether they should do it now and at one go. If you have a longer term perspective, then there's no harm in doing that, because trying to time the exact bottom of any market is near impossible and maybe a fool's chore. But steady and slow does win the race and will continue to do so even on a day like today. Thank you so much, Pankaj. Thank you so much, Hemant, for joining us. Thank you for all of our viewers who've tuned in. If you have a question for us, those WhatsApp numbers are on your screen. Until we see you today, same time, same place. That's all the time we have on the Mutual Fund Show. But stay tuned, a lot more coming up on the other side on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the portfolio.
Hello and welcome. You're watching Earnings Edge. I'm Anushi Vakharia and with me is Varsha. So we are going to be speaking about two interesting managements today. I'll start off with Sami Hotels. Now Sami Hotels came out with its Q1 FY25 numbers. They reported a 31% of a revenue growth, while the asset EBITDA in line with this was about 31.7% growth. The margin stood at 37.7% as compared to 37.6% last year. Coming to the ESOP and one-time expenses, now they've gone down by about 75.2% at 4.4 crore, but the net profit remained in the positive range at 4.2 crore as compared to a loss of 83.5 crore last year. But to discuss more on the Q1 FY25 performance and the outlook going forward, we are now joined in by Ashish Chakhanwala, the Chairman, Managing Director and Chief Executive Officer at Sami Hotels. Hello and welcome to the show, Mr. Ashish Chakhanwala.
Thank you so much.
So my first question to you is on the Q1 FY25 number. We've seen a decent set of numbers over here, revenue 31% growth, EBITDA margins also excluding the ESOP expenses and the one-time expenses have remained major in line. I want to understand what's the trajectory going forward. You expect an improvement in the EBITDA numbers going forward as well. So can you share your outlook on this? And along with this, how has the quarter been for you?
Thanks so much. So let's break up the existing quarter so that we have a good base for the coming next few quarters. So if you look at a room revenue, which is typically measured in terms of RevPAR or revenue available per room, we saw a room revenue growth of about 13% on a year-on-year basis for comparable hotels, same set of hotels as we call it. Total revenue growth for the same store was about 7%. The reason why 13% revenue growth led to a 7% total growth was because this quarter was slightly weak in terms of food and beverage because of elections. So large groups, conferences, all of that got deferred. So we actually had a great start in the Q1 with a 13% RevPAR growth. That pretty much sets the tone, Anushi, for the rest of the year. We feel that maintaining a high single-digit to early double-digit revenue growth is what we would target and we should be satisfied with. And we have already started seeing that starting July, we've started seeing the revenue growth kind of ramping up to what we had achieved in Q1. So all in all, we feel that whatever RevPAR growth we achieved in Q1 will start reflecting in being actually total revenue growth in the subsequent quarters.
Well, that's fair to understand, but can you quantify in terms of EBITDA margins now, where do we see this number going forward for the overall of FY25? And even if in terms of revenue growth, now we are adding about 302 more rooms in Q3 of FY25. Along with that, there's some renovations and rebranding which is taking place. So with the effects of all of these taking place in the second half of the year, what is the trajectory of the company with it in terms of its margins as well as its revenue growth?
So in terms of EBITDA margins, if you see, our stable portfolio did about 38.5% EBITDA margin. Overall reported slightly lesser because of the acquisition we had made last year, which was ACIC. ACIC has been showing tremendous margin improvement for the last 4 quarters post-acquisition. We feel that by the end of the year, our overall portfolio should be in the zip code of about 40% EBITDA margin, largely happening because ACIC keeps correcting every quarter post our acquisition. So in terms of EBITDA margins, we think 40% is the zip code that we are targeting before we end the fiscal year.
All right, that's fair. And now you mentioned a very interesting point about the RevPAR growth, which was at 13%. But if I go back a couple of quarters ago, the RevPAR growth has remained in the 15 to 20% of range. So from there on, now it is at 13%. Are we seeing this sustaining forward? Are we looking at the 13% number as the range going forward, or what's the outlook over here now? Mr. Ashish, I hope I'm audible to you. Mr. Shakanwala, I think you're on mute. Can you please unmute so we can listen to your response?
Can you hear me now?
Yeah, you're audible now.
Sorry, I had some issues. So I think if you take a 3-year view, 3 to 5 year view, we feel and we'll reiterate that, anywhere between high single digits to early double digit is a very achievable and sustainable RevPAR growth target, not just in the short term, but in the longer term.
All right. And now if I were to do a segmental breakup, now the upper upscale continues on this 21% of growth, while the mid-scale range of hotels has seen about a 4% growth. I want to understand what's the contrast over here. While one segment has shown a tremendous growth over here, the other one seems on a muted path. So is it because of the cities in which they are placed, or what's the color on this, if you can share?
No, so thank you for giving part answer. It's not just that the segment is underperforming or outperforming. Each segment has a certain diversification or concentration in cities. What we've seen is that the big office markets like Bangalore, Hyderabad, Pune, Delhi, they have outperformed the rest of the cities in terms of RevPAR growth. And because all of our upscale hotels are in these core markets, you see a concentration of the growth being there. And a bunch of our mid-scale hotels are dispersed across markets like Nasik and Coimbatore and Vizag, which are not core office markets in India. And therefore, you've seen their RevPAR growth being relatively lower. So if instead of the segment, if you were to look at cities in our portfolio, we've seen Hyderabad leading the pack, Bangalore leading the pack with about 17% RevPAR growth. Hyderabad, Pune would be in the zip code of 16, NCR at about 10%. And then, of course, then it starts tapering down into other markets. So it's more how cities have performed in terms of RevPAR growth. And that shouldn't be a surprise, right? If you see almost 65-70% of new office absorption happens in those 4 or 5 key markets, and that's been a big driver for demand for lodging services. So it's all about the cities, and mid-scale just tends to get a little muted because of the fact it's got presence in broader markets.
Okay, so the concentration remains on city level growth as compared to the segment level, as you've mentioned.
Absolutely.
Yeah, so now if I were to look at the net debt to EBITDA figure, now this has come down tremendously with the IPO proceeds, of course, which have taken place last year. 8.8x number last year, comparing that with this quarter, we've seen this going down to 4.9x, same as last quarter. But now I want to understand on the way ahead, you aim this number to come down to 3.5x. So what levers have you put in place to ensure that there is a further reduction that we are seeing place in the net debt over here?
See, really, there are really 2 levers for net debt to EBITDA. One is EBITDA and the other is how we reduce the debt. We are seeing the business producing reasonable amount of free cash. Our own estimate is that for FY25, we remain fairly comfortable in the range of 225 to 250 crores of free cash. Before any material capital expenditure or acquisition, that means our net debt goes down by that much. At the same time, you've seen our EBITDA growth being extremely humbling, and we expect to maintain a very high EBITDA growth during the course of the current year. So combined effect of a very high growth in EBITDA and of course the free cash that's building in the company, helps us achieve the targeted net debt to EBITDA number. In addition to that, it's worthwhile to mention that even the growth opportunities that we are pursuing or what we have pursued over the last decade, you've seen that they are largely acquisition-led. We don't do greenfield development per se. And therefore, if at all we invest any incremental capital in acquisitions, it actually leads to a very quick turnaround of that capex into revenue and EBITDA. Therefore, any capex that we deploy, unlike a greenfield development, tends to actually help our cause of deleveraging the balance sheet sooner than later, right? So it's really multiple levers that we have put in force. We remain fairly convinced as to where our balance sheet is headed, and it gives us the flexibility now to look at growing the business.
Okay, well, that was insightful. Now, my final question to you is about the pipeline of opportunities that we are looking at for the next 1-2 years. Of course, in the second half, we are seeing a lot of it taking place. But what's the way forward over here? Are we planning to add more geographies? What's the course of which hotels are we targeting? Is it in the upper upscale segment also going forward? And also about the F&B mix, are we planning to increase our F&B mix also as we move forward?
So I think we look at opportunities in really 2 buckets. One is internal and the other is external. We have a very good pipeline of internal growth opportunities. One you have mentioned, which is opening in the next 2 months, which is 302 odd rooms. In addition to that, we have incremental inventory being added in our hotel in Pune, our hotel in Hyderabad, and our hotel in Chennai. All of this is well within the control of the company. The most of the investment in the asset has already been incurred. It's about implementing additional inventory. In addition to that, we are looking at some pipeline, and that pipeline, as I mentioned earlier, is a combination of acquisitions and turnaround, something we've done for the last decade, but also some long-term variable leases, which tend to be very capital efficient. I'll hesitate to use the word asset light, but they're very capital efficient. So we continue to look at those opportunities. In terms of geographical selection, I think our numbers have taught us and further kind of reinforce the belief that we feel that the best use of a capital continues to be in core markets, where we feel that for the next several years, the expansion of the economic activity reflected in the growth of the office and the aviation market will make sure that there's adequate margin for safety for us to deploy capital. So it will be within the markets that we operate in right now. At this point of time, we don't expect diversification of markets beyond the core cities. In terms of segment, we have a pretty balanced approach. About 50% of our income comes from upscale assets. On a year-on-year basis, you may see some variation because acquisition is a very opportunistic-led business. But in the long term, we expect to maintain a balance between our upscale and a broader mid-scale portfolio. Coming to your last bit, which is on food and beverage, that's a very interesting question. What we have realized is that a bunch of our assets, especially in the upscale space, they have tremendous opportunity of us improving our market share in the food and beverage segment. And that's where a lot of our capex is going to help sure that we increase our F&B income.
Right. Thank you so much, Mr. Ashish, for giving us those insights, and the focus remains on the upscale segment. But now we move forward to Dhanuka Agritech, and Varsha is going to be addressing this. Varsha, it came out with Q1 FY25 numbers.
Yeah, right? Well, thanks, Anushi, for that. So yes, if you see Dhanuka Agritech's revenue was up 33%, while EBITDA margin is at around 15%. So to talk to us more about the numbers and the outlook going forward, I am joined by Mr. M.K. Dhanuka, who is the Vice Chairman and MD of the company. Happy to have you, sir, on the show.
Thank you very much. Let me clarify that in the recent meeting of the Board of Directors held on 2nd of August, I have been nominated as the Chairman instead of the Vice Chairman of the company. So right. From 3rd onwards, I am the Chairman. And Mr. R.G. Agarwal, who was the chairman, he has become chairman emeritus. And Rahul Dhanuka, son of the chairman, is now the managing director.
Right. Congratulations for that, sir.
Thank you.
Starting with my first question, given the strong momentum that we have seen in Q1 with 34% year-on-year revenue growth, do you believe that this is the right time to just revise the guidance from 18% to maybe 20 to 25% for FY25?
No, actually, the July has not gone well. We were expecting good rainfall in July, but scattered rainfall was there in the month of July. And from 25th July onwards, the rainfall has picked up. So the consumption of VD side has basically been very low. And the VD sides which was placed in the month of May and June, that has been returned back. Some quantities of that has been returned back by the dealers and distributors. So that's why we are continuing with our guidance of 18 to 20% growth in the top line for FY25.
All right. And also on your EBITDA margin side, so do you see your EBITDA margin going to around 21 to 22% given the current performance?
No, we have rather given the guidance of 100 pips degrowth in the EBITDA margin because of the introduction of new molecules and expenses being done incurred on marketing for promotion of new molecules. So that's why there can be a dip of 100 pips approximately in the EBITDA margin over last year.
Then where, is there a chance that we go to our EBITDA margin of 22 to 23%? Because I think in last September 2023, we had around 23% of EBITDA margin. So was that a one-off or extraordinary thing that we did last year?
You see, the second quarter is the best quarter. Ours is a seasonal industry. So quarter-wise, the revenues and the EBITDA margin differs. So second quarter is the best. So that's why the EBITDA margin in the second quarter is also higher. But overall, we are given guidance of 18% EBITDA margin for the whole year.
All right. Also, regarding companies' engagement with innovator partners for manufacturing patented technical molecules, how has the engagement been progressing?
No, it is at initial stage only. We are are in discussions with our Japanese partners, and considering our relationship of more than 25 years, we do hope that sooner or later we will get the molecule from the Japanese companies. Japanese companies are slow in taking the decision, but once they decide, then it is for long term. So let us wait for some time, and we hope that something will definitely happen in this direction.
Also, can you provide a breakdown of volume versus price-led growth in the current quarter?
Yeah, the volume growth was 39%, while the value growth was 33%. So the prices has reduced to the extent of 6% in the first quarter.
Also, as you said that Q2 is our best quarter. So how are you seeing Q2 shaping up right now?
As I told you, July has not gone well. So August and September we are dependent because the maximum consumption of insecticides and fungicides is in the second quarter in August and September. So we are confident once the south season will start, we will be able to coop up and August and September will turn out to be good months overall for the company and the industry.
Also, I wanted to understand on the volume side. So we have seen almost 39% volume growth, which is actually very good. Now, how do you see the industry for the quarter? What kind of growth are you anticipating for the industry in the current year?
I expect that the industry should have grown half in comparison to what Dhanuka has grown, because we introduced some new molecule, PARS, Lanevo and Mycor Super, for which we got a very good response from the market, which has boosted our revenues in the first quarter. But the other companies have not been able to launch some new molecules, or they have not got that much success in the new molecules. So these new molecules has played an important role in our top line.
And also on the specialty side, so what is the revenue mix? I mean, what's the contribution of specialty chemicals to overall revenue?
Overall, specialty is around 50-50. 50% or specialty and 50% is basically generics.
Also, and in terms of non-availability and rising freight cost, how is the scenario now? I mean, is it still same, or it has started improving? And are you able to pass on the increased freight cost to farmers?
Yeah, definitely it takes some time in passing on the cost to the farmer, because initially in the system, in the pipeline, the old cost inventories are available. So when the other peers also increase the prices, only then it is possible to increase the prices. Specialty portfolio, there is no change in the prices, but only it happens in the generics, which are coming from either China or from the domestic manufacturers. So definitely the prices are now either stable or they are on the rising trend, and the freight cost, which went 4-5 times, has now come to double only. So some freight has been reduced now from China to India, and we are confident that as the season will further progress, we will be able to pass on the cost to the consumer.
All right. Well, thank you so much, sir, for answering our questions, and all the best.
Thank you. Thank you, Varshali.
Well, this was the management of Dhanuka Agritech. Time for a short break. Lots of news on the other side. Stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
So it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future, as we've got your options covered. Futures and options strategy that'll help you move with the tide. An unmissable trade if you want to be in the money.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to
Hello and welcome to NDTV Profit. My name is Rucha Somaya, and today we have with us the MD of Scams, that is Mr. Anuj Kumar. Thank you for joining us. We appreciate your time with us. So the company reported Q1 numbers. Revenue was up about 27% on a year-on-year basis, while net profits were up 40%. So what is your first take on the results this time?
Good morning. Thanks for having me over on the show. I believe the results are strong and sustained now for a period of time. If you look at the quarter, blended revenue grew about 27%. This rode strongly on mutual fund revenues growing 26%. But also non-MF continued firing on almost all cylinders, and that component of the revenue grew 31%. All of this was done efficiently, so absolute EBITDA grew upwards of 36%. Absolute PAT grew about 42%, and just from an efficiency perspective, both EBITDA and PAT on a year-on-year basis grew about 300 absolute points in terms of margin contribution. So I think a sustained set of results, and underlying this, there is strong operating performance across products, which is reflected in the financial results.
Right. Last time we saw a lot of pressure on the yields in the MF part of the business. So what is your take on the MF side of the business?
So on the MF side of the business, I think there's been a set of strong, some of those are once in a lifetime kind of metrics. Our assets grew gross 35%. Equity assets grew a staggering 55%. We got almost 70% of equity net flows. You know that equity net flow is perhaps the metric to watch in the market. If there's one metric you're watching, that we had a contribution of about 71%. Overall, over 90,000 crore of equity net flow. On the NFOs, we garnered almost 82% of all flows. On the SIP front, it was a lifetime high of about 93 lakh SIPs getting set up. So across the board, I think almost once in a lifetime, aggregate metrics that I have seen. On the yields front, I think it was the most stable quarter, which means that aggregate, I think the yield performance, there was a very small compression, which was as per our expectation, but yields are holding out.
Right. In the last quarter, we saw a bit of pressure because of the renegotiations on payouts with AMC. So what is your take on the kind of renegotiations and the pricing around that front?
So you know that the pricing architecture is a small compression because of the telescopic pricing. It's like when you increase the bulk, you pay a little less. That is the deal for the AMCs. That takes out about 2 to 2.5% of price annually, give or take in that range. So think of aggregate compression to be in that range. We have some contracts up for negotiation this year, but I think we are doing a reasonable job of making sure that yields hold out broadly in the long term.
Right, right. So how big do you see the non-MF, if we move to the non-MF side of the business, how big do you see this kind of business going ahead? Because a lot of brokerages expect the non-MF business to rise in the next 3 years. So what's your take on this side?
We are very happy with the performance of the non-MF portfolio. If you see the stuff that we've done over the last 3 years, I think the story is playing out almost entirely. And I'll just give you some snippets. So at the aggregate, we said non-MF will continue staying ahead of the MF growth. That's held through this quarter too. So non-MF has grown 31% in absolute revenue. Within that, if you see the performance of the KRA business, that's grown 100% year on year. Now that's a stratospheric number. It is playing out because we are now participating in the DP and brokerage segment. It was largely an MF play earlier. We believe that there's still steam left in the KRA growth story, and you'll perhaps see similar numbers in the rest of the year, at least. Similarly, on the payment side, we came out to be one of the top 3 in India in the BFSI sector in UPI Auto Pay. So that's great vindication of the effort and the investment we made in the product. Overall, the payments business grew 44% revenue year on year. And again, I believe there is steam still left for similar numbers to be posted, at least for the rest of this year, if not beyond that. Thirdly, on the account aggregator side, while the numbers are small, I think from a product innovation and market share perspective, we've continued to scale. So we have now 16% of overall consent-based linkages in the industry. This number, you remember 2 years back, used to be about 2 or 3%. So I think from a product and go-to-market perspective, the team has done a fantastic job in scaling all of that to be at 16%. And so those are 3 large or significant parts of the non-MF stack that have done well. On alternatives, we grew revenue about mid-teens this quarter. Our aspiration is to continue growing upwards of 20%. There were some old contract fall-offs, as you know. It's a closed-ended industry. So at some time, a contract which is 7, 8, or 9 years old will come to an end. So we saw a little more of that incident in the current quarter. But we believe that for us to aspire for 20% growth in this segment, the domestic segment of AIFs, is completely reasonable. And the last thing I would say is that from an insurance perspective, while we still don't have large revenue lifts to report, I think from a product perspective, both growth in EIA, which is electronic insurance, and Bima Central have been very gratifying. In the quarter, we added over 1 million EIA accounts and over 1 million policies. We've never done this in the past. We expect similar numbers to come through in this quarter also. So I think the heft that we are creating in the overall insurance business is pretty strong. On Bima Central, we have about 1.5 lakh users of the product, about over 40,000 downloads of the app. So overall, that is also playing along well. So there is, there are these 4 or 5 key segments in the non-MF play which have done well. We'd added a lot of investments, built out platforms, and created go-to-market strategy for all of them. And I think that is playing out in the current day.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are
serious gashes and no other way to describe it. Yes, you could argue that the optimist will say that we are off the lows of the day, and the intraday of the Nifty, if it comes up on your screen next, will show you that yes, we might be off from the lows of the day, but still 2.7% lower is a significant downtick in trade, and it follows what the rest of the world is doing. Just get the intraday of the Nifty if we can for a moment, and then get the heat map up on the screen, and you will see what I'm trying to say. Pain at the broader of the spectrum, even more so, in the metals even more so, but from the lows maybe marginally higher, but really nothing convincing. The US markets may be off again from the lows of the day because Nasdaq is not down. Nasdaq 100 futures are not down 5% currently, they're still down 3.5%. So therefore, there is no taking away the fact that the world markets are in a bit of a tizzy and we are no different. And for whatever it's worth, I'll pull up the heat map, but there is, well, not much talking about, save for a few names which are defensives, and that's essentially the same set of 6 names, if you will, which are kind of moving around in the green and staying higher. But otherwise, I mean, just look at the cuts that have come into businesses and stocks. I mean, just for the metal stocks to get punished the way they have, upstream oil to get punished 6% as well. It is bloodbath across the screen, and I fear we may not be at the end of it, but who's to say that? Tamanna, broader markets even more worse off.
Actually, if I were to put it in 2 or 3 terms, that would be number one pointer there. The broader markets are hit much harder than your key indices, as ugly as the Nifty cut is looking. Secondly, spaces which have run up massively and where the valuation question was hovering have been hit the hardest. So if you pull up your sectoral indices, you'll see that as well. There you have the small cap 250. Yeah, so realty, metal, media, PSU banks. So if you look at this, of course, everything is hurting. So everything is in relative terms right now. The ones which have run up the highest have also been hit the highest. Even as we're talking about Indian markets, I just want to quickly pull up for you where some Asian markets closed and where Europe is right now. Because what we need to assess in the next hour or so is how deep that pain will continue. I mean, Nikkei is a mess. You have the finance minister of Japan coming and saying that we're trying to figure out what's happening. I don't know if the governor of Bank of Japan makes a statement, but 12.5% down there. Just want to pull up Europe for you right now and give you a sense of what's happening there. And you know, it's a second day of that carnage continuing. Everything down deep in the red. Your US futures, as Neeraj said, is also looking very, very weak. I just want to pull up I mean, I don't even know if we should look at the NSE 500 gainers and losers. All right, let's pull that up to see if there are any over there to talk about. If you're looking for spots of green, they're coming into the consumption story. That at the end of the day, the Indian consumption story will continue. People will buy their toothpaste, their soaps, their shampoos, etc. Philips Carbon Black has been on a roll and a story of its own for the last several days. Cera Sanitary is doing okay. Devyani International, because if you're looking at some, discretionary spends coming in, Marico numbers were decent, Dabur, HUL. So you have those kind of stories which are doing relatively okay. On the losing side, I mean, there are just so many, too many to actually even talk about, which are hurting very, very badly in trade today. So it's going to be a broader story. It's going to be a broader sort of theme over here, because like they say, when a floating tide or a rising tide makes all boats float, when that tide turns, there are a lot of those who are exposed. And well, there is a lot of exposure in these markets today, no doubt about it. Having said that, we seem to be off the worst points of the day, Neeraj, if that's any solace at all.
Yeah, is it a solace? Actually, let's ask Manpreet Gill of Standard Chartered that, because the world markets, as I said and as Tamanna said, continue to stay in a bit of a tizzy. Manpreet, great having you. Thanks for joining in. And it's a great time to have you, because you look at cross assets so closely. Everyone's toying around with what the single biggest cause for this correction is. Is it US data and geopolitics? Is it geopolitical tensions? Is it yen carry trade or more? Now, tell us what your thoughts are and how extended can this be?
No, I think there's a lot of searching for what exactly triggered this. And in my mind, there are two factors that really are driving the sell-off we're seeing pretty much in all equity markets around the world, right? I think one is just a reassessment of where US growth is, because on Friday night, one catalyst we got was labor market data, where we saw much more weakness than markets were expecting. And when you look at the reaction, US markets, bond yields moving lower, the pricing in of Fed rate cuts, I think that's one area where there was a little bit of concern. But I think the bigger driver of what we're seeing today, especially, is an unwind of the yen carry trade. Because look, a strengthening of the yen is something we've sort of flagged concern about for some time. But the Bank of Japan sort of stands out as an exception as the only central bank that's still tightening policy, when the Fed, the ECB, and most other major central banks are considering cutting rates. And what had happened is that when you look at investor positioning, we thought it was quite excessive, both on the short side on the yen and on the long side in trades like US tech. And I think the catalyst came together to really trigger an unwind of that. So in our mind, that really is a big driver behind what we're seeing. Geopolitics, yes, I think in the non-financial headlines, that's sort of the real headline. But from a financial market perspective, I'd argue that oil prices, show that that's not really the concern here. So the good news is that if this truly is unwinding led and it stays there, then those kind of moves tend to be short-lived in nature. I think the real risk we need to follow beyond the positioning unwind is obviously US labor market. I don't think that will be a cause of lasting concern when we're talking the next few days, but longer term, that's the risk I'd monitor more so than positioning, which I think we've already experienced to some degree.
Manpreet, are you saying that and again, it's an if, because I don't think there is a clear answer here, but if the yen carry trade unwind is a principal reason, then it is short-lived? Then the impact may be short-lived?
Yes, because when you think about positioning-led pullbacks, right? When I say they're short-lived, they tend to be measured in weeks or perhaps even a month, which is very different from fundamental-led sell-offs, which can be more of a 6 to 12-month type challenge. I think the real difficulty today is, there's obviously that search for a bottom, saying, okay, has the yen stopped where it is at 143, 144 levels? Are we going to 141? That's very, very difficult to gauge. Much better strategy is almost to wait to allow the dust to settle a little bit. I think where we can draw a little bit of encouragement is that when you look at a few other metrics like the NASDAQ, you look at US 10-year Treasury yields, or indeed the Nifty, right? We've seen pullbacks, but pullbacks that are still well within ranges we've experienced this year or within the last 12 to 18 months. So it's not that we've broken, well out of, recent trading ranges. We've just lost some of those gains in an unusually rapid or short period of time, leaving aside what's going on in Japan domestically. So to me, those sort of factors, together with the fact that going into this, we express a lot of concern more about positioning, and that then is what tends to trigger these sort of moves. To me, hard to decide whether the bottom comes today or later this week, or whether it's a couple of weeks away. But those are shorter term in nature, and those tend to, usually pause at some point, unless fundamentals really weaken. So that's really the lens I take.
Manpreet, hi, good afternoon. A lot of the chatter and the conversation is, are we going to see some unexpected comments from both the Bank of Japan and maybe from the Fed? Out of cycle kind of comments to calm fears. I was just wondering if you had a view on that, because the Bank of Japan decision has clearly not gone down well. We've heard from the finance minister in Japan. And do you reckon that there would be some kind of indications that central banks will want to give, that it's not as painful as it seems?
I think how central banks separate the short and long-term messages will be quite important, because where I think we're getting a lot of concern is, of course, no one would be comfortable with a 12% move in a headline index in a single day. But having said that, if we sort of just zoom out to the bigger picture, let's not forget that the Bank of Japan and Finance Ministry were also uncomfortable with the yen just getting weaker and weaker and weaker. Discomfort with volatility can be very different from discomfort with a certain level or valuation level, for example. So in terms of the messaging we get, I'd really be looking to those two messages to see how separate and distinct they are. I think that's on the Japanese side, of course. I think in the US, we do have a lot of scheduled Fed speakers through the course of this week. So there's going to be a disproportionate amount of interest and focus on what they say. I think at the last meeting, it was fairly clear that there was rising comfort with a steady sort of series of rate cuts starting later second half. I think most sort of took that to be September. The real question is whether there's anything in the labor market data that causes them to accelerate that timeline, or whether they see this as volatility, but not something that's a cause for concern in fundamentals to accelerate that. So again, trying to separate the discomfort with short-term volatility to do they see any changes in some of the longer-term fundamentals.
What about the India view, Manpreet? Obviously, we're not going to be unscathed from what's happening around the world, and the sense also to some extent that this was coming, valuations had gone up, sometimes in some stocks and sectors that really didn't deserve the kind of valuations which were coming in, frenzy, etc. Do you see a long-term impact for India? How do you gauge India in this bigger story?
Well, look, Indian markets don't operate in isolation. So what's going on elsewhere does matter. And it's a point I made on my several of my India trips, that often the risks for Indian markets tend to have, come from somewhere else in the world, not domestically within Indian markets. So I think, look, on the way down, often markets sell down across the board, right? Good and bad. That's just the nature of sell-offs in every cycle. I think the distinction tends to come when you get stability and the rebound. And undoubtedly, there are pockets of froth in different parts of Indian market. But, our view, for example, has always been that, we favor Indian equities from a regional perspective, the overweight relative to other Asia ex-Japan markets, because we see more sort of optimism for growth. And second, we said, look, one way to sort of navigate around those pockets of froth is to be more conservative in how you take that exposure. So we still favor large cap equities over small and mid cap, for example. So we think those messages don't really change. I think if this is, like I said, in a big picture, this is positioning led, a pullback that's across risk assets worldwide. Indian equities cannot be immune to that. That wouldn't change our fundamental view. I think it does make sense to avoid areas of froth, because then you're really trading momentum, not fundamentals. So in our view, it would be more about large cap equities. It would also be about looking beyond equities. I mean, in our multi-asset view, we've taken more of a balanced view between equities and high quality bonds. And bonds have actually done pretty well, as bond yields have fallen onshore as well. So those, I think, trends are still equally valid today. And I think those kind of allocation we'll be quite comfortable holding. Like I said, the real risk I'd still sort of monitor is just the US economy, because as long as that holds up in a soft landing as we expect, then we'll very well likely get through this.
One swallow doesn't make a summer. One set of jobs data perhaps doesn't bode completely towards a recession. Just one last question from my side, Manpreet, on the India story. Relatively still looks attractive. What are the spaces that you find with still some steam to give within sectors in India?
So I think from a sector perspective, obviously a few different places to look. I mean, just as an example, financials is one area where earnings are strong and obviously yields being high, should be a tailwind. But more than sort of the sector view, I think that the big sort of slice, I think, might be more useful in today's context is the large versus small and mid cap. Because looking backwards, you'd argue the small mid cap were a better place to be just from a return perspective, but we think the risks are a little bit high there, right? Especially when you think of valuations and froth. We think large caps is one place we'd still look at. That's sort of one preference we take. The other one, like I said, even looking beyond equities, right? Equities may be the main source of return through a big bulk of the cycle, but what we shouldn't ignore today is the opportunity in bond yields as well. We think that still makes sense, and last couple of days helped illustrate why. So I think it's about looking across those two areas today, as opposed to necessarily looking too deeply into sectors just yet. I'd really wait for the dust to settle a bit first.
Thank you so much, Manpreet, for coming in and speaking to us. Always a pleasure. Manpreet Gill saying a few important things, and if I were to just recap the highlights out of it, what happens with the US economy is most important right now. Does that poor data sustain, which deepens recession concerns? India is looking relatively still attractive. A lot of sectors to pick from. Financials are one of those that he talked about. But you'll be hearing this term through the day and perhaps over the next few days, yen carry trade. Everyone's talking about yen carry trade and how that has really spoiled the party. Vishwanath Nair is joining us now to explain, and that's what we said, Vishy. Tell me like I'm 5. What is the yen carry trade and why are we talking about the end of the yen carry trade?
Yeah, some terrible jokes earlier in the newsroom, but I'm not going to repeat that in front of the camera. But the yen carry trade, interestingly, this is not the first time that this topic is being talked about. But what is happening now is relevant simply because what happened in the markets earlier today. So what exactly has happened in Japan and therefore in the yen? The Bank of Japan, which is the central bank in Japan, had announced a rate hike last week on Wednesday, which forced investors who had been borrowing actively in the yen market to change their tack. Essentially, what this rate hike meant for these traders was that the carry trades that they were conducting, it basically got erased. All the gains that they made got erased simply because the yen started strengthening. Now, what that also leads to, I mean, why exactly this yen strengthening happened was because of weaker than expected jobs data that came from the US, as well as some mixed corporate earnings over the weekend from the US. All of this led to a lot of change in tack within the yen carry trade space, and investors started pulling money out from these highly risky assets that they were making money on. Now, what exactly is the carry trade? Now, that's what we need to fully first understand. Investors go to markets like Japan, where the interest rates were at all-time lows. The currency was fairly weak in comparison to the dollar. Borrow money from these markets and then go out and invest in higher return markets, typically markets which had higher interest rates, where the currency was slightly stronger. So you would go and invest in assets in those markets, and with the differential, you would make money. Now, what these kind of carry trades allow is that these higher yielding assets basically make more money for these investors, and the opportunity cost for this entire investment is quite low. And that's why carry trades became a very, very preferred sort of mode of transaction for a lot of investors. What has prompted this? Before that, let's look at the size. So at this point in time, we don't have a fair amount of understanding of what exactly the carry trade size is, but the expectation is about hundreds of billions of dollars worth of investments have happened in high yielding assets through these funds that were raised in this carry trade fashion. Let's try and understand what exactly prompted this kind of situation in the markets. Rates have been hiked by about 35 basis points in Japan over the last 4 months, and that precisely pushed up the yen. Japan's historically negative interest rates, and also you've got about multiple years of quantitative easing by the Bank of Japan, which had led to a long period of easy money floating around in Japan, and that prompted this introduction of the yen carry trade, which became very, very popular across the world. Yen, of course, was also weak in July, just a few weeks ago, that is. In July, it had reached its lowest since 1986. So there was ample opportunity for people to play that arbitrage and make money on top of that. However, just last week, the Bank of Japan, as I said earlier, said that they're going to raise their interest rates. They're hinting at another hike later this year. So all of this pointed to a slightly more hawkish tone from the Bank of Japan. And they are also going to start with quantitative tightening, which will reduce the balance sheet size. The expectation is that their balance sheet size will reduce by about 8% through the current moves that they have announced. And then future moves will lead to further sort of reduction in the balance sheet size. Now, that's very, very important from the point of view of any kind of international investor. And they want to maybe save themselves from sudden rise in interest rates in Japan, and that's why they are unwinding these carry trades that they had invested in earlier. That means a lot of money gets pulled out of higher yielding assets, and that's probably what you were seeing in markets across the world, including India. Back to you, Tamanna.
All right, so that's why everyone's talking about what Bank of Japan did and the yen carry trade. It's simply the loss of that arbitrage opportunity that we're seeing. We're going to take a very short break, but we're coming back and talking about what you should do when market jitters are deepening. Meanwhile, if you're looking at the flash at the bottom of our screen as I am, it is definitely a day of global crisis one way or the other. Prime Minister Sheikh Hasina is likely to resign in Bangladesh is the report coming up. Also one that she might leave the country. All that and more, and of course, sharp focus in the markets when we return. When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Welcome back. You have just a little over half an hour of trade in the markets today. And I mean, if you're still sticking around and being brave, kudos to you, because it's definitely looking like a rough day. Hemen Kapadia now joining us for more perspective. Hemen, I mean, do you see any signs of resilience anywhere on the charts?
Not exactly, Tamanna. I think Neeraj earlier mentioned about some stocks doing the same thing, something like Hindustan Unilever and stuff. So it's just those some of the FMCG stocks which are sort of swimming against the tide. But frankly speaking, Tamanna, the laws of gravity needed to catch up. We had gone up one way. I mean, time and again, it looked we were stretched and overbought, but market just refused to correct. It needed a reason. On Friday, the US VIX went to 29.15, Tamanna. So the VIX shooting up today was also expected. And yes, I believe currently 24,100 is something which the market won't close below today. But no, nothing much. There are a couple of gaps on the daily chart, Tamanna, which are not good. They need to get covered up, and I don't think the first gap of Thursday to Friday will get covered up in a hurry. So I guess there's going to be some time and price before we see stability coming in, Tamanna.
I mean, it's a tough afternoon out there for sure. So, but the markets have fallen a bit. It looks precarious. Are trades on the short side, or are you avoiding very large trades? So, I mean, qualify that also. Even if you're taking the trades, are you taking them in measured ways in smaller quantities, or are you doing the normal quantities, if you will?
Very, very, very valid point, Neeraj. Absolutely agree with you that, frankly speaking, there shouldn't be any trades. Like the earlier guest talked about the yen carry trade. I mean, these repercussions are something which you can't have normal criteria to measure. So, I mean, all these things to juxtapose, you have geopolitical Bangla. I mean, there are so many things, so many moving parts. So, frankly speaking, in a market like this, if this is not your living, I don't think you should be even making a living in a market like this. I mean, intraday or very short-term trading. Just avoid, wait for stability to come in, wait for the US VIX to fall, wait for the Indian VIX to cool. Obviously, it won't happen, Jiffy, but just wait for things to settle down. Let's see whether the support levels are working or not, and then take a stand, because currently it's still too, things are in a flux. So I would rather not do anything at all, honestly.
Himen, I dare say ask you, what is your strategy for tomorrow and for the next half hour?
Okay, next half hour, no, but I will go out on a limb and give two stocks which come with a caveat: please don't trade. This is academic interest only. But on a lighter note, the Nifty has taken support on the 55-day exponential moving average, but a couple of stocks which are looking slightly better than the rest of the market. First one is Rosary Biotech. We've overcome the 900 level after 1.5 years. The longer term charts are looking very positive. So once again, it's a conditional buy call. Buy at 900, stop loss 850, target 1000. Once again, if you can avoid the trade, technically everything is fine. It ticks all boxes. But on a market like this, I guess everything takes a back seat. Sentiments, volatility take the front seat. And the second one, which I like, is Mahindra and Mahindra Financial Services. So the fourth wave on the monthly chart, as far as the Elliott wave is concerned. We've been consolidating over here for more than a year. Now it's beginning up. So it's not a very short-term call, but yes, one can buy it at 290, stop loss 275, target 320.
Okay. Well, I'll take that, Himen. And I take on board the point that with a caveat that one shouldn't trade. You're saying, you're still giving these ideas. Himen, very quickly before we take that break though, metals and how precarious does it look? So, you know, there were some long calls last 4 days ago on some of the aluminum or the non-ferrous side, right? Forget steel. But everything from a Vedanta, Hindalco, etc. is corrected. How much further on the charts do you see?
I'll just take 30 seconds. Firstly, if I look at the Nifty Metal Index, Neeraj, it's frankly speaking been correcting for 8 weeks. So the correction has started even before the market was wobbly. International copper suddenly turned weak, and that dragged it down. And the stocks that you mentioned, I mean, I'll just briefly talk about Nalco and NMTC, and even Tata Steel. So Nalco, if you see Neeraj on the charts, there's a distribution pattern rounding top, and we've stagnated for the last almost 10 weeks. So this is already there. So I would say some more pain possible.
Okay. Okay, Himen, let's stay on. Lots more to talk about. Some more pain possible on metals, and look at the kind of falls that we've seen there. We take a quick break though on that note, on the note that it isn't getting any better. Keep on showing you what European markets and US futures are doing, of course. But on the other side, we'll try and talk about the derivative space as well, and maybe try and understand what is bucking today's trend and why so.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target?
Back with India Market Close right here on NDTV Profit. Let's go across to Agam, who's standing by for breaking down the derivative cues for the day today. Agam, are there some outliers or is it short build-up all over?
No, certainly short build-up all over. It's been a tough Monday morning and tough Monday, in fact, in general overall, especially for those who are long in the markets, because now there's a little bit of indecision of whether or not they should, in fact, move out of plenty of the stocks which were sitting on substantial gains. And, to a certain extent, a lot of those gains have been wiped out, at least partially speaking. And because of that, there is still a little bit more trepidation as far as the bulls are concerned. For now, of course, the Nifty coming off by around 2.5%, testing 24,000. At one point in time, we did go below that mark as well. A lot of shorts being built into the system earlier, and now, unwound to a certain extent, but and that's a result of 2% decline in open interest. In terms of the bank Nifty, we continue to see more and more shorts building into the system for the third straight day, in fact, even as the index comes up by around 2.5% there as well. This one also tested 50,000 on the lower end. Well, and naturally, the options market will have seen a considerable sea change of levels that we can keep an eye on. As you can notice, 25,000 has now completely out of the picture. 24,000 comes back, and with a lot of put writing. And as I was suggesting earlier in the morning as well, that 24,000 will be a little bit of a pivot point, if not a support level. But we're seeing a lot of puts being written there. So perhaps some traders, at least out there, are expecting the Nifty to halt its decline, at least in the near term. But when it comes to stocks, it's not been a great day, right? Because we've seen shorts in Samvadan, which is taking a knock around 9%. Vodafone Idea down 4%. PI Industry is also under pressure. You have a handful of names like Marico and Dr. Lal Pathlabs advancing. Marico, of course, reacting to earnings, and the FMCG pack also doing well. India Mart also under pressure. That's down around 5%, along with Chambal Fertilizers. And Chambal Fertilizers has been so very volatile around the mark of 500. But all in all, not a great day of trade for the benchmarks, nor for stock-specific action, and that is evident in the futures and options space as well.
The only stock-specific action, let's just pull up Paras Defense, and I just saw those lines on the screen. The numbers are out, and 76% gain in revenue. Look at the spike up. If there is some sort of green shoots and hopes, The market is rewarding it. Their EBITDA has more than doubled from 11 crores to 24 crores is what I remember seeing. So good numbers in the face of it for Paras Defense. At least that stock is seeing a bit of green over there. Meanwhile, Vijay Chopra of Enoch Ventures is joining us as well on the show. Vijay, very good afternoon to you. I hope it's been a relatively good day and a decent afternoon. Tell us, what are you thinking right now about the markets and what would you do next?
Well, I think that the satire was very good. Any person in the market, cannot enjoy this kind of redness. But, I was, Tamanna, talking about this, leave high beta, get into a low beta sector or segment of stocks. And I've been iterating it time and again. And I'm sure that you must have also, gone through my comments. So I think that, this carnage which has happened, probably we are going to see it some more because definitely markets were doing its excesses. The kind of run-up we have seen post 20,000, so there was no serious correction post the election day thing, barring that election day thing, we have not seen a serious correction, and that was also a V-shaped recovery. So I would say that, this correction would make stocks healthier. So there are lots and lots of good companies which we are having on our watch list. I would rather wait and, wait for the dust to settle down for a couple of days. And, there are great opportunities in the, I think, in the public sector space, in banking, in oil and gas, in chemical space, in paints. I think that there's a lot of opportunity in the market. And definitely money will chase good companies. But yes, the froth has to be taken out very frequently. And these are one of those days where, the froth has been taken out. And I would rather call it a necessity, or it was necessary for, for us to see this kind of a correction. Although nobody of us, any of the market participants who are primarily long only do not enjoy this kind of redness in the market. But I think that, this would make the market healthier, and there would be a lot of opportunities to enter into fresh stocks.
Okay. So, well, that's that. Vijay, everybody was waiting for a dip in the defense names, right? High beta, of course, yes, but there is an order book out there which has to be fulfilled. That isn't changing because markets have come off. Would you use these dips or maybe further dips to buy into defense? And if so, what within defense?
Well, yes, Neeraj, I think so. That, defense is a sector for the next maybe 5 to 10 years. It's not 5 months or 10 months, I think that these companies the orders would keep on pouring in. India is going to become a major center for defense production. And the smaller countries are going to look up to India like we look at maybe France or US or UK and maybe Russia for certain technologies. So our companies, whether they are shipbuilding companies or aircraft building companies, or maybe companies like BEL or BEML, they have developed capacities in the last 5-10 years where they can cater to these smaller countries. They do not have such capabilities. So I would say that just wait for some more time. There might be some more crack, and these companies would be, at good levels to enter. So all the companies you are showing on the screen, they would be, I would be a buyer in that. So similarly, rail companies, the kind of order book rail has, these rail companies have is also very, very interesting. So all these, RailTels and RVNLs and IRFCs and IRCTCs of the world, they are going to do well. So just wait for some time. I think they're going to come back very, very sharply. Once the market is oversold, we are going to see a major short covering as well, because nothing major has happened in India. So let me tell the audience, through your channel, that all these factors, whether it's Middle East or things happening in US or Japan, yen carry trade and all. So how much money has India received through yen carry trade? I think that it is minuscule as compared to US and Europe and other countries. So India anyway was not getting much money through yen carry trade. So it's just a knee-jerk reaction. This has become one reason for our markets to correct. Markets at times, they find reasons to correct. So this has become one reason. And I think it's good. As I said earlier, this would make our markets healthier. If there is no major political or geopolitical, no major jitters globally, I think our markets would come back. And
what
I'm
is
sure
the,
that
Vijay, one second. You're, one of those voices who are a little positive today. You're saying that when there's a pullback, our markets will come back. You're looking at rail, defense. A lot of people today have been saying those are sectors which are overheated. What do you think is going to be the trigger there? Because we're going to have to wait to see the situation clear up globally, isn't it?
Absolutely. As I said, let the dust settle down. And it's very difficult to predict, Tamanna, whether it's 1 day, 1 week, or maybe a month. I don't know. But yes, these sharp corrections would help the market in the longer run. And a lot of good companies can be entered into. Mind you that the kind of money which is pouring in through SIPs and our domestic institutions are sitting on loads of cash, and it is coming on a daily basis. So it has to be deployed. So these corrections would make good companies even better. And for sure, I'm sure that they must have exited on the top and they are waiting for entry points. So all these sectors I have talked about, these are great sectors. Just to give you an example, a company like Chennai Petro, it's a Government of India company invested by Indian Oil and Government of Iran, trading at a price to earning of around 5, huge earnings and huge order book, fantastic potential. Anyway, in the oil and gas space, which is close to a consumption space, I would rather latch on to this kind of a company. 940, 950 is a great price to get into this company. And so I'm sure that money would chase sense, because a lot of nonsense was also happening lately. And these corrections actually wake up a lot of people, even fund managers, apart from retail investors, who generally lose in such situations. But yes, these are wake-up calls and course corrections for the market.
All right, wake-up call, course correction, a lot of ways to describe what's happening right now. Now, one sort of stand-out factor has also been how the defensive play has strengthened. If you look at a heat map of the Nifty right now, you will see FMCG stocks standing out in trade today. Various reasons for it. Let's pull up a heat map of the Nifty, and you will see FMCG stocks standing out. And one of the reasons is also results. In some cases, it's a defensive play as well. Mahima is joining us with more. Yes, Mahima.
Right, Tamanna. So as you rightly mentioned, a lot of these FMCG names are, bucking the trade today, and this is because, it's the defensive play that's taking place now. Couple of things which have also aided growth for this FMCG stocks is that there's been significant recovery in the rural demand, and overall margin expansions for a lot of these names have taken place. Now, Britannia particularly is buzzing on the back of its Q1 FY25 earnings, which came out Friday post markets, where numbers are largely in line. Margins were slightly below the estimates. Net profits were also slightly below the estimates. However, the volume growth was around 8%. Value versus volume was around 6%. And for Britannia as well, the rural demand outpaced the overall urban demand. And they continue to target 2% cost efficiencies every year is what the management has guided today in their con call. And they've said that they might further take price hikes of 4 to 5% if the raw material prices keep rising. Now, Marico is also buzzing in trade on the back of its Q1 earnings, which were announced today. Numbers were largely in line in terms of net profit. It grew around 8.7%, and its margins have also expanded a tad bit. Now, key highlights: volume growth of around 4%. The numbers were largely in line, like I said, and India sales growth was around 7.4%, and international sales growth was nearly 5%. However, the management has given their outlook in their investor presentation, and they've said that overall food portfolio will be 2 times by FY27. They've said that they aim for a double-digit EBITDA margin for the digital-first brands by FY27, and overall foods and premium care is expected to rise by 25% by FY27. And overall, they've also said that they expect to retain double-digit constant currency growth going forward. Now, other couple of FMCG names which are also buzzing in trade today include HUL, Nestle, Dabur, Tata Consumer, as well as Godrej Consumers.
Okay, thank you for that, Mahima. Let me go across to Himen and get his view on any of these stocks. I mean, obviously, a defensive play. We saw this right after the budget as well. We saw this right after the election result as well, where these come in for a sort of bit of interest. Do you see that sustaining on the charts, Himen?
Yes, I think if you look at the Nifty FMCG index we posted all-time high last week, and we are slightly but not comparatively very far away from the high. And the interesting one is Hindustan Unilever, Tamanna. We've been here for what? 4 years. 4 years. It's in a very, very large range. 1850 on the downside and 2850 on the upside, so that's 1,000 points. And for 4 years, we've gone nowhere. Obviously, there have been bounces on both sides. So if and when we take out this 2850 range, I think it's going to be the beginning of a bigger move. So still looks good. And selectively, yes, I think many of these FMCG stocks are even, something like a Dabur moved and has consolidated. But Dabur, Tamanna, has been here for 3 years. A breakout about 660 is going to take it past 800. So many of these stocks have taken years in a thriving bull market. I think their time for the place in the sun is coming.
Is coming. Vijay, do you think so? That time is coming now for the FMCG stock, which have really sat it out in this bull run, isn't it?
Well, there has been a long consolidation. Look at a stock like Britannia, ITC. Eamon mentioned about Marico, Dabur. So these are all behemoths. You open your closet, I'm sure that you will find 10 products which are from Hindustan Lever or Colgate or maybe ITC. So any closet in the country for that matter, whether it's rural or urban or semi-urban, you'll find all these FMCG company products. So why these are not moving? So one reason could be that, the per capita income is not increasing. People are not having that kind of disposable incomes. But yes, I think that, post consolidation, I suppose that, there is a lot of potential. Maybe, a stock like ITC, I see ITC at maybe 800 or 1000. So this is my target for ITC, but it has been consolidating in that range for a long time. So I would be a buyer in ITC if I get it around 460, 450. These are great levels to get into an ITC with a longer term perspective. Similarly, Hindustan Lever, Britannia, Nestle. Look at a Nestle, it hasn't moved much. But again, it's a global behemoth. And I think that, Nestle can easily go up to maybe 3,000, 3,300.
Okay. Well, amongst other things, while there is carnage across the street, Airtel is not spared from it either, and it's set to report its first quarter numbers. Let's get in Rucha to talk about what is it that one should watch out for when it comes to Airtel's numbers. Rucha, good afternoon.
Good afternoon. Thanks, Neeraj. So Airtel will report its numbers post-market. Now, talking about the numbers, revenue is expected to ride around mid-single digits, around 4%, while margin is expected to remain flat at just a little bit of uptick at 26.5% versus around 25% in the previous quarter. The net profit is expected to rise around 24%, but this is after adjusting the one time that the company had in the previous quarter. Now, the company had an exceptional items in the fourth quarter, but if we look at the India business will be the key thing to watch out for, because the Africa business has already reported numbers. Talking about the Africa business were reported weak margins, and the performance was largely impacted due to a currency hit because of the devaluation of the currency. The mobile segment, however, continued to see good traction, and this is what we will see in the India business also when the company reports its numbers today. Also, the subscriber addition and the conversion of 2G customers to 4G is what is to be watched out for in the results today.
So Bharti Airtel, I don't know if by tomorrow it will be business as usual, and tomorrow morning we'll be talking about Bharti Airtel numbers and seeing their ARPU, etc. Or it will be another day of pain, possibly one more day of pain that you could see, considering what we have seen across the globe and that, completely continuing. But when sanity returns, sooner or later. Yeah. I mean, I'm wondering if a Bharti Airtel is something that you would have on your radar?
Yes, but it's sort of corrected by going upwards. The oscillators seem to indicate little bit of heaviness. I'd be more comfortable buying this closer to 1400, Tamanna.
Okay, by the way, some flashes on your screen and Honeywell seems to have done okay. I mean, I don't know if they were estimates, but broadly on the margin front, they seem to have certainly done a lot better. And it's showing, it won't show up in the stock price move. I mean, yes, a bit of a flash here and there, but that's a trading flash really. But good numbers, net profit up 33%. Remember, much like ABB and Siemens, it's an expensive stock, but doing okay, Honeywell, or at least on the quarter. The revenue growth could have been better for an automation company. And I think you will see the chalk and cheese between Honeywell and maybe an ABB. I may be wrong, but I think I won't be based on the estimates that I've seen for ABB as well. The top line difference might be the reason why the markets have taken such a liking to an ABB or a Siemens or some others versus maybe a Honeywell automation. So bear that in mind. But expensive stocks, all of them have to be kept in mind. Speaking of expensive and speaking of markets, we spoke earlier to Vinay Jaisingh, and he spoke about how while markets have been anticipating a rate cut for a while, the latest Fed decision actually hinted at a cut in September, and whether these rates cuts have been priced in or no by investors is what we asked Vinay Jaisingh of JM Financial. Listen to a small slice of that conversation.
So, yes. So I think if you look at the 10-year chart, it's exactly what you're saying, which is, close to 4%. So 5.25 is already being factored in the bond market of having a cut of as much as 100 to 125 basis points. 3 months to 4 months, we don't need to be as cute as whether, you get 125 in 3 months or 125 basis points in 4 to 5 months. But, I think that will become consensus. Remember, 6 months ago, we were talking about 7 cuts and even more aggressive cuts coming in totality. I think that's behind you. Probably a 6 month forward comment of 4% interest rate in US for 10 years as well as a 4% interest rate for Fed of 4 to 4.25 is a lot more real. Now, when that happens for the first couple of months, my bet is people will realize why that has happened, which is, you're seeing delinquencies and mortgage rates, you're seeing credit cards, payment problems happening from the retail customer. You're seeing capex slow down in US. And when you see all these things getting added up, the market will probably, short-term correct before they realize, guess what, the cost of capital is going down, which is good news for the market. But that, I think, will be 3 to 6 months forward. So 6 months forward, you'll probably see the market a lot more stable to moving up. But in the next 3 months, I see a lot of volatility in the global markets.
Okay, now meanwhile, while we're talking about volatility in global markets, there's volatility in global politics also. A story that is unfolding right as we speak is in neighboring Bangladesh, where Prime Minister Sheikh Hasina and her sister have reportedly fled the country and taken shelter in India. This is after hundreds of thousands of protesters demanded she resign amidst a deadly anti-government stir. We're getting news from local reports. These reports also suggest that the Bangladesh Army Chief is in talks with various political parties and stakeholders. A lot of turmoil there in the neighborhood. That footage coming in of Sheikh Hasina actually exiting. There's some reports that her residence was stormed by protesters. These protests have been going on for a while in Bangladesh. I saw newsflash, Neeraj, that the LIC offices locally in Bangladesh have also been shut for now. And these are anti-reservation protests which were going on for a while, and they seem to have completely spiraled out of control. You might see Sheikh Hasina landing in India sometime soon.
Yeah, and some of those earlier footages as well, or visuals of students, groups fighting against each other with stone pelting, etc. Were very, very scary. So big political development right in our neighborhood, and which is why this has that little bit of an importance. Okay, last 9 minutes of trade left. Let's try and take in closing strategies. I mean, you started off giving us your ideas this afternoon by saying that people shouldn't trade, but there's 9 minutes left or 8 minutes left. If you had to take a trade right now as a closing strategy, would you take one? And if so, what would that be?
Well, Neeraj, if you don't put a gun to my head, I'll still say the same thing. Please don't take a trade. And if you put a gun to my head, then I'd say maybe you can do something on a LTA Mindtree. A bounce is coming, but it's still too raw. The gashes are not yet getting covered up. Tomorrow we might see a slightly lower bottom before we see stability. So I'd say don't trade.
Okay, okay, don't. Vijay, you kind of do both techno and funda. If you were to wear the hat of somebody who's a chartist and think of a trade, would you take one right now? It could be a short trade too, by the way.
Well, shorting at these levels, I would say that.
Okay, no.
I won't prefer. But I said, BTST and all, I'm not that intelligent to comment on things like that. But I chase value. And I think a stock like Chennai Petro, as I mentioned, I would latch on to it at these levels even. And I think that it can easily go up to 1200, 1300. So 930, 35 is a great level to get into this kind of a stock, which has deep, deep value. Government of India company, no problem at all in buying such a company.
Okay. Okay, a winner of Friday's trade was Zomato. Big move there. In today's session, at least, at the first half of trade, Zomato fared much better, and even right now, it's faring much better than what the rest of the universe is, if you will. Hemant, if you were a tactical or a positional trader in Zomato who bought in sub 200, currently, would you take money off the table, or would you believe the charts are strong enough for you to stay invested?
Standalone Zomato doesn't look bad, Neeraj. What you mentioned on Friday, the outperformance or the resilience is very much apparent. And I don't think one day of a bad market changes it. My only, I wouldn't say a problem, but a slight point of concern is there's an upward gap between Thursday and Friday. Markets and stocks have a tendency, I'm not saying it's a benchmark or a ground rule, but I think out of 10 times, 7 to 8 times, markets and stocks have a tendency, or at least have it in their nature to try to cover up the gap. Maybe it doesn't get covered up with a bullish gap, I'd be more happy. There is a bullish gap between 243, Neeraj, and 238. So if I were to say this gap might get covered up, but otherwise, no evidence except the overall market condition that Zomato is weak. On all time frame, that remains stoic, strong.
Well, very, very, very strong is Zomato. You have to use the term very simply, because on a day like this, wherein only pure defensives have found favor, here is Zomato, which is seemingly doing okay. Just 2% lower is not too bad at all. But FMCG have ruled the roost today, so and naturally so not bad there. Just one quick thing, Vijay Chopra again it could be a chart call, but life insurance firms, the other ones which have done very well the whole of July and balancing out, not doing that badly today.
Well, yes, I think that LIC followed by HDFC Life would be my preferred picks. But again, I would very strongly recommend don't just jump and buy. Let the dust settle down. I like LIC a lot, so it has corrected also. And if at all you can even get it at a lower price, it would be a great buy around 1050.
Okay. Well, so that's the strong recommendation on those as well. And before we wrap up the show, Hemant, one final question to you. Which of the FMCG charts look strong? And again, we are doing this conversations from a perspective of the fact that the retail investor is not under compulsion to invest his cash like a fund would be, because it doesn't have to beat the benchmark per se. So that goes without saying. But be that as it may, for somebody who's got the itch to trade and looking at FMCG strength currently, Hemant, is there a trade there, or would you leave it alone?
No, there is a trade, but it's a positional investment sort of a trade, Neeraj. Strongest is Godrej Consumer, but since it's already moved, I would not want to chase it now. Two stocks which have the propensity and the capacity to surprise. First one is Hindustan Unilever, which we spoke about, Neeraj. It could very well, after 4 years, if the stock moves, it's not going to be 3 months, it's going to be 1 or 1.5 years, or maybe even 2 years of an up move. And Godrej, it's taken 3 years, Dabur. So it's a toss-up between Hindustan Unilever and Dabur. So on decline. So I'd say split money equally between both. Once again, time frame is 12 months or more.
Hemant, what about some of your discretionary players in this space? I mean, Neeraj spoke about a Zomato, but if you look at a Sapphire, let's even look at platform company like Delivery, etc. Do you think that if we are going to take that consumption theme forward, you could see opportunity here?
Yes, I think something like a delivery has been strange, Tamanna. We've spent almost 2 years, almost, and we've gone nowhere. But normally when there's such a protracted period of inactivity, the follow-up after that can be surprisingly positive. So I would say, yes, that isn't exactly a bad idea, honestly speaking, but we'll need some little bit of time and price confirmation to be honest. Yeah.
Okay, gentlemen, we'll leave it at that. Thanks so much for taking the time out and being with us. About a minute and a half left for the markets to shut shop. I mean, not too much has changed because the Nifty is still about 2.7% lower. So mind you, any hopes of a pullback, a close just below 2% are all dashed because we are still as precariously placed, and even for the banks has not looked too good. Save for FMCG, frankly, nothing else, as ITs look very, very choppy. And just the heat map, I mean, those 4 or 5 names, just 4 names in the green, and a lot of stocks under some serious cuts in the session today. No points for speaking about a name or two, because from an Adani Enterprises to a L&T to a Reliance to a Titan to HDFC Bank to Infosys, Tamanna, everything under pressure. I'm not even talking about the top 5 losers currently.
Yeah, I'm a little astonished at the extent of the gash in Tata Motors. Like everything is relative, as you're saying, but because of Maruti, 4% down is not that bad. Auto, if I were to mark out, is one of the big losers. Samvardhana, look at that, top loser on the Nifty 500 as well. Should we look at the advanced decline ratios to see if there's any green at all? And also tells you the extent of the carnage. Look at that. A yawning gap there, which has stayed steady through the day. 143 advances to 1973 declines. I mean, there's no question. I don't know if there's anyone who has been brave enough to buy in this market today. Possibly not. In terms of what has hurt the most, we'll just pull up the sectoral indices for you very, very quickly and go through that. You are going to be seeing, the metals have deepened and moved to the bottom of the barrel as we've come into close. It was the realty stocks through the day, Neeraj, but it's come down to the metals, and that's reinforcing the number one factor as being not just what the Bank of Japan has done, but those recession fears. Because we're going to go into a place where you have tepid demand, then this is looking iffy. I think just quickly the NSE 500 to see if there's enough of green to talk about. Yeah, just where we started. Cera Sanitary has done okay. Over here, you have a whole host of companies which have done very, very badly. Thermax also feeling the pain. Borosil Renew there, Adani Energy, some of those which are truly feeling the pain. I think another rough day, perhaps tomorrow. At least we'll have to wait and see if things get worse before they get better, but they'll definitely be as bad. What should you do in a market like this? We have a comprehensive set of stories and coverage for you all through the day. So while this is it from Neeraj, me and the team that put the show together, do stay tuned. A lot more coming up on NDTV Profit. When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future, as we've got your options covered. Futures and options strategy that will help you move with the tide. An unmissable trade. If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell?
Welcome to this very special edition of Editor's Cut on NDTV Profit on what has been a tough Monday. Not just for Indian markets and investors, but across the world. I mean, several words being thrown out there: carnage, sell-off, bloodbath, all of that. We're going to break down with, of course, all our editors in this special edition. Let's start with the biggest question I think everyone's asking right now. Is this something which is going to get worse before it gets better? We know all of the reasons: global markets, concerns of what the Fed will do, Bank of Japan, yen carry trade, etc. More pain to come?
So I think, and Tamanna, we spoke about this during one of the shows as well, right? That if there is interventions that come in from any of the finance ministries or the governments, notably Japan and US, then it's a separate case in point. But otherwise, falls like these don't last necessarily only for a day. They don't get bought into so quickly because there is the fear of the unknown. Unlike an event that happens, which is let's say a weak budget or a rate cut decision or a rate hike decision or so on and so forth, wherein the impact is largely known. Here, there is a mystery of the unknown, which may keep the smart buyer at bay, waiting for the tide to turn before she or he decides or their institution decides to invest. So I fear that we may not have seen the end of it. And from the way European markets are trading at the point of time when we are talking about, or the US futures are, I mean, unless things change, wherein some announcements are done by any central bank, Japan or US again, maybe there is still some pain to go.
Right. Let me put it this way to add to what you said. Let's look at some of the key indices that we are looking at. We all know that everything has run up phenomenally across US and in India and most markets. I'll first look at US Treasury bond yields. They are down to 3.7%, which is what would happen if the Fed cuts the rate. So when will Fed cut the rate? How much is a question the markets will watch. That's number one. Secondly, NASDAQ is down roughly about 5.7 to 6%, though individual stocks have crashed. But most of the constituents or stocks forming the NASDAQ have run up again, like they've skyrocketed. Nifty is down roughly since, if I take from 25,000, roughly we are looking at some 4.5%. Other indices more or less at the same level. Now, the only index that has fallen sharply is Nikkei, which is roughly about 19%, including 12.5% today. So if I leave Nikkei out, there is still a lot of more room for cuts. It might happen slowly. It might be a situation where we are getting into a correction kind of a market. Whether this is a price correction or time correction, we don't know, but this looks like a price correction.
I think price correction is especially happening in sectors and stocks where we have seen a lot of run-up happening. So you have the mid-cap, the small-cap index, which is the reality Nifty. From the Indian market point of view, I'm talking from the Indian market point of view, and it's been taken as an opportunity to do that, and that correction is happening now across the board on those sectors which is there. So the classic thing is that you saw the Nifty FMCG being the least falling today in that sense. It was I think one of the first only index which was up in the morning, and then it fell by 0.5% or so. So this defensive play which is coming into the market now, going flight of capital going to those defensive sectors, and those sectors especially which have run up a lot, who have done 100% returns in the last 1 year or so. We are seeing some kind of correction coming in mid cap, small cap, and
it's reminding me of 4th of June. Where obviously very, very different.
We didn't have a defensive play coming in.
Absolutely, you had a defensive play coming in. On 4th of June, right after the election results, when that whole carnage happened, pick up and see which were your top running stocks. It was all your FMCG stocks. And at that time, everyone was coming up on the channel and saying, Acha, their time rotation has finally started. The rotation has come. Defensives, no matter what happens, people will buy toothpaste, soap, etc. It disappeared in a day. I'm not saying that's going to happen here. Obviously, because that was a very different story.
That's a flow, I think, which will decide where it is going to
end. I'm saying the defensives get pulled up, and this whole story gets pulled up every time there are jitters. But then again, these are companies which are growing at very slow rates compared to the kind of alpha the Indian market is used to, and the stocks haven't done much. They've sat out this last 3-year bull run.
I don't know. Vishy, any thoughts?
I just want to say I'm not getting into the way the market is performing at this point in time, but then there is everything is not short term here. There is an element of slightly more long term, slightly more under the radar issues that will flow out. So the first of which is the fears of a US recession. Yes, a lot of experts that we spoke to today, and even people who put out their notes, are saying that there is a likelihood, but it's still low. We may see some slowdown, but a recession sort of a risk is very low. I am not entirely sure if that is true. At this stage, it's pretty much anything could happen, right? So one argument that people in the market are making is that the US has been slow in, or has sensed a delay in its rate cut. It has pushed it to September, and you know that is a very recent sort of development. Them announcing that they will start look at a first rate cut in September. The expectation was it would come much earlier in the year, and it didn't. And that's why the fears that US might come in late into the game, and that might push the US economy into a kind of a recession. What that will also push for is across the world, there will be ripple effects. You will see some impact here in India. You have companies who have gone out and taken these special trades with the yen as a backing currency, borrowing in yen and then converting it into dollar later. They've taken that because there was a big benefit on the interest costs that they were earning, right? Those things don't vanish overnight, even if the broader equity markets correct.
But in terms of the number of companies who actually have that kind of an exposure from, so you're saying 2-3 things. Let's just come to the Indian exposure first off, because that's a question that we're getting time and again, and we'll take some viewer questions as well. You know, is India that vulnerable to the yen carry trade in relative terms?
Let's not, let's not mix those two. There isn't. But the currency market is vulnerable to any kind of movement, right? So even if it is a handful of companies that face an issue with their repayments, that problem will show up in the market.
The other point that I want to make is a lot of the moves that we've seen today are not necessarily fundamental in nature.
That's right.
It's not because there is a yen impact which is fundamentally felt by Indian companies. When there is a risk off and when money flies out, or if money doesn't come in, stocks will correct, independent of whether fundamentally there is an impact or no per se, because this is a sentiment that is turning. And I think when this sentiment turns in a market which is overvalued, or in a set of markets which have run up quite a bit, there is no saying as to when it stops, because we were expensive at 25,000. We are expensive at 24,000 if you want to make that argument, and we can make an argument that we are expensive at 22,500 as well. So this need not be just fundamental in nature. Sure, after a point of time, after 5 days, you will cut down the tails and get down to the pockets and squares and figure out, okay, this sector actually gets more impacted because of the yen exposure otherwise. But right now, I don't think the market is making that distinction.
So there would be a change in the kind of earnings growth estimate, which will be calculated over the next few
Even
days
if that
or
doesn't happen, Sajid.
weeks on the impact, not immediate. But on an entire financial year basis, what could be the impact on that?
But I want thoughts from all of you on this. Now, unless somebody has to make a point.
I have a question to him, but I'll come later.
The only point I wanted to make is that if there's a currency impact, it will show up in March, not during the middle of the year. That's when the repayments kick in, and that's when you will see most of the impact. So where yen is at that point in time will matter.
Okay. So now let's play the devil's advocate and try and think of what this does for the future, aside of the fact that we know sentiment has turned, etc., and stuff like that. There is a graphic that we have of how brokerages have shifted their narrative and argument around what could happen to rate cut cycle, right? So Citi expects 125 basis points by the end of 2024, JPM 50 each in September and November, BOFA starting September. So that's the first point. And two, the technical factors. For the longest time, we were hoping that oil prices should come off. They are decisively off, 70 and 75 currently. We've been hoping and praying that yields come off.
They have.
Look at the US Treasury yields. They have come off quite meaningfully, right? So aside of the fund flow picture, the technical triggers which typically bring about an excitement in risk assets are there in play. So when the dust settles, which at some point of time it will, do any of you believe that there is a chance that the recovery could be V-shaped? Because hitherto we've been used to seeing a V-shaped recovery in risk assets, equity markets. Can that happen, or could this be prolonged, is the question. I have my thoughts, but any of you?
Okay, I'm going to stick my neck out and say yes, there will be a V-shaped recovery, and it will be sooner than anticipated.
Okay.
And one of the reasons I'm basing that on, Neeraj, is the conversation we just had about half an hour ago, that there's going to be a series of appearances that various Fed officials make through this week. And those comments that they make are going to be watched very, very closely. After the kind of carnage we've seen, any kind of positive indications, any kind of dovish commentary will be seen as a positive. If it's a sentiment which is a problem, turning that sentiment, or that sentiment might not take too much time to turn. We've seen that time and again, money waiting on the sides, nothing is fundamentally changing. India is not looking hurt in any way economically. I mean, I think you are going to see a recovery. You're going to see it fairly quickly.
That's one bull. That's relatively one bull.
That's managing.
Sorry,
That's managing the sentiment which Tamanna is talking about. But more than that, it would be more of a flow which is going to come in, with foreign flows which are going to come in, which may slow down a bit, because a lot of trade that goes into emerging markets are funded by low-cost, financing, which actually, I mean, is from Japanese banks, which is there. So,
but Sajid, that doesn't end.
It doesn't.
So
It doesn't end.
At 22,000 or 23,000, the impact will be priced in.
Also, what is the quantum
so now it's
of
getting, the risk is getting priced in.
Yeah.
Earlier it was risk free. Now it's risk priced, basically, which is there. So the people on the fringe which were taking this money will not be there.
So you don't believe it will be a V-shaped recovery?
It's not going to be V-shaped recovery.
I will agree with him.
Will the inflows come in? Yes, it will come in. But will it be as big an inflow? I don't think it's going to be that.
Okay, now 2-3 parts to this. One is that Fed is going to cut the rates for sure, whether it's September or October. It will be a little more aggressive, which we
earlier
also. I don't know. I mean, that's a speculation. I'll not get there.
I don't think
they will pretend to do it earlier.
So,
but
so the line of thought here is that Fed will cut rate. RBI is unable to cut rate. Let me look at our own market, come back to our own market. Now, what's the biggest problem that we are going to see? Managing the retail investors' mood and sentiment, as you rightly said, that's going to be a tough ask. Because I'll give you 4 data points here. 1987, 1998, 2008, 2024. So between 2008 and 2024, we haven't, I'll say 2010, when we came out of this one, we haven't had a major, except for the pandemic, right? So now this one is a situation where asset bubble has built so much, so the fundamental part will not come into play immediately, but you will slowly start feeling the pain. You will slowly start seeing earnings cut into earnings. Fed might cut the rates, but here the cost of funds are not going down as yet. So that's where I have a question: how would RBI approach this? So therefore, right now MPC meeting is on, and day after tomorrow they are going to come out. So how will RBI look at it? This will be on top of their mind. Yeah. Forget inflation data, forget growth and everything. I mean, this is a crisis in the past. Central bankers have managed in 87, 98 and even 2008. Now this is a completely different kind of crisis that we are looking at, because at 2 ends of the spectrum, one end of the spectrum you have rates going up and the currency going up. At the other end, rates are going to go down, but we are caught in between.
But I'm not sure if India is a crisis though.
It's not a crisis. No, I'm not saying it's a crisis. We will get engulfed.
Okay,
that's the whole problem. Therefore, V-shaped recovery would take a longer time.
There was a question on the asset bubble even about 2 months ago. When the last monetary policy announcement took place, this question was posed to the RBI, and their firm view is that they are not seeing a bubble. Yes, there are concerns in pockets, but those concerns, there are always going to be concerns. You don't have a perfect system. You're always going to have pockets where the situation is not ideal. Having said that, the RBI has a lot of confidence in the way that the Indian financial markets, broader financial markets, are performing, and that they believe that they are at the right track. So if they are going to hold the rates, and they've been holding the rates for now, 10 policies announcements now. Yeah. So they are very assured on themselves that this is the right place to be, and they're going to stay put. Now, whether the Fed's decision to cut rate in September, and therefore the RBI, when they meet in October, will they be forced to cut it then? All of these questions are maybe if possible.
Everyone's penciling in April for India.
Yeah, so
that's 2025.
That's what 6 months after the Fed starts cutting.
Everyone's. I mean, no one is penciling in a 2024 calendar.
100%. It's not likely
in India at all. What changes? Why should Shaktikanta Das today, Governor Das, look at all of this and say, "Oh, let me do something about it"?
There is nothing that is
pushing. I mean, he's the only central banker who hasn't, bothered everyone, unlike Bank of Japan and
there's a reason. There's a reason why Shaktikanta Das over the last 2 policies has been making an effort to specifically say we are not worried about what the US Fed is doing. Yeah. We are our own central bank.
But does the RBI not as of to change the sentiment is the question, Vishnu. Does the RBI really need to cut to change the sentiment?
They don't. They need to just change their stance.
Central banks don't cut for sentiment's sake.
At times they do.
At
March
times they do.
2020 was an example, right, Sajid?
May of 2022, when they started the rate hike cycle, that was specifically was a sentimental rate hike. It was not like nothing had changed in the domestic economy. The expectation was that this war is not going to end anytime soon, and therefore things will start showing up badly on the inflation side. We need to at least signal to the market that we are ready to act. After that, they've continuously hiked. That's a different story. But when it happened as of May of 2022, it was only sentimental.
Yeah. So my last quick 30-40 seconds, and typically institutions, when they buy these days, and now we know that institutions follow a mix of fundamentals and charts. So people who are going long, go long and don't necessarily cut their positions because stocks have reached a particular level. They wait for the tide to turn, and even if they can't time the top, which because nobody can, right? They keep a trailing stop, if you will, up to a particular level that it slides down to. I think that's what large short sellers do in times like these, that they are short. They will not extinguish their shorts just because the levels have been reached so swiftly. So I think what could happen is that shorts will stay in the system. They will let it ride until the tide turns. So instead of trying to, so it could well be a V-shaped recovery, right? Tamanna is saying there will be one, Sajid is saying there won't be. Who knows?
You're saying a softer U maybe?
No, I'm saying I don't know, but my limited point is what institutional people who are shorting right now would do is wait for the tide to turn before they cut. So there is no need for a retail investor who is watching us right now to be a brave heart and buy just because the markets have fallen 1,000 points. Wait for a bit, bide your time. Buy it 5% higher. It's
absolutely,
okay.
Yeah, absolutely. So there is no nobody should just rush into it. I think that's a question everybody is asking us on YouTube and other social media. What should we do now? Be calm, don't sell, just stay on the sidelines, and don't buy till you get a clarity. See, buying should be there only when there is clarity. You had euphoria, and now you have a completely different situation. So should not be caught between the two.
Absolutely. So a lot to unpack. Remember, this is just a slice of all of the analysis that we're doing on NDTV Profit. You can go to our website, our social media handles, and you'll see a whole host of views over there. But we just wanted to give you an amalgamation of all the conversations we've been having since early this morning and as this unfolds. The pain's definitely not going away in the next 24 to 48 hours. So let's make that very clear. And if you need to be on top of all of the events unfolding, you know where to come. But for now, thank you so much for joining us on this very special edition of Editor's Cut.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
you can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future, as we've got your options covered. Futures and options strategy that will help you move with the tide. An unmissable trade. If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Market ends lower amid a global sell-off as the benchmarks close nearly 3% lower. 12 sectors end in the red. Nifty Metal emerges as the worst performing sector. Asian markets crash. Nikkei logs the worst day after yen's rally, while Korea's Kospi ends close to 19% lower. European indices also trade in the red. And what should you do in a volatile market? How should you trade? We bring you expert opinion ahead on the show. Gautam Adani lays out his succession plan in an interview with Bloomberg. Says he plans to retire at 70. The future of the Adani Group lies in the hands of his sons Karan and Jeet Adani, along with nephews Pranav and Sagar Adani. Bangladesh's Prime Minister Sheikh Hasina resigns and flees the country amid violent protests. She may be headed to a safer location in India. The Bangladesh army has reportedly given a 45-minute ultimatum to the Prime Minister to step down. Anti-immigration protests rage on in the United Kingdom as the country sees its worst riots in 13 years. Prime Minister Keir Starmer warns the far-right protesters, says, "You will regret this." The US Secretary of State Antony Blinken warns his G7 counterparts that Iran and Hezbollah may carry out an attack against Israel. Well, good evening and welcome. You're watching Profit 360 on NDTV Profit, and I'm Nupur Talwar Suri. Well, we begin with what's happened in the Indian markets. The Nifty fell 400 points at opening bell, while the Sensex opened over 1,000 points in the red. Now, the Nifty and the Sensex closed the day's trade about 2.5% down each. The PSU pack of RVNL, Cochin Shipyard and Mazgon Dock bled heavily in the trade today, down over 8%. FMCG stocks turned saviors for the Nifty as Hindustan Unilever, Nestle, Britannia and Tata Consumer were the gainers in the Nifty, pulling the index back above 24,100 levels in late trade. Now, Tata Motors was the biggest loser in the trade today, and the Nifty Metal Index was the top sectoral loser. Well, in fact, it was a meltdown across the world as stock markets across Asia and Europe dived into the red. Now, it was the Nikkei which began the sell-off, suffering the biggest ever daily loss of close to 4,500 points. Now, fears of the US going into a recession sent stock markets across the world into a tailspin. South Korea's Kospi index closed almost 9% lower after hitting lower circuit. This was the biggest fall in its history. Now, Taiwan's Taipei index too closed the day's trade 8% lower. Hong Kong's Hang Seng ended the day 2% in the red, and China's Shanghai Composite Index were down 1%. The sell-off in the global markets comes on the back of fears of the US economy going into recession. These fears were rekindled after unemployment data from the country grew. More than expected quarterly earnings of corporates in the country were also weak. Now, Japan's central bank raised interest rates in a surprise move last week, and this triggered volatility in the Japanese stock markets. The Japanese yen too has strengthened, causing concern. As for Europe, the stock 600 index was down over 3% the last time we checked, and London's stock market lost over 2%. Paris has tumbled over 2.5%, while the German market shed over 3%. And Italy lost 4%, while Spain also slumped by almost 3%. And here's a view from a market expert. Pranav Gundlapalli of Bernstein says that banks can be bought as a long-term investment only. Listen in to what he has had to say on this.
We would advise to go into the banks, provided the horizon is a bit longer. The banks are cheap, but this whole ROA normalization will play out over the next few quarters, which means there are not going to be any nice upside catalyst driving a re-rating. So it's going to be like, yes, valuations are cheap, so which means downside is going to be limited, but you'll have to wait for the entire re-rating to play out.
Well, we also spoke to some market experts about whether one should review their portfolio or not. Hemant Rastogi, CEO of Wise Invest, says that long-term investors should stay away from thematic funds.
So my point is that not because there is a correction in the market that we need to relook. I feel that for someone who is trying to build a portfolio over a longer period through smaller contribution should always stay away from sector and thematic fund. And if someone has included, surely it's time to kind of relook at that.
And another market expert, Pankaj Mathpal of Optima Money Managers, talked about investing trends. He said that the focus should be on proper asset allocation and what should realign their portfolios if it's skewed towards small cap funds.
Investors have invested more in small cap, mid cap, and especially in some themes like PSU or defense. And we have been advising this that investors should maintain a balanced portfolio or proper asset allocation. So if investors have more investment or more allocation in small cap or themes like defense and PSU, is the time that they should realign their portfolio with their financial goals and reduce their exposure in these sectors and themes. But yes, they should stay invested.
Well, in a recent interview with Bloomberg, Gautam Adani, the 62-year-old chairman of the Adani Group, revealed his plans to retire at the age of 70. He intends to hand over control of the conglomerate to his sons and his nephews by the early 2030s. Adani emphasized the importance of a smooth transition for long-term stability of the business. The Adani Group, which has a market capitalization of $213 billion, operates across 10 listed companies in various sectors, including infrastructure, ports, shipping, cement, and solar energy. Now, despite discussing the possibility of dividing the group's extensive operations, the family has decided to maintain a unified approach after his retirement. And in fact, Marico's first quarter earnings were in line with street estimates. The company reported that revenue rose by about 6.7% to 2,600 crore rupees. The EBITDA has surged 9.1% to 626 crore rupees, and margins were slightly up, though with net profit surging by 8.7% at 474 crore rupees. Marico also reported that domestic revenue growth will trend higher, with pricing and volume growth to gradually rise. The company's domestic sales rose by about 7.4% and international sales went up by about 4.8% this quarter. And retail and auto sales are measured as vehicle registrations on the government's Vahan website surged nearly 14% year-on-year to 2 million units in July. But all's not all right. Now, dealers are still sitting on unsold inventory that's worth 73,000 crore rupees. We spoke with CS Vigneshwar, the Vice President at Dealers Lobby of the FADA, to understand this problem.
Well, the stock levels at dealerships has been a concern for the last few months. In fact, the stock levels have actually grown to 72 days, which is 5 days more than the month previous. In terms of value, it has gone to about 73,000 crores. It's a big source of concern because there is little reason why inventory needs to be built up so many months before the season. Usually it happens 1 month before the season, and it really doesn't make any impact in terms of favorable impact to the customer for building up inventory this soon. In fact, it only is a drain on the customers, it's a drain on the dealers' profitability without any causing anything favorable to the customer. Yes. Have been facing some headwind, and we've been seeing that for a few quarters. But interestingly, right now, the build-up has been happening across the range, not only in the entry level, but also in the medium and the higher level SUVs, MUVs. All these vehicles are being affected. Recently, a lot of manufacturers also have cut prices and have brought in discounting for their high-end SUVs too, and the mid-level SUVs. All this points to the fact that there is a build-up of stock across the board, not only on the entry level, but also in the luxury top-selling SUVs in terms of pricing.
Now, as young professionals starting your career, managing your finances can be a bit overwhelming. You will be confused as to how much you should be saving for your future. Today, on our special series on personal finance, we try to understand how young professionals can save for a better and a secure future, why you need it, and how to start saving for it.
It's never too early to start planning for a secure future. Let's dive into 5 simple and accessible steps that will help you begin your retirement planning journey without feeling overwhelmed. Step 1 is to start early. Your money grows more the longer it's invested. Even small contributions made early can lead to substantial savings by the time you retire. Here's an example. Imagine you put away 100 rupees a month at the age of 25. With an annual return of 7% by the time you reach 65, you'll have accumulated approximately 2,64,000 rupees. But if you start saving the same amount at age 35 with the same annual return of 7%, you will have just 1,22,000 rupees when you retire. See the benefits of starting early? Step 2 is to set clear goals. Now consider your lifestyle and any other potential expenses and break this down into smaller achievable milestones. This will keep you focused and make it easier to track your progress and stay motivated. Step 3 is to automate your savings. Set up automatic transfers from your checking account to your retirement account. This set it and forget it approach ensures that you consistently save a portion of your income without having to think about it each month. Step 4, take advantage of employer plans. Now, if your employer offers a retirement plan like the Employee Provident Fund, try contributing more than the mandatory amount. This is effectively free money that can significantly boost your savings. And finally, step 5, educate yourself. Take the time to learn about different investment options such as stocks, bonds, and mutual funds. Strategize where you should put your money for maximum returns. Resources like financial blogs, books, and online courses can increase your financial literacy as well. Begin now, and your future self will thank you.
Well, we slip into a very short break. On the other side, we bring you top international news, including a look at what's happening in Bangladesh. Stay with us. When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish
Welcome back. You're watching Profit 360, and here's a look at the other national news stories. Now, Maharashtra is witnessing heavy rains with floods in several parts of Pune and Nashik. The IMD has issued a red alert for Nashik and Satara, while Pune and Mumbai have also been issued a yellow alert. The Chief Minister Eknath Shinde visited the flood-affected areas and distributed relief materials to the people. 12 people are stranded in Nashik's Malegaon due to rise of the Girna river's flow. Water levels, disaster response teams from the NDRF and the fire department are on the spot and preparing to rescue those who are stuck. And flash floods in Himachal Pradesh have claimed 13 lives with the recovery of 4 additional bodies on Sunday from Mandi and Shimla districts. Now, the disaster has left 55 people missing and has inflicted heavy damage estimated at 700 crore rupees. Rescue efforts are underway with 410 personnel from the Army, the CISF and local forces employing advanced equipment such as drones and sniffer dogs to assist in the search and recovery operations. And Sheikh Hasina has resigned as the Prime Minister of Bangladesh amid a coup-like situation across the country. Sheikh Hasina was airlifted out of her residence earlier today and taken to a safe location as protesters opened the gates and entered the premises. This comes after weeks of protests around a 30% quota in government jobs that would benefit the descendants of war veterans. Our correspondent Saurabh Gupta is with us from Kolkata and has more details on the situation.
Well, the latest on the Bangladesh protest situation is that Prime Minister Sheikh Hasina of Bangladesh has resigned and in all likelihood also left the country. She was airlifted from Gana Bhavan, which was breached a few moments ago by protesters who have been leading these protests, which were initially against quotas but soon turned against Prime Minister Sheikh Hasina. And of course, after that, there was violence on the streets of Dhaka and the rest of the country yesterday. Rangpur yesterday was particularly violent. Sirajganj was violence. And also, a lot of other places also witnessed violence. Now, today, of course, these protesters, in defiance of a curfew, were marching in Dhaka. And, of course, the Gana Bhavan, which is the official residence of the Prime Minister, was breached. And before that, of course, flying over Indian airspace at this point. And it is being presumed that that aircraft is extremely important because it seems to have taken off from Dhaka and then, of course, flown over Calcutta and then flown on. Now, destination unknown is something that we've been given to understand right from the beginning since Prime Minister Sheikh Hasina was evacuated and airlifted to a safer location, but the army chief has held a press conference in Dhaka. He has announced an interim government. He has asked for a halting of the protests. He has also said that he has issued orders that no one will open fire. Not if Prime Minister Sheikh Hasina is on board that plane, but she has resigned is what we're being given to understand. And also this came after an ultimatum from the army in Bangladesh. But at this point, what we know is that she has resigned. The anti-quota protests had become anti-Sheikh Hasina protests, and Bangladesh will soon have an interim government, according to the army chief, who's just addressed the nation in a televised press conference a short while ago. So where is Sheikh Hasina? That is unknown. What next in Bangladesh? An interim government takes over. No firing orders have been issued.
All right, so a fluid situation coming out of Bangladesh. Of course, we'll keep a track of that. It's time for a very short break. When we return, we bring you more news, including what's happening on the Iran-Israel conflict.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option.
And welcome back. Violence erupted across Britain over the weekend due to false anti-immigrant claims. Protests spread to cities including Aldershot, Sunderland, Liverpool and Belfast. In Rotherham, rioters attacked a hotel housing asylum seekers. Middlesbrough experienced car fires and bottle throwing, while Liverpool saw a library and a food bank set on fire. Nearly 150 arrests have been made and several police officers were injured. The chaos that followed was after incorrect rumours that a 17-year-old attacker in Southport was an undocumented immigrant. The British Prime Minister, Keir Starmer, is holding an emergency meeting with police chiefs today. And Iran's foreign ministry spokesperson has stated that the country is not looking to escalate regional tensions but believes that it must punish Israel to prevent further instability. This statement follows the killing of Hamas leader Ismail Haniyeh in Tehran last week. Additionally, the Organization of Islamic Cooperation has announced that it has accepted a request from Palestine and Iran for an urgent meeting of its executive committee to discuss the latest situation in Gaza and the Middle East peace process. Meanwhile, the U.S. Secretary of State Antony Blinken has warned the G7 countries that an attack by Iran and the Hezbollah against Israel could occur today. In response, the Israeli government is considering a preemptive strike on Iran to prevent any potential attack on its soil. And SEBI officers staged a silent protest at SEBI Bhavan earlier today. Let's go across to Charu Singh for more on this. Charu, tell us more about the protest and what is it that they are asking for?
Hello. So several officers across the grades of A, B and C have been participating in a silent protest at the Security and Exchange Board of India's building at Bhavan 1 in Mumbai. And their requirements are many. They are saying that they are against the leadership for the past 2.5 years. They are also against a new software that has come to upload their key responsibility areas. They were also told that if they don't upload their information about their day-to-day activities and what work they are indulging in on that software, their allowances in the following month will be stopped. However, an apology email was circulated regarding this particular thing. However, the employees' mistrust has been increasing significantly, and that is why it led to a silent protest today. Around 200 people participated in the protest. However, there are around 1,000 employees working at SEBI. It was also suggested from a source to NDTV Profit that the Employees Association that denied any protest happening on Monday on the basis of a Saturday report said that they suggest that this reply from the association was not something that majority liked or resonated with.
All right, Charu, thank you very much for bringing us all those details. Well, on to the Olympics now, and here's a look at what the Indian contingent has been up at. Indian men's hockey team was at the headline yesterday, even after losing Amit Rohidas with a red card in the second quarter. Now, the team produced a defensive masterclass and eventually went for a shootout, which PR Srijesh made look very easy. Now, this victory led the team into the semi-finals. For today, of course, all eyes will be on Lakshya Sen, as he will be aiming to become the first Indian male shuttler to win a medal at the Olympics, as he will be facing Malaysia's Zijia Lee in the bronze medal tie. Also, India's Maheshwari Chauhan and Anantjeet Singh Naruka will be in action in the skeet mixed team qualification. Well, that's all we have time for right now on Profit 360. Thank you very much for joining us, but do stay with us for more news and updates. When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future, as we've got your options covered. Futures and options strategy that'll help you move with the tide. An unmissable show. If you want to be in the money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed.
Welcome, you're watching the Mutual Fund Show. I'm Tamanna Inamdar. Today on the Mutual Fund Show, I think we're going to focus on the question that is on every investor's mind. It's that time of the month when a lot of SIPs go out. It's also that kind of a day when portfolios are looking bruised and battered. It's not just the Indian markets that have seen a sharp cut, but it is a global kind of an impact that we're seeing. So a lot of questions right now, right, that we've been talking about all day. Is this something that's going to persist? Is the US going to go into a recession? What happens to India? What happens to global markets? What happens to the Nifty? But in this particular show, we're going to be talking about what happens to your portfolio. Is this a good time to buy the dip? Because remember, Indian retail investors are also very smart at doing that. What is the kind of strategy that you should employ in order to navigate the ongoing market sell-off? There are two ways of looking at it. In fact, various views on what you should do. And we're going to be speaking today with Hemant Rustagi, CEO of Wise Invest, and Pankaj Matpal, founder and CEO of Optima Money Managers. Welcome to both of you. Thank you so much. Pleasure to speak with you on the Mutual Fund Show today. Hemant, let me come to you. It's a tough day on the street for investors of every kind. But for mutual fund investors, I think at the end of the day, they would be the most secure knowing that their SIPs are going out on time. Is that the way you should look at it?
Oh, absolutely, Tamanna. I think you're right. This is a tough day. And in fact, this is the third time in the recent times that we are seeing such a day. We saw that there was a deep cut in the market when the election results were announced, and also on the day when the budget was presented. And this is the third time. And as you rightly mentioned, I think this time the reasons are slightly different. The more basically global reasons than the domestic reasons. But you're absolutely right. If you analyze the way the investors have been investing in mutual funds in our country in the last few years, most of them are investing through SIP, which means that they are following a disciplined approach. They are committed to kind of hold this money for a longer period. And I think one important thing is that most of them have align these investments to their goals. So they have much more clarity in terms of how long they can hold these investments. So I think any investor who has kind of been investing in a disciplined manner has done the right thing by selecting funds as in line with the asset allocation. I think I would say that those investors need not really worry about the kind of deep cut that we're seeing in the market, because we know that volatility in the market is a natural phenomenon, and these times will come and go. But only difference this time is that the reasons are global, and we need to really wait it out whether the recovery that we saw in our earlier two occasions, whether we'll see that kind of recovery or it's going to take some more time.
Pankaj, let me come to you. Wait it out is some of the advice that is coming in. What about the question of buying the dip? Look at the next few days and what is going to happen here on. You are going to hear from central bankers. You'll probably hear from the Federal Reserve in September. You could see a rate cut. You could see a reversal of this trend. Is this a good time to start lump sum investment or bump up SIPs or start a new SIP?
Yes, Tamanna, see, when we talk about mutual fund, generally, especially in equity, we expect a long-term horizon. Means investors invest with a long-term view. Considering that fact, I'll say that it can be an opportunity for investors. I'll not say that you invest the total amount in a single day, but definitely every dip is an opportunity for investors for investing in mutual funds. But Tamanna, I'll say one thing that considering the recent trend, investors have invested more in small cap, mid cap, and especially in some themes like PSU or defense. And we have been advising this that investors should maintain a balanced portfolio or proper asset allocation. So if investors have more investment or more allocation in small cap or themes like defense and PSU, is the time that they should realign their portfolio with their financial goals and reduce their exposure in these sectors and themes. But yes, they should stay invested.
Okay, so you should stay invested. But, I'll just take that forward to Hemant. The whole rage, two-part rage, one of NFOs, one of thematic funds, and especially in some of the sectors that Pankaj mentioned, defense, infrastructure, all of these themes which have really been running up. Is it the right time for investors to relook and reallocate, stick to basically the good old bread and butter, your large cap stocks?
Tamanna, it depends on the kind of investor you are. Look, the fact is that people who have been investing over the last many years have built a decent sized portfolio. They are comfortable with how equity market behaves. They understand the nuances of how equity market functions. Obviously, they reach a stage where they think that they have the risk profile to invest in these kind of funds. I mean, they can be fine, provided, again, of course, the important aspect always is how much exposure do you have to sector and thematic fund. Now, while there are thumb rules which say that 10 to 15% can be invested, but the thumb rule obviously always do not take into consideration your own personal situation. So it depends on, like I said, the kind of investor you are. But for the retail investors, if someone has been investing here thinking that there is an opportunity to make a quick buck, obviously not because there is a correction, even otherwise also, I think there is definitely, I feel that an opportunity or also the time for investors to rethink their strategy as to how much investment they should be having, or if at all they should be having in that. Because my belief always is that if there are certain themes, certain sectors, they have the potential to do well going forward. And if you're invested in well-diversified fund, which have been performing consistently well, surely the fund manager will have exposure to these two or three or four sectors or segment that have the potential. Of course, it may not be as much as you actually can get when you invest directly into those, but they will definitely be participating through this diversified fund. So my point is that not because there is a correction in the market that we need to relook. I feel that for someone who is trying to build a portfolio over a longer period through smaller contribution should always stay away from sector and thematic fund. And if someone has included, surely it's time to kind of relook at that.
But today, what about today and now? It's very timely that we're doing this show today, on the 5th of the month. and people are figuring out what to do. They're probably looking at their portfolios. They're saying that yes, I have made money over time, and I'm seeing some of those gains which are still right now notional evaporating. Do they have to wait? Buy, sell, hold is a very simple, basic kind of a query which viewers have been asking us, and let me put that to you now first, Pankaj.
I'll suggest that investors should add or top up their flexi cap fund, or they should add flexi cap funds to their portfolio, and they can book profit from small cap fund, especially even then they have lost some good amount today. But still, I'll say that it's the time that you should book profit from small cap or exit from small cap if you have a large exposure. And flexi cap within diversified category looks better, or large cap index funds can be considered. And if you want to add theme, for example, you do not have exposure to theme, then I'll say that healthcare or consumption, these themes could be better compared to your defense or PSU, because see, thematic funds perform better within a certain period of time. So when we have seen that these themes have outperformed the broader market, so now it's a time that you should exit from those themes and add such themes where you are looking, where you can expect better performance.
Okay, so let me recap that. Very specific and important advice from Pankaj Matpal. He's saying move from your small cap funds and increase allocation in your flexi cap funds. You can look at large cap funds. If you're keen on thematic funds, then look at healthcare and consumption, which haven't run up as much as others. And remember, it's the recession-proof story, right? So that's why they call the defensives. Hemant, you have similar advice?
Yes, I think, but like I mentioned earlier, I think it's important for investors to realize what will work for them in the long run. If you're making any decision based on what is happening in the market today, trust me, if you see a recovery, if there is a, let's say, unscheduled rate cut by US, and then suddenly if you see a recovery, then the thought process will change again, saying everything is fine now, why should I make a change? So I think it's important not necessarily to look at only the market mood and how the markets are behaving, then make changes. As I mentioned earlier, I think one needs to really look at what will work in the long run. In the long run, for a retail investor, for someone who's trying to build a portfolio, as I mentioned earlier, I think the key is always to go into well-diversified category. And I think that if someone was keen on having exposure to all the three market segments, for example, the multi-cap funds can be great addition. Then there are a large and mid-cap fund and of course the flexi-cap fund. So my view is that, like I said earlier, not because there is a correction in the market, but otherwise also I think investors should relook at their portfolio, realign if there is a need, and try to build portfolio with well-diversified fund. And of course, those who have the risk profile, who understand the attendant risk, can obviously have exposure to different markets, different sectors or different themes.
Okay, so keep it steady, hedge your risks, and at the end of the day, remember, it is the domestic investor who's been putting his faith or her faith in mutual funds that has kept Indian markets relatively fine. I mean, I know you're looking at a 600 plus point cut on the Nifty today and it's seeming painful, but if you compare with what's happening in the rest of the world, it's definitely not that bad. All right, let's take specific queries, and remember, if you want to write into us or you want to ask our experts your questions, the numbers on your screens. Let's start with Piyush Dhule's question. He's 28 and asks that I have 60% exposure to mid-cap and small-cap sectors, but should I reduce the exposure in the current market scenario? Thank you for your question, Piyush, and thank you for watching. Pankaj, let me come to you first for your response. So it's not unusual to have investors like Piyush, and especially he's 28 only, who have a larger exposure to mid and small caps. Do you think it's time to relook at that strategy?
Exactly, Tamanna. Actually, 60% allocation in mid cap and small cap is not a good choice. And now also means my suggestion, he should reduce exposure from small cap at this moment. If he wants to exit even, that is good. Because we are seeing that small cap have run well, and is the time that should have larger exposure in large cap, flexi cap. Flexi cap category, because fund managers have choice, they can allocate funds according to situation. So flexi cap can be a better choice at this moment, but definitely from mid cap and small cap, Piyush should reduce his exposure.
Okay, so reduce your exposure in small cap and mid cap. Anyway, it was not a great idea to have 60% exposure to these sectors. Hemant, what would be your advice for Piyush?
Well, Tamanna, I would say, like, look, there are three segments in the market: large cap, mid cap, and small, and all three have an important role to play. Of course, the key is to have them in the right proportion. Now, how do you decide the right proportion? One is to follow a thumb rule, which says that for any investor who's investing over a longer period and who's not very well experienced, should always have a bias towards the large cap. Now, that can be either through pure large cap fund, or it can be through flexi cap fund, or even large and mid cap fund. So that again depends on the kind of investor you are. So I think someone like him, if he's investing for a long term, even then I think the exposure is high. He needs to kind of cut down that exposure. Now that can be done in a phased manner. It need not be done on a single day or immediately. It also depends on whether he's looking to increase his SIP. Now, for example, if he's investing, let's say 10,000 rupees and 6,000 is going into small and mid, and he wants to add another 10,000, he can actually invest that money in the large cap or a flexi cap or a large and mid cap, rather than kind of, stop investing in this. So I think there needs to be some clarity on how you look at your investment process going forward, and what is the size of the investment and how much money are you investing in this, because the percentage does not always give you the right idea.
All right. One more question coming in, and this is from Mahendra, age 36. Asks, is it a good idea to invest in foreign funds right now, given they may consolidate further and could be up for grabs for lower valuation? Excellent question, Mahendra. And Pankaj, this is what I say about the Indian investor who is largely optimistic. I mean, they're looking at an Nvidia, all the mega cap stocks which have been completely liquidating, and saying that I watched these stocks from afar and thought they were out of reach. Are they in reach now? What would be your advice?
Tamanna, adding international funds to your portfolio is a good idea. But at this moment, if somebody wants to invest, I'll say Indian markets are looking better. So have larger exposure in Indian market only, because you do not know the bottom of these funds. So not the good idea to add at this moment these NASDAQ or this kind of funds, especially US market I'm talking about. Better invest in Indian market.
Okay. All right, so it is a good idea, but not right now. And an important point over there, that in relative terms, do the Indian markets fundamentally look better? Well, absolutely, perhaps they do. We'll take a very short break, but we're coming back with your queries. We're going to focus on your queries in today's show. It's a day when people want to know what to do with their portfolio, and we'll try and help you out as best we can. Very short break, and we're right back.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Welcome back. You're watching the Mutual Fund Show. Now, this is the portion of the show where we take your queries. Ananya has written in, age 35, says, I want to buy the dip, but do not believe mutual funds are the right avenue. So is it a good idea to rely on ETFs to buy the dips? Ananya, excellent question. Thank you for writing in. Hemant, let me come to you first on this. People do want to buy the dip. Ananya's point is a valid one. Why should she go through mutual funds, pay that fee? Should she just look at ETFs right now?
Well, I think this is an important question, Tamanna. It's not only because on a particular day you want to buy a dip, and this is the issue that we keep discussing again and again, whether I should go for active fund or passive fund. Again, I think there are pros and cons of investing in both. Of course, there is no doubt about the fact that if you're buying an ETF or an index fund, because there is a cap on the expenses, the costs are lower, right? And of course, there is no human bias because these ETFs and index fund, they track a particular index. So in that sense, yes, I mean, there are advantages of that. But I think, again, there have been occasions, there will be occasions even going forward, where you'll see that actively managed funds, not necessarily maybe in the large cap, but in the small and mid cap, and also those options which give you a mix of different segments can do better. So it clearly depends on, as an investor, whether you want to go in for a passive fund or active fund. But I think both have pros and cons. And also, let's not forget that in the rising market, you may see that the passively managed fund will do better. But in the market, when the market turns choppy, or if you see a steep fall, there is no protection because the index funds have to be fully invested in all time. Whereas in the active fund, the fund manager does have the liberty to kind of keep being in cash for some time. So like I said, there are pros and cons of both. You can always have a portfolio which has a mix of active and passive funds.
But Pankaj, right now, the question is that Ananya wants to buy the dip. To buy the dip, should she look at ETFs?
Not exactly. As Hemant said, I agree with him that ETFs as well as mutual funds, both are important in the portfolio. So at the dip, you can even buy mutual funds, because when you invest in mutual funds and markets are down, the NAV will be low. So that can also be a good choice. So both can be in your portfolio. And the advantage with the actively managed mutual fund is that fund managers, they try to reduce the risk. They try to manage the risk. So that is why you cannot ignore active mutual funds. As you want to build your portfolio, you have space for both the things.
Okay, Manish writes in, age 25, asks, I don't feel much comfort in equity valuations right now. Can you suggest some safer mutual fund bets for someone waiting for a correction? I think, Manish, your question has come to us, or you've sent this question to us before that correction. Having said that, many will argue a 2.5% cut in the Nifty is not really a correction, even in your broader markets. But Hemant, I'll let you field that question first. What are safer bets for someone waiting for a correction? And is that wait now over, or has the correction just started?
No, Tamanna, I think we can't say that the wait is over. I mean, we just discussed that there are global issues right now. We need to really see how the market pans out from here. But, if someone is looking at a safer option where the money can be kept and, invest in equity at the right time, the question is, what is the right time, whether you're able to time it properly or not. But I think the options would be maybe a liquid fund where the money can be kept. And as and when one feels that there is an opportunity to get in to equity, one can do that. But I think timing that is always very, very difficult. So maybe one way I would say is to kind of do systematic transfer plan. And maybe you can do it on a weekly basis, you can do it on a fortnightly or even monthly basis. And within that, if you see a dip in the market, then maybe you can switch a larger portion of that rather than trying to time in market, because it has happened on so many occasions that investors have been waiting for correction. When the correction does happen, they feel that this will go down further, and suddenly there is a U-turn in the market and they lose the opportunity. So I think timing that can be a bit difficult. STP can be a good option. Like I said, in the process, if you see that there is a fall, try and transfer a larger sum through switch.
Timing the market is actually a losing proposition one way or the other, which is why the good old SIP investors at the end of the day always feel that comfort. Perhaps they're not really crying buckets today like a lot of investors may be. Pankaj, would you agree with that? That it's tough to time the market and wait for a further correction. But the question specifically was, suggest some safer mutual fund bets What would you reply
Exactly. See, I'll say two options. One, as Hemant said, that one should invest in a staggered manner, so STP can be a good choice. Second is one category is there which is called balance advantage fund. So this category gives you this opportunity that you invest in one fund, and fund managers, they take a call that how much in equity, how much in debt. So balance advantage fund can be a good choice that you invest your money and leave it on the fund managers. But within this category also funds are managed differently. So select a fund which has lesser allocation in equity at this moment, like ICICI Prudential Balance Advantage Fund can be a good choice in this category, or Kotak Balance Advantage Fund. So this kind of category can be a good choice. Or if you want lesser risk compared to this even, then there are conservative hybrid funds or equity savings fund. These kind of categories can be considered.
Okay. So you have to look at various categories at this time, and STP is a good idea because tough to time a correction. It could be today, it could not be today. I mean, you will hear people saying with complete confidence that this is just the beginning. If things turn by tomorrow, then they're not going to be really able to tell them anything. Let's take this question from Sahara. Nagraj says they've received a security deposit of 12,000 rupees, looking to invest this amount into mutual funds. Where can I invest in? Let me just add one bit to that question and take it to Pankaj first. If Sahara was sitting today with this 12,000 rupees, would you say deploy the cash today or stagger it over the next few days?
Again, it depends that how much money he has already invested, his portfolio size. But if somebody wants to build a portfolio now and the horizon is longer, this amount can be invested in one go today.
Okay, can be invested in one go today. That's interesting. Hemant, someone sitting with a bit of money and anyway looking to deploy, today is a good day?
Well, today is a good day, but we don't know whether it's stopping here or the correction will continue. It should be that tomorrow you start feeling that, okay, I kind of acted very fast. So again, you can stagger it. Like I said earlier, it's very, very difficult to time it to perfection. Maybe if you want to invest 100 rupees, maybe 30, 40 rupees, you can begin investing and then maybe wait and see how the market pans out. But in this particular case, if he's saying he has a security deposit of 12,000, I don't know if he has to kind of refund it after a year or what is the time horizon. I think all that is important. So even if the market presents a great opportunity, if the time horizon is not long enough, I would say stay out.
Yeah, but I mean, at the end of the day, they already want to deploy that 12,000 rupees. The question is about whether they should do it now and at one go. If you have a longer term perspective, then there's no harm in doing that, because trying to time the exact bottom of any market is near impossible and maybe a fool's chore. But steady and slow does win the race and will continue to do so even on a day like today. Thank you so much, Pankaj. Thank you so much, Hemant, for joining us. Thank you for all of our viewers who've tuned in. If you have a question for us, those WhatsApp numbers are on your screen. Until we see you today, same time, same place. That's all the time we have on the Mutual Fund Show. But stay tuned, a lot more coming up on the other side on NDTV Profit.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Long Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome to this very special conversation on NDTV Profit. I'm Tamanna Inamdar, and today I'm speaking with India's G20 Sherpa, Amitabh Kant. Now, we're speaking about an issue which is top of mind right now in the country, but honestly is something which is becoming a problem year after year. I'm referring to the horrific tragedy in Wayanad, Kerala. A number of lives have been lost. The tragedy keeps unfolding. The fact is that we've seen these kind of landslides, flooding, destruction caused by it in other parts of the country as well, especially hilly areas. We have seen this happening many years in a row as well. Now, Mr. Kant had a piece in a newspaper, a column recently, and that caught my eye, which is why I was very keen to speak to you. Thank you so much, Mr. Kant, for giving us time on NDTV Profit. And I'm actually going to begin with what you ended your piece with, where you say the Wayanad tragedy is a stark reminder of the delicate balance between nature and human activity. It's something which seems very profound and obvious, but something we seem to be forgetting. I want to understand from your perspective where we've gone wrong.
So, Tamanna, the challenge is that whatever we do, all our activities have to be compatible with sustainability. And what we are witnessing, not merely in Wayanad or the Western Ghats, but even in the Himalayan states of Uttarakhand, Himachal, is reckless construction. What we are seeing is huge amount of road construction, tunnel construction, major projects going on, and more than that, huge imprint of the human element which is impacting the ecology without any scientific study of the carrying capacity of the region. So it's very important that in all these areas, these are very, very sensitive areas, particularly the Western Ghats, which figure amongst the one of the 8 biodiversity hotspots in the world. They are, Wayanad, for instance, has some of the rarest natural reserves. It has some of the most beautiful mountains. It has some of the most beautiful wildlife parks. But all this, and I've lived a very long innings of my life in Kerala, and I was the district collector in the neighboring district of Calicut, and I was a very frequent visitor to Wayanad, and my heart really breaks out, and I feel very devastated because Wayanad was actually almost close to 85% green dense forest. In 1950, 85% green dense forest. There has been a 62% decline in green dense forest, and that has been replaced by a huge amount of plantation crops. So what you've seen in recent times is greenery in the form of rubber plantation, tea plantation and coffee plantation replacing green dense forest. Yeah. So you've seen a 62% decline in green dense forest, but an 1800% increase in plantation crops. Now, plantation crops are not able to keep the soil firm enough, and the soil gets very badly degraded. And therefore, you're seeing when flash floods happen and you see huge amount of construction taking place, they have very, very adverse impact on the region, and that is what is happening in Wayanad. But a similar story can be seen in exactly the same story of landslides and flash floods occurring in Uttarakhand and Himachal as a consequence of our lack of scientific study and our inability to do good scientific construction based on carrying capacity of the region.
So you're absolutely right, Mr. Kant. We've seen this in Uttarakhand, we have seen this in Himachal, we have seen this in many other areas of the country. I mean, our cities get flooded, but that's a slightly different issue, and I'll come to that in a bit. My question is, number one, who is responsible? And I don't mean this from a political blame game kind of point of view. You are someone who's seen the inside of how government machinery works, how it all functions. And the layman thinks, oh, it's all corruption. People go for permissions, they're given permissions to do whatever they want. There is no ecological survey. Anyone is building just anywhere. We keep using the word rampant construction. I want to understand how it actually happens. How do we get to a messy state like what we've seen in, for example, a Wayanad?
So the important thing is that in all these regions, the power to give clearances for, authority to give clearances for construction is vested with the local panchayat. And in some of the other regions, it's vested where there are municipalities, they are vested with the municipalities, elected municipalities. Now, neither the panchayats or the elected municipalities have any knowledge of either the carrying capacity of the region or they have any scientific studies available with them. So they go on recklessly giving clearances for all construction. All construction, wherever required, anybody seeking permission is given a construction permit. And therefore, what you are witnessing in some of the most sensitive areas of Uttarakhand, what you are seeing in some of the most hilly areas of Himachal, and in Uttarakhand, permission being given away freely to anybody seeking permission without any form of study of carrying capacity. So firstly, my belief is that in many of these regions which are ecologically sensitive, the power and the authority to give construction clearances and permits on hilly slopes, on very sensitive regions, etc., where the degree of slope is more than 20 degrees and in all ecologically sensitive areas, actually must be taken away from the panchayats and the municipalities, and that clearance should be vested in a committee which has the knowledge and the power, either at the state or the central government, which has a broader perspective of sustainable development of the region. So firstly, take out the authority, the power to give clearances for construction wild. And secondly, I think the government of India must commission a carrying capacity study of these regions. Now, what Wayanad has seen is that suddenly it became popular for tourism purposes, and what we have seen is a mushrooming of over 400 resorts in the region. Everybody who had resources started constructing a tourism resort in that region. Now, I'm totally against any kind of mass tourism in the hilly states of India. The more we do this, the mass tourism has huge adverse impact in terms of reckless construction, but it also has a huge impact in terms of invasion of culture, invasion of on local ethos, etc. And I'm a great believer that on all these areas, we need to promote high value tourism so that in these regions we have fewer tourists but high value tourists and good quality tourists, so that the unit value realization from tourism in these regions is much higher, and we are able to ensure that the tourists we get are people who give back to the destination in terms of relishing it in a better manner, and rather than treating it as a picnic party occasion.
Mr. Kant, someone listening this might turn around and say, but what about the local economy? What about the kind of jobs tourism provides and how it gives opportunity?
Yeah, so local economy, my experience of Kerala, and I took Kerala when I became secretary. I believed that it should not be mass tourism, and we took Kerala from a $20 a night destination to a $500 a night destination. And when you take a destination on a high value growth up the value chain, you create many more jobs. So Kerala actually ended up creating many, many more jobs in the backwaters of Kerala by going back to its roots, to its traditional architecture, its traditional martial art, its traditional cultural art forms. So when you are doing sensitive, high-value tourism, your ability to create jobs is much greater. Your ability to earn for the states is much more than getting large number of tourists who are paying $10, $15 a night, rather than getting fewer tourists who are capable of paying you $500 a night.
Okay. So we talked about what is the cause, and you said rampant permissions given by local bodies is some part of the cause. Let me ask you now about the solution, Mr. Kant, because this will keep happening again. Maybe not in Wayanad, maybe in some other area.
No, so I'm very clear. I'm very clear about that. I'm very clear about this, that these, based on the Gadgil Committee report, these areas should be declared as ecologically sensitive areas, not merely in terms of draft notification, but the final notification should be issued, that the power to give clearances for construction should be banned, and by the local authorities. If any clearance needs to be given, it should be based on scientific studies and should be actually cleared at the Government of India level in these regions. These are very sensitive areas to be left to the local panchayats.
So that is in terms of permissions. What about what is already constructed? Because year after year, you're going to have the same problem. There is already rampant and excessive construction, which that ecology cannot, tolerate, or carrying capacity, as you have mentioned it. How do you reform that?
Tamanna, to my mind, we need to do a lot of more reforestation in these areas. We need to bring in very sustainable agricultural practices, because local population will be able to create many more jobs with sustainable agricultural practices and with reforestation. What we have witnessed in regions like Wayanad is a move away from forestation. Now, you need to bring back green forestation, and that can itself be a venue for a huge amount of job creation. What you need to do is to bring back sustainable agriculture rather than large-scale plantation, which to my mind has a very huge adverse implication on the soil culture of the region.
You think it's time to take a harsh measure, and I'm asking this, knowing full well what the extent of devastation has been, but you think it's time to take harsh measures in some of these areas, go in and break down construction which doesn't meet norms, where permissions have given incorrectly?
No, I'm not talking about. I'm talking about being, taking a very long-term, constructive and a positive approach for the good of the society. And the good of the society is when development takes place which is compatible with sustainability, where human development is not compatible with sustainability. You will have very adverse impact in the long term. And therefore, my view is that change of land use should not be permitted. It should be very careful. It's an issue which needs very careful handling. Construction of tunnels in these areas should not be permitted. Construction of roads should be very sensitively handled. And all construction in this region should be based on carrying capacity. Now, whatever construction has earlier taken place which is illegal needs to be a very hard look needs to be taken at that. Wherever illegal construction has been done already, states need to take very firm action. But please do not do this construction on the slopes of river beds. What is happening in many of these areas is where water bodies are flowing, where river beds are there. You are doing construction on the river bed, so you're not allowing the flow of river. And therefore, when the anger of natural gods take place, these constructed areas are just getting devastated. So let us not do things which are scientifically not valid and not correct, and that will have a very adverse impact, especially in the some of the biodiversity hotspots of the country.
Just last point, Mr. Kant, because I know you have shortage of time as well. We've talked about hilly areas. We've talked about the devastation in Wayanad. What about our cities? Mumbai, Delhi, Bengaluru, Chennai.
So cities, there's a No, so that's a very important point, because we must understand that 42 of us cities have been rated amongst the 50 worst polluted cities in the world. And Delhi has been rated as the worst capital in the world in terms of air quality. Now, obviously, there's a collapse on urban governance. There's a collapse of municipal governance. And we need to get this act right. We need to clean up our cities. Household segregation of waste is not taking place. Municipalities are not collecting waste. They are not treating the waste properly. And so we have good examples of how municipal governance has been reformed in Indore, in Surat, in Mysore, cities after cities. So we need to really create a huge sense of competition amongst the Indian cities, the top 50 cities, and they must become the finest cities of India. And if these 50 cities become the finest cities of India and are able to clean up air pollution, then they will have a huge demonstration impact on the other cities of India. So there is to my mind, one of the biggest challenges for India is to invest its resources on good municipal governance, lay focus on governance, lay focus on capacity development, focus on outcomes, and clean up these 50 cities of India.
Well, I hope there is real action on this, because we sometimes, it comes and goes in the news cycle, frankly. And it becomes the headline of that day and of that week. But the extent of devastation and the extent of economic hindrance when you don't have cities and you don't have regions which are ecologically sustainable is really something that we can't begin to imagine. Thank you so much, Mr. Amitabh Kant, for joining us and giving us your perspective.
No, my view is that...
Yeah. Yes, sir.
Thank you. Thank you. No, my view is that if we are able to improve our 50 of our top cities in terms of the quality of life and in terms of better municipal governance, we'll add at least 1% more to our GDP.
Absolutely. Thank you so much, Mr. Khan, for joining us today.
Thank you. Thank you. Thank you.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on Monday.
Welcome back. Now, Marico's first quarter earnings were in line with street estimates. The company reported that revenue rose by 6.7% to 2,600 crore rupees. Now, the EBITDA surged 9.1% to 626 crore rupees. Margins were slightly up, though, with net profit surging by 8.7% at 474 crore rupees. Marico reported that domestic revenue growth will trend higher with pricing and volume growth to gradually rise. The company's domestic sales rose 7.4% and international sales went up by 4.8% this quarter. And in fact, retail auto sales measured as vehicle registrations on the government's Vahan website surged nearly 14% year-on-year to 2 million units in July. But all's not all right. Dealers are still sitting on unsold inventory worth about 73,000 crore rupees. We spoke to CS Vigneshwar, the VP at Dealers Lobby, FADA, to explain the problem to us.
Well, the stock levels at dealerships has been a concern for the last few months. In fact, the stock levels have actually grown to 72 days, which is 5 days more than the month previous. In terms of value, it has gone to about 73,000 crores. It's a big source of concern because there is little reason why inventory needs to be built up so many months before the season. Usually it happens 1 month before the season, and it really doesn't make any impact in terms of favorable impact to the customer for building up inventory this soon. In fact, it only is a drain on the customers, it's a drain on the dealers' profitability without any causing anything favorable to the customer. Yes. For many months, entry-level cars have been facing some headwind, and we've been seeing that for a few quarters. But interestingly, right now, the build-up has been happening across the range, not only in the entry level, but also in the medium and the high level SUVs and UVs. All these vehicles are being affected. Recently, a lot of manufacturers also have cut prices and have brought in discounting for their high-end SUVs too, and the mid-level SUVs. All this points to the fact that there is a build-up of stock across the board, not only on the entry level, but also in the luxury top-selling SUVs in terms of pricing.
Now on to the big global news story. Sheikh Hasina has resigned as the Prime Minister of Bangladesh amid a coup-like situation across the country. Hasina was airlifted out of her residence earlier today and taken to a safe location as protesters opened the gates and entered the premises. This comes after weeks of protests around a 30% quota in government jobs that would benefit the descendants of war veterans. Our correspondent Saurabh Gupta, who's joining us from Kolkata, has more details about the situation that's unfolding in Bangladesh.
Well, the latest on the Bangladesh protest situation is that Prime Minister Sheikh Hasina of Bangladesh has resigned and in all likelihood also left the country. She was airlifted from Ganabhavan, which was breached a few moments ago by protesters who have been leading these protests, which were initially against quota Indian airspace at this point, and it is being presumed that that aircraft is extremely important because it seems to have taken off from Dhaka and then of course flown over Calcutta and then flown on. Now destination unknown is something that we've been given to understand right from the beginning, since Prime Minister Sheikh Hasina was evacuated and airlifted to a safer location. But the army chief has held a press conference in Dhaka. He has announced an interim army in Bangladesh, but at this point what we know is that she has resigned. The anti-quota protests had become anti-Sheikh Hasina protests, and Bangladesh will soon have an interim government, according to the army chief, who's just addressed the nation in a televised press conference a short while ago. So where is Sheikh Hasina? That is unknown. What next in Bangladesh? An interim government takes over. No firing orders have been issued by the army chief, and that's what is the latest from this developing, fluid and volatile political situation in Bangladesh, where the Gana Bhavan has been breached by protesters a little while ago.
Well, the British Prime Minister Keir Starmer is holding an emergency meeting with police chiefs as violence erupted across Britain over the weekend due to false anti-immigrant claims. Now, protests spread to cities including Aldershot, Sunderland, Liverpool and Belfast. In Rotherham, rioters attacked a hotel housing asylum seekers. Middlesbrough experienced car fires and bottle throwing, while Liverpool saw a library and food banks set on fire. Nearly 150 arrests have been made and several police officers were injured. The chaos that followed was because of incorrect rumours that a 17-year-old attacker in Southport was an undocumented immigrant. And Iran's foreign ministry spokesperson has stated that the country is not looking to escalate regional tensions but believes that it must punish Israel to prevent further instability. This statement follows the killing of Hamas leader Ismail Haniyeh in Tehran last week. Additionally, the Organization of Islamic Cooperation has announced that it has accepted a request from Palestine and Iran for an urgent hearing of its executive committee to discuss the latest situation in Gaza and the Middle East peace process. Meanwhile, U.S. Secretary of State Antony Blinken has warned that G7 countries that an attack by Iran and the Hezbollah against Israel could occur today. In response, the Israeli government is considering a preemptive strike on Iran to prevent any potential attack on Israeli soil. Well, that's all we have time for right now on Profit Insights. Thank you very much for joining us.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit. Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target, what's good for long term, when to buy, when to sell. How do you stay ahead of all the financial noise to achieve your dreams?
this conversation, when I was invited to host by Anudeep, the point of this discussion was the advent of credit size on India, how exactly it has been growing over the last 5 odd years in terms of the business growth, in terms of potential of the Indian market. So after discussing all of these topics, I want to take this through this conversation with all 3 gentlemen. I'll start with you, Maurice-san. Now, you've spent, what, 10 odd years as the head for global business. I was just looking at the designation that they've given you, Senior Managing Executive Officer at Credit Saison and Head of Global Business. He's also MD Credit Saison APAC, Managing Partner Saison Capital. That's a mouthful, but I just want to start firstly with your 10-year-odd experience. What exactly have you learned from the Japanese office? How's that sort of driving your decision-making and your thinking here in India?
Sure. But let me go back a little bit before getting to Credit Saison. So I was born and grew up in Japan, and I went to college, and then my first career was a bank. So I started with a bank, which happens to be today's Mizuho Bank. And yeah. And I went to business school in the US before I started my own startup, which now you can call fintech. And then I joined Credit Saison 11 years ago when it started to expand globally from the scratch. And going back to your question, my 11 years with Credit Saison is actually a combination of my past experiences, in a sense that it's about building business from the scratch, so startups, entrepreneurship, but under the traditional financial institution, which is Credit Saison. And the experience and the learning from Japan is that Credit Saison is a very unique DNA and open culture that allows this combination to maximize the potential. So I've been like literally flying around, running around in my own drive, but with always the backing and support, and also long-term thinking and patience. And that really allows me to, after, looking back 11 years, after the initial 5 years, then I sort of came to India and then really sort of thought, here we can make something great. So it's really, that what makes us here.
All right, I'll dig into the India bit shortly, but for next question to Shiska-san. 30 years now in your role at Mizuho, I wanted to get a sense of what exactly this career path has looked like for you.
Thank you. Kojiro Shizuka, I'm a managing director and head of Global Corporate and Investment Banking Coordination Department, which shortly promotes and supports overseas business of Mizuho and reports into Global Head of Overseas Business. A little bit about Mizuho. Mizuho is one of the 3 largest banks in Japan with total asset of $2 trillion US. We have offices in 30 countries, 5 in India. That's top 3 countries that we have most offices overseas. I joined Mizuho at the retail branch first, and then mostly on the client coverage and product coverage side, facing clients, pretty much all my Mizuho career. In Japan, it's very usual, now a little bit changing, but to spend your career in one organization, unlike Mori-san. So when I joined Mizuho, I started with retail. I did a lot of product coverage, like fixed income sales, M&A advisory, private equities. And on the corporate side, the client coverage side, I did corporate finance, supporting global tech fund out of Japan. And I did, from the overseas perspective, I did 2 stints in New York, totally about 7 years, 3 years before the financial crisis. and 4 years most recently on the investment banking side. So I did gain a lot of experience within Mizuho, doing business, supporting business, and Mizuho has been changing, dramatically, supporting, overseas clients from traditional corporate banking to investment banking, more the retail side as well, Japanese clients to non-Japanese clients. I think that's a lot of Mizuho journey that I'm experiencing.
All right. And Koyama-san, what about you? You've spent now close to about 3 decades. We can speak on that side. Close to about 3 decades now for you. How are you sort of viewing this journey of your entire career as well as the bank itself?
Okay, thank you very much. Again, my name is Takeshi Koyama. I'm now working for the corporate strategy as the reporting into our group CEO, responsible for the group entire financial group strategy. And then, so first of all, I feel very much privileged to be here. And then congratulations on this fantastic event. And also, before responding to your question, I want to say, as you kindly mentioned, I spent almost 29 years with Mizuho. And then, so I joined former IBJ. That is the same with Mori-san. In that sense, Mizuho lost Mori-san. And then we are now trying to get back him. That's why we injected capital. So anyway, I started career as kind of very typically working for the one of the branch in Japan. And then out of my almost 30 years career, half of my career I spent for the client business, including my 4 years in New York and 5 years in London, most recently, and mainly working for the global investment banking side. And the remaining half, almost 15 years, I've been working for corporate strategy. And most recently, I was in London for where I spent 5 years until 2 years ago, and then back to Tokyo. And then again, as I mentioned, I'm working for the corporate strategy. And then, of course, the 29 years is just journey, as you mentioned. And then through the course of matter, I've been learning quite a lot. And then what I'm now focusing on is I'm now rebacking to the sort of the social responsibility and also the responsibility of the financial institutions. And at the same time, upon my the international career, I'm committing to both Japan and also international global. And then particularly in my 5 years in London, I had a very good fortune to be very much involved for India-related things. I had a very strong connection with many talented people sitting in London, sitting anywhere in the world, the Indian people. At the same time, I have a very strong belief onto the India-Japan corridor. That's why based on my global international experience, I have some feeling this is my mission to commit to this alignment. With that, in that way, my 20 years career is something to do with here, why I'm here.
Okay. Thank you for that. Morisa, next question for you. So, when earlier Presha and the rest of the management members were making the presentation and talking about credit science in India, the MNC or the multinational sort of lineage of this company, that topic came up over and over again. Why would you choose India, and what exactly does the MNC tag do for a business in India?
So again, over the last 11 years of journey, we started off from Southeast Asia, and then we entered into Vietnam, where we acquired Société Générale, the French bank's 100% subsidiary, which was doing point-of-sale financing, motorcycle financing. Now we are issuing credit cards, but we acquired half of it. So that was there. In Indonesia, we set up multi-finance company, which is a non-bank financial license company, but we needed a 15% at least local shareholding. So we did a joint venture. And then we did many different things. But when it comes to India, we were looking into some M&A opportunity. Then but we lost the deal. But then, since then, I've been starting to meet fintechs and banks, NBFCs, and venture capitals, and all those people. And then I was really, really fascinated and impressed by the ecosystem here. And that is enabled by, and compared to the market that I was operating in, that is enabled by like clear regulatory framework, or the digital infrastructure, like India Stack. And also India has lots of talent in tech industry as well as financial sector. And that naturally results in attracting all the world-class investor, whether it's VC, PEs, et cetera, and that creates a really sort of robust, ecosystem within India, which is, of course, large and fast-growing. And one of the things is that that I learned back in 2018 is that we could set up an NBFC with 100% ownership. And that was also critical for us because it's not so easy to do something from scratch before we see something. So then we came up with this idea of again coming back to the point that I made earlier about the partnership. If this ecosystem is so many players, and we can work with them in a particular way, then that may be our entry strategy, and then work with the partners and grow with the ecosystem while we make revenue and profits, and while we learn the market. So that's kind of crystallized into this sort of thesis when we came into India. But to your point about MNC. Yes, we have different businesses and offices in different parts of the world, but I think we're starting to look like a true MNC only for the last few years. And India clearly sort of shifted our gear into that. And as I told you, the reason why we expanded even further to LATAM, many people actually ask this question, like, why Brazil and Mexico? Why? And there's a clear reason why, which is sort of out of your question, so I wouldn't, go into details. But one of the clear reasons is, again, we can sort of, apply the India playbook in a similarly robust, financial and fintech ecosystem. So that was the reason. But yeah, so I think we're only starting to look like MNC, but. Yeah, so it's just the journey is just started, and we're now in the process.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards...
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
2024, India's already seen an influx of a lot of people in the lending market, in the credit market. You've seen a lot of local companies set up fairly successful businesses, some of them not so much, but most of them, yes. What went behind your decision?
Yeah, thank you. So India clearly is a growing market, growing economy, scale, large population, pool of exceptional talent. So during the last decade, or especially last few years, we've been making a lot of decisions how to expand our business portfolios. So last couple of years, we made investment into financial platform in Vietnam, Philippines, Indonesia. And then, of course, India was our target as well. And Mori-san, early last year, walked us through what Credit Saison does in India. And one of the key concepts during within our strategy is what Koyama-san mentioned about social responsibility, how to solve social issues around the globe. That was one of the key strategies that we wanted to focus, and of course the financial inclusion. And when Mori-san walked us through, we just hit it off. We loved the concept. And then we met Presha and the management team, and we just dig in through their business and try to understand. India market, a lot of government-led initiatives that made us comfort. With regards to the company, of course, very focused tech team who are not thinking only about tech, but how to, speed up the process, how to analyze the credit, and then, of course, the consumer experience, user experience. And then the management team, and the lastly but not least is the cultural fit with Mizuho. I think that was the most important part. And then that's why we made 15% investment with the board seat. That's an equity method affiliate of of Mizuho, which we don't really usually do. But the fit and the market overview and the potential, I think that's one of the reasons and the big reasons that we made the investment.
Koyama-san, you already have a banking franchise that's active here in India, right? So then why this NBFC partnership?
Okay, thank you very much for asking. Just a simple answer is this could be supplemental. So we do believe between the Kisetsu and between Mizuho existing business, we might be able to create some synergy, big synergy. Of course, we are thinking what we might be able to do for the Kisetsu client. But with this alignment, we might be able to, together with Kisetsu, we might be able to expand our client bases. And then that will, again, I want to echo to Shizuka-san, that will prove our commitment to India through the commitment to the social responsibility. But back to maybe the question to Shizuka-san. I just want to add several aspects. Maybe 2, 3. First reason why we decided our commitment to this alignment is, firstly, we believe in India. And of course, without doubt, that this country has the biggest potential to grow in the world. And also, the government and the regulator are really well managing the process. And also, we are so impressed with the fascinating technology in India. So from the Japanese perspective, so UPI, account aggregation, credit bureau, those kind of things are really fascinating. And then that might be able to make Kisetsu to make some big leap in the very properly managed way. So in that way, we believe in India, we believe in India's potential, India's future. That is the first reason. Second reason is we love in Kisetsu. Because of the quality of the company, particularly with a very high level of the technology you are having, and also the very high quality of the management. I want to say, as the Presha mentioned, I know the Kisetsu is targeting to be a top 10, But I still want to say this is a properly aggressive. So my impression is the management really thoughtful and then well managing the process and the strategy. So in that way, we believe in the tech, the quality of the management, and then the passion of the employee you guys having. So that's why we decided we love in Kisetsu. And then lastly, third reason why we decided this investment is, again, we are seeing a very true good fit from a strategic perspective, at the same time, philosophical perspective. Long story short, we believe we have a very big chemistry. So that's why we decided this investment.
Okay. Just for the audience, before coming here, I had texted a friend who's very active in the Bangalore startup space. And he's engaged with the company quite a bit. But then I was asking him what his opinion of the company was, right? And his response was, because Koyama mentioned account aggregation, I wanted to pick this up. His response to my query was Macha, because that's how they say friend in Bangalore. But Macha, decent folks, very ambitious, but please ask them how account aggregation is going to change their lives. I want to pick that question with you, Marisa. There's a lot of digital public infrastructure that is coming up in India. Obviously, that has made lives easier for lenders. You've built a business that's now, what, 12,000 odd crore as of March 2024. You're aiming for a 50,000 crore book. That's what Prisha's presentation showed. What is that India thesis that's going to bring that company up to 50,000 crore? How do you think you're going to grow this over time? And how much is digital public infrastructure going to help you?
I believe, first of all, there's a lots of unmet credit demand. And when this economy is set for scale and people have aspiration, and there are lots of small businesses that are actually making up the employment and the economy, and there's again lots of gap in demand and supply of the credit. And so the market potential is huge. So something like you mentioned, like account aggregator, or for that matter, like we use different data to cater into different segments, and also tech and those, and that is a really enabler for us to sort of go deep into the segments or the needs that couldn't be sort of met otherwise. So again, when the gap is huge, and there's many sort of enablers like this, public digital financial infrastructure, I think we are the ones who really take advantage of it to fill. And not necessarily us ourselves doing it, but our partners are also doing it. So collectively, I think we're really sort of in the front line to fill the gap. And if we do that properly and successfully, I just can't think that we don't grow like we target. But the key is we do it rightly and properly, right? And just to add to the point, as an NBFC, even in Japan, we believe that the NBFC's job is to go to the front line and cater to the segment or cater to the needs that were not necessarily so easily met by the banks because of the different structure or different appetites, right? But again, we are NBFC, and we'd like to, play that role in India's growth journey. And we believe, the potential is just big enough, and the right set of infrastructure is now being set up, and we are, I think, becoming quite good at using those to grow.
All right. I want to ask one question for the entire panel. Do you want to say something, Shizaka-san? No. Okay. So let me ask you a common sort of a question, and I want all three of you to give me a short, quick answer. Right? This partnership is now fully functional. There's a business that's growing quite fast, and as the management members were pointing out, that the quality of the growth is actually quite pristine. What is the outlook that you have for credit size on India? First Morisan, then Shizuzan, and then finally Koyasan.
So outlook, just Prisha and the team presented. We have clearly set sort of right eye. so that's the forward outlook, and then cascade down to the immediate plan, and we are so clear in terms of what we want to do and what we need to do. So the forward outlook, right eye to the top 10. So that's the answer. Short answer.
Okay. Thank you for that.
Yeah, I think Kisetsu's team has a great balance between offense and defense, and I think that's very important for when the companies to grow. And then, as Presha mentioned, it's mada desu, so that we're still expecting and supporting the business with the support of all the lenders here.
Koyama-san.
Have an echo to Shizuka-san. So the Kisetsu has been already proving themselves, but still mada desu. So through this alignment, we might be able to prove more. And just one episode I want to share is when I look back to the Japanese 1960s, when the Japan made a very rapid hyper growth. At the timing, at the individual level or the small corporate level, so there has been the very, very big resistance and the hesitancy for the borrowing. But the borrowing leverage sometimes accelerates the growth. But that needs to be very properly managed. So my belief is technology might help. And then I think in that perspective, we see a very high quality of the technology and then very well properly managed pace of the growth. I think Kisetsu might be the big contributor to the Indian growth. So we see high levels of the technology and then very well managed the lending capacity. I think India as a whole might be able to skip several steps and then which accelerate the growth of the country.
All right. So that's Morisan saying that the right eye, you want to focus on just the right eye of the bird. Shizuka-san talking about the ability to grow within India as a market and the unmet credit demand that exists, and Koyama-san, of course, talking about the technology that will boost that quality of growth, good quality of growth. All right, thank you so much, gentlemen, for talking to this audience and talking to me. Pleasure talking to you as always.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable show.
If you want to be in the money.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360. Well, good evening and welcome to The Big Story. I'm Nupur Talwar Suri. Now, it has been meltdown across the world as stock markets across Asia and Europe dived into red. It was the Nikkei which began the sell-off, suffering the biggest ever daily loss of close to 4,500 points, followed by South Korea's Kospi index that closed almost 9% lower after hitting lower circuit. Now, this was the biggest fall in its history. Taiwan's Taipei index too closed the day's trade 8% lower. This volatility was triggered after Japan's central bank raised interest rates in a surprise move last week. The Japanese yen too strengthened, causing concern. Neeraj Shah is now joining us with a quick explanation of what we've seen through the day today.
Carnage, or any other synonym that you can use for world markets at large. This is the sell-off is the right term, and it happened across the world, by the way, because look at the Asian screen. China is maybe slightly better because it didn't sell off as much, but Nikkei had a terrible day, and the rest of the Asian markets, Taiwan, Kospi had a trigger attached to it come in as well. So lower trigger out there because the market sold off over 8% too. So across the Asian screen, there was red. And India was not left far behind, by the way. Any attempts at recovery were doused off, and we ended over 2.5% in the red for the large caps. So the Nifty and the Sensex were 2.5% lower. More importantly, the mid cap and the small cap indices saw an even bigger drop, with 3.5% for the mid caps and the small caps cracking under pressure as well. And frankly, if you look at the heat map for the Nifty, you will see that not one sector was spared. Sure, FMCG probably sold off less, and which is why you had the likes of HUL, Tata Consumer, Nestle being in the green, and which is why only a small tick of red on the FMCG index. But look at what happened elsewhere. Autos, banks, infrastructure, IT, all of these were taken to the cleaners, and which is why stocks like Tata Motors, ONGC, Adani Ports, the metal names like Tata Steel, Hindalco, all of them came under some serious selling pressure in the session today. No point in singling out names because everything came off. The broader end of the spectrum, if you look at the BSE 500 losers and gainers, you will see there were some gainers, maybe the likes of PCBL, which is having a different day, different last few days on the EBITDA guidances, or stocks like Marico, Dabur, etc. Essentially from the FMCG space doing well. But look at the red end of the screen, and across the board, from an auto to Thermax, which is this whole industrials play, Adani Energy correcting, public sector banks, construction names. It's a lot of bloodbath on the screen today. And like we said, not a single sector was spared. The key is, viewers, it's not about individual names, but about what the markets could do in the near term. And it's very likely that the kind of fall that we had today, and we end with this Nifty intraday move maybe if we can, but the way we paced ourselves today, sure, we tried to bounce back from the lows of the day, but I don't think we were able to, and that is where the problem lies. That world markets are looking iffy. When the Indian markets shut, European markets were in the red and US futures were trading in the red as well. So the world markets are looking iffy, and any kind of attempt at a bounce back was also sold off, and which is why don't think that we can say with conviction that the markets will bounce back immediately. It may be better to wait for the market to show its hand before investors try and be a brave heart and try and bottom fish. Certainly, this kind of a market fall doesn't warrant an immediate bottom fishing. It probably pays to sit on the sidelines, wait for the market to show its hand, and then get in.
All right, so wait and watch is what Neeraj is suggesting. In fact, to discuss what's setting off this global meltdown, we are now joined by Chakri Lokpriya, Managing Partner of Red Strawberry, Sunil Subramaniam, Market Veteran, and MK Global's Chief Economist, Madhvi Arora. Good evening, all of you. Thank you for joining us on this broadcast. Madhvi, coming to you first. Now, we have seen this mayhem in the Indian markets, and before that, of course, the Asian markets went into a tailspin earlier in the morning. This current turmoil began, of course, with the Bank of Japan's rate hike last week. Help us make sense of what we've seen today across the Asian markets and the Indian markets.
So clearly, I think, the Goldilocks narrative, which was being sold off until almost a month ago, has, sort of toppled. Market was, actually enjoying the narrative, which was basically based on the fact that you would see policymakers cut rate despite a relatively healthy growth. And that narrative was sort of floating the market apart. What we saw in the last 1 month or so, 1.5 months or so, has been a confluence of various factors. One is, of course, the macro rate has started softening. I don't think it's in a situation that you can actually call it a hard landing scenario. But, the narrative is slowly changing towards a weaker labor market, which it is, especially after having seen last week's labor data in the US. And more importantly, the divergence in the policy making within the developed market space, with Bank of Japan, finally moving away from its accommodative policy stance and looking to further hike rates in the coming months or so, which clearly has meant that the yen carry trade has sort of unwound to the extent that Japan, which is one of the key investors in the US treasuries market, especially with Japanese life insurance firms, which are big chunk of players in the US treasury markets, are now looking to obviously come back home because a large part of their portfolio is also unhedged. This kind of carry unwind essentially has led to a lot of panic in the markets, of course, be it Japan or even in the US, and especially with the narrative which is now moving towards a panic situation more than a macro disaster per se. I think it's more a panic at this point in time, where the market is now calling for a massive cut by the US Fed, to the extent that we are market is now expecting more than 100 bips cut in the next 3 months or so by the US Fed, which obviously would, catamount to a panic situation in the US economy, which I don't think is currently warranted at this point in time. But clearly, the change of narrative has led to, market positioning getting a little disturbed, because nobody was really pricing in a scenario wherein the Goldilocks would be disturbed to this extent.
Madhvi, of course, there seem to be US recessions concerns, that are also capturing the global markets. And essentially, that's what set off this sell-off. The employment data didn't look too good. But do you think that this may just be a bit premature? Because that's what I read from what you were saying, that we are perhaps reacting too early to it.
Yeah, I agree with you. I think to a large extent, this is beyond just in the macro situation. It's a part of it is largely panic at this point in time. There is, of course, slowdown in the US economy, which was anticipated given the tight financial conditions that the economy has been experiencing, even with a comfortable fiscal. I think to a large extent, there's been an irrational panicking that you're seeing in the markets globally at this point in time.
All right, let's also bring in Mr. Subramaniam into this discussion now. What are you looking at? How do you perceive what's happening? It's, we wouldn't be wrong to say that this is almost a global sell-off. We're, of course, waiting for the US markets to open at about 7-ish. But largely, it's not a good day. Everybody in the red, including, of course, me.
I didn't find a red shirt to put on. No, but I have a slightly different take to what Madhavi is saying, and I'll tell you where the difference is. So I'm not very sure that it's as much a reaction to the US data. I think it's more of a reaction to the Japanese rate hike. And I'll tell you why I'll say this. Because even if you take India, right, as per my estimates, a quarter of the FIR money that flows into India comes from Japan. Roughly half comes from the US and another quarter comes from Europe. Chakri can reinforce this. If he has a slightly different thought, he can say it when he talks. But that cost of funding for a Japanese FII, because hedge funds leverage money and they borrow on a floating rate basis. So any rate hike comes immediately hitting. And so it's very similar to, let's say, a margin trader in the Indian stock market, right? So there would be bankers who would be calling, because the margin of safety will get breached because the cost of funding goes up, and they would be actually forcing them to sell. That's number one. Second is algorithmic trades. See, a lot of these hedge funds and other players, what they do is they feed these data into computers and set these stop losses so that they protect themselves from a fast fall. And those computers actually trigger it. There's no human intervention. So for me, I think it's a greater Japan effect rather than as much the US effect. And why Japanese market fell so much internally was also because the strong yen hurts Japanese exports, and the US is the biggest market for. So if the US is going to slow down, then Japan is going to get hurt big time. And that's why you saw South Korea also getting hurt, Taiwan also getting hurt. So the export markets into the US get hurt. And that's where, if you see in India, normally IT is a safety sector, but IT got hurt because IT is again exposed to the US. So to me, I would put a slightly greater weightage to the Japanese decision to rate hike and lead to the strengthening Japanese yen as a bigger trigger. And because ultimately a US rate cut is something an equity market should welcome, right? What's happened? There is a subtle difference, is that a rate cut which comes from a control, from an inflation perspective, that is, inflation is easing, so I cut rates, is a positive signal. Whereas recession is coming and so I'm going to cut rates is a negative signal. But that being said, let's take it a month or 2 months from now. And let's assume this 100 basis points rate cut is actually going to come through. The equity markets would welcome it. And I would see that that cheap money would again flow back in from the US into emerging markets, and India would get a benefit. So this is an initial knee-jerk reaction on this situation. Otherwise, equity markets love rate cuts, love softer interest rates to help them to margin. So for me, it's a Japanese thing which has been a bigger trigger today, and then the overhang of Israel-Iran. That's generally a nervous factor, so which is also hitting it. And where the US recession is actually hitting is probably in terms of metals, global cyclicals, crude, those kind of things, because then that's going to mean that there's only a softer demand. Already China is already going through a slowdown. So it's my summary. That's why I slightly differ to say that I would give a greater importance to the Japanese decision in this whole sell-off globally.
Right, Chakri Lokpriya, if you could come to you next. Now, do you agree with that assessment that Mr. Subramaniam just made? And also, if you could weigh in on the impact of the yen carry trade, is that also a factor that is rattling the markets, perhaps?
Hello, good evening. Thanks for having me. I would build on what Sunil just said. I tend to agree with him because, what is a yen carry trade? A carry trade is when an investor borrows in a low yielding currency and then invests it in a higher yielding currency. And such trades are usually leveraged. And so when the trade unwinds, the first thing a leveraged investor does is unwinds those leverage positions. When those leverage, so which means this does not impact the longer term deals that are entered into by, let's say, India with Japan or Japan with other countries, but the initial carry trade is what impacts. And the money that is invested by Japan into the US treasuries, not all of it is carry trade. There is a certain amount of a very stable money, but only the leverage rates get unwound, and they get unwound in a hurry. And that's exactly what we saw today. And the impact of that, as Sunil said, is that, when the Japanese yen becomes more appreciates, then the exports of Japan into the US hurts. So it has a reverse effect of slowing down exports from Japan and therefore hurts its balance sheet. And then on the other hand, you have, why is US, now where did this whole thing start off? Is US had a slightly bad unemployment data. They said they were going to cut rates in September. So they penciled in probably September 25, November 25, December 25. That's roughly 75 basis points. Now with what the Japan did, they might front end, but some end of that 75 basis point cut in the US. But does this impact the US balance sheet? No. So they would wait and watch. Now, would it impact other countries like India in particular? Not so much, because carry trades are not an integral part of our what you call trade flow. Our trade flows are priced differently.
All right. We are going to slip into a very short break, but on the other side, we are going to ask all our guests what their advice to investors is. So do stay with us. We'll be back after a short break. When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Well, thank you very much for staying with us on Profit 360. You're watching the big story on the mayhem that we've seen in not just the Indian market, but also Asian markets. We have Madhvi Arora, Sunil Subramaniam, and Chakri Lokpriya with us. Mr. Subramaniam, how susceptible do you think is the Indian market to these global factors? Now, we saw a nearly 3% intraday fall. Are you expecting this volatility to last a little bit longer, given the weak data that is coming in from the US? And of course, there is a lot of geopolitical tension that's still around.
So couple of things to give clues to that. So first is, I think that the Dow futures are showing a pretty sharp drop. So it means that the drop, or I wouldn't call it carnage, but the drop in the US is going to sustain. So which means there will be that spillover effect on India. Second is that I would also point out a slight difference. The reason I focus on Japan so much was because if you see the Friday fall, Friday also the market corrected, right? The Friday fall, the large caps fell, but the mid and small caps didn't fall as much. But today's fall, the mid and small caps have fallen greater than large caps. So generally, when you have an international related sell-off, it's the large caps that tend to fall because the mid and small caps are by domestic buying. Why today did mid and small caps fall more? There are two reasons for that. One is the fact that Japan, last year, I remember, they raised a lot of money from Japanese investors, Japanese FIIs, which were large and mid-cap combos. not just pure large cap. So there was a significant increase in Japanese allocation to Indian mid cap. So when they sold off, mid caps also got. So that's why today is more a Japan-driven sell-off. The second I would also suspect is that in such a carnage is happening, domestic fund houses, right, whether they be PMS, AIF providers or MFs or insurance companies, who don't want to catch a falling knife. So they are waiting for the market to settle to see how much the fall is going to be before going and buying the stock that they like. But to generate cash to be able to buy the large caps which they want to buy, they have been probably selling mid and small caps today. So that's why. So part of the Japanese money and part of the domestic fund managers reallocating in a diversified fund, in a multi-cap, flexi-cap fund, they have probably been shedding, they have been booking profits. And where would they be doing that? They would be doing that where the rise has been the largest. You know, areas like defense, infra, some parts of energy, PSUs have had a massive rally, which is not entirely backed by fundamentals, is more of a future projection. This will happen, that will happen. So all of that, I think there's been a significant of profit booking. So I would say that would continue, because when large caps again correct tomorrow and day after, fund managers would like to buy good quality large caps at much cheaper prices. So if the fund manager is going to behave this way, right, they're going to wait and watch and wait to buy, I would suggest that the retail investors do the same. Don't try and catch a falling knife, right? See, if you're doing an SIP, you don't panic. You continue with your SIP or your STP because your rupee cost averaging is going to come to your aid. If you do want to deploy money, put a 1% or 2% of the free cash that you have into the market now. Don't put it all. Spread it out over a period of time, because I expect this volatility and this to last for a few days and not to jump in to put all the money in like tomorrow or the day after.
So, right, the advice coming in is wait and watch. Mr. Lokpriya, to you now, what is your outlook on the Indian markets and what would your advice be to investors?
Nupur, I would, Sunil has put it so well that there's nothing much for me to add, in the sense, I wouldn't buy, I would wait by the sidelines for some more time, let the market, settle down. And, there is going to be some reallocation of capital between mid and large cap stocks, less about the change in prospects, but more about because fund managers want to reallocate their exposures. And sometimes, in these kind of falls, always markets overshoot, individual stocks overshoot on the downside. And in terms of where India is still strong, is manufacturing is still strong. The PSUs, the banks which have reported earnings are still strong. So, the whole theme remains unchanged. Now, and as interest rates start coming down in the US and India, as in a natural cycle of events, again, banks will do well, financial services do well, manufacturing because of lower cost of borrowing benefit. So I think wait a little bit on the sidelines, but again, still it's the same Make in India theme, which will continue to do well.
All right, Madhvi, we have spoken about what's happening in the US markets and the concern about recession. But I had a quick question. Do you think that this prolonged monetary policy, tight monetary policy, in fact, is actually pushing the US towards more of a recession? It's harming them more than they could have perhaps envisaged.
See, to be very fair, I think US has had a very comfortable run. Nobody expected this, right? A year ago, January of last year, if you had checked any of those global CEO surveys, they would have said recession was coming in 2023. They all went wrong. Why? Because fiscal was a massive support. 2024, beginning of the year, nobody would have expected a recession, in the US actually coming, because the sense is always that whatever has happened in the last quarter would continue in the current quarter as well. So we tend to have a very myopic view of the markets or the economy in general. See, to some extent, of course, the monetary policy, when it is too tight, tends to restrict the economy to a large extent. In this case, I think, as I said, fiscal has been a massive support to the US economy, which has led to the golden run in the US, macro cycles as well, and also has led to Fed actually not able to catch the cycles right. We are still debating what is the real neutral rate in the post-COVID world, be it India, be it rest of the world. And I think policymakers everywhere are struggling with that answer. To some extent, yes, if the Fed continues to remain tight, given the current macro dynamics, of course, you're going to probably lead to a much, harsher economic realities, than if Fed actually tends to start cutting rate at a stable, steps and probably lead to a more softer landing. Yes, but I think it is unfair to say that tight monetary policy has led to all of this. Of course, the economy has had a very good run, and incrementally fiscal probably would not have that much support that it gave for 2 years or so. So I think any which way we've sort of stretched the whole recession scenario, and now finally the labor market is now letting off all the heat, and now we are actually getting to see some slowdown, which obviously is a function of policy making to some extent, but not necessarily all.
Right, Mr. Subramaniam, final words on the rising geopolitical tensions. That's something, of course, that's triggering the markets. And we have, through the day today, at least seen a lot of worrying statements coming in from Iran and Israel, both. The US also wading into that debate, warning G7 that there could be an imminent increase in tensions.
Well, yes, it's an overhang, but I would say if the Japanese and the US situation gets clear, the geopolitical tensions shouldn't make a difference to your investing in the Indian stock market, because I think we are fairly insulated from that kind of a tension. In fact, only thing which can worry us is a spike in oil prices. But I have a contra view there, that if at all Iran is getting into a war, he's going to pump more oil to finance the war. So I don't see oil then rising because of that, though there'll be initial spike because of the tension, but the actual supply, and see already Saudi and everybody haven't done the production cuts to the extent they said. So oil looks to be easy. So I wouldn't worry too much about geopolitical from India specific. It's a Japan and the US thing. And even US, like I mentioned in my earlier chat, that ultimately the rate cuts are positive for equities and positive for FI flows into India. To me, it's the Japanese situation, the uncertainty, once that settles down, I think we'll bounce back. And the biggest geopolitical concern was Russia, Ukraine, and that didn't hurt India stock market in any way. So I don't see why this should hurt India. It will have its repercussions on some markets around the world, but not necessarily India, as long as the oil prices are under control. So it's the oil which I would say wait and watch to see on a geopolitical front.
All right. Mr. Lokpriya, any final words about the geopolitics, as well as your sense of how long could we see this volatility now?
It's a couple of things. One is the geopolitics itself. If you look at oil price, the price is there at about $70 odd, so which is a very comfortable number for Indian oil exports. If you look at the basket crude price, it can sustain a much higher number of an oil price. So that is not really a concern now. Second is the general slowdown that we're seeing. There are two different reasons. One is, U.S. consumer has slowed down. Some amount that is at the lower end of the income, where the inflation is hurting them. In China, all kinds of consumers have slowed down. Whether you've seen Louis Vuitton sales and Cartier sales slow down in China, which has not happened in the US. So the economies have to, the balancing in these different countries is slightly different, and that will have because India being still a domestic-led economy, at least in terms of earnings growth for the next couple of years, I think we're largely fine.
All right. I'm afraid we're running out of time on the big story, but all three of you, thank you very much for joining us this evening. So the word coming from all our experts is wait and watch, and things should be better perhaps sooner rather than later. When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome to this very special edition of Editor's Cut on NDTV Profit on what has been a tough Monday. Not just for Indian markets and investors, but across the world. I mean, several words being thrown out there: carnage, sell-off, bloodbath, all of that. We're going to break down with, of course, all our editors in this special edition. Let's start with the biggest question I think everyone's asking right now. Is this something which is going to get worse before it gets better? We know all of the reasons: global markets, concerns of what the Fed will do, Bank of Japan, yen carry trade, etc. More pain to come?
So I think, and Tamanna, we spoke about this during one of the shows as well, right? That if there is interventions that come in from any of the finance ministries or the governments, notably Japan and US, then it's a separate case in point. But otherwise, falls like these don't last necessarily only for a day. They don't get bought into so quickly because there is the fear of the unknown. Unlike an event that happens, which is let's say a weak budget or a rate cut decision or a rate hike decision or so on and so forth, wherein the impact is largely known. Here, there is a mystery of the unknown, which may keep the smart buyer at bay, waiting for the tide to turn before she or he decides or their institution decides to invest. So I fear that we may not have seen the end of it. And from the way European markets are trading at the point of time when we are talking about, or the US futures are, I mean, unless things change, wherein some announcements are done by any central bank, Japan or US again, maybe there is still some pain to go.
Right. Let me put it this way to add to what you said. Let's look at some of the key indices that we are looking at. We all know that everything has run up phenomenally across US and in India and most markets. I'll first look at US Treasury bond yields. They are down to 3.7%, which is what would happen if the Fed cuts the rate. So when will Fed cut the rate? How much is a question the markets will watch. That's number one. Secondly, Nasdaq is down roughly about 5.7 to 6%, though individual stocks have crashed. But most of the constituents or stocks forming the Nasdaq have run up again, like they've skyrocketed. Nifty is down roughly, since if I take from 25,000, roughly we are looking at some 4.5%. Other indices more or less at the same level. Now, the only index that has fallen sharply is Nikkei, which is roughly about 19%, including 12.5% today. So if I leave Nikkei out, there is still a lot of more room for cuts. It might happen slowly. It might be a situation where we are getting into a correction kind of a market. Whether this is a price correction or time correction, we don't know, but this looks like a price correction.
I think price correction is especially happening in sectors and stocks where we have seen a lot of run up happening. So you have the mid cap, the small cap index, which is the reality Nifty. From the Indian market point of view, I'm talking from the Indian market point of view, and it's been taken as an opportunity to do that, and that correction is happening now across the board on those sectors which is there. So the classic thing is that you saw the Nifty FMCG being the least falling today in that sense. It was I think one of the first only index which was up in the morning, and then it fell by 0.5% or so. So this defensive play which is coming into the market now, flight of capital going to those defensive sectors, and those sectors especially which have run up a lot, who have done 100% returns in the last 1 year or so. We are seeing some kind of correction coming in mid cap, small cap, and
it's reminding me of 4th of June. where obviously very, very different.
We didn't have a defensive play coming in.
Absolutely, you had a defensive
Yeah.
play coming in. On 4th of June, right after the election results, when that whole carnage happened, pick up and see which were your top running stocks. It was all your FMCG stocks. And at that time, everyone was coming up on the channel and saying, Acha, their time
Rotation
has
of
finally
money.
started. The rotation has come.
Yeah, you're right.
Defensives, no matter what happens, people will buy toothpaste, soap, etc. It disappeared in a day. I'm not saying that's going to happen here, obviously, because that was a very different story.
That's a flow, I think, which we'll decide where it is going to
I'm
end.
saying the defensives get pulled up and this whole story gets pulled up every time there are jitters. But then again, these are companies which are growing at very slow rates compared to the kind of alpha the Indian market is used to, and the stocks haven't done much. They've sat out this last 3-year bull run.
Yeah, I don't know. Vishy, any thoughts?
I just want to say I'm not getting into the way the market is performing at this point in time. But then there is everything is not short term here. There is an element of slightly more long term, slightly more under the radar issues that will flow out. So the first of which is the fears of a US recession. Yes, a lot of experts that we spoke to today and even people who put out their notes are saying that there is a likelihood, but it's still low. We may see some slowdown, but recession sort of a risk is very low. I am not entirely sure if that is true. At this stage, it's pretty much anything could happen, right? So one argument that people in the market are making is that the US has been slow or has sensed a delay in its rate cut. It has pushed it to September, and that is a fairly recent sort of development. Them announcing that they will start look at a first rate cut in September. The expectation was it would come much earlier in the year, and it didn't. And that's why the fears that US might come in late into the game and that might push the US economy into a kind of a recession. What that will also push for is across the world, there will be ripple effects. You will see some impact here in India. You have companies who have gone out and taken these special trades with the yen as a backing currency, borrowing in yen and then converting it into dollar later. They've taken that because there was a big benefit on the interest costs that they were earning, right? Those things don't vanish overnight, even if the broader equity market is correct.
But in terms of the number of companies who actually have that kind of an exposure from, so you're saying 2-3 things. So let's just come to the Indian exposure first off, because that's a question that we're getting time and again, and we'll take some viewer questions as well. Is India that vulnerable to the yen carry trade in relative terms?
Let's not let's not mix those two. There isn't. But the currency market is vulnerable to any kind of movement, right? So even if it is a handful of companies that face an issue with their repayments, that problem will show up in the market.
The other point that I want to make is a lot of the moves that we've seen today are not necessarily fundamental in nature.
That's right.
It's not because there is a yen impact which is fundamentally felt by Indian companies. When there is a risk off and when money flies out or if money doesn't come in, stocks will correct independent of whether fundamentally there is an impact or no per se, because this is a sentiment that is turning. And I think when this sentiment turns in a market which is overvalued or in a set of markets which have run up quite a bit, there is no saying as to when it stops, because we were expensive at 25,000. We are expensive at 24,000 if you want to make that argument, and we can make an argument that we are expensive at 22,500 as well. So this need not be just fundamental in nature. Sure, after a point of time, after 5 days, you will cut down the tails and get down to the pockets and squares and figure out, okay, this sector actually gets more impacted because of the yen exposure otherwise. But right now, I don't think the market is making that distinction.
So there would be a change in the kind of earnings growth estimate, which will be calculated over the next few
Even
days.
Even if that doesn't happen, Sajid.
Weeks on the impact, not immediate. But on an entire financial year basis, what could be the impact on that of that?
But I want thoughts from all of you on this. Now, unless somebody has to make a point.
I have a question to him, but I'll come later.
The only point I wanted to make is that if there's a currency impact, it will show up in March, not during the middle of the year. That's when the repayments kick in, and that's when you will see most of the impact. So where yen is at that point in time will matter. That's all.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future, as we've got your options covered. Futures and options strategy that'll help you move with the tide. An unmissable trade. If you want to be in the money.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future, as we've got your options covered. Futures and options strategy that'll help you move with the tide. An unmissable trade. If you want to be in the money.
We also need to be prepared if there is any medical emergency required, if there is a theft or your pet straying away, if there's a third-party liability. What if your pet goes and bites somebody else?
Oh, let's hope that doesn't
So there could
happen.
be a liability on you because of that as well. So there are a lot of things that we need to keep in mind. So one is to be mentally and emotionally prepared to have another living being in your family. The other is financial element. So all in all, I would suggest that if you're planning to have a pet, besides the acquisition cost, keep a provision of approximately 10 to 20,000 rupees every month. If you believe that you can afford that kind of money, only then should you get a pet.
So now let's play the devil's advocate and try and think of what this does for the future, aside of the fact that we know sentiment has turned, etc. and stuff like that. There is a graphic that we have of how brokerages have shifted their narrative and argument around what could happen to rate cut cycle, right? So Citi expects 125 basis points by the end of 2024, JPM 50 each in September and November, BOFA starting September. So that's the first point. And two, the technical factors. For the longest time, we were hoping that oil prices should come off. They are decisively off, 70 and 75 currently. We've been hoping and praying that yields come off.
They have.
Look at the US Treasury yields. They have come off quite meaningfully, right? So aside of the fund flow picture, the technical triggers which typically bring about an excitement in risk assets are there in play. So when the dust settles, which at some point of time it will, do any of you believe that there is a chance that the recovery could be V-shaped? Because hitherto we've been used to seeing a V-shaped recovery in risk assets, equity markets. Can that happen, or could this be prolonged? Is the question. I have my thoughts, but any of you?
Okay, I'm going to stick my neck out and say yes, there will be a V-shaped recovery, and it'll be sooner than anticipated.
Okay.
And one of the reasons I'm basing that on, Neeraj, is the conversation we just had, about half an hour ago, that there's going to be a series of appearances that various Fed officials make through this week. And those comments that they make are going to be watched very, very closely. After the kind of carnage we've seen, any kind of positive indications, any kind of dovish commentary will be seen as a positive. If it's a sentiment which is a problem, turning that sentiment, or that sentiment might not take too much time to turn. We've seen that time and again, money waiting on the sides, nothing is fundamentally changing. India is not looking hurt in any way economically. I mean, I think you are going to see a recovery. You're going to see it fairly quickly.
That's one bull. That's
managing.
Sorry,
That's managing the sentiment, which Tamanna is talking about. But more than that, it would be more of a flow which is going to come in, with foreign flows which are going to come in, which may slow down a bit, because a lot of trade that goes into emerging markets are funded by low-cost, financing, which actually is from the Japanese banks, which is there. So,
but Sajid, that doesn't end.
It doesn't.
So the impact end. At 22,000 or 23,000,
so
the impact will be priced in.
Also, what is the quantum
so now
of
it's the risk is getting priced in.
Yeah.
Earlier it was risk free. Now it's risk priced basically, which is there. So the people on the fringe, which were taking this money, will not be there.
So you don't believe it will be a V-shaped recovery?
It's not going to be V-shaped recovery.
I will agree with him.
Will the inflows come in? Yes, it will come in. But will it be as big an inflow? I don't think it's going to be that.
Okay, now 2-3 parts to this. One is that Fed is going to cut the rates for sure, whether it's September or October. It will be a little more aggressive, which we
earlier
also. Yeah. I don't know. I mean, that's a speculation. I'll not get there.
I don't think
they will pretend to do it earlier. So, but
yeah. So the line of thought here is that Fed will cut rate. RBI is unable to cut rate. Let me look at our own market, come back to our own market. Now, what's the biggest problem that we are going to see? Managing the retail investors' mood and sentiment, as you rightly said, that's going to be a tough ask. Because I'll give you 4 data points here. 1987, 1998, 2008, 2024. So between 2008 and 2024, we haven't, I'll say 2010, when we came out of this one, we haven't had a major except for the pandemic, right? So now this one is a situation where asset bubble has built so much, so the fundamental part will not come into play immediately, but you will slowly start feeling the pain. You will slowly start seeing earnings cut into earnings. Fed might cut the rates, but here the cost of funds are not going down as yet. So that's where I have a question: how would RBI approach this? So therefore, right now MPC meeting is on, and day after tomorrow they are going to come out. So how will RBI look at it? This will be on top of their mind. Yeah. Forget inflation data, forget growth and everything. I mean, this is a crisis. In the past, central bankers have managed in 87, 98 and even 2008. Now this is a completely different kind of crisis that we are looking at, because at 2 ends of the spectrum, one end of the spectrum you have rates going up and the currency going up. At the other end, rates are going to go down, but we are caught in between.
But I'm not sure if India is a crisis though.
It's not a crisis. No, I'm not saying it's a crisis. We will get engulfed. Okay, that's the whole problem. Therefore, V-shaped recovery would take a longer time.
There was a question on the asset bubble even about 2 months ago. When the last monetary policy announcement took place, this question was posed to the RBI, and their firm view is that they are not seeing a bubble. Yes, there are concerns in pockets, but those concerns, there are always going to be concerns. You don't have a perfect system. You're always going to have pockets where the situation is not ideal. Having said that, the RBI has a lot of confidence in the way that the Indian financial markets, broader financial markets are performing, and that they believe that they are at the right track. So if they are going to hold the rates, and they've been holding the rates for now, 10 policies announcements now. Yeah. So they are very assured on themselves that this is the right place to be, and they're going to stay put. Now, whether the Fed's decision to cut rate in September, and therefore the RBI, when they meet in October, will they be forced to cut it then? All of these questions are maybe
everyone's
if possible.
penciling in April for India.
Yeah, so that's
2025.
That's what 6 months after the Fed starts cutting.
No one is penciling in a 2024 calendar.
100%. It's not likely
in India at all. What changes? Why should Shaktikanta Das today, Governor Das, look at all of this and say, "Oh, let me do something about it"?
There is nothing that is pushing
he's the only central banker who hasn't, bothered everyone, unlike Bank of Japan and
there's a reason. There's a reason why Shaktikanta Das over the last 2 policies has been making an effort to specifically say we are not worried about what the US Fed is doing.
Yeah.
We are our own central bank.
Yeah, but does the RBI not as of today change the sentiment? Is the question, Vishnu? Does the RBI really need to cut to change the sentiment?
They don't. They need to just change their stance.
Central banks don't cut for sentiment's sake.
At times they do. March 2020 was an example, right, Sajid?
May of 2022, when they started the rate hike cycle, that was specifically was a sentimental rate hike. It was not like nothing had changed in the domestic economy. The expectation was that this war is not going to end anytime soon, and therefore things will start showing up badly on the inflation side. We need to at least signal to the market that we are ready to act. After that, they've continuously hiked. That's a different story. But when it happened as of May of 2022, it was only sentimental.
Yeah. So my last quick 30-40 seconds, and typically institutions, when they buy these days, and now we know that institutions follow a mix of fundamentals and charts. So people who are going long, go long and don't necessarily cut their positions because stocks have reached a particular level. They wait for the tide to turn, and even if they can't time the top, which because nobody can, right? They keep a trailing stop, if you will, up to a particular level that it slides down to. I think that's what large short sellers do in times like these, that they are short. They will not extinguish their shorts just because the levels have been reached so swiftly. So I think what could happen is that shorts will stay in the system. They will let it ride until the tide turns. Yes. So instead of trying to, so it could well be a V-shaped recovery, right? Tamanna is saying there will be one, Sajid is saying there won't be. Who knows?
You're saying a softer U maybe?
No, I'm saying I don't know, but my limited point is what institutional people who are shorting right now would do is wait for the tide to turn before they cut. So there is no need for a retail investor who is watching us right now to be a brave heart and buy just because the markets have fallen 1,000 points. Wait for a bit, bide your time. Buy it 5% higher. It's
absolutely,
okay.
Yeah, absolutely. So there is no nobody should just rush into it. I think that's a question everybody is asking us on YouTube and other social media. What should we do now? Be calm, don't sell, just stay on the sidelines, and don't buy till you get a clarity. See, buying should be there only when there is clarity. You had euphoria, and now you have a completely different situation. So should not be caught between the two.
Absolutely. So a lot to unpack. Remember, this is just a slice of all of the analysis that we're doing on NDTV Profit. You can go to our website, our social media handles, and you'll see a whole host of views over there. But we just wanted to give you an amalgamation of all the conversations we've been having since early this morning, and as this unfolds. The pain's definitely not going away in the next 24 to 48 hours. So let's make that very clear. And if you need to be on top of all of the events unfolding, you know where to come. But for now, thank you so much for joining us on this very special edition of Editor's Cut.
When you talk about somebody being empathetic, Okay, of course that depends on again which stage of your life you are on. Okay, so if you've kind of finished the Maslow stage of roti kapda makan that you need.
Sure.
Now you've done you with your savings, and then after that you say, okay, why am I saving all this money? Let me start giving it away. Let me involve it in causes.
Self-actualization.
Self-actualization. So that is of course a certain part of the personality.
And rather than giving on an ad hoc basis, which might end up, depending on the amount of resources that you're looking at, it might end up bringing these people into trouble. So have a set group of people or causes that you're donating to, and you have kind of a plan for that also.
Sure.
A philanthropy plan, whatever amount you want to give, so that could probably help in the long run.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future, as we've got your options covered. Futures and options strategy that will help you move with the tide. An unmissable trade. If you want to be in the money.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
It began in the US last Friday, engulfed Asia today, and is heading back to the US now. Dow, Nasdaq and S&P futures promise another day of big losses for the American stock markets. Once the darlings of Wall Street, now leading the losers. Apple, Nvidia, Meta and Microsoft are set to open with big losses. Car maker Tesla's futures point to a poor open in trade. SEBI issues rules to check front-running in mutual funds and other fraudulent practices, makes fund managements accountable. Indian markets end lower amid a global sell-off as the benchmarks close nearly 3% lower. 12 sectors end in the red. Nifty metal emerges as the worst performing sector. What should you do in a volatile market? How should you trade? We bring you expert opinions ahead on the show. Bangladesh Prime Minister Sheikh Hasina resigns and flees the country amid violent protests. She may be headed to a safer location in India. The Bangladeshi army had reportedly given a 45-minute ultimatum to the Prime Minister to step down. And Gautam Adani lays out his succession plan in an interview with Bloomberg, says he plans to retire at 70. The future of Adani Group lies in the hands of his sons Karan and Jeet Adani, along with nephews Pranav and Sagar Adani. Good evening and welcome. This is Profit 360 and I'm Nupur Talwar Suri. Muridhar Swaminathan is also joining me in the studio. Right, so all eyes are on the US markets after Friday's tumble in the US markets. Asia followed suit this morning. Fears of a recession in the US economy were rekindled after unemployment data in the US grew higher than expected. It is likely to be another rough day for the US markets if the futures are to be believed. Dow Jones Industrial Average futures lost about 800 points. The Nasdaq 100 futures are also down by about 5%, while the S&P 500 futures are down 3%. And in fact, Matt Orton, head of advisory solutions and market strategy and chief market strategist at Raymond James Investment Management, joins in from Florida. Hi, your initial thoughts? It's not looking very good, is it?
No, it's never fun to wake up on a Monday morning and see the extension of the sell-off.
Right, absolutely. So what is your expectation from the day today? The Nasdaq 100 futures already indicating perhaps what could be the index's worst open in 4 years. Now, also break down for us what is leading up to this. Of course, the jobs data was very, very poor. Apart from that, Japan didn't do too well as well. So is that a tailspin effect that we're seeing from that, from the Asian markets?
So I think when you take a step back from all of this, it's important to put the totality, to steal a word from Jerome Powell, the totality of all of the data and all of the different moves into context. Because I think what really started a lot of the jitteriness in the market really goes back a month ago to the big rotation that we had in the US, moving out of mega caps into small caps, into more cyclical names. I mean, literally just a month ago, we were all enthusiastic that the growth story was intact, that the economy was going to have a soft landing. And now we received some data points that I think has thrown that narrative into question. At the same time, you're seeing the unwind of a $10 trillion plus carry trade with the yen, and the BOJ further spooked markets last week by increasing rates by 25 basis points. So I think a lot of investors have been caught off sides on multiple fronts of different trades. And you combine that with thin summer liquidity, it just is a recipe for really, really big moves in the market. So when you see the NASDAQ down 4% or so, it's incredibly uncommon. It never feels good, but I think it's important for longer term investors to sit back and ask, what fundamentally has really changed to justify these moves? I would say there hasn't been that much from a fundamental perspective that has changed my opinion with respect to a soft landing in the US. And so I'm looking for a little bit more calm to come back to the markets. And that's when I want to start using this opportunistically. We haven't had a chance to put money to work in a long time. So for all of those investors who've been sitting on the sidelines saying, I need a better entry point to put money to work, this is it. So I'm telling investors they should really be getting their shopping list ready, because we will have a good opportunity to put money to work over the long term.
Good morning, Matt. Murli here. We can keep the shopping list ready, but before that, I just want to, before I ask you a question, I think the US markets have opened, the cuts are very sharp. You can see them on the screen. Amazon is down about almost 10%. Apple is down 10%, almost, I think, the worst fall in 4 years. And you can see on your screen multiple indices, stocks, whether it is Alphabet or Tesla, name it, they are all sharply down. My question is, it started in US, went to Asia, and then went to Europe. Now it's back in US. Is this a contagion?
I don't think it is. I think, at least in the short term, there's been a lot of technical damage done to charts, and we're in that cycle where I think you have some algos that are driving a lot of the trading activity, taking off of these cues, but there will come fundamental levels where investors and real money is going to come back into the market and say, some of these stocks, the mega caps being down 10+%, in a single day after already being down 10+% 1 or 2 days in the last week, the forward multiples start to look really, really attractive. And again, I think there's a lot of money that's just been sitting and waiting. So I think a floor is going to come, but until the algos until the algos are put back into control and you have real money starting to guide the markets, I think you're going to see this whipsaw effect start to take effect. What I'm looking for most is, do we violate the 200-day moving averages on some key charts? Is that going to be a harbinger of some further downside before money starts to come back in? But I don't think this is going to be a contagion where you continue to see sell-off after sell-off in global markets, because money is going to come back to work.
Okay, so you seem to be very optimistic and hopeful that money will come back to work and it is not a contagion. Hopefully it is not. But what will it take for the markets to calm and come back? Do you think a good word from Fed or somebody, one of the Fed governors has also pointed out that, Fed will do whatever it takes and the usual routine line. So what will it take for this, relentless selling to calm down and investors to calm down?
So I think any sort of good economic data is going to be helpful. Unfortunately, we don't really have too much of note until you get to August 14th, where you've got the CPI in the US. I think that's going to be really important. But we do have some points this week that are going to be worth following. You have ISM services. I think following the employment component of that is going to be important. We're going to have the senior Fed loan officer surveys later this week on Thursday. I think not seeing credit deterioration, willingness of banks to lend money, I think all of that might give a little bit more confidence to people that things aren't really that bad, or at least as bad as the market is signaling them to be. And I think if you get those little confidence steps, that will give some people the willingness to start to step in and start to put money to work in this market.
Right. There are some very, very smart investors who have moved to cash. There were reports suggesting that Berkshire, Warren Buffett had moved to almost $290 billion in cash. What's your assessment? Are many people sitting on cash, and what we are seeing now is simply a speculative position cut that is bringing the fall?
That's a really good point because a lot of investors have been overweight cash. I've been telling a lot of our investors, at least over the past couple of months, that they should be using the current levels of interest rates to lock in income going forward. And that's been the right call, especially given the massive backup we've seen in Treasury yields over the past few weeks. And I still think there's opportunities for investors to do so because we know a cut's going to be coming. The question is just how big is that cut going to be? So remaining in cash is not the trade. Whenever you start a rate cutting cycle, cash unambiguously underperforms in every single case. So I think investors who are moving there are doing it more from a positioning standpoint. They're taking profit on some trades and looking for other opportunities, which isn't a bad idea in this sort of market. But I think a lot of that cash, to my point earlier, is going to need to find a home. And when you see some stocks that are down 10% that have rock solid balance sheets, have just posted good earnings, that's a good opportunity to start to maybe redeploy that money and put it to work, especially if you do get a little bit of encouragement from the economic data.
Quick question on the geopolitical side of it. Are we seeing an impact of the tensions between Iran and Israel, perhaps, and what's your sense of that?
I think that's helped add some, dare I say, stability to the energy markets. You haven't seen oil completely roll over to the degree that you've seen the rest of the commodity complex. I think it just injects another element of uncertainty into this market. You have uncertainty coming from a lot of trades unwinding. You're heading into a very busy election season in the US. And now you have rising tensions in the Middle East. I think all of that just makes this recipe for more volatility, at least in the short term. But I don't think that I think is an aside. It's more related to just the energy complex. And I don't think that is what's causing, or at least it's very marginal to impacting the overall red we're seeing across the rest of the equity complex.
Right. If I circle back to your point that you made, whenever interest rates are cut, so when will that cut come? The Fed chair was not really very clear whether it will come in September or November. We really don't know. But will the current, if I may call, crisis in the markets force the Fed to call for an emergency meeting and announce a cut?
There's been some talk of that, but I think that would send a really dangerous signal because the Fed is having an emergency meeting. Things really must be worse than we think if that's actually going to happen. I think September, my base case before a lot of this data was December. I've pulled that forward. I do think we're going to see a cut in September. I don't think we're going to see a 50 basis point cut unless there's really sharp deterioration over the next couple of data prints we're going to get. In advance of that, I think Powell set the table during the FOMC last week to have a cut in September as long as the data cooperates. I think the data is cooperating with him on that front. But to get a 50 basis point cut, to get an emergency cut in front of that, that's going to require a massive revision to their summer economic projections. It's going to really, I think it would send a very, very negative signal as to the reasons of why we're cutting. And I think, again, that's why I would argue, I think the market's gotten ahead of itself in pricing 100 basis points of cuts before the end of this year and a full 300 before the midpoint of next year. That's extreme, and I just don't see the hard or soft data points saying that things are that bad in the economy that we need to have that happen. You look at earnings, you look at what companies are telling us real time with respect to their results. We're getting double-digit year-over-year earnings growth. We're seeing a broadening of that growth across sectors. And guidance has been pretty good across the board, even in cyclical parts of this economy. So that gives me a little bit more solace that the foundation, the fundamental foundation, still remains in place.
So, Matt, you think, of course, there's a lot of overreaction at play over here. Any final thoughts?
So I would tell investors when we start to get a little bit of stability, start to look at some of the mega caps, because again, I would argue they are in fact defensive given their earnings stories. Look at some of the higher quality cyclicals like industrials that are levered to AI CapEx spending. Those areas we continue to see increase from the hyperscalers. There's tons of opportunity across this market, and investors should use this pullback to build a balanced portfolio going forward.
All right, Matt Horton, appreciate your joining us on the broadcast this evening. Thank you.
Thank you. Good to see you.
Thank you.
All right, and so on that note, we slip into a very short break. But on the other side, we'll look at how Indian markets have reacted through the day and also get some advice in terms of what Indian investors should do next. Do stay with us.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. You're watching Profit 360, and our focus this evening is on the global sell-off, which we now see perhaps more sharp in the US, as they also seem to have taken those cues. Now, let's quickly bring your attention to what happened in the Indian markets. Now, the Nifty fell 400 points at opening bell, while the Sensex opened over 1,000 points in the red. The Nifty and the Sensex closed the day's trade about 2.5% down each. Now, the PSU pack of RVNL, Cochin Shipyard and Mazgon Dock bled heavily in trade today, down over 8%. FMCG stocks turned saviors for the Nifty, as Hindustan Unilever, Nestle, Britannia and Tata Consumer were the gainers in the Nifty, pulling the index back above 24,100 levels in late trade. Tata Motors, also one of the big losers in trade today, and the Nifty Metal Index was the top sectoral loser. And to discuss what's happened in the Indian markets, we've got Ajay Bagga joining us. Good evening, Mr. Bagga. Thank you very much for speaking to us on NDTV Profit. To begin with, what's your sense of what happened today? The Indian markets in the red, just like me, of course, but not looking too good today.
Yeah, but relatively much better than the rest of the world. And again, you know, what has fundamentally changed from last Wednesday, before the Bank of Japan came in with the rate hike, there was already carry trade unwinding happening, as we have seen with the Mexican peso, the Aussie getting hit already in the last 2 weeks. The big issues for the markets are concentrated returns from the Magnificent Seven, too much hype around AI, which is now leading to disappointment. Third, at all-time high levels, at elevated valuations, the room to stumble is just not there. So any little bit of disappointment is leading to sharp falls. And fourth, then today, Japan, US economy, Japanese carry trade unwinding, the geopolitical risk, and Warren Buffett selling a big chunk in a Magnificent Seven. I think all that came in together to spoil sentiment. Are we near to a domino effect in the markets? No. Is it like a 2000 euphoria and a bubble? No. The AI might have been a bubble, yes, definitely, and those will suffer, like railways and defense stocks in India, all the 100 PE stocks in India, all those will get hit, but have the fundamentals changed? No. So I would say we'll have to refocus investors back to the fundamentals. This price has to be paid in the market, price-wise, time-wise. It always happens in market cycles. So we'll have to pay that price, but it's not, it's a time to prepare, not a time to panic. I think that's very clear.
Right. Ajay Murli here. You have answered a number of questions I had in mind. You have very clearly said that this is not going to be a contagion. It will soon come back on track. Now the question is, we should, from the investor's point of view, not traders, you're saying we should refocus on fundamentals and try and look at select stocks or sectors where you can find opportunity. In your view, what should investors do? Which kind of sectors should they wait and watch and pick up, or should they simply go and pick up indices in the form of passive index funds?
Yeah, Murli, great to be on your show after a long time. I would say, I'm a very boring person for investors. I myself bought the entire market today. So I bought small cap indices, I bought mid cap indices, I bought the total market index. I found it on sale today, and I'll do that again tomorrow. But that's not what investors largely want to listen. But that boring strategy of get rich slowly is what makes money. So what I would say, picking stocks right now, yes, active fund managers can do it. For 99.99% investors, not very possible. One big question people are asking today, if Warren Buffett is sitting on $277 billion of cash, should we cash out of our portfolios? Yes, possible, but we will come to know his actions only on his declarations at the end of the quarter. So we don't know today if he has invested back in something or he's bailing out some company with all that cash. We'll never come to know unless, it's a big thing, like in 2008 when he bailed out AIG and Goldman Sachs. So we can't really follow a big investor like that. We have to see what works for us. What works for us is being as diversified as possible. If you can pick up quality stocks and sectors, go for it. I don't, agree with the mutual fund industry, Murli, which has been launching manufacturing funds, defense funds, power funds. This is back to you. You are a veteran. You remember 2006, 7, 8 when infra funds were being launched by everybody, and it took 10 years to show any returns for those funds. So same we are doing with these manufacturing funds and blah blah funds. In June, mutual funds saw 22,000 crores coming into thematic and sectoral funds. While the best trade, if I could have shorted defense, I would have. Most of them are cash stocks, so I just sold them off. And I've been saying that very publicly for the last 1.5 months, that you are factoring in the execution for the last 5, 6, 7 years with no room to stumble. That's not a very good scenario to make money. So I would say very concisely, stay invested, regularly invest, if possible, own the entire market, because on your own, finding out the sectors which will rotate and take these markets higher will be difficult. Fourth, the biggest risk is not being invested. Biggest risk right now is not having any